China, 67%. That's tariffs charged to the USA. We're going to be charging a discounted reciprocal tariff of 34%. You think of European Union, very friendly. They rip us off. 39%. We're going to charge them 20%. These tariffs are going to give us growth like you haven't seen before, and it'll be something very special.
Donald Trump spoke of being lenient while announcing tariffs. Now, if these were lenient, we'd only wonder how would that be had they been aggressive. You're watching Power Breakfast this morning on CNBC TV18 live from the Mumbai News Center. I'm Hormuz Fatakia. With me today is Mangalam Malu, and these are the headlines we are tracking this morning.
April 2nd, 2025 will forever be remembered as the day American industry was reborn, the day America's destiny was reclaimed.
U.S. President Donald Trump unleashes a barrage of reciprocal tariffs to match duties put on the U.S. goods by other countries. A 10% baseline tariff on all imports to the United States will come into effect from the 5th of April, and higher duties on some of the country's biggest trading partners has been imposed effective the 9th of April.
The Trump administration imposes a 34% additional tariff on top of existing levies on China, while European Union has been taxed by 20% and India by 26% import duties. Mexico and Canada, two of the United States' biggest trading partners, have been exempt from any new tariffs.
Global markets in a sharp risk-off mode after Trump unveiled sweeping tariffs impacting 185 nations. The U.S. stock futures tumbled sharply, with the Dow futures down nearly 1,100 points.
Asian markets have plunged as well this morning, with the Japan's Nikkei tumbling over 4%, while South Korean indices have dropped over 2% after Trump's tariff announcements. The GIFT Nifty is indicating a gap down start of nearly 400 points for the Indian markets.
On account of all this uncertainty, gold prices have soared to a record high above $3,160 per ounce after Trump's tariffs rattle markets. Oil prices, on the other hand, fall on concerns that a global trade war may dampen the demand for crude. Well, it's a Thursday morning. We come to you live from the CNBC TV18 Motilal Oswal studio, and it's a big Trump-sized hole that the market's bracing itself for at the open itself. And the biggest reason for that, the US President Donald Trump has announced reciprocal tariffs, the baseline tariff of 10% on all countries effective 5th of April. Donald Trump said he's been kind to the countries by charging them roughly half of what they charge the United States. Calling these as discounted reciprocal tariffs, President Trump did say that the US will charge an import duty of 26% on India and 34% on China. A 25% tariff is being announced on automobile imports and auto parts, while the previously worried pharma sector remains exempted for now, bringing in a sigh of relief for some of the drug makers. Markets across the globe reacted sharply to the announcement, with Dow futures falling over 1,100 points. The Nikkei itself this morning, the Japanese index, fell by over 4%. The South Korean index declined by nearly 2% as well, and as a result of which the GIFT Nifty itself is indicating a cut of 400 points at open itself. So let's listen into the key announcements made by the US President in his speech around tariffs.
My fellow Americans, this is Liberation Day, waiting for a long time. April 2nd, 2025 will forever be remembered as the day American industry was reborn, the day America's destiny was reclaimed, and the day that we began to make America wealthy again. We're going to make it wealthy, good and wealthy. For these reasons, starting tomorrow, the United States will implement reciprocal tariffs on other nations. It's been a long time since we even thought of that. We used to think about it a lot. We didn't think about it for many decades, and you see what's happened. For nations that treat us badly, we will calculate the combined rate of all their tariffs, non-monetary barriers, and other forms of cheating. And because we are being very kind, we're kind people, very kind. But we will charge them approximately half of what they are and have been charging us. So The tariffs will be not a full reciprocal. I could have done that, yes, but it would have been tough for a lot of countries who didn't want to do that. Not a full reciprocal. I could have done that, yes, but it would have been tough for a lot of countries who didn't want to do that. So if you look at that, China, first row, China, 67%. That's tariffs charged to the USA, including currency manipulation and trade barriers. And so we're going to be charging a discounted reciprocal tariff of 34%. I think, in other words, they charge us, we charge them less. So how can anybody be upset? They will be, because we never charge anybody anything. But now we're going to charge. You know, you think of European Union, very friendly. They rip us off. It's so sad to see. It's so pathetic. 39%, we're going to charge them 20%. So we're charging them essentially half.
And as Donald Trump unveiled a flurry of tariffs, starting with a base tariff of 10% across the board, CNBC's Eamon Javers details the tariffs imposed on various countries.
President Trump announcing 10% across-the-board tariffs. He's calling those reciprocal tariffs on all countries in the world. And then a select group of about 60 countries are getting additional tariffs based on their tariff history against the United States. You read off some of the highlights, 20% for the European Union, 46% for Vietnam, 32% for Taiwan, 24% for Japan, 26% for India, and the list goes on. Significant tariff increases now for a lot of countries in your neck of the woods. And the president has said that the United States feels it has been taken advantage of in recent years and decades. He wants to do something about it. And the question now is, how permanent will these tariff rates be? Does this imply that all of these countries can now enter into negotiations with the United States in order to rearrange global trade and to bring in revenue to the U.S. Treasury? One of the things the president said in the in the Rose Garden earlier today is that he's going to get billions of dollars in additional revenue to help offset his tax cut plans for later in the year. So that suggested to me that we might be talking about something the president sees as permanent and not something the president sees as negotiable in the short term. But we'll see.
Countries like Canada, you know, we subsidize a lot of countries and keep them going and keep them in business. In the case of Mexico, it's $300 billion a year. In the case of Canada, it's close to $200 billion a year. And I say, why are we doing this? Why are we doing this? I mean, at what point do we say you got to work for yourselves and you got to, this is why we have the big deficits. This is why we have that amount of debt that's been placed on our heads over the last number of years, and we're really not taking it anymore. But such horrendous imbalances have devastated our industrial base and put our national security at risk. I don't blame these other countries at all for this calamity. I blame former presidents and past leaders who weren't doing their job. They let it happen, and they let it happen to an extent that nobody can even believe. That's why, effective at midnight, we will impose a 25% tariff on all foreign-made automobiles.
What happens to the likely effects of these reciprocal tariffs? Well, it could begin a trade war, or could it rearrange the global trading mechanism itself? How does it play out domestically in the US, and what does it do to their own inflation? We have a bunch of expertise coming in. CNBC's Steve Leisman takes a look at the tariff effect, more importantly, on US's own domestic economy.
I think it's worse. I don't know what the average tariff is. Maybe we could just pull up. I asked him to make a board on Canada, the EU, Mexico, and China. Those are the principal sources of our imports. So that's the stuff that matters. I think it's over 20%, if I'm not mistaken. So a good chunk of all of our imports will have a tariff over 20%, I believe. And by the way, yeah, you see that big one on China, which I think is actually 54 because it's 34, I believe, plus 20. In any event, people modeled in 20%, and they were detracting from GDP. They were adding to the CPI. This just seems like the president having his own sort of school of economics that's different from everybody else. And he said that the economists were all wrong, but in fact, they would insist they were absolutely right. Here's a comment from the Cato Institute, which, as you know, is very conservative. They said, quote, "These so-called reciprocal tariffs don't mirror foreign trade barriers and ignore those imposed by the United States. For all of President Trump's talk of a new golden age, this huge tax increase will inevitably result in higher prices for American families, lower growth and business investment, and diminished exports and manufacturing output." So it is not a good forecast or a good look from the economists and the forecasters. And as you can see from Wall Street on these tariffs here, the president believes this will lead to a golden age of growth and increase in manufacturing. Economists believe it will lead to lower growth and higher inflation, and really puts the Fed in a pickle here. You can see that there was something of a bump, however, in the probabilities of Fed rate cuts, and I think that comes from a view of greater economic weakness, and they believe that it will be so great, I think, that the Fed will be forced to ignore the surge in inflation. There are the probabilities a touch higher than they have been. That December number for the third cut had been as low as 60, even 50%. But now that he's very serious about these tariffs, you have the market saying, hey, the Fed's going to cut 3 times because I believe not that the inflation is going to be low, but that the economy is going to be that bad.
And the impact of all of this has been felt across markets globally, and the US markets too. They ended higher in regular trading, but as Donald Trump made his tariff announcements, futures on Wall Street cratered as these sweeping tariffs were announced by Donald Trump, and the Dow futures were down as much as 1,100 points. The Nasdaq futures are down 4.5%. S&P 500 futures are also down 3.5%, and that's because there is a risk of a trade war that is rising now, and this is being felt on the US futures as well. And the Asian markets too have opened with sharp cuts this morning. The Taiwanese index, mind you, is shut for trading in today's session, but if you could see, there is red across the screen. The Nikkei in Japan is down almost 3.25%. The Hang Seng is down 2.5%. As you can see, the Shanghai Composite 2 is trading with losses of 1%. The Kospi in South Korea too is trading with losses of a similar quantum. And as you can see, now if you pull up the GIFT Nifty as well, and that will give you an idea. It's a slight improvement from the earlier ticks, which was pointing to a 400-point gap down, and it's currently implied open suggesting a 300-point gap down for our own markets. And the Chinese markets will also be in focus because the new reciprocal rate on China will be added to the existing tariffs, totaling to 20%, which means that the true tariff rate on Beijing under this Trump term is 54%. And that impact is also being felt on the Hang Seng, as we just mentioned, is down 2.5% in early trading. But we take a short break here on Power Breakfast. Up next, we get you more updates on Trump's tariff plans and its likely impact on the global markets. Stay tuned. Back on the other side.
With the baton of power set to shift, Bharat's youth will drive the next wave of change. The biggest leaders and policymakers, global trendsetters, business icons, and entrepreneurs will come together to inspire the next generation of change makers. Don't miss your chance to witness it all live. Rising Bharat Summit 2025.
Welcome back. You're watching us here on Power Breakfast on CNBC TV18, a special edition, as there has been a big development overnight with the US President Donald Trump unleashing a barrage of reciprocal tariffs to match duties put on the US goods by other countries as well. The key highlight of that, a 10% baseline tariff on all imports to the United States, which will come into effect from the 5th of April, and higher duties on some of the country's biggest trading partners. It's been effective the 9th of April. The question: how much revenue are the new reciprocal tariffs likely to bring into the US, and what could the impact of that on their economy be? CNBC's Steve Leisman takes a look at those numbers.
President Trump's economic advisors have said the tariffs could bring in as much as $600 billion a year. But the Nonpartisan Tax Foundation believes it could be half of that. What economists say cuts into tariff revenues are a decline in imports, because if you tax it, you'll get less of it. Lower returns to capital and labor, as well as lower GDP. Erica York from the Tax Foundation says the $600 billion estimate from the administration, assuming a 20% tariff on all imports, could be more like $300 billion in revenue, and that's before the effects of retaliation. York told me the White House tariff revenue numbers are not realistic. They missed that imports would fall and that tariff payments would shrink the income and payroll tax basis, both of which significantly reduce the expected revenue tariffs will yield. Already, several forecasters have downgraded U.S. GDP forecasts because of the coming tariffs. Goldman says it would be a 0.4% hit to GDP and wrote this week the fiscal package is unlikely to offset the GDP hit from the tariffs. The White House has said that tariffs are tax cuts, but because they're believed to be mostly paid by U.S. businesses and consumers, economists treat them and score them like tax hikes. Steve Leisman, CNBC Business News.
And let us also now listen to some expert reactions that are coming in on Donald Trump's tariff announcements and its impact on the U.S. economy.
I think my baseline is that this is the opening round of what may be a very complex set of negotiations across scores of different countries. So I think maybe, as Secretary Bessent has been quoted, it maybe puts a cap on max tariffs, but I think there's a long way to go to see how the tariff war is going to eventually be settled. I think there's definitely a headwind, Sarah, from the trade policy uncertainty. We saw evidence of that back in 2019. There's much more uncertainty now. So companies are not eager to invest or hire, so long, especially if they're exposed to trade. And so I think it's a headwind to growth. A recession would not be my baseline, but you'd have to say that the odds of a recession have gone up compared to where we would have been 3 or 4 months ago, just from really the uncertainty effect on consumers and businesses in and of itself.
This was stronger than what many of us expected. But it's the opening step. So I would assume that this will not be in place in a month, 2 months, definitely not in the back half of the year. So I'm in the camp that this is the beginning of a big negotiation. Korea and Japan don't charge tariffs for automobiles anymore. So Mexico and Canada will most likely be addressed with the USMCA agreement. That's scheduled for 26, but that will be brought forward, hopefully in the next month or two. And that the autos will be folded into that discussion. Germany, it's about, they charge us 10%. We charge them 2.5%. That could be fixed.
So this is a broad-based, all-out assault by Trump on the notion of free trade that was supposed to benefit the U.S. and the rest of the world. And it is striking that this is such a broad swath of tariffs encompassing a wide variety of products, and it doesn't discriminate between U.S. allies and rivals. It hits everybody pretty hard, and countries in Asia in particular seem to be hit quite hard. But there are many countries around the world, even those like the United Kingdom, with which the United States runs a trade surplus, that have gotten hit with some tariffs. So nobody really has been spared. Mexico and Canada seem to have gotten off lightly on this round at least, because it seems like there are no additional tariffs being imposed on them.
I think that, up until now, what we had, were the skirmishes between the administration and Canada, Mexico, China, Europe. And then today is when the war actually began. The global trade war starts today. And I was really struck by pundits and strategists and economists and analysts all saying, well, today was going to be the day, that at least the uncertainty is going to end today. But no, the uncertainty didn't end today. All we know is that it was the official day of the trade war, the global trade war. And now we're going to go through a multi-month or multi-quarter period of the law of unintended consequences. And so we're going to be writing fresh chapters in this book on making uncertainty great again. Everybody talks about, the breath of fresh air, that it's a 10% baseline tariff. That's the baseline. The average tariff rate just went from 2.5% to 20%.
Right, that's about the US markets, the expertise. What we'll do is we'll take a short break and tell you how these overnight cues are likely to impact the Indian market. For starters, we have the GIFT Nifty, which is indicating a 400-point downtick. But will that gap down mark a bit of a bottom? Will we see recovery from that? Can India outperform this uncertainty, or will we fall after the global weakness? All those cues coming up right after this short break.
That started 25 years ago believes that its best is yet to come.
Yeah, it's kind of surreal. And even when I saw Young Turks 25 years, I told you the same thing. I said, my God, we've come a long way. And when you look back, I mean, 8 doesn't feel like 25. I think life in the internet industry is life in the fast lane. Till 6 months before the IPO, we weren't even planning an IPO. It was Sanjeev Bikhchandani, who was an independent on our board.
Who said IPO?
Who told us on a January board meeting that, guys, you are ready to IPO. We said, what are you talking about? He's saying, yeah, 3 years ago we were at the same level and you guys are growing faster.
Most unusual celebration case that you've seen?
I believe they're now breakup and turning single again parties.
What breakup and turning single again parties?
Their parties and get-togethers. like, listen, now guess what? We're all single, we're partying. But all kinds of stuff is happening, as we know. Like proposal economy is happening. Yeah, people now, youngsters are choosing exotic locations to go make a proposal, and they actually travel.
For the last few quarters, we see our frequent travelers are actually taking more trips than they were ever before. Right? It's a combination of short-term vacations, and we've seen trends like
the YOLO phenomena is here to stay.
And Gen Z, and it's real, and Gen Z.
Welcome back. You're watching us here on Power Breakfast on CNBC TV18. In case you've just tuned in, pull up the GIFT Nifty for you. It's a 400-point gap down that we're expecting at this point, which is now actually narrowed down to about 261 points itself. Trump had announced a barrage of tariffs overnight, because of which the global markets are facing that big a hole, which is a Trump-sized hole itself. The Asian markets as well. The Taiwanese index is shut today. You have the Nikkei and the Kospi coming up for you. Both of them under a wee bit of pressure. The Hang Seng down about 1.7%. Let's pull up the Kospi or the Taiwanese index. Both of them lower as well. The big question: how will these overnight cues impact the Indian market? Our research team is always joining in with the Power Prep segment. The stocks that are likely to be in the news. It's also a Thursday, which implies that we have the weekly options expiry that plays out too. So Let's go across to Sudarshan first. Sudarshan, the weakness that we are seeing in the global markets, we've spoken about all of that. Is there a case that India perhaps, is less affected by all of that is happening by virtue of the others getting affected a little more?
Good morning, Mangalam. So if I can start with, if there was any hope for Trump to be kinder or nicer, as he had said earlier, those hopes got diminished within few minutes of his speech. When he started his speech, all the US stock futures were up around 1% or more than that. But as he started his speech and started talking about tariffs, those stock futures were down in the range of 3 to 4%. And following those cues, GIFT Nifty for us is indicating start with a cut of nearly 300 points. But mind it, it has seen a minor recovery from the lows. At one point, it was down more than 400 points or nearly 400 points. But talking about yesterday's session, it was a good day of trade for us. All the frontline indices saw a healthy gain. Even market breadth was in favor of advance decline ratio at the close was in the ratio of 3:1. On the institutional flows front, FIs continued to sell. They have sold for 3 consecutive days. Yesterday also, they have sold more than rupees 1,500 crore, but it was offset by DIs, which have bought nearly 3,000 crore. And with this, FI's long exposure also saw an increase, and it's at 32%. And they have added long positions of more than 4,600 contracts, and it was a minor increase in short positions. Now coming to the option front, on the call side, 23,300 call and 23,350 call have seen healthy additions, and on the put side, 23,200 and 23,300 put have seen healthy additions. What does it indicate? Because ahead of tariff announcements, people did not want to take the risk. So there was in a very short range. That's the reason you saw that 23,000 call also seen healthy additions, and in the put side also 23,000 put saw healthy additions. Now coming to support and resistance. For support, it's seen around 23,000, which is 50-day moving average. If it slips below 23,000, the next support comes around 22,928. That is 20-day moving average. Resistance for now is 23,467, which is 100-day moving average. Stocks that will be in focus, one sector that will be in focus is the pharma, especially stocks like Zydus Life, Aurobindo Pharma and Dr. Reddy's, because they have major revenue mix that comes from US. And now the news is US President Donald Trump has decided to exempt pharma from the reciprocal tariff. So keep an eye on these stocks.
Indeed, pharma will be the sector to watch out for. The tariff exemptions only for now. That's the important thing that you need to keep in mind. Sudarshan, thanks a lot for that. Over to Vamakshi now, who joins in with all the market cues we need to watch out for today. Vamakshi, good morning.
Well, good morning, Hormaz. Yesterday was a good session, but not sure if that would transpire today as well. Yesterday, market closed with healthy gains. The Nifty rose by 167 points. So did the Sensex, up nearly 593 points. The market breadth was firmly in favor of the advances. The broader markets continued to outperform the benchmark indices. All the sectoral indices closed in the green, with Realty Index leading the charge. FMCG, bank, IT, as well as auto sectors were some of the top gainers in trade yesterday. But when we look at the US markets, they too closed higher, but the US futures saw a carnage as President Trump unveiled his sweeping reciprocal tariff measures. The yield on the US 10-year Treasury too slipped along with other global bonds. When you look at the gold prices, the demand for safe haven naturally goes up. The gold prices too rose, but the oil on the flip side saw a bit of a cut. The most important cue to watch out today will of course be the reciprocal tariffs imposed by President Trump. But apart from that, keep an eye out on RBI's OMO purchase auctions of around 20,000 crores. US initial jobless claims will also come out. But again, all of this will be overshadowed by the reciprocal tariffs. As far as levels to watch out are concerned, there's a strong support at 23,000, 23,100. But we'll have to wait and see whether or not the index breaches this. As of now, when we look at the GIFT Nifty, it is indicating a gap down start to the trading session today.
Indeed, Vamakshi, thank you so much for that. What about individual stocks? There are a bunch of them as well. Upasna joins in with a list of stocks that one needs to watch out for. Upasna.
Good morning, Mangalam. Where it looks like a huge list of corporate developments that has happened overnight. First up, let us look at the FY25 updates. MOIL will be in focus as manganese ore production of the company has seen an uptick of 2.7% on a YoY basis, and the manganese iron ore sales has also seen an uptick of 3.3% on a YoY basis. Next up is PNB Bank. The global business has seen a sequential uptick of around 2% and 14% on a YoY basis, and domestic business has seen an uptick of nearly about 1.7% sequentially and 13% on a YoY basis. Now, ESAF Small Finance Bank will also be in focus as the bank's total deposits has seen an uptick of 17% on a YoY basis and nearly about 4% sequentially. And gross advances has also seen an uptick of nearly about 4% sequentially and 1% on a YoY basis. Now, Dabur will also be in focus on the back of its Q4 update. The company says that the FMCG volume trends continue to remain subdued for this quarter, and India FMCG business is likely to decline in mid-single digit. Dabur's consolidated revenue is expected to be flattish during Q4 FY25 is what the company has indicated. Hindustan Zinc will also be in focus on the back of its Q4 update. The company says that the mined metal production has seen an uptick of 4% and 17% sequentially. Maruti Suzuki will also be in focus as company has said that it is announced a hike of car prices across 7 models with effect from 8th of April 2025. And mind you, Maruti had informed earlier of this price hike on exchanges on 17th of March. Overall, if we see, this is the third price hike announced by the company in 2025 so far. Hero Motors will also be in focus on the back of its March auto sales. The company has seen total sales higher than estimates, up about 12% on a YoY basis. And Hero's Q4 sales, if we see overall, it has seen a decline of 1% on a YoY basis as compared to the growth of other peers. So certainly, Hero has underperformed. Bharat Forge will also be in focus as North America truck orders fall further in the month of March and orders are at 7th month low. BEL will also be in focus as company has signed a contract worth 593 crore with Indian Air Force. Tata Com will also be in focus as company has approved 16.71 million euros share buyback from ITC Singapore. And lastly, Macrotech developers will also be in focus as company denies approval of fabricated board resolution, and it has also said that House of Abhinandan Lodha, that is HOABEL entities, use fabricated board resolution for trademark use. So all in all these stocks will be in focus today on the back of the corporate developments.
Upasana, thanks a lot for that. Plenty of stocks to keep an eye out for, but particularly, of course, the pharma sector that needs to be watched out in today's session. We take a short break. We get you more updates on how Donald Trump's tariffs will impact other countries. Stay tuned. We'll be right back. Welcome back. And of course, the big newsmaker today is Donald Trump's tariff announcements, and global markets are reacting to this. We have Sanjay Suri who is joining in to tell us more. Sanjay, thank you for joining in. What can you summarize from the statements made by President Donald Trump?
You know, there was a first proposal from Donald Trump that he will apply universal tariffs on all countries. that then moved on to his plan for reciprocal tariffs on countries. What we have now is a bit of both coming together. So there is going to be a universal tariff of 10% on all countries. That will be a 10% tariff on exports of all countries coming into the US. And on top of that, there will be a reciprocal tariffs. Under that plan, the US government has worked out a certain level of tariffs that country applies on goods from the US. Now, the US said it will apply half of that on that country, and therefore, for India, for example, the US has worked out that it's 52% that India applies as tariff on goods from the US, and so the US says it will apply 26% on goods coming into the US from India. So this is not quite as kind as it sounds. It's not as kind as Trump said it will be. This is a figure certainly that will be disputed, and with India and with many other countries. So this is going to just start off a whole lot of confrontations between the US and just about every country, and this is going to snowball into a major trade issue. It will be a problem that will hit countries around the world, but it will hit the US no less, and no doubt Trump will see the consequences of this also for the US in days to come and weeks to come, and they may not be quite as he foresees them or as he believes they will be.
All right, thanks a lot for that. So important one to watch out for here as well. The US trading partner countries reacted to the tariff announcements as well and vowed swift retribution. Here's what the Canadian PM Mark Carney and Australian PM Anthony Albanese had to say on the US tariffs.
We're in a situation where there is going to be an impact on the US economy, which will build with time. In our judgment, it will be negative on the US economy. That will have an impact on us. But the series of measures will directly affect millions of Canadians. We are going to fight these tariffs with countermeasures. We are going to protect our workers, and we are going to build the strongest economy in the G7. In a crisis, it's important to come together, and it's essential to act with purpose and with force, and that's what we will do.
The unilateral action that the Trump administration has taken today against every nation in the world does not come as a surprise. For Australia, these tariffs are not unexpected, but let me be clear, they are totally unwarranted. President Trump referred to reciprocal tariffs. A reciprocal tariff would be 0, not 10%. The administration's tariffs have no basis in logic, and they go against the basis of our two nations partnership. This is not the act of a friend. Today's decision will add to uncertainty in the global economy, and it will push up costs for American households. This is why our government will not be seeking to impose reciprocal tariffs.
We'll take a short break here on Power Breakfast. Up next, we'll take a look at how Donald Trump's tariff orders could impact specific sectors in the Indian market. Stay tuned. Welcome back. Now, just before we move on, let's pull up the GIFT Nifty and check if there has been any improvement from the lower levels. There was an improvement earlier in the show from a 400-point gap down. We were looking at a 260-point downtick on the GIFT Nifty, and it'll be interesting. So same as well. 275-point downtick is what the implied open is currently suggesting. But to summarize what has happened over the last few hours, plenty of news developments coming in from the White House, and what has Donald Trump announced here is just to summarize it is the fact that he's announced a baseline tariff of 10% on all exports from countries to the US. That's the first basic announcement that he's made, and then he's announced an additional reciprocal tariffs on as many as 60 countries, which include India, China, Vietnam, and many other Southeast Asian countries as well. But Canada and Mexico, which were the first countries on which Donald Trump had imposed tariffs after taking office, have been exempt from any further reciprocal tariffs. There were indications made on this earlier as well that all three nations have been in talks. The products under the USMCA have also been exempted. So this is another important development, particularly for Canada and Mexico, and their currencies have reacted to these developments. Now, when do these take effect? Now, the 10% tariff that has been announced, that takes effect on the midnight of the 5th of April, and the higher tariffs announced, they take effect on the 9th of April, which is 12:01 a.m. So 2 dates for the implementation of 2 different lines of tariffs. Now, if you look at the country-specific tariffs that have been announced, take a look at this. China, 34% reciprocal tariff. India as well. We'll get to country specifics in just a bit, but take a look at the others. Taiwan, Japan, South Korea, Cambodia, Vietnam, anywhere between 25% to 50%. That is the reciprocal tariffs that have been announced. Now, for sector specific, pharma is the sector that you need to keep an eye out for because it has been exempt from any further tariff announcements for now. The administration will be launching an investigation into both pharma and semiconductors, and they'll come to a conclusion, and then maybe at a later date tariffs could be imposed on these sectors. But for now, no exemption on pharma. There is also no exemption. There is also exemption from gold, copper, steel, aluminum imports. They will also not be subject to any reciprocal tariffs as made by the announcements. But the automobile tariffs and the auto part tariffs that were imposed, that were announced last week, they remain in place. They take effect today. The 25% tariffs that were announced last week. Now we come to India. The 26% tariff announcement that has been made. This reciprocal tariff. In fact, Donald Trump spoke about India. He also mentioned that Prime Minister Modi is a great friend, but I told him that you are not treating us right, and hence we'll be imposing this half of the 52% that India imposes. So we'll be imposing half, which is 26%, is what Donald Trump said. And an official White House statement also mentions that in case the tariff barriers are removed, it will increase US exports to India by as much as $5.5 billion. Now that's the White House statement as well. When it comes to China, there were already 20% tariffs that were in place. Another 34% tariff. Now that takes the total to 54%. And just yesterday, before the tariff announcements, China had already said that they are going to restrict companies from investing in the US. And so as a result of which, you could see the market impact as well. US futures are down sharply. The Asian markets are down sharply as well. And the GIFT Nifty 2 is indicating a very sharp gap down for our own markets as well, Mangalam.
Absolutely. The question is whether this, gap down will be bought into because of the relief that we've got on pharma. Also, the fact that we open near key support zones itself. How do these, tariffs impact specific sectors? Autos could be one of them. Sudarshan joins us back on the show. Sudarshan, from a sector-specific standpoint, auto seems to be most impacted here. What's your take?
So first of all, as far as today's announcement is concerned, it's a status quo for the auto sector. What do I mean by status quo? If you remember, last month, US President had announced that on auto and auto parts, 25% tariffs will be imposed effective April 3. So that is effective. So today, effective today, that announcement, 25% tariffs come into effect. Now, in the reciprocal tariffs that President has announced today, in that reciprocal tariff announcements, auto is exempt. So, but it does not mean that auto is exempt from tariffs. So earlier tariff announcements remain. Now, for an example, UK, for which JLR is the base. Now, on UK baseline tariff is 10%. Does it mean that on JLR 10% tariff will be imposed? The answer is no, because President has clearly mentioned that on all the foreign-made auto companies, tariff will be 25%. So on JLR also, the tariff will be 25%. Another positive thing, if I can say, products which are part of US, Mexico and Canada agreement will be exempt from tariffs. Now, because of that, two companies that might be in focus are Samvardhana Motherson and Sona BLW. If you remember, Samvardhana Motherson in its exchange disclosure last week had mentioned that to their auto parts that they supply to auto companies, either those products are manufactured in the US or for other products, those products are part of US, Mexico, Canada agreement, and that's the reason impact would be very minimal of these tariffs. So factoring all these things, keep an eye on auto companies. I won't say there would be a relief rally, but as far as today's announcements, it's a status quo for this sector.
All right, status quo for this sector, so that is no further bad news. But on various other sectors, what could the impact be, whether there would be a relief rally, whether there would be a further impact? Vinny joins in with a lowdown on all of that. Vinny.
Good morning. So absolutely what we're talking about is the other sectors where we'll see the impact coming in. 26% tariff actually turns out to be a big impact coming in for some of these sectors. That is textile, footwear, shrimp exports, machinery, equipment, cables and wires also will see, because some of these companies have a good exposure to the US market as well as transportation equipment and any other sector except for the list that they've given in terms of an exemption. All these would see a major impact coming in. Do not forget, especially for textile, footwear, chemical products, food products. When you say shrimp products also, so stocks like Avanti Feeds, etc., Apex Frozen, all these will see an impact because they have a large exposure to the US market, and the differential rate in terms of the tariff, India was charging a much higher rate. Now, obviously, this 26% rate that comes in for the Indian imports will be a big blow for these companies. Chemicals specifically also is going to be seeing a big impact coming in. So companies like SRF, Naveen, Galaxy Surfactant, PCBL, they have a very good exposure and a big exposure to the US markets. So as of now, it doesn't turn out to be good for them. Previously, chemical companies, the existing import rate was around 3.5%. Now it's 26%. So significantly higher. But, Hurmaz was mentioning those rates on the other countries as well. So given other countries, whether you see a China, Japan, it's much lower, the India rate. So that is something that will still be a leg up on that front, but still a higher rate is something that turns out to be a concern. Exempt list, pharma is exempt as of now from this list. So that's a positive for pharma companies, and we could see a relief rally on that front. Other than that, semiconductors, copper, gold, silver, lumber, and energy products, these are exempt. So maybe that positive sign we could see coming in for these sectors and companies as well.
All right, Vinny, thanks a lot for summarizing all of that for various sector-specific tariffs as well. Now, President Donald Trump imposed a reciprocal tariff of 26% on India. Let's listen in to DBS Bank Singapore senior economist Radhika Rao, who spoke more on this front.
What you have on hand, or what is likely to come ahead, is the bilateral trade agreement. So under this bilateral trade agreement, there could be terms on India buying a lot more from the US. Like you rightly pointed out, it could be energy, it could be defense equipment, it could be, say, agricultural products. But I don't think it'll be a blanket one. I think India also needs to protect its own farmers and agricultural base, which is still the main employer in the country. And the larger aim of the BTA is also, to the bilateral trade agreement, is to increase the size of trade. US at this point is India's key trading partner. It makes about 17-18% of overall exports from India. So it's certainly a very important market. So I think that's why you would see this horde of discussions and negotiations that have been going on all the way since February. When we started off, when you do a back of the envelope calculation, most of us started off with the tariff differential. It is to mean that what India imposes on the US and US imposes on India. What you've seen now is 26%, which is almost more than 2.5 times what that tariff differential is, to mean that there are a lot of other soft factors that have been added in. Non-trade barriers, you've also seen currency movements, not only for India, for across other trading partners as well, which means that if there are, again, to my mind, if there are some concessions that are made, it could be that you could get a bit more discounted, tariff rate, and that would be a part of the negotiations that are going on. So I would think the window to lower this 26% is very much still live.
The window to lower these tariffs are still alive, and of course negotiations are ongoing as well. We take a short break here on Power Breakfast. Up next, we get you cues from the commodities market. Stay tuned.
माननीय सदस्य लोग ये कह रहे हैं कि हमारे सदस्य नहीं है यहाँ पर जो हमारे साथी हैं, लेकिन अध्यक्ष महोदय मैं ये कहना चाहता हूं, ये जो बिल लाया जा रहा है, भारतीय जनता पार्टी में एक मुकाबला चल रहा है। भारतीय जनता पार्टी के अंदर मुकाबला चल रहा है कि खराब हिंदू कौन बड़ा है। और ये बात अध्यक्ष महोदय मैं ऐसे ही नहीं कह रहा हूं। जो पार्टी ये कहती हो कि दुनिया की सबसे बड़ी पार्टी है, अध्यक्ष महोदय वो अपना राष्ट्रीय अध्यक्ष नहीं चुन पाए अभी तक। अध्यक्ष महोदय भारतीय जनता पार्टी क्या है?
जी Welcome back. You're watching us here on Power Breakfast. It's all about the impact of the tariff barrage of reciprocal tariffs announced by Donald Trump overnight. Has that had a bearing on the commodities? Oh yes, it has. There's been a fair amount of risk off and also flight to safety. Manisha Gupta joins in with all the updates from the commodity space overnight. Manisha.
Thank you so much for that, Mangalam Vali. Yes, there has been a huge impact, especially for the gold prices, which in any case had been hitting record highs. And overnight, as this statement was coming in, not too many markets were open, but we did see gold react to this in the international space. And $3,167 an ounce is what we've seen into gold prices as all-time highs. If you look at the gold futures, well, we've surpassed 3,200 therein. So very, very strong gains coming in here. The markets are more concerned about, of course, tariffs on India, but also tariffs on China, which have jumped up to or ballooned up to 34 and 54% now if you put the total in. And that has impacted the metal space very strongly. COMEX copper has seen a decline of 4%. We're trading at a 3-week lows onto this one. The global aluminum prices have seen a 2% decline. That one is trading at a 10-week lows right now. And that pretty much has been the case across metals. Most of these metals down the overnight markets. Also has seen a bit of a decline come in has been the crude oil prices. It fell 1% yesterday. It is down 3% right now on concerns of weak energy demand. While, of course, the list of goods not subject to reciprocal tariffs has been a bit of a support because you have steel, aluminum, copper, and bullion. Bullion means gold and silver. So clearly, gold and silver are exempted from these tariffs. And then any import of oil, gas, refined product has been exempted into U.S. But the rest of the world will see demand concerns coming in, and that's exactly what the commodities are reacting to.
Take that point entirely, Manisha. The commodities reacting to that. We are seeing some bit of a relief in gold and silver, perhaps some flight to safety as well, but a decline in Brent and some subdued performance of the dollar index overnight as well. Before we take your leave on this edition of Power Breakfast, just a quick recap of the Asian markets overnight. We saw a big gash in the US futures. The Hang Seng's opened with a cut of almost 1.5%. Now that's accelerated to about 1.9%. The tariffs on China a lot worse than on India. Nikkei was down about 4%. It's now ameliorated its losses, now down by just about 2.95%. The Taiwanese index is obviously shut for trade today. And we wrap up with GIFT Nifty, which at one point was down by about 400 points and now recovered with a cut of just about 250 points. But you don't go anywhere. The all-important Bazaar morning call comes up right after this short break.
मैं अखिलेश जी ने बहुत हंसते हंसते कहा है, इसको हंसते हंसते जवाब देना। इस सामने जितनी पार्टियां हैं उनका राष्ट्रीय अध्यक्ष उन 5 लोगों को ही चुनना है परिवार के। हमें माननीय अध्यक्ष जी करोड़ों सदस्यों में से 12-13 करोड़ सदस्य प्रक्रिया कर चुनना है तो देर लगती है। आपके यहाँ जरा भी देर नहीं लगेगी। मैं कह देता हूं अभी 25 साल तक आप अध्यक्ष हो जाओ, नहीं बदल सकता।
अध्यक्ष महोदय, क्योंकि जो बात निकल के आई है वो मैं फिर आगे बढ़ा दूं। अध्यक्ष महोदय, जो बात सोशल मीडिया या और जगह गुपचुप हो रही है, कहीं ऐसा तो नहीं था कि अभी कुछ दिन पहले यात्रा जो हुई है वो कहीं 75 वर्ष की एक्सटेंशन वाली यात्रा तो नहीं थी।
What we're going to be doing is a 25% tariff on all cars that are not made in the United States. If they're made in the United States, there's absolutely no tariff.
Over 3,000 entrepreneurs, investors and heirs have made it to the Forbes list of billionaires in 2025. That's 247 more than last year. Not only are there more of them, but they're richer than ever. The billionaires on the list are worth $16.1 trillion in total, up nearly $2 trillion over 2024. Their total net worth is more than the GDP of every country in the world besides the US and China. The US, with a record 902 billionaire citizens, continues to boast more billionaires than anywhere else on the planet. China, with 516, remains second, and India, with 205, still ranks third, which is 5 more billionaires than we had last year, but not a single Indian has a net worth of over $100 billion. So who's on the list? The richest man in the world is Elon Musk with a net worth of $342 billion, followed by Mark Zuckerberg with $216 billion and Jeff Bezos with a net worth of $215 billion. There are only 3 people in the world with a net worth of $200 billion. Oracle's Larry Ellison, Louis Vuitton's Bernard Arnault, and legendary investor Warren Buffett round up the top 6 in the world. There are 15 billionaires with a net worth of more than $100 billion.
My fellow Americans, this is Liberation Day. We are finally putting America first. And starting tomorrow, the United States will implement reciprocal tariffs on other nations. We will establish a minimum baseline tariff of 10%. China, 67%. That's tariffs charged to the USA. We're going to be charging a discounted reciprocal tariff of 34%. You think of European Union, very friendly. They rip us off. 39%. We're going to charge them 20%. These tariffs are going to give us growth like you haven't seen before, and it'll be something very special.
Good morning. You're with us here this Thursday morning on a fresh new edition of Bazaar Morning Call. Well, Trump has neither been nice nor has he been kind in that sense as he promised he would be. And he's imposed tariffs which are much higher than the worst case that many in the market were expecting. So read across the globe, it's a big day. And we'll track, of course, everything that you need to know through the course in the run-up to the market open and, of course, beyond that as well. Lots of industry-specific discussions and, of course, the market very much in focus as well. I'm Prashant. With me, my colleagues Surabhi and Nigel. Guys, hi, morning.
Hi, morning, folks. And I was just thinking, Prashant, and you'll remember this. I think in our careers, this becomes the third biggest seminal moment, which is sort of global in nature. The first was the global financial crisis that we reported on. The second, obviously, was COVID. And now this, Donald Trump trying to reorient the world, shift its axis, get manufacturing back to the US. Whether it'll work or not, we'll find out.
I feel a few years younger now. That's what we. But I think the hope was that the bite is not going to be as bad as the bark. It didn't play out that way. It appears President Trump means business, at least of what we heard as of now.
I mean, it's just, I know that picture of him holding that placard, right? I mean, it's just incredible. Scenes that we've not seen before. I mean, the president of the US standing there, we're going to charge this, we're going to charge this. It's
and that was his pitch as well, right? That in a couple of years from now, you all will figure that I was right. And this is about making America great again and, the golden age and wealthy again and all of that. So.
Well, let's drill it down in terms of how we are stacked up, right? We'll look at the market first, and I'll give you a quick sense. It's about a 1% cut on the GIFT Nifty as we begin this morning. US futures are down sharply. Asia is down as well. And the graphics will come up on your screen. So about a 250-odd point cut on the GIFT Nifty is what we are showing at this stage. I mean, the point is yesterday the market went up 160 points. So that's got to reverse. That's got to go. And then there'll be some more pressure. So 250 to start with, maybe higher as we go along, because the rest of the world is, of course, much under pressure by a lot more. Now, more sort of global market indicators in a bit from now, but let me just get straight to the sort of tariff news. So Trump's reciprocal tariffs, neither nice nor kind. And I'm just taking off from what he himself said. Well, they'll be nice and kind, but neither of those two, much harsher than expected. And as I began by saying, and we were kind of sort of phrasing this in a clear way, right? Will this be a risk shock for markets or a clearing event? And I think it's pretty clear what it is. It's a risk shock. And those who were expecting this to be a risk shock, what has actually been delivered is actually worse than that. Those expectations as well. I mean, Goldman Sachs, for example, were saying that they expect tariffs. Now, they revised it higher. But even after that revision, they expected tariffs to rise by about 15% or so. It's risen more than that. Now, just a quick run through. China has been assigned a tariff of a total of 54%, EU 20%, India 26%. And of course, there's a whole list of countries, and we'll get to that in a bit from now. The thing is, tariffs are being levied based on an estimate. At least that's what they're claiming. This is an estimate of both the tariff that other countries are charging the US and their estimate of non-tariff barriers. Things like VAT. Is the currency of that country being artificially suppressed so as to help exports? So, I mean, that is essentially what is going into their calculation of what the reciprocal tariffs are going to be. And of course, they're taking half of it. And that's what they're saying. It's a discounted rate in that sense. Now, the thing is, the hope is really that Trump is and this is globally the case, and they've also said it. The White House, I think, has issued a statement that these tariffs will remain in force as long as President Trump sees them fit. And based on negotiations, etc., they can be brought lower. So that's the hope. The problem is, since these reciprocal tariffs are based on tariff and their estimate of non-tariff barriers, say, for example, a country like India, if we lower our tariff rate by, say, X%, how much will that translate in helping the US tariff to be brought lower? Because it's not just the tariff rate, it is these non-tariff barriers which go into that calculation as well. And I think, that is something that we need to watch out for. We'll discuss with guests as we go along. Just a quick bit, effective US tariffs now rise to close to 25%. When Trump took office, it was about 2.5%. JP Morgan says this basically translates, these hikes basically translate into a tax hike for the US of about $660 billion, which is about 2.2% of GDP. I mean, that number is enough to wipe out and and push US into a recession by itself. And of course, JP Morgan has also got something to do about the world. They say that large tariff shock threatens US in a global recession as well. Now, just a quick bit on India. Indian exports to US, and these are just rough and dirty calculations. I just looked at the India exports to US. They were $91 billion. A 26% tariff translates to about $24 billion as a percentage of GDP. Our GDP is about 0.6% of GDP. But of course, I mean, it will not be that. It will be most likely lower because it's not, obviously, I mean, there is exemptions right now. And of course, all of it is not going to be borne by Indian manufacturers. Pharma specifically finds a mention. A lot of commentary around how pharma could see a relief rally. The sector has been exempted. But I must say for now, because the executive order clearly states that some sectors on which tariffs have already been imposed and sectors on which tariffs are yet to come under the national security section. I mean, so they've been talking about onshoring and getting manufacturing to the US. So these sector level tariffs may come later. So be mindful of that. Just to tie in the levels, we start sharply lower for the Nifty. We get to the first big support zone, which is 22. I mean, it comes in at 22,867, which is the 20-day moving average, and then 22,692, which is the 61.8% retracement of the bounce that we've seen from the 3rd of March low. And similarly for the Nifty Bank, the 20-day is 49,534, and then the 61.8% retracement is 49,368. So a red day, and I'm assuming not very many places to hide. Maybe pharma is one for now to begin with, but one needs to be mindful. The tone, the tenor, what they want to do is very aggressive. So will they really, after talking about pharma for a long time, will it be completely exempt for all time to come, or will we have to deal with it later? That's the question. Surabhi.
Absolutely. Well, actually, Prashant, before I get to how some of the Asian markets are reacting, and there's a statement out of China already. They're saying we will take resolute countermeasures, against the imposition of these very stiff tariffs from the US. So more on this in just a bit. But let's actually listen in to some of the excerpts that came in from last night's address. Donald Trump announcing this new Liberation Day.
My fellow Americans, this is Liberation Day. Waiting for a long time. April 2nd, 2025 will forever be remembered as the day American industry was reborn, the day America's destiny was reclaimed, and the day that we began to make America wealthy again. We're going to make it wealthy, good and wealthy. For these reasons, starting tomorrow, the United States will implement reciprocal tariffs on other nations. It's been a long time since we even thought of that. We used to think about it a lot. We didn't think about it for many decades, and you see what's happened. For nations that treat us badly, we will calculate the combined rate of all their tariffs, non-monetary barriers, and other forms of cheating. And because we are being very kind, we're kind people, very kind. But we will charge them approximately half of what they are and have been charging us. So the tariffs will be not a full reciprocal. I could have done that, yes, but it would have been tough for a lot of countries who didn't want to do that. Not a full reciprocal. I could have done that, yes, but it would have been tough for a lot of countries who didn't want to do that. So if you look at that, China, first row, China, 67%. That's tariffs charged to the USA, including currency manipulation and trade barriers. And so we're going to be charging a discounted reciprocal tariff of 34%. I think, in other words, they charge us, we charge them less. So how can anybody be upset? They will be, because we never charge anybody anything. But now we're going to charge. You know, you think of European Union, very friendly. They rip us off. It's so sad to see. It's so pathetic. 39%, we're going to charge them 20%. So we're charging them essentially half.
Hey, what do you say? It was political theater, but it's economic reality as well, not just theater as well. Now let's see how this reality is playing out across Asia. Markets are down, but I must say that markets have slightly, just that ever so slightly recovered. The cuts are between 1% to as much as 3% across the Nikkei, for instance. That's the market that's falling the most. Nikkei is still down about 3%. The South Korean market is down about 1% right now. And Hong Kong is also lower by about 1.5%. Mainland Chinese equities relatively better off. Very, very flat on the Shanghai Composite, must say that. And China, like I said, has just been issuing the statement saying that we will, we propose, an immediate resolution. And proposing that the US immediately cancels reciprocal tariff. Otherwise, China will take, and I quote, resolute countermeasures. So let's see. The rhetoric and the back channel parlays, all of that has begun. Very quickly, let's pull up the table for Asia. Where do those tariffs stand? China is at 54%, the highest. We come in at 26%. South Korea is at 25%. Look at the others. Vietnam, one of the major manufacturing hubs in the region, 46%. Thailand, 36%. Bangladesh, massive for textiles and one of our biggest competitors in textile and apparel exports, 37%. Likewise for Sri Lanka, major player in apparel exports, 44%, and there's Indonesia, Malaysia, Australia the least at 10%. By the way, the Australian Prime Minister also came out with the comments saying Trump's decision is not the act of a friend. South Korea has responded by taking emergency measures. Their Commerce Ministry has gotten into a huddle, and they're saying we are going to start negotiations very, very soon to pressurize the US to lower tariffs. A lot of the automaker shares, by the way, across the region are down. Nothing new for them, but it's just that 25% auto tariff that gets implemented from today. So your Kia, Hyundai, Nissan, Honda, Mitsubishi, all these shares are down between 1% and 4.5%. Now, the silver lining for India, want to be a little hopeful as well this morning, is that A, we're not alone in this. B, if you heard a lot of the companies, talk to us through the week, companies were saying that everybody will get hit. So relatively speaking, if our competitors, exporting competitors get hit more, for instance, China, for instance, the markets in the textile trade like Bangladesh, Vietnam, then can some of the Indian manufacturers hope to benefit? Let's see. That's the silver lining. And last but definitely not the least, the fact that pharma, at least for now, has been left exempt. So maybe it's a small breather, but one that we want to hold on to. Very quickly, beyond the tariff headline, just because there's a lot of domestic news flow as well, I just want to leave this on the radar. Dabur, the fund flow picture, fund flows are on your screen. 1,500 crores of selling yesterday, which was lower than the last 2 days. But let's see how these numbers evolve. Dabur is a bigger story domestically. Dabur's fourth quarter update is again very, very bleak, very similar to the third quarter update. There's been no pickup in the fourth quarter. Dabur, in fact, is saying that their consolidated revenue will be flat and the India FMCG business will decline in mid-single digits. And the margin is going to be falling by about 150 to 175 basis points. That's a stinging statement coming in from Dabur. They're saying there's no pickup in demand and the general trade continues to be under pressure. So aside of all the tariff talk, this is one stock, domestic facing, but yet we need to, watch carefully.
Well, I recall when Trump won the elections, right? What was the talk? He's going to be good for equity markets. He's going to be good for the cryptocurrency. You want to revisit that? Liberation Day or Liquidation Day? Just take a look at the cryptocurrency market. It's lost $200 billion in the last 3 to around 4 hours. And even the stock futures in the United States, well, they are sharply lower. So this Liberation Day has turned into Liquidation Day, particularly for the US markets out there. On India, the silver lining is that India, well, the tariffs are relatively low if you compare it with some of those peers like Surbi mentioned, Bangladesh, Pakistan, as well as China. Morgan Stanley note, well, they have highlighted maybe there is some scope for negotiation as well. And that's the hope out there. One positive, though, is that part of the uncertainty is out of the way. Because the markets don't like uncertainty. At least you've heard what the man has to say. And from here on, the hope is maybe, in fact, there will be better times to come. Maybe there'll be some kind of renegotiation. Maybe it doesn't go the whole haul. That is the hope out there. What about the FIs? How are they positioned? They're net short. Close to around 68% of their positions are on the short side. In the last few trading sessions, they added some shorts. So overnight, well, it was pretty much more or less flattish. And the clients, as well as the FIs, they are on opposite ends of the spectrum. Mildly so. We have been making this point at the start of the series as well, that the open interest is relatively lower if you compare it with the previous series. The important levels you need to track. As the GIFT Nifty is suggesting, we pull back by around 300 points or thereabouts. That would mean that we're going to be starting closer to around the 20 DMA. By the end of today, I want to see that 20 DMA getting defended. If that 20 DMA is defended, it still gives you hope that we could see a bit of a pullback from here on. Though, keep in mind, global equities are likely to be in a bit of a flux. The range that you're looking at in terms of support, the 22,800 odd level, you don't want that level to break. The Nifty Bank, extremely important player for today because, you're talking about tariffs. You'll want someone to come in there and bat for the bulls. It could possibly be the Nifty Bank. You have the April 1st low, that's a couple of sessions ago, 50,750, that level shouldn't break. The 200 EMA as well is the level that you'll want to conquer on a closing basis. Keep in mind, today the volatility will only pick up because for the Nifty, it plays out the weekly expiry. The sector of the day is clearly going to be the Farmer Index. In fact, if you look at the yesterday's intraday chart on the Farmer Index itself, it ended at the high point of the day. But today, you very well have a big gap up opening on the pharma stocks because some of them have underperformed, and stocks like Oro, Dr. Reddy's, as well as Zydus, all of them, well, they have a fair bit of exposure to the US market. So by the end of today, you'll want India, to recover from the first hour's lows. And let's see how that plays out. The FI sell number is going to be most crucial by the end of today.
Absolutely. And I think it's a long day and we're just getting started in that sense. Points taken, Nigel. Well, it's Tariff Thursday, and we have a power-packed lineup on CNBC TV18 all day today to analyze tariff implications for industries, sectors. So top voices across the globe. Ed Yardeni of Yardeni Research, James Knightley of ING will be joining us very soon. We'll have top market voices and economists like Sandeep Bhatia of Macquarie Capital. Neelkant Mishra will be joining us from Axis Bank. Kulin Lalbhai of Arvind Textiles will be in focus. We'll talk about that as well a little later. Sameer Narang of ICICI Bank, the economist there. Pranjul Bhandari of HSBC. We'll have Nilesh Shah of Kotak Mahindra Asset Management Company who will be with us as well to discuss the implications from this. And of course, the macros are important. Ashok Gulati and Ajay Srivastava will be speaking with us on as far as the implications for agri, industrial products and some of the other specific sectors as well. That is just a teaser of some of those who are going to be joining us.
Okay, well, it's a long list. Some of the top seasoned bureaucrats also will be with us today. Najib Shah, S.C. Garg, Gemini Bhagwati and Amitabh Kant, all of them will be joining in to analyze the impact of those US tariffs on India. We will also be joined by the top industry experts and economists like Anurag Sehgal, Agneshwar Sen, Neha Anna Thomas and Sakshi Gupta to discuss the implications of Trump's 26% tariff on India.
Okay, we have our first set of guests with us. Ed Yardeni, President at Yardeni Research is with us. James Knightley, Chief International Economist at ING is with us as well. Gentlemen, thank you for waiting longer than usual. We were getting done with everything which has happened. Ed, a simple question. Obviously, these are much harsher than the worst estimates that I saw out there in the street. Hope is they will be negotiated lower, but your first thoughts?
Well, back a few days ago on Monday, I wrote a piece characterizing this as the reign of tariffs, Trump's reign of tariffs. And I actually lowered my outlook for where the S&P 500 might end up the year, lowered it from 6,400 to 6,000. And today that may look a little too optimistic given the reaction of the markets. But my first thoughts are that this is not a good policy. This is a very bad policy. And the only good thing is that maybe there'll be negotiations that will reciprocally lower tariffs. We don't want these tariffs to remain intact. So lowering tariffs may be the outcome of negotiations. The problem is that there's still a 10% tariff, which is apparently a tariff that won't go away. And I think the Trump administration intends to raise $300 to $600 billion at an annual rate with this tariff. And that may still be too high for some countries.
James, your first thoughts, and just one specific thing. These tariffs, these reciprocal tariffs include non-tariff barriers as well. So, for example, in the case of India, the table will come up. They're saying the tariffs charged to US is 52%. Now, that is their estimate of, VAT, forex, currency, and other things, right? So, in this, what Ed is saying, that maybe tariffs go down for everyone. But the point is, there is a limit to how much you can cut tariffs and then hope for Trump to lower his tariffs as well, because it is not entirely just tariffs. It is their estimate of all these non-tariff barriers as well. James, go on.
I would cast some doubt on that, because there's a growing story here in the United States that actually, where did these numbers come from? Because if you look at some of those numbers, like 97% charged by Cambodia, it's raised a few eyebrows as to where these numbers are really coming from. But someone has come up with the solution. You can run through this, and basically what they've done is they've taken the trade deficit. They've come up with this idea that it is this tariff rates plus non-tariff barriers. But what we've got is it's basically looking at the ratio of exports to the US divided by the trade balance. And if you run through that and look at all the countries, that is exactly what they've done. These aren't a scientific calculation of all the trade tariffs and all the barriers at all. It's seemingly somewhat of a fabricated number. And then to say, well, we're going to charge every country 50% of this. Again, it does suggest that this is, you know, you would hope that political leaders around the world are going to pick up on this and think, hang on, this is not what we charge you whatsoever. So I think that there could be some reasonable scope for some renegotiations here, as a lot of countries make the point that these numbers do not match up with reality, basically. So that gives me some hope that we will get a recalibration. But, you know, this is Donald Trump, and we've got to be prepared for
we saw that.
volatility.
We've seen that. We've seen that. I think Ed must have also seen it, right? That ratio.
Yeah.
So, as you said, I mean, it looks like a fabricated number. So is that, I mean, then if they've just pulled this out of thin air, how should one read this? That they just want a high number somehow. So you get to that high number, but then they're willing to backtrack and lower it far lower, or they just want to go ahead. Ed?
Well, look, I think the most important story here is that we're still talking about 25% permanent tariffs on steel, aluminum, and autos. And I think this has the potential to bring inflation back in a serious way in coming months. And if that's the case, I think that has the potential to really depress the consumer. And this time around, the Fed is not going to be able to come to the rescue here, because it can't possibly lower interest rates when inflation is significantly above its 2% target. I think that inflation, which has been running around 2 to 3%, is about to run at 3 to 4% because of these ridiculous tariffs. And the notion that foreigners pay tariffs is absurd. The reality is Americans are going to pay the tariff, and it'll be mostly American consumers. And they're already very angry about the inflation they've experienced during the Biden years, and they were promised by the administration, this administration, that they were lower prices, and it's going to go quite the opposite way. I think the Republicans are running the risk of losing their majority in both houses of Congress next year. I think this is just a disastrous policy.
So we're seeing some of that, right? By the way, the U.S. 10-year yield, it's cooled off. It's now almost at the 4% mark as we're seeing that flight to safety play out. Gentlemen, so two-part question. Let's first talk about the impact. For now, whether these are scientific numbers or not, they are the numbers. He's just declared them, so we have to deal with them, right? So, Mr. Yardeni, you said you've lowered your estimates for the S&P 500. What about the U.S. economy itself? Do you believe? Because earlier you were very, very confident about the health of the economy. Do you believe that a recession could be a reality now?
Well, the extraordinary thing is how well the economy performed over the past 3 years in the face of a significant tightening of monetary policy. I was one of the few economists who said that we would not be a recession. And so I'm kind of still hoping that the economy will prove its resilience. But this is a major, major stress test. And I've lowered my expectations for this year. I haven't lowered my expectations for the rest of the decade. I still think there's a chance that we'll have what I've called the roaring 2020s, but that doesn't look very realistic right here. So I've lowered my numbers to about 1.5% real GDP growth this year, and I was thinking it could do like what it did last year, which is 2.5% to 3%. And we could have a very strange year where growth is maybe 1% or less in the first quarter. Then it could be up 3% in the second quarter because people are buying cars left and right before the tariffs drive up car prices. And then in the second half of the year, we could have a real slump led by weaker consumer spending.
1.5% best case U.S. growth for 2025. Got that. James, similar question to try and map the growth implications for Asian exporters, right? Because Trump is trying to shift the world's axis. He's saying, you know, the U.S. needs to manufacture. So countries like South Korea, China for that matter, manufacturing was all about Asia. It was the Asian tiger, so to speak, right? How much immediately in this year would you expect the growth impact to be for Asia?
Well, we're already seeing a reaction from the US consumer. We stand a very real possibility that we have negative consumer spending growth in this first quarter, as Ed alluded to. And I think in this environment where we've got households that are very worried about their spending power, and that's going to be intensified by the effects of the tariffs. We've got households worried about austerity. What does that mean for jobs? What does that mean for entitlements? And then if you overlay that with the third threat, which is sliding equity markets and perhaps possibly declining wealth levels in America, it's a pretty poor recipe for growth, certainly this year. For the US economy. So that does translate, we would fear, into, we've had this wave of imports to try and preempt some of the tariffs, that we do see much weaker exports into the US later on this year. I think certainly, it's going to be years away before we see meaningful reshoring to the United States. So there will obviously still be plenty of opportunities, but the big fear is not necessarily the tariffs itself for these Asian exporters. It's much more going to be what is the US consumer doing and what is the knock-on for the rest of the world in terms of the global growth story.
Mm-hmm. Well, take that point, James, and it'll be interesting to see if they're going to be getting additional revenue. That's the US administration. What do? Do they go ahead and they implement some tax cuts so to keep the economy afloat? But James, earlier when we had spoken, you were factoring in a couple of rate cuts from the Fed. That goes out of the window now for 2025 itself?
No, I don't think so. Again, Ed's probably got a more upbeat medium to longer term view on the US consumer than I perhaps do, so therefore perhaps feels that inflation is more sustainable. But I'm more of the mindset, well, these tariffs are probably going to be a one-off. I would hope they're going to be a one-off, and that we could potentially see them either rolled back in coming weeks or potentially rolled back in subsequent months. So there certainly is going to be a near-term spike up in inflation, but in 12 to 18 months' time, are we going to be in that sort of still lingering at 3 to 4%? I'm doubtful, and I think the Fed, being somewhat forward-looking, okay, they have already implemented 100 basis points of rate cuts, but I think they'll be looking at the more pessimistic outlook for US growth that analysts are having, and they presumably themselves are having as well, and are looking medium to longer term. What is inflation going to be in, say, 18 months' time down to perhaps 2 years' time? And therefore, there's still, I think, scope for 2 rate cuts that we have. We've got I think near term, the Fed are going to be hesitant. We've got a September rate cut and a December rate cut and a March 2026 rate cut. I'm still sticking to that for now. And it is more the growth story looking at more negative in an environment where inflation is higher.
All right, so you're sticking to that Fed rate cut forecast that you gave us earlier. Before we wind up, Ed, 6,500 on the S&P 500, lower to around 6,000. What should it look like, give and take whatever we have, what we've heard from President Trump? He was supposed to be good for the US market, but it seems, as of now, it's likely to get into a bit of a dizzy. What should be the number we're looking at on the S&P 500?
Well, I've lowered it quite a bit. I started out the year optimistic, thinking that Trump would get it right. Instead, he seems to be getting it very wrong. And I had 7,000 by the end of the year with strong earnings and valuation multiples staying up. But like everybody else, I've lost my confidence in Trump's ability to do this right. And as a result, a couple of weeks ago lowered it to 6,400 on the S&P. Now I'm down to 6,100, 6,000, 6,100. I think that's still a realistic, achievable goal, but I think it's going to require that either we negotiate a lot of tariff reductions or the president declares victory one way or the other and backs off of this potentially disastrous policy.
No, got that. James, just one last question. I'm still sort of looking at the basics, right? You said you started with that number, that starting point is kind of, you said fabricated. Have you confirmed that, because it's all over, and I think it's a theory in the US as well. Is that confirmed, and how does that work? So, for example, India, our exports to US are about $91 billion. India runs a surplus, so US runs a deficit of about $40 billion. So what is this formula, this fabricated formula in that sense?
So it's the 40 divided by the 90 to give you the sort of rough 50%, and therefore halve that, and you get to about a 26% tariff that is being applied to India.
And it looks like this is what they've done? Or it's just sort of coincidental
you
that
can
it's...
get the same number. So for the EU, the ratio works out at about 40%, 39%, I think it is. And so what they've done is basically halved it and given you a 20% tariff. For countries where they are running a trade surplus, well, where the US runs a trade surplus, so for example, the UK runs a trade surplus, but it therefore gets the minimum 10% tariff.
Got that. So I asked Ed this, if this is, they've pulled this out of thin air, so like they wanted to be very maximalist in their opening move. So say 52 and say we're only imposing 26. So does that mean anything from a very near-term market perspective, James?
Well, I think it means, it suggests that political leaders around the world have got some scope for negotiation, saying, well, that's not actually the number, and coming up and proving it, and therefore they've got perhaps a little bit of leeway. But we come back to the point that Donald Trump actually really needs the cash if he's going to he needs the fiscal headroom to be in order to enact these extended and expanded tax cuts that he's promised us all. So he needs the money as well. So that's got to be coming into the thinking too.
All right. Gentlemen, thank you very much. I reckon it's been a long day for both of you, and I think it continues to be a longer day for us here. Thank you very much for staying up. Thank you for joining us, Ed and James. Great to speak with both of you here on CNBC TV18. Well, we'll take a quick commercial break here, but that kind of really sets you up in terms of just thinking about these tariffs at a broader sort of macro level. We'll talk about stocks, which our team is watching out for, because there are implications for pharma and other spaces. That's coming up.
US President Donald Trump's net worth has doubled in the last year from $2.3 billion to more than $5 billion thanks to his social media platform Truth Social and cryptocurrency bets. Mukesh Ambani remained the richest Indian and the 18th richest man in the world with a net worth of $92.5 billion. The other Indians on the list included Gautam Adani at number 22 and Savitri Jindal at number 48. Shiv Nadar was at the 51st position with a net worth of $34.5 billion, Dilip Shangvi at number 79 with a net worth of $24.9 billion, and Cyrus Poonawalla at number 86. Only 13.4% of the billionaires on the Forbes list are women. There are 2,681 male billionaires and only 406 female billionaires.
Welcome back. You are with us on Bazaar Morning Call, and we're coming to you from the CNBC TV18 Motilal Oswal studios. It's a roller coaster morning this morning. It's the Thursday tariff effect that's really playing out. Very quickly, let's pull up the Asian markets again. Still down between 1 and 3%. That's the reality of it. Let's also pull up the GIFT Nifty in the implied open to get a sense of where we could start, because Asia is down, like I said, 1% to 3%. Some of the markets have recovered a bit. The cuts are not as deep as, originally the Nikkei opened down 4%. Now it's down about 2.75%. That is our implied open. 250 points gap down is where we'll probably begin the day. Beyond the tariff headlines, of course, a lot of individual stocks to track as well. Some because of the tariff news, some because of other news flow. So let's straight away get to our list of top stocks to watch. Guys, morning to all of you. Let me start first with Sudarshan, who's watching out for a bunch of auto stocks. I think some because of the sales news, and others, I'm sure, because of the tariff news as well. Sudarshan?
So for today, majorly I have two stocks. First one is Hero MotoCorp. I'm going with red on the stock despite companies reporting March sales, which are higher than estimates and are up 12% if you compare against the same month last year. But the reason the sales are higher because of impact has come in due to emission standard norm, which came into effect on April 1. And due to that, last week of March saw pre-buying. That's the reason these numbers are looking elevated. If you look at the Q4 numbers, Hero Moto has underperformed peers. Q4 growth, Hero Moto has reported decline, while all the other companies like Bajaj Auto, Eicher Motors and TVS Motor have seen a growth. So that's the main reason I'm going with red for Hero MotoCorp. Next stock is Bharat Forge. North America Class 8 truck orders for the industry are out. Now the orders have continued to see a decline. For the consecutive 3 to 4 months, the orders have been declined, and now the orders for the month of March have come in at a 7-month low. That is the lowest since August 2024, and these orders are down both month on month and year on year. ACT Research, the agency which publishes the data, they are mentioning several reasons of this decline in the order, and some of them are: first one is policy uncertainty, and second reason that there is a moderation in the economic activity as well. So these are some of the reasons that they have pointed out, and because of that orders are declined, and I'm going with red for both these stocks because of these factors.
Okay, all right. Thanks a lot for that, Sudarshan. Well, let's hop across to Mangalam. Mangalam, plenty of talk of what's going to happen to the US consumer. For the time being, Dabur's numbers indicate that the domestic consumer as well isn't doing too well. Dabur's numbers, volume numbers subdued again.
Well, that's correct, So a stock that I'm tracking today has nothing to do with the tariffs, but it's spooky nevertheless, and that's Dabur. Consumption in India hasn't picked up as per Dabur. In fact, they say that FMCG volume trends continue to remain subdued in the fourth quarter itself, and they are likely to see a mid-single-digit decline in the India business, as a result of which their consolidated revenue in the fourth quarter will be absolutely flat. And what are the reasons that they are attributing to this weakness? One is delayed winter, secondly is urban slowdown, and the third part is weakness in general trade, which has impacted their India business. As a result of which they'll also see 150 to 175 basis points contraction in the fourth quarter EBITDA margins. Now, what remains to be seen is it a Dabur specific issue, or does this percolate down to the entire FMCG pack? Because over the last few quarters, Dabur has been underperforming the other FMCG companies, and the company has been promising better times but not delivering them. Post the third quarter, they said that consumer sentiment has bottomed out. They'll only see improvement from here. In fact, post the second quarter also, they said that the second half will see mid to high single-digit revenue growth. That's not the case to be. So whether the street, ignores what the management has to say and react to what the management does is something we'll watch out for. For starters, the stock in the red today.
Got it. All right, Mangalam, thanks for that. I'm looking at Hindustan Zinc and going with red more to do with what's happening in the globe rather than with regard to the operational performance. But the reason we're highlighting the stock is because of the quarterly operational numbers is what they've given. On a quarter-to-quarter basis, actually, there is an improvement. But otherwise, if you look at the saleable metal production, it's down by around 1%. The zinc production, that's down by close to around 3% on a year-on-year basis. And the lead production, that's marginally up. But because the headline number, that's a saleable metal production number, is still lower on a year-on-year basis, going with a tinge of red on this one. That said, let's hop across to Abhishek. He's tracking a few banking and financial names. Morning, Abhishek.
Morning, Nigel. So to begin with, some of the business updates of lenders have come out. PNB over there, weak business momentum seen. Deposit growth is at 14.3% YOY, but just 2.4% quarter-on-quarter. So quarter-on-quarter, it's the weakest growth that you are seeing in last 5 quarters. Domestic deposits are up 13.3% YOY and about 2.4% quarter-on-quarter. Advances growth are at 13.6% YOY and about 0.64% sequentially. So YOY is the weakest growth that you are seeing in last 4 quarters, and sequentially quarter-on-quarter, it's the weakest growth that you are seeing in last 15 quarters. Domestic advances are up 13.2% YOY and about 0.6% sequentially. Calculation shows that the CD ratio, credit deposit ratio, has declined both YOY and quarter-on-quarter. M&M Fin, now Q4 is supposed to be a strong quarter for them, but we are seeing weak disbursals over here. So disbursals are up just 1.2% YOY and down about 5.9% sequentially. The total assets are up 16.5% YOY and about 3.8% sequentially, suggesting that the tenure of the book might have increased. Now, stage 3 has improved by about 23 basis points quarter-on-quarter. Stage 2 has improved by about 80 basis points on a sequential basis. Collection efficiency has improved on a sequential basis, but has declined on a YOY basis to 97% versus 101% YOY and about 95% sequentially. Liquidity in the balance sheet has been showed up, so it's now at 10,000 crore, up nearly 10% quarter-on-quarter, and forms about about 8.4% of the total assets. AU Small Finance Bank, they have met their annual guidance for growth. They had given out a growth guidance of 20% and they are at 19.9%. Robust deposit growth also seen over here on a sequential basis. Deposit growth is nearly 10.7% quarter-on-quarter. Advances growth is at 7.7% sequentially, while AUM growth is at 6.2% sequentially. The CASA has also improved over here. So overall, the CASA growth is at 5.5% on a sequential basis, but CASA ratio has declined as other deposits have grown massively. Back to you.
Okay, all right. Got it. It's a bunch of financials. We'll watch out for how the stocks react to those business updates. Thanks for that. Let's move to Upasna. She's watching out for a few stocks, including, I think, BEL and Kirloskar Oil. Upasna, good morning.
Good morning, Surbhi. First up, let me start with BEL. Yet again, this stock will remain in focus today as well on the back of its order win. The company has signed contract worth 593 crores with Indian Air Force. This contract is mainly for providing maintenance services for Akash missile systems. Also, company has indicated that it has concluded negotiations with customers for orders worth 5,000 crores. Now, next up is Kirloskar Oil Engines. The company bags order worth 270 crores from Defense Ministry. The company will design and develop in-house speed engines scalable from 3 to 10 megawatt. While these engines will be mainly used for propulsion and power generation on the ships for Indian Navy and Indian Coast Guard. So all in all, these two stocks will remain in focus today. I expect both of them to open in green on the back of the order win.
Okay, all right, got that. Thanks very much, Upasna, for those. Let's get across to Vinny. She has a few names on her radar as well this morning. Vinny, good morning. Tell us.
Good morning. So firstly, we are just going to talk about Mahindra Lifespaces. Now, they have won a redevelopment order. This is for 2 residential societies in Andheri West. So yes, they have the premium location coming in. Approximate value of this redevelopment project is 1,200 crores. And this will be under the state's cluster development scheme. So yes, this is a partnership with that. And a big one coming in for the company. In the recent times, they've got a lot of new order wins as well. So in terms of the redevelopment side, as well as in terms of development projects. So interesting to watch out for Mahindra Lifespaces. We're expecting green here.
Okay, all right, got it, Vinny. Let's quickly then recap our list of stocks to watch. The ones that have positive news flow around them are Bharat Electronics, Kirloskar Oil Engines because of the orders, Mahindra Lifespaces, AU Small Finance Bank. These are the ones on the green side, but on the negative side could be Hero Moto, Bharat Forge, Dabur, Punjab National Bank, M&M Finance, and Hindustan Zinc.
Okay, all right, time to slip into a short break, but our coverage on Trump's tariffs continues on the other side. Stay with us.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18, now streaming live 24/7 on YouTube. How about listening to Global?
Welcome back. So we're getting up or gearing up for the roller coaster. The implied open has been telling us that we'll probably start about 250 points down in line with how the Asian markets are reacting. By the way, Dow futures at one point in time, they were down 1,000 points, now down about 850 odd points. So US futures are also sharply lower. What does this tariff storm mean for India? Let's get the conversation going. We have with us Amitendu Palit, Senior Research Fellow at the Institute of South Asian Studies at the National University of Singapore. And we also have with us Sanjeev Krishnan, Chairman at PwC, to take this conversation forward. Thank you, gentlemen, so much for joining in. Morning to both of you. So, Sanjeev, opening thoughts. Trump is trying to shift the world. He's trying to get American manufacturing back. But in the process, there's a lot of chaos. What do you make of the new tariffs that have been announced, particularly on a lot of the Asian countries, including India?
So I think the first thing first,
I think this is obviously from a US standpoint, they are doing what they believe is good for them. I think from a Southeast Asian perspective, and particularly from an Indian perspective, I don't think there's need for us to be too disheartened, I would say, because this is something which is going to happen to multiple countries, and as we have seen in the news that came in last night, multiple countries are going to get impacted for it from the tariffs. Now the question really is that what is our competitive advantage, and I think that's what one needs to focus on, because let's take imports into the US coming from Southeast Asian countries, etc. It's not only that India has been put on tariff, China, Vietnam, where the supply chain, the elongation of the supply chain was really impacting imports into the US. I think all of them have, all of the countries are getting impacted. So for us, I think the broad framework really from my standpoint, as we see it really is that we need to focus on our competitiveness on a go-forward basis. A few days back, we came up with what we call an ideas framework, which is where we need to be able to continue to invest and also diversify our export portfolio to make sure that India mitigates the impact of some of these tariff regimes, which of course any country, in this case US, will continue to do in what they think is best for them.
Absolutely. No, take your point entirely, Sanjeev. I think the first order impact for India is not that great, but it's not that big, but it's the second and third order effects that I think we're far more worried about. Amit and those, let's get your thoughts in as well. So take Sanjeev's point entirely that I think, and for us, for now, for instance, pharma has been spared, others are being tariffed a lot more. But the issue is if the US consumer itself starts consuming less, because commodities across the board, products across the board are getting more expensive, then there is a hit on US growth, global growth, and then there is a market, storm to deal with as well. Equity markets overall, financial markets freezing up as this chaos plays out. So how significant would the second and third order effects be?
Thank you, Sivi. I think a real pleasure for me to join on this show and quote unquote best greetings on what is being called the Liberation Day by President Trump. I would bring in 2 points to the thought that you shared. The first is that you did mention about the impact this is going to have on the US economy domestically, what's going to mean for the US consumers. And I think to that extent, President Trump has already made it pretty clear in a few interactions that he has had over the last 1 month that there is going to be short to medium term pain for all the measures that he is bringing in. So it's in a way sensitizing the US consumers about the fact that, look, tough days are ahead, but they're all for a better, brighter future. The American dream is going to come back. So that's his domestic narrative and rhetoric. What it means otherwise is obviously very significant. The United States growth is going to shrink. And it's not just the United States growth that is going to shrink. There is going to be a contractionary effect across the headwind inflation trajectories in many parts of the world because the supply chains are going to get badly impacted. But more importantly, Suvi, there's one point I want to draw your attention to. If you look at the tariffs that have come, the tariffs are not just tariffs. They are tariffs including trade barriers and currency practices. That's the heading on which this has been announced. And it's very interesting. If you, for example, it's very ad hoc in character. If you look at a country like Turkey, Turkey has been called out twice in the executive order because of the high tariffs it imposes on rice husk and apples. Yet, if you look at tariffs, the reciprocal rate for tariffs on Turkey is very small. It's just 10%. Whereas for many other countries, the rates are much higher. Now, this, I think, is where the crux of the matter lies. These tariffs are going to be bargaining chips by the US administration for taking out extracted concessions from its partners on several other areas, which could be with respect to currency practices, which could be with respect to many other barriers. I think specifically for India, there are 2 areas of concern. The first is the quality control orders, which have been very reflected upon in detail in the foreign trade barrier report that was brought out 24 hours before the reciprocal tariffs in number 1. And number 2, India does figure among the list of countries which the US administration considers are currency manipulated countries. So I think these are the 2 areas, and also subjects like government procurement markets, where the US would expect concessions. Those are difficult policy areas for India to address. I think that's where the real risk lies.
Absolutely. No, a point taken. Good morning, gentlemen. To the point of how they've arrived at these numbers, Prashant here, it looks like what they've done is they've taken the deficit, divided it by the imports, and that's how they've got to the number. So, the deficit with India is about $46 billion. US imports about $88 billion. So about 46 divided by 88, that's the 52% claim tariff number. So, I mean, if this is true, and many are pointing out that this is how they've arrived at that number, it's I don't know, I mean, what to make of it. But specifically, Sanjeev, if I can ask you, there are many who are saying that for countries, for sectors like textiles, Bangladesh is hit higher, Vietnam is hit much harsher. How would you respond to that? Because I'm assuming cost of making stuff in those countries is lower, and it's also easier in that sense, widely acknowledged. So is that actually a silver lining that they are hit harder than us with regards to specific tariffs? Go on.
Well, I mean, I would say that, so that may be true. I certainly won't comment on what's happening there, but I would only make one comment. Inefficiency in production anywhere, if that is leading anyone, could be us, could be anybody else, to do better in the short term. That's only going to be in the short term. I think the important thing really is that it's a call for Indian industry to become a little bit more efficient. And in some ways, I think it could be a paradigm shift in the way we look at our manufacturing over the years, etc. If manufacturing has not been our strongest space so far, it's again a call for action that, okay, figure out your logistics cost. Start thinking that scale is important, and big can be beautiful and big can be better, because some of those will give us the efficiencies that will make sure that we are even more competitive in the global markets. You are right that in the short term, India possibly may not suffer as much because there have been greater tariffs on some of the other neighboring countries India has, particularly in the segments that you mentioned. But that's going to be only a short-term thing, and as is being said, some of these are going to be used as bargaining chips. I think from an India standpoint, I also feel a little bit more confident because we all know that a BTA is being negotiated at this point in time. Possibly the only country, at least to my mind, India is the only country with which US is actually negotiating a BTA at this point in time. So I have a lot of hope from that standpoint as well. But I mean, again, the moot point, and that to me is the underpinning. It's a call for action for us to be a little bit more efficient and to make sure that our trade interests are protected, which I'm sure the government of India is doing at this point in time.
Yes, absolutely, gentlemen. I mean, back channel parlays will definitely, take place, and let's see where this eventually ends. Thank you so much for joining in with some opening thoughts, at least, on this very, very busy morning and very, very chaotic morning, might I say, from a market standpoint. Just want to point out that our teams have verified the official White House document is actually putting India's tariff at 27% and not 26%. The placard that President Trump was holding up and whatever he tweeted out on social media, there, the number was 26% for India, but the official release from the White House, which has tariff lines for a lot of countries, including us, the release there talks about a 27% for India. So just putting that on the table. Let's take a quick break on that note. Come back on the other side. We'll, of course, have our technical experts joining in, also Deepan Mehta joining in for some fundamental ideas.
Before crafting your investment strategy. How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC TV18 and CNBC.
Welcome back. You're tuned into Bazaar Morning Call, and let's get straight to some fundamental analysis. Deepan Mehta, Director Elixir Equities, joins us on the show. Hi, Deepan. Good morning. Hope you got enough sleep last night. President Trump was, shooting out the tariffs, and a lot of investors were a little bit jittery. But now at least that uncertainty is partly out of the way. So let's focus on the markets and let's focus on stocks as well. Deepan, today for starters, the pharma stocks could start off in the green. And late in trade yesterday, you did see a surge actually. So that told you that the pharma index itself, had a bit of a sniff that maybe nothing is coming for them, nothing negative, at least as of now. Your view on the pharma stocks, and do you think that they'll get away, or do you think that given the uncertainty, you'd rather stay away?
Good morning, Nigel, and thank you for having me on your show. I slept through the entire announcement. You can always catch up in the morning. But I think it's a great sense of relief for the pharma sector. And I think pharma stocks again will come back into the reckoning. I don't think that having announced this kind of an elaborate tariff policy in place, that they should start tinkering with it very soon. So I think pharma has a clear run for the next several quarters or so. And clearly, I think the Trump administration recognized the fact that pharma provides a very important, it's a very important import for US, considering that it keeps the healthcare costs lower. So from that point of view, I think it's very positive. I would focus on some of the CDMO players, I think, where the prospects look really good, although they are trading at expensive valuations. But I think growth rates will be higher over there because they have an advantage against Chinese when it comes to this particular activity within the pharma space. But on the whole, my first reading is that it may create opportunities as well. And we'll have to go company by company to understand how these tariffs are playing out for them. And there could be a few surprise winners as well. Could be even textiles, who knows. So I think this entire earnings season will be quizzing all the managements on what they make out of this Trump policy.
Deepan, I mean, absolutely take your point on pharma, etc. And a great space. Numbers for the fourth quarter should be pretty solid, etc. as well. I just want to make one, it's just one caveat. The executive order excludes reciprocal tariff goods that are subject to or that will become subject to sectoral tariffs through Section 232, which is their National Security Act. And this includes pharma. So the only thing is that sector level tariffs may still yet come. They're not come as part of this. It was not on the agenda last night. So that is the only caveat. But I mean, I take your point in that sense. Maybe a bit of a relief at the margin. But otherwise, I mean, it's not great news at all, right, Deepan? For world markets, for at least in the near term, economies, trade, I mean, a fair bit of disruption and turmoil in that sense, beyond what happens today.
Prashant, I see this as an opportunity. And if you go back into our 20-30-year history, whenever there is turmoil in global markets, and if you buy Indian stocks in 2-3 years down the line, you get exceptionally good returns. And in a way, a lot of Indian companies that we are investing in are completely insulated from all these global trade. We look at the banking sector, infrastructure, cement, retail, entertainment, hospitality. I think they are not affected by what Mr. Trump says. And investors are focusing on those sectors. So if you consider the entire listed space, apart from pharma, IT, textiles, specialty chemicals, there are a lot of sectors where investors can have there's no certain uncertainty around these Trump tariffs. And such events, they provide a good entry opportunity. So if you're sitting on cash, you've not taken advantage of this recent rally which has come through, then this is a great time to invest. And I think investors should consider the history. Whenever there's turmoil and you have bought, you've always made a very good return.
So far, there is going to be turmoil in trade. Is there turmoil in stock prices? Maybe not yet, right? You would agree, starting points matter. I mean, it's not as if they're not wildly off in that sense. It's not like one of those big global financial crises which have brought prices sharply down. But anyway, Deepan, what is on your mind? 2-3 ideas which really, to your mind, stay insulated from all this.
No, I think that NBFCs are looking very interesting to me. With usual disclosure, I think stocks like Bajaj Finance, L&T Finance, even beaten down stocks like IIFL Finance. So within the banking space, I think there could be several triggers for NBFCs, starting with interest rate cuts. And we have this lower risk weightage, so that's looking good. After a long time, I think retail also looks quite interesting. Specialty retail companies, the likes of Campus Activewear, Metro Brands, Go Fashions, Ethos, I think all of these companies have had pretty soft quarters. Even tier 2 retailers like V-Mart, we saw what numbers they declared in terms of their same-store sales and overall sales, very impressive. V2 retail, I think, so that looks quite interesting to me. And like that, I think many ideas are there. We spoke about cement also, ACC Ambuja, I think they have a good run. And after a long time, we are seeing a lot of flow of orders to the infrastructure builders and to the defense sector. So I think it's business as usual over here. And although I agree that stocks are not really at throwaway valuations, but you may not expect multi-bagger returns. but at least you can expect returns which are typically historically what we have got historically in the Sensex and Nifty, which are around 12 to 14% or so.
From the companies that have won orders, which any particular names you like? Very quickly, Dipan.
Hindustan Aeronautics, I think, very good visibility over there.
Okay, all right. Thanks for that, Dipan. Stay with us. For the time being, we slip into a short break. Come back, we'll get you pre-opened rates. We'll also be joined by Sudarshan Sukhani as well as Mitesh Thakkar. Stay with us.
.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21.
Welcome back. This is Open Exchange. We're coming to you live from the CNBC TV18 Motilal Oswal studio. Well, as promised, let's get in our technical guests. We have Sudarshan as well as Mitesh that join us on the show. Good morning, gentlemen, and thanks a lot for joining in. Well, Mitesh, you go first. A 300-point gap down. What do you do?
Yeah. So, morning, Nigel. I think, while the GIFT Nifty is indicating about 300-point kind of cut, I'm hoping it limits itself to about 200, 220. So, basically open near yesterday's low. If that scenario plays out and then, we don't break below that, then I think after some choppy first couple of hours, we might actually recover. Because the structure to me on the daily and the weekly charts is still positive, especially on the Bank Nifty. So I'll keep a watch over there, and banks will not be directly affected by the tariffs. So I think I'm hoping that the Bank Nifty could lend some strength on the upside to the Nifty and we could hold on. In case the Nifty starts breaking below the levels of 23,100 and close below that, then I think I'll be slightly skeptical and would be keen on reducing our long exposure.
Okay, so you're not looking to buy the initial dip. You'll observe the first hour of trade and then you'll take a call. Is that correct?
That's right.
Okay, all right. Sudarshan, what about you?
Good morning. Well, I'm very clear. Yesterday I said do not trade. There is far too much confusion in the market. And yesterday we all knew that the Trump announcements are coming. So there was no way we could have taken a trade on the long side or the short side. Doesn't matter. Today, the same view continues. See, the markets hate uncertainty. So half of the uncertainty is over. We all know what kind of tariffs have come. But the other half still remains. How will it affect us? How will it affect a sector? Will it be good for this one? Will it be bad for this one? Will it affect Japan and then help India? I mean, I don't have the answers, but the market will find these answers in a few days. It won't find it at 9:15 today. So that half of the uncertainty remains. There is no sense in doubling in a market if it does not know which direction it wants to go into. In a few days' time, we will have much more clarity whether we are going lower or whether we are building a base. But today is not a day to trade.
Okay, so sitting out at least at an index level. Got that. Gentlemen, morning. Let's also talk about stock trade. Sudarshan, so are you saying no trade at all or only index? Are you trading any stocks today? What's the recommendation?
It's no trade in the index. There are some trades always in stocks. So Ashok Leyland is an intraday short, stop above 210. HCL Tech, another intraday short with a stop above 1550. I also have Dr. Reddy's as an intraday short, but now I've been hearing you and maybe traders should be careful before going into this short position and maybe it'll work out with a stop above 1180. My only buying idea is GMR Airports, and there it's not an intraday trade, but I think there's a positional buy here. So keep a stop at 72, adjust the stops according to the gap down, but stay there. And primarily intraday shorts are is what I'm looking at.
Okay, intraday shorts, got that. Mitesh, what about your stock list for the day?
Well, I need to apologize. I think there's some problem with my computer. I'm not able to switch and it's got on hang mode just the Zoom meeting.
No worries.
Allow me a few
We'll,
minutes to come back with this.
yeah. We'll come back and take your stock trades in a bit. In the meantime, let's also get Deepan's view on Dabur. Deepan, while we're all very worried about this whole global storm playing out, I'm more worried about, hearing Dabur. Look at how negative their update was for the fourth quarter. Talking about a margin decline, talking about a mid-single-digit decline in the India FMCG business, no pickup. Your thoughts on the stock?
Yeah, so we've been very negative on FMCG for a long time. And I think we have to move away from FMCG stocks, considering that volume growths are very tepid for the entire sector. A lot of products have reached maturity phase. And I think, I think investors who have been in these stocks for decades, and they've been great multi-bagger stocks in the past, need to move on. And there are many other, stocks within the consumer investment theme which they can play, but definitely it's not FMCG. Even at these levels, I would consider exiting FMCG stocks, although they haven't rallied much and they have underperformed for the past several quarters or so.
Okay, all right. Deepan, good getting those thoughts across. Let's welcome in our next guest, right? Sharp increase in oil imports from the US. Prabal Sen is energy analyst at ICICI Securities. He's with us now. Prabal, good to have you with us here. It's the start of what is going to be a long and tough day. What did you make of it? Any implications for your sector with these tariffs last night?
I think the language suggests that energy, so far at least, has been kept out of the ambit of the tariffs. I still don't know if the 10% flat tariff that has been talked about, in addition to the reciprocal tariffs, we are trying to get a view from the companies whether the petroleum fuel exports to the US will be impacted by this 10% tariff. But at least the higher reciprocal tariff don't seem to be applicable to the energy segment as of now.
Okay, no, absolutely. It is not applicable. But any other roundabout implications from a stock perspective, not business-wise, Prabal?
Well, I think, frankly, more experienced people will be better at commenting on the overall impact that will be there on valuations and multiples across the board. I don't think this is something that anybody has been prepared for. Obviously, you have been expecting that this tariff order will come, but an impact on the broader market will obviously singe every sector, not just mine. The benefit or the small positive, if I can eke out, is that multiples for our sector, specifically the oil and gas sector, are not really anywhere near, premium multiples across the board. So to that extent, the possibility of a further derating or a structural derating is relatively less. The second aspect is that, peculiarly enough, the concerns around global economic growth can have an impact on slightly lower energy prices. And India being a price taker and a major importer of crude oil and other gas inputs, there I think the margin improvement can actually help, offset any impact on volumes or growth that may happen with disruption in export volumes or, any other spillover impact that one might see. So I would say that impact definitely will be there. But as of this moment, I think the oil and gas sector is the least of our worries from a broader
Absolutely. You said it, Prabal. Now, I'm just actually looking at, just allow me 1 second. I'm looking at the first pre-open rates that have come through. So 182 points down on the Nifty. It's pharma all the way. All your pharma stocks are pushing higher. Divi is 4%, Dr. Reddy's 3.5%, Lupin 4.5%, Aurobindo 6.5%, 7%. Gland Pharma, Glenmark, you name it, Gland is up about 12%. So mid-cap, small-cap, large-cap, all pharma. Generics players, CDMO players, all kinds of pharma stocks are ripping higher this morning on this relief. At least they've been spared for the time being. And we'll talk about pharma as we go forward in just a bit. But probably just my quick question, as the market goes through this turmoil, it will require all the help that it can get. So from that standpoint, I don't know if Reliance can do its thing. At least on the oil and gas business side, do you see any positives up ahead as we're going to be looking at the fourth quarter numbers and looking forward? Overall GRMs, given what's happening in the oil and gas markets. So can we expect any help from RIL?
I think for RIL, I think the performance of the OTC business.
I think we've just lost that line with the Prabal. We'll try reconnecting. But it is really pharma along the way. Deepan, let me ask you about this pharma surge. Right now, it's, you buy everything on a morning like this, right? It's a quick trade. But if you were to kind of stick your neck out and be a little picky and choosy from a portfolio standpoint on pharma stocks, then would you stay with large, generic players which have US presence, whether it's a Sun Pharma, whether it's Reddy's, etc.? Would you go with CDMO players? What would the more nuanced approach to pharma be for you?
So I think, again, Sun Pharma comes back as a part of your core holdings. And with this uncertainty, rested for the moment, I think Sun Pharma's strategy for the US markets and rest of the globe is very innovative, different, and will yield rich results going forward also. And looking at some CDMO players as well, I think, but they're very expensive. So waiting for correction, stocks like Suven Pharma, Divi's Laboratories, and even OneSource, I think they're pretty interesting. There's this Blue Jet Pharma also, which is quite an interesting company. So I think that within the pharma also, eventually investors will try and get a bit selective and go for companies which have a superior business model.
All right. Any quick take on some of these EMS companies, Deepan? If the tariffs are higher on Chinese imports, maybe that throws up a bit of an opportunity. Some of them have seen a sharp correction as well. You think so? Or you want to stay away, given the high multiples that they've given the low margins as well out there, and given the run-up that we've seen in the last few years?
See, I think there's an opportunity, and as I said earlier, that as the dust settles down, it may make sense for some of the Chinese players or other international multinational companies to start operating or sourcing from India as well for the US market. So let's just wait and watch. Nothing specific comes to mind as far as EMS is concerned. But yes, I think I was quite impressed with Syrmia SGS's numbers, and the management commentary also is quite positive. The stock has corrected significantly, and now at least trading at valuations which kind of makes sense if it can grow at that 25-30% type of clip for the next few quarters or so.
No, got that. Deepan, thank you very much for joining us. Good conversation, and I hope we speak again soon as we navigate through the day. By the way, at least the start at the pre-open is now come to an end. I think I saw 0.78%, 0.8% kind of a cut. Which is, 180 points. You're basically just reversing what you gained yesterday in that sense. So 23,150 or so is where we are starting at. I think let's get Sudarshan in 9-10 call. Sudarshan, what do you have?
Well, GMR Airport is a buying opportunity with a stop under 72.
Okay, GMR Airports with the stop under 72. Aditya Khemka is now with us. He's fund manager, Intred Asset Management. Aditya, good to have you with us here. Good morning. Let's just talk about pharma, which is seeing a bit of an uptake. So it's been spared, but should we say for now along with it? Because if you read the executive order, it's part of sectors which are included under this national security thing. So sector level tariffs may yet come. What's your sense?
Yeah, hi, good morning, Prashant, and thanks for having me. I would agree with you. I think you should say for now because, historically the Trump rhetoric has been to include pharma as a part of their tariff on India. And, sooner or later, my belief is that pharma will probably fall under the tariff situation. And it is a national security issue. Remember, Indian pharma companies export anywhere between 50 to 60% of the volumes of medicines in the US. So, from that standpoint, if the US were to take a stance that, are they vulnerable to India stopping medical supplies to US, would that become a national security issue? Yes, it would, because 50-60% of your volumes would evaporate. So tough to believe that it won't happen. But when and how and in what shape is something that we don't know.
Okay, so Aditya, I'll ask you the same question I was asking the previous guest as well. In order to try and play this the smartest way, because we don't know what President Trump does tomorrow, whether he imposes certain new conditions on even pharma exports that are coming into the US. But what would be the best way to play this? Should you stay with CDMO players? Should you stay with players who have a great specialty generics pipeline, maybe specialty products like Sun Pharma? What would your personal preference be?
So personally, we are more focused therefore on companies which have nothing to do with US. To be honest, we are focused on hospitals, diagnostics, Indian-focused pharma companies, be it your Torrent, your Alchem, your RPG Life Sciences, your companies which are more focused on India and less to do with the US. Same goes for any hospital business or diagnostic business which is listed. They have nothing to do with the United States. So if you have to take exposure to healthcare, you are better off, looking at these kind of stocks because they don't have the exposure to US to have a risk. Understand as a fund manager, when we think about this, the entire tariff angle, whether it happens, when it happens, at how much rate, we don't know. But there is an added risk now owning the stocks which have exposure to the US. Is there an added reward in owning them? The answer is no. So if there is no added reward, but there is just added risk, it just doesn't make sense to keep owning them. That's the whole perspective here.
That's an interesting point. Yeah, today we could get that relief rally, but this isn't over. And you have no idea what comes on pharma as well in the coming weeks and days, perhaps.
So to say for now, is relief. And that's essentially the point. But, well, we'll take what we get because otherwise fewer places to hide in that sense. Yeah. But it's just, day one, right? There'll be, I think Neelkant made a good point, a thing which we can all understand. He put it in the parlance of a street fight. But the question to him was, can this all be reversed if a new president takes on? And he answered it by saying, if you slap someone, they slap you back. Then you kick someone, they kick you back. Then you punch someone, they punch you back. And then you say, well, let's go back to how it was. It doesn't work like that. And, so it's like a starting point. And I think we'll see a lot of moves going forward over the next many weeks and months as well. So the opening rates are on your screen. 23,180 is where we are at. It's 150 points lower. It's basically just a reversal of what we saw yesterday. It's not severe by any yardstick. It's like any other open. 0.6 lower on the mid-cap index. The small-cap index is down about 0.33% or so. And the stocks are all coming up on your screen. Pretty normal kind of a session, right? 3:1 is the declines to advances. So more down than up, and that's understandable. But for now, at least at this point, it's okay. So 260 lower on the Nifty Bank as well. That's the rate which is coming up. Let's talk about stocks, Surabhi.
Yeah, absolutely. Not bad at all compared to the declines we've seen across Asia, thanks to the fact that we're a domestic-facing country. Speaking of domestic, Dabur, 5% lower. That's the one that's taking it on the chin because of the poor Q4 update. Let's talk about Nifty stocks then. IT is weak. There's no denying that, no taking away from that. And that's the sector that's getting hit the hardest this morning. Wipro, HCL Tech, TCS, Infosys. Look at all the IT stocks. The cuts are anywhere between 1% to about 2.5%. If you go in the mid-cap space, and the cuts are even bigger on stocks like Persistent, LTI, Mindtree, Memphis. So a very clear downtrade today is IT. It's across the board down. Okay, let's move on. What else? Stocks like ONGC, Zomato, Hindalco, they're all on the weaker side. Financials are not able to provide too much support, at least not right now. HDFC Bank, Shriram Finance, these are all stocks on the lower side as well. Let's look at some of the other names. Reliance, let's see what Reliance is doing. It's down about 0.7%. ICICI Bank also down about 0.5%. L&T, slightly lower. L&T is actually very close to the flat line, so let's see. On the upside, obviously, as you would expect, only Pharma and Pharma. Dr. Reddy's 5%, Sun Pharma 4%, Cipla 4%. And a bunch of PSUs are actually having a good morning. They're outshining on a day like today. NTPC, Power Grid and BEL. All these stocks are seeing green.
Well, that's right. I think the IT pack is getting hit, and particularly mid-cap IT pack is getting hit on the back of US recessionary fears. So take a look at some of the frontline F&O counters. You have Persistent Systems, KPIT Technologies. Both of them are down. Coforge as well is down close to around 2.5%. On the flip side, just to name a few of those pharma names, should be mentioned a few. Gland Pharma and Piramal Pharma from the broader markets, both of them, they are bucking the trend. They are some of the big outperformers this morning. A few other notable names that are moving around. Well, you have Sharda Cropchem. That stock is down close to around 7%. So there may be some kind of worry on that front. So that stock, in fact, is a little bit lower in trade. A couple of other notable losers. You have L&T Tech Services. That stock as well is lower. But as we are doing that market check, I'll tell you what, the markets have cut their losses now down to close to around 100 points. The bulls will say this is something that we like, at least for the initial minutes. And if you can put the crisscross lines, it's just a few minutes into trade, from around 300 stocks that are advancing, now you have 900 stocks that are advancing. Good going. Mid-cap index recovers from the low point of the day.
What are we talking about? It's a normal day.
I was just thinking, Surabhi, yesterday during closing, I think we were chatting on how tomorrow we could see a relief move, right? And I said, well, we're saying this with the risk of being immediately proven wrong. But can you be wrong and still be right? I mean, look at the...
This is not bad at all. I mean, this could be a regular day. I mean, absolutely in the market, for now at least.
And I think it'll be interesting to see the foreign number, the flow number, because is this retail once again sort of piling in a big way and supporting things and sort of buying this... And of course, I mean, I think for today, the foreign sort of activity will pick up as we go through the paces through the course of the day. So I think it's just still the initial kind of first reaction which is coming through. And so we'll have to give it time. Yeah.
Also, foreign managers will have to, they have a lot more to think about on their other positions in China, in South Korea, in these countries which have been slapped hard.
I think, just to give you a couple of technical levels, on the Nifty bank, it's good to see the 200 DMA has got protected, and on the Nifty, the 20 DMA, at least as of now. You'll want both those two levels to get protected, and gives you some hope that we'll see an additional fight from here on. Expiry day as well, so things can get volatile in the final couple of hours of trade.
Absolutely.
Absolutely. And, lots to track as far as specific stocks, etc. are concerned. But let's just actually put maybe just a few other names, right, up there for our viewers before we bring in our next guest. Do we have our market master with us? And I think we should be able to go to them in a bit. So, yeah, I mean, it is all pharma. The biggest volume-led gainers are Oro, Dr. Reddy's, Lupin, Sun, Cipla, Zydus, Gland, Divi's, Piramal, Laurus. My God, Glenmark. It is between 3 and 9% gains, and we should actually have those up at the bottom of the screen. So this is the biggest volume-led. Mankind, you can throw in Marksons, you can throw in Newland, you can throw in Moripun, you can throw in Supriya Life Sciences, 3.5%. And I'm not looking at some aggregation of pharma stocks, but I'm just looking at, I've just sorted the biggest volume-led gainers as far as the NSE is concerned, and this is what is coming up. About 10, 12 names, but all from that one space, at least for now.
Oh, absolutely, yeah. So not too bad. Now, how is the Indian side getting ready for its response? Sources have been telling us that Indian officials are right now analyzing the impact of the differential and reciprocal tariffs. We have our colleague Abhimanyu joining in. He's been working the phone lines to see. Till now, no official response from India. We've seen that from a lot of countries. We've seen that from the EU, Australia, China, not yet from India. Abhimanyu, what's the latest?
India is analyzing the impact of differential and reciprocal tariffs. Now, these tariffs are going to kick in 2 phases. The first phase would be 10% of tariffs kicking in from the 5th of April. And additionally, 16% of tariffs are going to kick in from the 10th of April. What sources have indicated so far that the government is studying the impact, is analyzing the impact, and it has also indicated that differential tariffs will mean a mixed bag for India, which means gains in some sectors and also losses in some sectors due to variation in competition with several countries. Also, sources have indicated that the clause 4 of the American order clearly says that the American president retains the power to cut tariffs with countries which are going to address the American concerns. India is already engaged in BTA negotiations with the United States, and both the countries aim to conclude the first tranche of the BTA negotiations within 2025 itself. So India, of course, remains engaged in negotiations with the US, and what had earlier been indicated that sectoral level, expert level talks would start virtually in the next few weeks, and expert level engagements will also possibly pave the way for in-person talks between both the countries. It remains to be seen what is going to be the overall impact. A detailed statement would be issued possibly in course of the day by the government, replete with analysis. So all eyes, of course, would be on what is going to be the possible impact.
All right, thank you very much for that. Sandeep Bhatia is with us, Managing Director and Head of Institutional Equities at Macquarie, and he's now joining us. Sandeep, good to have you with us here. Pharma, I want to just start with, I mean, any thoughts, any discussions with your team, especially with pharma, your pharma analyst in particular, on, the sector is seeing a big move.
I think it's good to see that the pharma has been exempted. I think what this means is that it's not the Trump administration not immune to domestic internal U.S. political pressures and requirements, and the pharma business is definitely integrated into the entire medical healthcare system in the U.S. So we remain positive on pharma. We like Sun Pharma, and this is. I think an indication of what should be taken as a broader message is that the tariffs that have just been announced our opening move, and there could be negotiations. India is already in bilateral trade agreement negotiations, and we could see changes in the tariffs for India and even for some other countries.
Gentlemen, I want to take just one moment to relish the fact that we've got, on a morning like this, we've got green on the screen. Look at the mid-cap index. It's already broken out into positive territory. Thank God for our founding fathers for always wanting to make India a very strong, resilient, domestic-facing economy, integrated with the world, but very strong domestically as well. And maybe that's what's helping us on a morning like this. That's the mid-cap index. Even the Nifty, 100 points down right now. Sandeep, so with that optimism, let me ask you the question on the broader market. As this tariff storm rages out and foreign investors have to decide what they want to do with their positions in other markets, like I was saying, China, Korea, Japan, could India be a beneficiary at all? Could they say India's maybe least impacted, relatively speaking, so let's allocate some money? Maybe it's a very simplistic question, but I'm asking you nonetheless.
I think it's a good question. I think India is in many ways an economic island. We have to appreciate the fact that we will be best placed to weather the storm. I don't think that India, both in terms of its economy and its geopolitical position, is at any way disadvantaged. I think we will see near-term pressures. The real challenge actually is not directly to India, but the entire political economic system and order is being overturned as we see. The real impact, therefore, on India will be the demand destruction that will happen globally. I think people will be very simplistic to assume that this is my exports and this is my direct impact. But remember that tariffs are going up not only for India, but tariffs are going up for other countries. And a lot of other countries around the world are significantly more globally dependent on exports to the US than India is. So I think the first impact is a very short-term direct impact, but the longer-term impact is on the entire demand, global GDP growth and trade will definitely suffer. The only other positive thing that can come from a slowing global GDP growth is energy prices may fall, but all this will happen over the next 6 to 12 months as things become clear what the final tariffs are. But definitely, as far as US is concerned, tariffs are up from where they were in 23-24.
No, absolutely, Sandeep. Take your point. I mean, the growth ramifications really need to be seen and they'll play out. But again, from a very near here and now perspective in terms of markets, would you anticipate more foreign flows?
I would think that right now is a risk-off moment. So to say that foreign flows will be rushing into India because of that, no. But yes, India will be least impacted of all the emerging markets. That much I can definitely see.
So you believe India will outperform from here on?
In terms of a relative outperformance means that the rest of the market can fall apart, and if we are where we are, it's also good. So yes, India is an outperforming trade in the medium term, which is a 12-month scenario as far as I see it.
All right, Sandeep, shorter conversation today. Thank you very much for joining us. It's a pleasure having you here on CNBC TV18. Well, let's now welcome in Neelkant Mishra, who's joining us this very busy morning, Chief Economist at Axis Bank and Head of Global Research at Axis Capital. Neelkant, good morning. Great to have you with us here. I'm sure you've been poring over the details and, of course, talking to your team and getting a sort of view out there. So I just want to get that view, Neelkant. I remember speaking with you 2 days before, 2 or 3 days back, and you said it's just going to be the opening gambit and it's going to linger. We won't get clarity and it'll go back and forth, but this basically means a lot of uncertainty. What has been announced is much harsher, Neelkant, would you agree, than what anyone thought?
Yes. The fact that the impact is not $300 billion, but closer to $700 billion is of course much bigger. The market should, I think, start getting used to the fact that uncertainty will now accentuate. So not only should we expect some countries to retaliate, we may also see significant currency movements starting to show up in the next several weeks. And And as the negotiation process kicks off, because remember that these are, they have deliberately started at 50% of what they think is the effective barrier. I mean, how it has been calculated, there are enough social media calculations on how simplistic it has been. But whatever be the case, they've started at 50 because I think the assumption will be that, look, we are going to raise it further if the negotiations are not doing well. If you start to retaliate, we'll raise it further. Either way, the estimate that I put out the last time we chatted, that about 1% of global GDP at the very least of investments can get postponed because of this. I think that estimate now needs to be revised further. The $700 billion odd of extra revenue that on an annualized level the US will start now to collect is about 0.6% of global GDP. So this is effectively fiscal tightening for the world. The US, of course, not all $700 billion will come from foreign producers. For example, if you take the smartphones, if production in China and Vietnam is going to be up more than 45 to 55%, or more expensive, and that from India about 25% more expensive, I mean, the US consumers will have to pay because there's not going to be any smartphone production in the US immediately. So there will be quite a bit of that $700 billion that will have actually come from US consumers themselves in the form of higher inflation. And frankly, it's only through higher inflation that tariffs actually become effective on what the US government is trying to do. So, but the US government will have some tools to provide some solace, some assumption, some comfort to the US consumers through some other tax cuts. But the gist is that this is a straight first shot 0.6% of GDP, global GDP. The postponement of production would be another 1%. I think we are talking about a significant rise in uncertainty for financial markets.
Nilkant, sorry, just to get those figures in, 1% hit to 1% hit to US GDP, right? Or global GDP?
Global.
So 1% hit to global GDP.
Because of postponement of investments.
Okay.
In addition to what is actually a 0.6% of global GDP tax that the US is now collecting or wanting to.
Okay. And you briefly mentioned that enough social media posts about how this number is being calculated simplistically, etc. We had an ING economist in the morning who said, well, and he used the word, not I, he said fabricated number. So they divided the deficit by imports and arrived at that 52%. Is that really so? So they're taking the size of bilateral trade, overall bilateral trade, and it's got nothing to do with tariffs per se, the rate of tariff. Nilkant.
Yeah, so if you plot the gap between MFN, see the executive order talks about how, this started around 1934 when the US government started to have bilateral agreements, and then over time it transitioned into a global agreement, and there was a most favored nation MFN rate that was being offered that is not inconsistent, and so that is how the justification is made. But when you look at, and therefore India actually on this is slightly better off because India's MFN rates were much higher than the effective tariff that has been imposed. Like India, it was 17%, but the tariff, they have calculated is about 45-50%. In Vietnam, where the effective MFN rate, average rate was 9%, their effective rate is 81%. So, which is why I think there are various other factors, and I don't think it is possible to quantify the impact of non-tariff barriers very efficiently. So some of the speculation on how this may have been calculated is right, but remember that the objectives remain the same, which we had discussed the last time. Multilateralism is over. The US does not want to get hollowed out industrially, and the dollar they want to depreciate, though I don't think this is going to help. And thirdly, that they want to generate out of revenue out of imports. So all of those three objectives are what I think we should solve for.
Okay, got that. By the way, Nilkant was talking about currencies, so I'm just taking a very quick look at what the currency markets are indicating, global markets, and there are big moves playing out. Look at the yen. The yen has surged, which you would expect because of the risk haven, the risk-off nature of trade. The yen is now quoting at 147 to the dollar, and that's a straight move of 1.3%. That's the kind of rise the yen has seen. The euro is stronger because the euro as a bloc is coming together with very strong statements saying that, you know, we will stand together and we will do whatever it takes to sort of mitigate the impact. The euro is at 1.09 now. That's a 0.5% appreciation for the euro. This is all this morning trades that are taking place. The yuan has weakened to about a 2-month low, but even for the yuan, the reference point that the PBOC sets every morning is stronger than what the markets had anticipated. So that's a little bit on the currency side. Nilkant, great to be listening into your views. So for someone sitting here in India and watching all this, a very simple question. Should we feel slightly relieved because we're not as badly impacted as a lot of the Asian exporters, export-facing economies? Or is there a lot of reason to worry because of the second and third order effects? What you said, 1% being shaved off global growth itself, which eventually will come back to hit us as well.
I said more than 1%. I said 1% because of investment getting delayed. That's a broad ballpark back of the envelope, Nick. And in addition to the 0.6% of volatility.
In addition, so it's 1.6%, yeah. Overall impact on the global economy, yeah.
Exactly, which is at the first shot, right? And so now we have to see second order, third order effect. So this is not going to help anyone. And I think, you know, previous speakers have also mentioned, and it's a reasonable number to work with, that we are slightly less affected directly. And remember that many of the problems that we had self-inflicted on ourselves, we are starting to solve them. Like the liquidity side, I think the RBI has been very proactive and it has shown a lot of action after stating its intent. And therefore, the liquidity premium that existed, which was very significant and which was actually slowing down the economy, is now very quickly getting whittled away. So the domestic economy actually should be on a better footing for its internal demand. So India economically, I think, will be less affected. There may even be new opportunities that come up. So if Vietnam is not in a hurry to bring down its tariffs, then there is a lot of apparel, footwear. India becomes relatively cheaper. I mean, there's a 20% gap between Vietnam and India. Tariffs on Vietnam versus tariffs on India. It's an advantage that can actually start to play out in our favor. I mean, it's very unlikely that footwear and apparel will start getting manufactured in the US because of these tariffs. So there may even be opportunities that come our way. But the channel through which I think the impact will be the worst will be the financial markets. So remember that people are just about starting to cope with the fact that this uncertainty will be there for a long time. The Fed put that the markets had become addicted to over the last 3 decades, that whenever there is a problem, the Fed can cut interest rates and the things will get sorted out. This time, it is a much, much more complex problem. And the equity risk premium, which is the inherent uncertainty, which prices in the inherent uncertainty of returns in what is actually a much riskier asset class than bonds, is something that was too low and will now start to rise. So we should get used to lower price to earnings multiples. This will get priced in over several quarters and years, but I think it would be, while we are less affected because of this, in fact, the gap, as I said, between MFN rates and what has been imposed is perhaps India is much better off. Second, we are less exposed to global trade on the good side than we have than many other countries. And thirdly, our own economic headwinds that we had created for ourselves are now starting to ease. So economically, I think we'll be fine. But I think the financial markets, the currency markets, I think are going to get badly affected.
All right. Hi, Nilkant. Good to hear your thoughts. And as you said the last time around as well, equity markets could be in a bit of a dizzy and could be in a bit of a flux, as you had mentioned last time around as well. Just want to clarify a couple of things. For the Indian GDP forecast, do you see any kind of hit? Are you factoring in anything? You've already mentioned longer term that could be throwing up an opportunity because the tariffs on India are not as much as some of our peers. So in select sectors, there could be opportunities. But in the near term, are you pulling back GDP estimates by any amount? And also, what about the RBI? You know, the Fed is unlikely now to go ahead and cut as much. At least that's the feedback we've got in the last few hours. Do you think the RBI has it in them to effect a couple of more rate cuts for the remainder of the Yes, please.
Any change that happens over a few hours can very quickly reverse over the next few hours as well. So remember that as the economy starts to slow in the US, and it is reasonable to expect that growth will slow because even though tax cuts may be introduced, there will be a lag before they start to show up, but the price shock will be immediate. So we'll see, I mean, how that plays out. In fact, it could actually happen that the US goes into a very sharp slowdown, and in which case the Fed then sees room to cut rates. So those things will change. I think that's something that we have to get used to. But when I think about the Indian economy, see the headline level, which is the easiest to do, if you exempt pharmaceuticals and some other sectors, and you focus on what is the change in duties, effective duties, and assume that in the next 6 months, by September, I think the assumption is that the bilateral trade agreement will be done, and by then India would have actually negotiated down some of these rates. The actual impact could again be only about $8-10 billion. And as of now, it seems it's 15-20, but it is wrong to expect that all of that will be borne by India. I think it is reasonable to expect that, like we discussed about smartphones, that some of the, a reasonable part of that cost will be borne by the US consumer, because there's no way that those kind of price cuts can be offered by Indian producers. So I don't think the direct impact is that big. I think the second order effect, because of the prolonged uncertainty, the fact that global GDP itself may be slowing, that there could be IT services.
Sorry, Nilkan, go on. Sorry, go on.
So the prolonged uncertainty, think about what happens to, say, IT services exports. So those are the kind of things that we should worry about. So versus yesterday, today, is my GDP growth forecast going to be lower? Absolutely. Will it be 1 percentage point lower? Will it be 0.5 percentage point lower? Too early to say. But I would re-emphasize that I think RBI's rate decisions are going to be far more affected by how good the monsoon is, how the hailstorms are affecting yields of wheat, how monsoon shapes up, rather than what the US Fed does. On the currency market, there may be some more volatility. I think you were asking the previous speaker about FII flows. Clearly, in this uncertainty, people will pull back from EMs, especially given that we are in the same basket as China and Vietnam and Thailand and many other countries which are very badly affected. So on the dollar flow side, I think RBI again will have to factor in the fact that they may have to intervene again to protect the rupee.
Got that. Nilkant, I had a couple of questions. One, do you have a specific view on pharma? Because pharma today, from a market point of view, is rallying. It's been exempted for now, looks like, but they've made a special, they've looped, put pharma in along with other sectors like semiconductors, etc., where they're saying it's part of a review and sector level tariffs may still come. Or you think we should go with the fact that, well, it's not going to come? It's not happening. It's exempted. Do you have a strong view?
There is no way to have a strong view when you're not controlling the decision-making process, so you don't even know how the decisions are being taken. You only understand the broad objectives. Frankly, on pharma, this is not something which is very critical for labor and job creation. And I'm not sure if the US wants to disrupt a very large part of their healthcare system. So my understanding, my assumption would be that, and given that, the manufacturing cost gap between India and the US is like 80%, so it's very unlikely that that's going to come in. It'll only increase costs, increase insurance premiums and all that. So frankly, I don't think this will get affected. This is too small for the US to bother about, and it is too critical for affecting the support base of the Republicans. So I think the risk is lower, but you're right. The reason they have given is that these are critical. There are things that we don't have, so we need to sort of keep them out for now. Whether they will pull it back when there is a negotiation happening between China and US and India and US and say that, you know what, we are now bringing this back on the table. Those are kind of things that can happen, but at this stage, I think it's reasonable to expect that they will not be back.
And Nilkant, Prashant, by the way, you're asking Nilkant the hardest question, almost asking him to read Trump's mind. Or I don't know if his advisors or even his wife can really read what he's about to do next, right? But maybe she has an ear into these things.
I just want to ask Nilkant one thing, Nilkant, and you'll have a good sense of this, right? You said India is domestic facing, and so that's a good thing. So in that sense, lesser impacted economically because of these tariffs. do you think the government and the RBI is already starting to do it, kind of, put all their efforts towards sort of really priming the economy in that sense to be able to withstand this global hit a little more? RBI meets on the 9th of April.
Yeah, but see, RBI has already taken a lot of action.
Correct.
Remember that they had taken out about 5 lakh crores, 5 trillion rupees of liquidity because of the dollar interventions between September and January. They have now re-injected 5.5, 6 lakh crores. And
it was more from the fiscal side, Neelkant. Sorry, government side.
So government fiscal deficit. In fact, the government is already, going to be less of a headwind. Remember that this whole narrative that the government was supporting the economy and is no longer because capex growth is not happening as fast is absolutely wrong. The government's fiscal deficit fell by 80 basis points of GDP in FY24. It fell by another 80 basis points in FY25, and it's basis points in FY26. So the government is less of a headwind than it was. And remember that it is because the Indian government has stuck to its consolidation path that the 10-year Indian government bond is one of the safest assets in the world right now. And you're seeing yields come down. We are seeing for the right reasons, demand-supply reasons. And therefore, I think from the government perspective, I would expect that, slight more push on domestic demand factors. Remember that we also have the advantage of having a real estate cycle, which is coming off of a 10-year downturn. It's only been 2-3 years of an upturn. There's a lot of room for growth there. So some of those policies, I think they can be definitely supportive of domestic activity levels, even as the world goes into this reset.
So finally, Neelkant, and last question, which would be a good segue into our next discussion as well. You discussed pharma. I just want your final take on two more important sectors from an export sense. They were important for India, apparel and textiles, of course. And then there's electronics, where so much work has gone in the last couple of years. Do either of these two sectors, do you think they could potentially stand to benefit because other countries have been slapped with tariffs which are far higher than where we are as well?
Absolutely. I do think so. Given that on a relative basis, now if the formula is what it was, then perhaps it explains why India's tariffs are a bit lower. But either way, the fact that that India was losing out on apparel and footwear because we didn't have an FTA with the US and Vietnam and Bangladesh with their relationship with EU and US were benefiting. Now that these tariff walls become less extreme for India, will become relatively will become an advantage. Similarly, on electronics, there is so much more that can happen out of India. Think about the fact that one very large smartphone company, despite being part of PLI, had actually shifted production, most of it incremental because they were losing global share, had shifted production to Vietnam, or was doing more in Vietnam than in India. Maybe now it's an opportunity for them to start doing it in India. So there are things that can happen.
But Neelkant, on electronics, I'm just going back by everything that we've heard on iPhone, right? Because Trump always takes these, poster boys of the US dream, whether it's Harley Davidson or whether it's the iPhone. And he's been saying that why can't we make these iPhones here? And we know there's a fair amount of investment that's already gone into Foxconn's factories. The Tatas are manufacturing for them. The Apple stock, by the way, was down 6% overnight on the fears that a lot of this perhaps will have to go back to the US. So are you still confident about electronics exports as a growing story?
Yeah. Remember that this is the first salvo. We don't know what the bilateral trade agreements between India and the US are going to show up. The fact that the US wants to do more semiconductors is understandable. Does the US have the manpower, which can assemble smartphones at a wage rates of 12 to 14,000 rupees a month? Is something that I think cannot be changed by tariffs. So if the concern is bilateral tariffs, I think it's the US interest. So remember that they're trying to solve for their self-interest, the end of multilateralism. They're trying to solve for generating revenue out of import tariffs. But they also realize that economically it is no longer viable for them to be assembling stuff in the US or even doing, say, camera module assembly or display module assembly. So these are things that economically are just not viable in the US. And if India does the right negotiations and can bring down the tariff rates on certain items, they will get the right rates for importing in the US, exporting to the US as well. So I don't see this as an insolvable problem, or that electronics now the story is over. I think that would be a wrong interpretation.
All right, absolutely. And Nilkant, really appreciate you joining us with that perspective. Really helpful as a frame of reference to think this through. And you may want to, if you are so inclined, can listen into the next conversation. We have the management of Arvind joining us, and we'll focus on textiles as a space, not just for the company, but for the sector. It's a sector conversation which we're going to have. So we'll take that break, and we'll have Kulin Lalbhai of Arvind join us on the other side.
Welcome back. So just a quick check on the markets again. The small flash of green that we had on the mid-cap index, that's kind of, given way. It's again a decline of about 0.8% right now. The Nifty is still nursing a cut of about 100 points. That's the situation. Let's talk about the tariff implications now on the textile and apparel sector. And to do that, we have with us Kulin Lalbhai, Vice Chairman at Arvind. Kulin, great to have you on. This just takes me back many, many years. I started my career as a reporter on textiles and apparel exports. And I remember that was the time, 2005, when the WTO quotas were going out. It was all about the India opportunity. 20 years later, Bangladesh jumped in, took away a lot of that opportunity. Vietnam jumped in, and there was always China. But is this a new reset? Is this, so to speak, a second lifeline for the Indian textile and apparel export sector, because our tariffs are lower than a lot of these ASEAN countries? What do you make of the overnight announcements?
Yes, I think the overnight announcements, of course, they are very large ones, and we'll have to digest them in the days to come. And it'll remain to be seen, how the discussions progress, because honestly, as others have also been saying today, this seems to be an opening salvo, and there's going to be negotiations happening. But I think if one just takes a step back, I think this whole geopolitical realignment which is happening, China plus one, Vietnam and Bangladesh have been big beneficiaries of the market moving away from China. And India relatively was not getting as much of that business as we possibly could because of different tariff and market access issues. And now if you look at it a little bit more holistically, with India discussing with the UK, EU, and the US, I think if you take that as the frame of reference, then this could be a very, very exciting time. Because I think India is looking holistically at a multipolar world and how we can engage differently with the West. And if we are able to land all of these negotiations in the right place, it could definitely be a step change for the entire sector.
Hi, Kulin. Good morning. Good to see you, Ben. Kulin, just going by the stock price reactions, the street believes that it's an opportunity for you guys. You conquer that, the tariffs put on India are not as much as some of our peers. So in that sense, it could be an opportunity. Do you agree?
Yes, I think, of course, relatively to all the other competing countries, the tariffs put on India are lower. So by that logic, of course, there would be that advantage. And I think if there is a parallel conversation going on a bilateral trade agreement, I think that makes it even more exciting, because this is the chance to really see how the US-India trade can go to that $500 billion mark. And there are a lot of sectors such as textiles, footwear, toys, where as the discussions progress and a zero for zero sort of opportunity could emerge, that would make it very exciting. I think in the very short term, there is uncertainty. Of course, these discussions will be progressing with multiple countries. So we'll have to see in the weeks that follow how the discussions are progressing.
But the global retailers, they could tell people like you all that, that absorb some part of this impact. So in that sense, it could hurt profitability. What is your take on that?
Yeah, I mean, see, this is a very live discussion, so we don't know exactly where it's going to land. But all the production in the world is largely in Asia. And these industries are industries which are low-cost manufacturing. So there is a part of it which perhaps could be coming down to negotiations. But if the tariff increases are large, then, of course, they would also have to be borne by the US customers.
So, Kulin, just exactly that. The tariff is 27%, by the way, not 26, 27. Our teams have confirmed that. Out of this 27% additional cost, rough breakup right now, how much do you think Indian companies will be able to absorb? How much will be passed on to the US consumer? Because that will also impact demand, which could be, which could be another hit.
Yes, I think it would be something which would have to be passed on to a large extent in industries like electronics and textiles. But again, I come back to the same thing that I mentioned earlier. I think this is an opening discussion. And I feel that the real opportunity that the two countries have is to get into these bilateral trade agreement discussions. And I think a lot of a large win-win opportunity can come out of this. I think another aspect that I think this announcement brings is the opportunity to speed up our discussions with the EU and the UK, because I think world over you will see new trade agreements happening with higher speed and higher efficiency as the world recalibrates to these things. But you are right about the fact that if large cost increases happen in the US in the short term, there could be some demand consequences there.
All right, Arvind, I hope you will join us again as the story progresses, as negotiations take place, and you yourself and your team get a sort of better sense since this is only, the story is only, 7-8 hours old. Thank you very much for joining us on this important day here on CNBC TV18. Well, let's move on and get another sort of perspective. Samir Narang is now joining us. He's head economics research group at ICICI Bank. Pranjul Bhandari is Chief India Economist at HSBC. Thanks very much, Samir and Pranjul, for joining us on this important day. This is, of course, as we've been discussing, much harsh. What's been imposed is much harsher than what anyone thought. Let's just contextualize this for India. Samir, if you can start first, what is your own assessment of what's the hit? It's, of course, very simplistic because there are negotiations, there will be give and take, etc. But on a static basis, what is the hit as you see it?
So, Prashant, as all of us know, we export around $85 billion worth of goods to America. Services is on top of that. And goods typically will have, lower elasticity compared to services. So you should expect on the goods front, perhaps a 10 to 15% impact directly on India's exports to the US, and that that amounts to somewhere around, given our overall exports to the US, $8.5 billion to say something like $15 billion. So the base case impact in our sense is that should be around 0.3% of GDP. But as has been pointed out earlier by some of the panelists, that India should also benefit given the fact that tariffs on India have gone up less than what they have gone up on China, on Vietnam, and some of the other countries which are doing a lot of contract manufacturing. So ideally, we should be better off.
To that point, and we just had the management of Arvind with us, but you've got to start with the basic sort of cost of production as well, right? I mean, is there a big difference in some of these areas on cost of production, say textiles, footwear, etc.? I mean, are those countries much cheaper? So even the tariffs for them are rising more. I mean, is it a big advantage? Is it an advantage? Does it open up a window, as some are saying, Samir, quickly.
It will, Prashant, because the cost of assembling these products in India will be far cheaper, because the wage component will be a very significant part in any assembly work that is being done, including services exports. So given that, if we can get our infrastructure right, and cost of shipment is, and logistics costs are in line with the Asian countries, I think it's a very big opportunity, because the 10 to 15% differential makes a lot of difference in terms of margins for the final retailers.
Pranjul, good morning. Thanks for waiting. What is your sense on some of the numbers? I'm assuming the numbers are what they are, but what's your perspective on how things will progress from here? Some have said this is an opening gambit, very maximum, highest cap, and then you kind of work back from there. Your thoughts, Pranjul?
Well, look, I must say that the situation is very fluid. If I come back to your channel in a few months, I'm sure, we'll be talking very different sectors, making very different points, because things are changing so much. But I think my thoughts from what happened last night, number one, of course, it's come as a bit of a shock, because, when I was seeing a lot of analysis around me, in a way, people were assuming a 10%, tariff addition to India, and it turned out to be more like 27%. But I think the silver lining, of course, is that, some of the other countries have got it even worse, ASEAN, China. So in a way, we're not doing that badly. So some sort of luck out there. But having said that, I think there's a lot of fluidity in a few things. Number one, in terms of which sectors are winners or losers. As in today, everybody's excited about pharma, but it's possible that something gets slapped on pharma, say, 3 to 6 months down the line. Today, we're not that excited about textiles or maybe electronics, but it's possible that, with the bilateral treaty, something sort of changes for textiles and it becomes a completely new opportunity for us. So this whole list of winners and losers are going to change dramatically. And I think that's going to bring a lot of uncertainty and volatility, into the markets. In terms of growth numbers as well, I think we need to think carefully between the direct impact on growth and the indirect impact on growth. My own sense is that, very simple back of the envelope calculation, 27% increase in tariffs across sectors, excluding pharma, can shave up about 0.5 percentage points from India's GDP growth. If you assume that some sectors are there in which the US consumers will take the hit, maybe it won't be 0.5, it will be 0.3 percentage points of growth drag in the short run. But I think this is not where the story ends. I think the second half of the story is more important. How much does global growth slow? And on the back of that, via second round effects, how much does India's growth slow? And one thing I'll be watching there a lot is FDI flows around the world, because they are a very good indicator of capex. If it slows across the board, it means that global growth, global investment is really falling. And the second round impact on India's GDP growth can actually be harsher than the first round impact. So I think these are the few things we need to think carefully about. Of course, our silver lining is that we have inflation which has fallen substantially. Our sense is that we'll have inflation below the 4% target for several months in a row, which gives a sort of long rope to the RBI to ease, something it's already done. I think we'll also see changes in its liquidity management facility. It's taken liquidity from deficit to surplus, but what we may see next is steps on how do you make this surplus a little bit more permanent in nature, so banks get the assurance and it actually adds to growth over time. So I think there's a lot of monetary policy easing that is there. The opportunity is there. And then the second big thing that India has, which a lot of other countries don't have, is services exports. It has not gotten into protectionism yet. It's rising very rapidly, at least right now. And that gives us this immense buffer, which many other economies don't have.
I think, I almost want to say to all of us, because who knows, right? I mean, services exports, God forbid if he starts looking there, then we have a real problem. So, well, fingers crossed. Hopefully, we're not going to go down that road anytime soon. But Pranjul and Samir, just a quick question to take that point forward on the RBI's response to what we're seeing. Pranjul was talking about the liquidity measures anyway that the RBI has been unleashing. Durable liquidity is what it's all about. Samir, comment on this. Do you expect any added measures over and above the prevailing domestic conditions and RBI's own liquidity mandate because of what's happening now with these tariffs? If you could quantify more liquidity steps, how many rate cuts, what are you expecting this year?
Well, the current liquidity framework, was started in 2019, operationalized in 6th of February 2020. And in that, the change from the previous framework was that the fixed repo facility, which was available to the banking system, was taken off. And it was desired that system liquidity should be in a little bit of deficit for effective monetary transmission. Since then, a lot has changed. Particularly, we have 24/7 payments. And banks have a preference to retain or hold some liquidity rather than, give it in the call money market. So in the current framework, perhaps the changes that would be required, as Pranjal was suggesting, would be operationalizing perhaps a fixed repo window in which banks have an on-tap facility which can be utilized anytime, and that will give them some comfort. It will also give a signal in terms of to the banking system for deposit costs to come down, because ultimately, unless and until deposit costs come down, for the system as a whole or for the economy as a whole, cost of borrowing on a durable basis is not likely to come down to that extent. So I think those are some of the steps on the liquidity front one should expect. We do expect RBI will continue to maintain positive, durable and surplus liquidity. And on the rate
cuts, rate cuts just very quickly.
Yeah, 25 basis points in April. Overall, I think given the impact of the current, tariff, there is a possibility that the RBI would like to also, change stance and give a signal that they would expect the liquidity surplus to continue. And this is a cycle on the liquidity and rate front, which will perhaps prolong for some more time.
Pranjal, April 9 expectations and beyond, rate cuts?
Yes, so we think RBI can cut a lot from here on. We expect 3 more rate cuts in the year. 1 has been done, so 3 more. Overall, 100 basis points rate cutting cycle. That's 1. The second is liquidity. It's been infusing a lot of liquidity, but I think over time, steps might be taken to make them more permanent in nature, as I was saying. Third is, regulatory easing. A lot of steps have been taken. For example, bank lending to NBFCs, all of that has been eased a bit. And our sense is RBI is sort of going to be a little easier on those fronts. And fourth, something which a lot of people don't really speak about, the rupee. I think it's good to see that the rupee, is looking like a more flexible currency at this point of time. I think this has a lot of benefits. And one big benefit is that if over time supply chains get rejigged and manufacturers want to put plant in India, they want to get assurance of a flexible, market-friendly exchange rate. So I think the fact that we've moved towards that direction is also positive for us. So I think on all these 4 fronts, I must say, central banking, RBI will be the only game in town, in my view, for the next couple of months in order to lift growth. It's not going to be fiscal policy because fiscal policy is tightening, and that's probably something good. We've taken it for granted because we have it. But, the countries that don't have macro stability are paying a price for it in terms of market turmoil. Thankfully, we have fiscal, which is showing market discipline and macro stability, and monetary policy, which is supporting growth and is easing. So we have this very nice combination of growth and macro stability, which is to our favor, in this whole world of global storm.
All right, storm it is, and no one wants to touch that. The fiscal stability and, of course, lower bond yields, etc., all a consequence of that. But RBI, 9th of April, of course, rate cuts expected, perhaps assurance that liquidity will remain ample. Thank you very much, Pranjal, for joining us. Samir, good to see you back on the show. And we will chat again. As Pranjal, you said, next time we speak, I think things will be, different, and how different we'll have to see. But thanks once again, both of you. We'll take a quick commercial break here. Markets are not doing bad at all. We're down just 70 points. And by the way, briefly, the Nifty Bank had come into the green. It is in the green as we speak. It's up 30 points, but it is in the green. And I think we should just look at the small and the mid-cap indices. Small cap index is down small, 0.2%. And I think the mid-cap index is also down a little bit more, 0.6% or so on the mid-cap index. Take that break. Nilesh Shah of Kotak Mahindra Asset Management Company with his views, his perspective on the other side.
माननीय सदस्य लोग ये कह रहे हैं कि हमारे सदस्य नहीं है यहाँ पर जो हमारे साथी हैं, लेकिन अध्यक्ष महोदय मैं ये कहना चाहता हूँ अध्यक्ष महोदय, मैं कहना चाहता हूं, ये जो बिल लाया जा रहा है, भारतीय जनता पार्टी में एक मुकाबला चल रहा है। भारतीय जनता पार्टी के अंदर मुकाबला चल रहा है कि खराब हिंदू कौन बड़ा है। और ये बात अध्यक्ष महोदय मैं ऐसे ही नहीं कह रहा हूं। जो पार्टी ये कहती हो कि दुनिया की सबसे बड़ी पार्टी है, अध्यक्ष महोदय वो अपना राष्ट्रीय अध्यक्ष नहीं चुन पाए अभी तक। अध्यक्ष महोदय भारतीय जनता पार्टी क्या है?
जी, मैं अखिलेश जी ने बहुत हंसते हंसते कहा है, इसको हंसते हंसते जवाब देना। ये सामने जितनी पार्टियां हैं उनका राष्ट्रीय अध्यक्ष उन 5 लोगों को ही चुनना है।
Welcome back. Well, the market's not doing too badly. The Nifty is down only around 60 points. And the point we made earlier this morning was, if the Nifty needs to fight back, it has to be on the banking names. And that's precisely what's happened. The Nifty Bank is now up close to around 100 points. Remember, the pharma index is outperforming, but there's only so much the pharma index can do. You have the big names, the banking names that have moved up, and that explains the recovery. Nilesh Shah, Managing Director at Kotak Mahindra AMC, joins us on the show. Hi Nilesh, good morning. Good to see you win. Well, Trump's tariffs have been announced, at least for now. And it appears, though India is going to be levied at 26-27% or thereabouts, it's at least relatively lower in comparison to our peers. How do you approach the Indian markets from here on?
So one, Nigel, President Trump has proven Sant Tulsidas correct. Sant Tulsidas wrote centuries ago, Samrat ko nahi dos kosai. And President Trump is proving that for weaker nations, WTO is there. For stronger nations, WTO doesn't matter. In fact, he has historically coined new definition of import duty, which is your trade surplus with US divided by your exports to US. That is called import duty. I'm sure we are going to see one Ivy League case study on this new definition. There's one interesting WhatsApp forward which I have received. I haven't checked the authenticity, but it has come from a reasonable source. The US has imposed mass tariffs twice in its history. One was in 1828 and second one was in 1930, roughly about 100 years apart. And both of that resulted into recession or Great Depression. Coincidentally, third tariff mass hike is also coming after 100 years. And as that WhatsApp forward suggested, you need all the people to be dead who remembered the impact of tariff on the economy before you can play that game again. Clearly, this is one game which is lose-lose for not only US, but also for other countries. There will be higher inflation in US if tariffs come into play. There could be impact on growth as supply chain gets disrupted. And this could result into US stock market correcting as the Dow futures and NASDAQ futures are indicating post-announcement of tariff. Half of American household wealth is in US equity, and 2/3 of American economy is driven by consumption. Higher inflation, lower growth, wealth effect evaporating. Could this result into stagflation in US? Well, it won't be called stagflation. It will be called hard landing because US is a developed nation. Effectively, it's a lose-lose situation for the world as the theory of comparative advantages gives way for Make America Great Again. As India... Yeah, go ahead.
No, Nilesh, I was just saying that we were so glad you were joining us because you have a knack for putting things most beautifully in the best philosophical manner. And I think on mornings like these, philosophy ultimately comes to help as well. Because, you know, first it was the financial crisis, COVID, and now this all man-made. On November 5, markets were ripping higher. That Trump is great for financial markets. And now where are we? So what would your advice be to investors?
It all depends upon how situation evolves. I will still say picture abhi baki hai. President Trump has not finished. He will continue to make announcements. And it is up to India as to how we leverage this. We have been imposed tariff duty, but it is much lower than most of our peers. In sectors like pharma, there is no tariff impact. In sectors like garment and footwear, soft toys, we could probably get business from our Asian peers. IT sector will get impacted as technology spending slow down if American growth slows down. And we'll have to be also careful about how China, with its massive manufacturing capacity, dumps goods all over the world, including India. I think there is always silver lining in the dark cloud. And if India can go and negotiate with US, especially, by leveraging oil import or defense import and reducing that trade deficit, and also showcasing that, look, in China, where you run more than $500-600 billion deficit, you are not actually able to operate in China as freely. Your Facebook, your Twitter, they are not operating in China, but they all have free runway in India. So if we can negotiate under clause 4 of the of the order and probably reduce the impact of tariff on us compared to our peers, it's a great opportunity. Markets will carefully watch how government and the entrepreneurs of India capture the opportunity and then take a call. At least as of today, market is not reacting in panic, which is positive.
Okay, so Nilesh, we hope that stability prevails. One quick last question. Remind us of the firepower calculation. In all the last 5-6 months of turbulence, it is domestic money that has helped us. Now, if these foreigners keep selling because of this global chaos, then to what extent can you keep buying? What is the average cash level? I remember you saying it was, I think, if I remember, over 2 lakh crores of firepower. But please do share the latest numbers with us.
So, Surabhi, roughly the cash balance has remained around that level. Whatever flows we are getting, it's getting invested in the large cap space mostly, and a couple of small and mid cap space where valuations have corrected meaningfully. Within FPI also, we have seen passive turning buyers in the month of March, passive ETFs. I hope it is harbinger of the buying by FPIs on the active side, and if not buying, at least reduction in intensity. Now, please remember that we have firepower, but we are not here to give easy exit to FPIs. If I know their trade side, if I know they are on the selling side, we are going to buy at a lower price, not at a higher price. So money is irrelevant. Once you show the card, the game will be played based on the cards you have on table.
That's an interesting point. And while it could be slightly chaotic in the near term, as an investor in mutual funds, I'm very happy to hear that mutual funds are not here to give easy exits to FPIs, which could be on the run. Who knows how this plays out? But thank you very much for joining in, Nilesh. Always value your perspective. Well, with that, I guess move to commodities now. We have Manisha joining in. Manisha, what a morning. Good morning to you.
Well, yes, it started really early for all of us, didn't it? And yes, we have seen a very strong knee-jerk reaction come in for many of these commodities as well. You know, just to remind you, well, of course, there is a risk-averse scenario that we are looking at in the international markets, but all of these commodities are global in nature. So country-specific tariffs does disrupt a lot of global trade there. So markets are looking at higher than expected US tariffs. The best-case scenario that the street was anticipating was 5 to 10% and worse between 15 to 30%. And we seem to be looking on the higher side here. 10% of baseline tariff is what we've seen all countries, and then the major producer and consumer of commodities have had it on the higher side. When you look at the China markets, well, we're looking at around a higher number of 34% there. China already is dealing with 20% of tariffs, and that makes it 54% of tariffs. And remember, China is the major consumer and producer of many of those industrial commodities. So we are looking at reaction coming in for many of those. For India, we're looking at 27% at this point in time, and that reaction clearly has come in for the gold prices, which has now made 22 days of all-time highs in 2025. And we've seen 3165 break on the higher side, 3200 in the front month futures as well. So very strong gains continuing in the safe haven buying in sense of gold there. Crude oil prices, well, 80% of countries in the global markets import crude and 20% of them produce that. So we are looking at crude prices also taking an impact from this. 3% of a decline is what we are dealing with right now. There are concerns of weak energy consumption going forward in the new fiscal, and that's what's bothering the crude prices. The metals also have had a similar scenario come in. Natural gas prices fell 4%. You have COMEX copper, which hit an all-time highs in the month of March, also has declined quite sharply, 4%. There are reports from UBS and Goldman Sachs saying that if these tariffs continue, then we are looking at a collapse in sense of copper markets going forward there. Well, zinc, aluminum prices have seen a 5.5% of a decline on the weekly basis as well. But this is overnight markets, and the iron ore prices in China fell by 6%. It has been a 3% of a decline coming in for other industrial commodities like rubber and cotton as well. And that shows you on how we've seen prices go on on weekly sense as well. We have seen some exemptions coming in like steel and aluminum articles, but remember, there already is a 25% tariff that we have seen on these metals. Auto parts is what has been exempted as well. And more importantly, while the US has imposed 25% tariffs on all imports when it comes to steel and aluminum, so that is the reason they have been exempted at this point in time. The other commodities that you see exempted at this point in time is copper, semiconductors and lumber articles as well. And then it has been about bullion. By definition, bullion means gold and silver both. So as of now, there is an exemption for both of these. All exempt articles also may subject to future 232 event as well. So as Nilesh was telling us that this is it is not finished yet, and we could be looking at more negotiations and retaliatory tariffs, and some of these numbers perhaps pulled back as well. I also want to show you on what we've done in sense of commodities on a week-on-week basis until now, and everything has seen a decline, barring gold. Well, that's the only one that's trading on a firmer note at around 3% on the higher side. Silver is down by 3%, and that's exactly what the case has been for many of those metal prices also. So whether it's copper, aluminum and zinc, we're down 4 to 5.5% on the weaker side. So, well, yes, apart from safe haven buying in gold, everything else in the negative.
All right, Manisha, it's a very comprehensive look at what's happening across commodities right now. Time for a quick commercial break here. On the other side, our special segment, it's the economy. It's very much about the economy. Lata is going to be speaking with agri-economist Ashok Gulati and trade expert Ajay Srivastava as to which Indian sectors will be impacted most by tariffs.
हमें माननीय अध्यक्ष जी करोड़ों सदस्यों में से 12-13 करोड़ सदस्य प्रक्रिया कर चुनना है तो देर लगती है। आपके यहाँ जरा भी देर नहीं लगेगी। मैं कह देता हूं अभी 25 साल तक आप अध्यक्ष हो जाओ, नहीं बदल सकता।
अध्यक्ष महोदय, क्योंकि जो बात निकल के आई है वो मैं फिर आगे बढ़ा दूं। अध्यक्ष महोदय, जो बात सोशल मीडिया या और जगह गुपचुप हो रही है, कहीं ऐसा तो नहीं था कि अभी कुछ दिन पहले यात्रा जो हुई है वो कहीं 75 वर्ष की एक्सटेंशन वाली यात्रा तो नहीं थी?
Over 3,000 entrepreneurs, investors and heirs have made it to the Forbes list of billionaires in 2025. That's 247 more than last year. Not only are there more of them, but they're richer than ever. The billionaires on the list are worth $16.1 trillion in total, up nearly $2 trillion over 2024. Their total net worth is more than the GDP of every country in the world besides the US and China. The US, with a record 902 billionaire citizens, continues to boast more billionaires than anywhere else on the planet. China, with 516, remains second, and India, with 205, still ranks third, which is 5 more billionaires than we had last year, but not a single Indian has a net worth of over $100 billion. So who's on the list? The richest man in the world is Elon Musk with a net worth of $342 billion, followed by Mark Zuckerberg with $216 billion.
Hello and welcome to It's the Economy. We continue our analysis of how the 27% tariff imposition on Indian exports to the US will impact the economy. Just to remind you, it is zero tariffs on pharmaceuticals, on copper, and on some energy products and semiconductors. We do export some energy products as well to the US. It is 25% on automobiles. That doesn't change. That's the global, and of course on steel and aluminium. And the 27% India-specific number impacts all the other exports. Joining us to discuss what's the impact on Indian economy, Indian agriculture and trade are two experts: Ashok Gulati, distinguished professor at the Indian Council for Research on International Economic Relations, ICRIER actually, and former chairman of the Agricultural Prices Commission, I guess the best agri-economist we have. Also joining us is Mr. Ajay Srivastava, the acknowledged global trade expert. He heads GTRI, the Global Trade Research Initiative. Gentlemen, thank you very much for your time. We do need sector-specific experts now. Dr. Gulati, first to you, sir. Our agri-exports, mainly I understand from the numbers, is basmati rice and shrimps to the US. These are seriously impacted, you think, because of the 27%?
27 or 26%?
So no, it is 27. Apparently, Trump said 26, but in the annex, it is 27, and actually it was Mr. Srivastava who pointed that out.
Anyway, you know, looking at the tariffs on Indian products in isolation is not the right way to look at it. If you're looking at, let's say, rice, now rice tariff going all the way up to 27%, what are the options? Will they stop eating rice, or will they import from other countries? Which are the other countries? That's Vietnam or Thailand. Their tariff structures are even higher than ours. So in fact, we could be a gainer because we will get this tariff advantage vis-a-vis our closest competitors, Thailand and Vietnam, as far as rice is concerned. Okay. So to analyze commodity by commodity or sector by sector, you have not to look at just your tariffs, but the tariffs of the competing nations who are supplying the same product to US.
Actually, the competitors list will run, sir. We have the Southeast Asian, data as well. And as you pointed out, Bangladesh, Thailand, Vietnam are all going to suffer slightly higher tariffs than ours, between 2 and 10% more than us. But Mr. Srivastava, first thoughts from you. How do you take the impact? Will our exporters take some of the impact and keep some of the prices higher, because that's what the competition from Vietnam and Thailand will do?
So I agree with Ashokji that it's basically relative disadvantage that is at work right now in today's scenario. And we see many of our products will be hit. For example, marine products will be hit, and our auto components will be hit because they will be supplied maximum from Mexico at zero tariff into US markets. So, but electronics will be hit because our value addition is very less, and it can barely absorb 27% tariff hike. So countries like China, where most of the supply chains are concentrated, they despite higher tariffs, it will be difficult to dislodge China from electronics. So these are my initial thoughts.
Okay, so your initial guess is that auto parts will be impacted because a lot of it is coming from Mexico, and there is no tariff. So auto components could be impacted, right?
Yes.
And electronics, China will be better able to weather, and therefore we may lose out.
Because our value addition in electronics is 10 to 15%, not even that in many of the advanced products, whereas most of the supply chains are concentrated in China. They were dispersed earlier, but in the past 10 years, they are concentrating. For example, Apple supply chain, basically it's located in 1 or 2 cities. Everybody is together. So it's difficult to dislodge them.
Okay, fair enough. But even auto parts, actually, Samavardhana Motherson told us that their factories are in Mexico. So probably even there we have to get a little granular. Dr. Gulati, according to you, which are the sectors where we may not be able to pass on? For instance, textiles. Do you think Vietnam or Bangladesh, for instance, will be better able to absorb part of the shock and pass on less and therefore outbeat us or something like that?
No, in fact, that's where our largest benefit is likely to be. Because textiles, if you look at the last 10 to 15 years, Bangladesh has captured the global markets and the US markets much faster than what India has been able to do. Same story is with Vietnam, although China has been vacating some space. But what is going to happen, because Vietnam tariffs are going to be much, much higher than ours. Even Bangladesh is at, I think, 37%. Right? And China at 34%. So all the three major competitors on garment exports, apparel exports of India are, at 34, 37, and perhaps Vietnam is at 45 or 47%. So we are going to get a big advantage in that, in terms of relative incentive structures. So on textile, I feel we will be the gainers.
So that's very big. In fact, Gokuldas exports at the moment is up 7%. So clearly the market has zeroed in on what you are saying. Mr. Srivastava, any other sectoral detail that you can give us? You said auto components you would worry a bit, and electronics, as you say, you would worry a bit. Anything more you can add in terms of nuances? Mr. Srivastava, I mean, textiles, for instance, you agree we will be at an advantage?
Yes, because textile, the nuance is that in, say, cotton textiles and even in synthetic textiles, labor component is 30 to 40%. And if China suffers 54% tariffs, textile is not a very high-tech item. Labor component will dominate, and compared to India's 27%, 54% on a low technology item, it will give immense opportunities for India or even global manufacturers to relocate to India. But the problem is the uncertainty, unpredictability. Trump says India charges 54% tariffs, and he just halved it to 27%. When he raises 27% to 37 and then 54%, nobody knows. So if I am an investor, I am seeing that China tariffs are high, India low, India is a good possible location for me. I'll still have to figure out whether Trump will stay with these tariffs, or after a month, he will get angry at some country and then revise it to full value, say 54%. I think that's the reason they are using two values. So that uncertainty has to be worked out at the investor level. Right now, it's not clear.
Very, very pointed, issue, sir. Dr. Gulati, therefore, a general equilibrium analysis is called for. Nothing can be ceteris paribus at this point in time. So what would your sense be? There have been economists telling us that they're expecting a 1% fall in global GDP because of the factors you both are saying. Uncertainty. No one will want to invest. Can you give us some general equilibrium impact on global, US and on India?
Well, that's a big question. And looking at 2-3 things with the increase in tariffs, how much inflation is going to be there in the US economy, and will the demand shrink there? That's one question. Now, for a particular commodity, it may be very minuscule proportion of their total expenditure, but when you look at all the commodities and if their prices go up by 26% or 28% or 30%, depending upon which country it is coming from, then there is likely to be some impact on the demand reorientation or even compression. Now, that demand compression of the largest economy in the world, the consumer economy in the world, can send signals around the world to slow down their production. So on top of this uncertainty about tariffs, I'm worried about whether the demand compression will be there, and that will slow down the growth process. But my feeling is, frankly, it will take 3 to 6 months to know and stabilize the system which direction different countries are going to move, and whether there is a possibility of renegotiation on different things. I think this is the first shot, literally a 440 volts shock that President Trump has given to the entire world to reset. Looking at it from his angle and America first angle, trade deficit of $1.2 trillion, and which is increasing over the last 5 years, is very unsustainable. So all said and done, I think he's correcting the entire world trade order. But the way he has calculated these, that is a mystery a bit, because how much is the tariff? He says India is applying 52% tariff on us, and he says it's a tariff plus non-tariff barriers plus...
So we worked out that formula. Apparently it is how much we export to the US, that is how much they pay us, divided by how much they export to us. And the difference is 52%. And he halves that and imposes 27 on us. It's an import-export calculation.
It's not a currency manipulation. It's not what is written in the text.
No. He takes all that
and that's not. It is a very...
Apparently he assumes that the trade deficit reflects everything. It reflects our currency manipulation. It reflects our non-tariff barrier. So it is the deficit. That is the key number according to, the initial comments we are getting. Very quickly, sir, is there a financial sector impact? I want quickly both of you to comment on that. Dr. Gulati first. Financial sector impact in the sense that, investments to EMs may not come by the FPIs.
Of course. The financial sector, the bankers have to look at the risk, and risk is enhanced. Which sectors to give? Which sectors are going to compress and which sectors are likely to expand? So each bank will have to literally work what is likely to be the unfolding scenario. And I would say they will go slow and steady and perhaps at a standstill in giving more and more of loans on that. So there is likely to be some sort of a, lull in the loan activity, in the investment activity, and that's going to impact the overall growth process.
Yes. Mr. Srivastava, last word, out of time. What is the impact on rupee, you think?
So I can only, at this point of time, I'll say that because of the tariffs, US consumers will have to shell out more money. That will lead to more inflation. More inflation means interest rates. They have to jack up interest rate. That means FPIs will be withdrawing money from world over. That means stock markets world over will feel duress. And then the related impacts, we all know what's going to happen.
Yeah.
So unpredictability is the basic factor. Yeah.
Yep, I take your point, sir. Thank you very much. As Dr. Gulati also said, it's going to take 3 to 6 months, provided President Trump doesn't change his mind, even after those 3 and 6 months. Prolonged period of uncertainty, but there is going to be an impact, not just on the trade channel, but also because of the economic channel, financial channel, and confidence channel, is what our experts tell us. So there is a negative impact, but immediately do not run away sector specific. It's possible that textiles, pharmaceuticals are all going to be advantaged because our competition is being hit even harder. We wrap up on Bazaar on that note. Thank you very much, Dr. Gulati and Mr. Srivastava. We will continue our analysis after the break.
Jeff Bezos with a net worth of $215 billion. There are only 3 people in the world with a net worth of $200 billion. Oracle's Larry Ellison, Louis Vuitton's Bernard Arnault, and legendary investor Warren Buffett round up the top 6 in the world. There are 15 billionaires with a net worth of more than $100 billion. US President Donald Trump's net worth has doubled in the last year from $2.3 billion to more than $5 billion thanks to his social media platform Truth Social and cryptocurrency bets. Mukesh Ambani remained the richest Indian and the 18th richest man in the world with a net worth of $92.5 billion. The other Indians on the list included Gautam Adani at number 22 and Savitri Jindal at number 48. Shiv Nadar was at the 51st position with a net worth of $34.5 billion, Dilip Shangvi at number 79 with a net worth of $24.9 billion, and Cyrus Poonawalla at number 86. Only 13.4% of the billionaires on the Forbes list are women. There are 2,681 male billionaires and only 406 female billionaires.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18. Now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC TV18 and CNBCTV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC TV18 and CNBCTV18.com. CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the
Well, welcome back. We're, of course, getting you the continued coverage in terms of the impact of Trump tariff announcements, which came last night. I'm Prashant. With me is, of course, Surabhi. And Surabhi, the markets are, I think, in a better place overall from, of course, the morning swoon that we saw. Nifty is down just 35 points. And I think the Nifty, the Bank Nifty actually is in the green.
Absolutely.
A little bit. So this is not all that bad at all.
No, absolutely. And it's again looking much better than the rest of the Asian markets, which is still reeling under pressure, down between 1% to about 3%. So we'll have, another set of special guests joining in just a bit to decode what these tariff announcements mean for India. But before we get to that, we have to address a story that's coming up on your screen as well. So let's actually put the spotlight on that. We're learning from sources that the RBI has sent a letter of displeasure to Bajaj Finance. And this is on co-branded credit cards, that part of their business. Vivek is joining in with the more. Vivek, what are you picking up?
Well, that's right. What we understand from our sources is that the RBI has sent a letter of displeasure to Bajaj Finance. This is on the co-branded credit card business. Remember, our Bajaj Finance actually had 2 types as far as the credit card business is concerned. One with RBL Bank and the other one with DBS Bank. The RBI communication, as per sources, actually has gone ahead and cited 2 earlier communications that has transpired between RBI as well as Bajaj Finance. One is a letter dated Jan 31st and Bajaj Finance's response to that particular letter on February 22nd. So now the latest letter of April 1st that, that was received by Bajaj Finance, where RBI has clearly stated that the company has not proactively identified gaps and vulnerabilities as far as the credit card business practices are concerned. They flag significant risk to customers. Their communication also points to reactive approach, failure to maintain adequate internal controls, and along with that, in the response that Bajaj Finance had given to RBI, they had actually said that their role was limited to customer solicitation. However, RBI does not agree with them. They say that Bajaj Finance cannot absolve itself of responsibility to partner banks and, more importantly, to their customers. So what are the regulatory directions that RBI has sent and given to Bajaj Finance? Number one, they say that Bajaj Finance must now monitor and ensure adherence to all timelines. Along with that, Bajaj Finance now needs to seek an independent validation through an external audit process with prior RBI approval. And along with that, they say that the audit must cover data security measures as well as cyber security measures. Along with that, this is very important. The company says, RBI tells Bajaj Finance that going forward, Bajaj Finance must now obtain explicit approvals from the Department of Supervision of RBI if it intends to re-engage in the co-branding credit card arrangements. It is important to note that the current RBI regulations do not require NBFCs and banks to seek prior approval from RBI before entering into a co-branded credit card agreement. Now, Bajaj Finance, however, it's important to note that the impact may be limited given the fact that at the end of Q3, Bajaj Finance actually said, and it's part of the investor presentation, that it will cease incremental sourcing of co-branded credit cards with RBL Bank as well as DBS Bank. Existing cardholders will continue to receive services from the respective banks. We reached out to Bajaj Finance. We have not yet received a response. If and when Bajaj Finance do respond to us, we will update our viewers on the same.
All right. Vivek, thank you very much for that. So that's the individual stock story that we are focusing on. Let's move on to the other, the big one, of course, which is the impact of Trump tariffs on India, economy-wise, sector, industry-wise, etc. as well. We have Mr. S.C. Garg, former Finance Secretary of India. We have Mr. Najib Shah, former chairman of CBEC, joining us now to run us through what they are making of things. Gentlemen, good morning. Great to have both of you here. Mr. Shah, if I can start with you, sir. You know, in that article that you wrote for us for CNBC TV18 early March, you had kind of said that, FTAs perhaps are being talked about, negotiated. But at that point, you also said studies which are in the public domain show that India's exports to FTA countries don't necessarily outperform, growth otherwise. We have the tariffs now. They are much higher compared to general expectations, although many are now pointing out that other countries are worst hit. So that perhaps at the margin is the only silver lining. How are you looking at this entire thing?
Times ahead, difficult times ahead. What I had mentioned in that article was basically the Niti Aayog study itself, which pointed out that India's exports under the FTA to ASEAN countries specifically had not really shown the sort of export benefits which we anticipated when we went into the FTA. So one was only telling that you go to FTAs with caution. And currently, the silver lining, apart from everything else, the other countries being impacted with higher tariffs, is that pharma is not there. Textiles are another area of strength for us. Bangladesh and Vietnam seem to be having a higher tariff as of now. But there's a great amount of uncertainty. And I don't think this helps business, this helps trade, this helps the Indian exporters. He'll have to factor how much pain he will absorb to ensure that he doesn't lose his market in the US. A lot will depend on the discussions which seem to be ongoing between India and US, and how much India thinks we will concede to ensure that our exporters do not suffer a very bad deal when they enter the US markets.
Absolutely, Mr. Shah, points well taken. We need to understand now how much of this 27%, which is the number that's been given to us, how much of it can be realistically negotiated down, because back-channel parlays would still be on, as we thrash out the terms of the new bilateral agreement. So, Mr. Shah, what would you say? I mean, given the different tariff lines, the different product lines involved, what can we expect?
Focus on specific commodities where we believe we need to export and not lose our export share. So which means if, for instance, take for instance engineering goods and engineering products, if we believe that that is a market we don't want to lose, we should, if necessary, reduce the tariffs on that specific commodity. Go tariff by tariff, commodity by commodity, rather than look at an overall reduction, because I don't believe that we should violate our MFN principle. We should ensure that whatever we agree to reduce for US is applicable to imports for all countries, and negotiate accordingly with the US. That's the only way I think we should go forward, and our exporters need to brace up for challenges.
But Mr. Shah, and help us understand this, because that's where the complexity is arising. Let's take, for instance, the sectors which are very important for us from an export standpoint, which would be pharma, which would be electronics, which would be textile. Now, these are not very heavy import sectors. We don't import a whole lot of pharma or textile, or for that matter, electronic components into India. But is it really item by item or segment by segment? Because what seems to have happened is that they've taken the overall trade deficit into account and then arrived at a number. So how does negotiation happen when you're talking about the total trade imbalance versus sector by sector tariff lines?
Keep reminding them that the president started off with reciprocity, which, of course, nobody knew until last night what reciprocity meant. We assumed that it will be item by item or sector by sector, and not a blanket 27% across the board. So we need to remind them that, look, if your concern was this particular product, here we are reducing this product. And like you rightly pointed out, these are not import-dependent commodities, textiles or electronics. But nevertheless, our tariff structure is still higher than what US is imposing for corresponding imports from India. So that's the only way we need to negotiate going forward, and hope that we are able to persuade them, because this 27%, as rightly pointed out, has been arrived at a completely fairly arbitrary manner. Exports, you see exports to India, see your imports from India, and you say it's 52 and divide that. He kept announcing 26, the next year talked of 27. So I assume there won't be any further changes, and 27 is what it is. So I think there's the only way to go forward, because there's so much uncertainty right now. And since parlays are going on, we need to understand from them, how do we address those concerns of them without losing focus on what is needed to protect our own domestic industry, what is needed to encourage our exporters.
No, even if there was that weighted average formula which many were expecting, even if those who were not expecting sector by sector but a weighted average overall tariff rate, this 52% is got nothing to do with tariffs per se. It's basically they're targeting the overall imbalance and saying, well, this is because of everything in it. And as you said, keep reminding them. The only thing is that I think we'll have help with all other countries also reminding them that this was about reciprocity. This is not just, this is, and I think others perhaps also in that same boat. Mr. Garg, come in here on this discussion. Your first thoughts, sir, impact and what can we do? Mr. Shah earlier said FTA is, of course, work in progress, but we need to enter those cautiously and carefully because we have data which shows they don't, outshine growth otherwise. I mean, FTAs by themselves. Go on, sir.
See, Prashant, I don't think this whole issue should be seen as a bilateral issue. There is a massive restructuring of the post-World War II global trade and the tariff structure going on in the world. Trump has taken all these measures with a view, with the objective of making America a manufacturing nation again. And as you have rightly pointed out, he has worked out that how much per unit we pay as tariff to whoever we export, and what they pay to us when they import from that country. And therefore, going forward, what a particular country, let's say India, can do is not dependent upon between US and India. It will also need to take into account what Vietnam or what other countries would do it. See, if you have seen it carefully, only two major industrialized and high-income countries have suffered very high tariffs. That is the South Korea and Japan. because South Korea, earlier a developing country, was sort of having much larger import tariffs than the developed countries or industrialized countries had. They have not changed the tariff. They have not reduced, despite having become a very industrialized country in itself and exporting massively to America. Same is relatively for Japan. So what will need to be done going forward, to my mind, is to watch how these countries react. My own sense is that a country like Vietnam or Thailand or South Korea or Japan, for that matter, including China maybe, because they don't need those high protective tariffs any longer. It's actually a legacy issue why there's so much high tariffs. They don't need it. So will they now roll back, reduce their tariffs? I expect Vietnam to do it very easily. If they are charging about 92% tariff on American goods to them, if they reduce it to 9% or 10% or 5%, I don't think Vietnam economy would suffer at all. And if that happens, or Thailand does it this way, India cannot simply look at that bilaterally, goods by goods or sector by sector, we'll negotiate. I don't think Americans have patience and the time to do these bilateral negotiations. We'll have to also see whether we can take broad brush calls. And here, again, if you analyze the Indian basket of exports to America and American exports to us, I don't think we need to have such high tariffs at all, whether it's agriculture or whether it's industry. So slash the tariffs down massively. The Indian industry might suffer some short term, but Indian consumer will not suffer at all. I think the time has come to join in this it's big reordering of the world trade and the economy which is happening.
No, absolutely. But what's also happening alongside, I mean, this is reciprocal tariffs we're talking about. Alongside, there's a lot of pressure from the US to open up products like automobiles, right? And that throws up a big question mark on domestic manufacturers, domestic OEMs, etc. So that pressure on defense imports, on auto imports, that's a separate part of the conversation. And Mr. Shah, maybe if you could comment on this, on whether there is a greater threat for domestic industry than what meets the eye this morning?
It depends entirely on the import components of the export product or the import components of the domestic manufacturers. Fortunately, very few sectors really are dependent on American imports, which is why our trade balance is so healthy. So that's so we can identify specifically those industries, those products, those components which go in the manufacture of such goods, and look at those. So I don't think the Indian exporter is at a greater threat because of the fact that the American market is a big market, is a consumer's market, rather than the Indian manufacturer, because of the fact that our imports from America, which go into the manufacture of other products in India, are limited, are lesser.
Till now. So that's the question, till now. But, you know, for instance, I go back to the auto example, and the US president on numerous occasions has been hitting out publicly, saying it's impossible to sell anything to India. Look at their car tariffs, look at their auto tariffs. So if India, and to go back to Mr. Garg's point, maybe Mr. Garg, if you could come, and you're saying India needs to have a far wide-reaching sort of thought to this. But if India were to start opening up, in sync with what the US wants, this could be pretty damaging for domestic industry, wouldn't it?
Automobiles, which you just said. In automobiles 20 years, 30 years back, we perhaps needed some protection. But today, compare the prices of a Tesla being manufactured in America or Tesla being manufactured here. It makes hardly any difference in cost, because so much of automation, robotics and other things have taken place that in automobiles, the labor advantage is completely gone. Even today, in EVs, etc., many of the components, engines and others, you are in any case importing. So I don't really see any threat if you reduce the 60% tariff to 10% on automobiles. I think we need to get out of this unnecessarily overprotective mindset. It's not required any longer. Why should American almonds or apples have a higher tariffs than Afghanistan or Iranian almonds? What is the problem if we have the same tariff?
Mr. Shah wants to come in, I think. He's shaking his head. Mr. Shah?
No. The rates of, we don't have any US specific tariffs, Subhash. All our tariffs are MFN, except where we have a FTA, which is WTO compliant, and which permits us to have this reduced tariffs in respect of those countries with whom we have a free trade agreement. Otherwise, the tariffs are common across the board. So if you're going to reduce tariffs for any product which is coming in from America, it will apply across the board for all imports coming in from all countries, which is the principle of MFN, as you are more than aware. So I think auto sector specifically is a sector which, because of protection, has gotten investment into the country, and we are an export country now. Hyundai and Nissan and Volkswagen, everybody exports from India. So I think auto sector has reached maturity, Sam. It's Mr. Subhash Garg, and that perhaps you can look at some reductions.
Yeah, no, I just want to ask this quick question. We're out of time, but say, Mr. Garg, you said, say, for example, countries like Vietnam, you expect them to drop tariffs substantially. They don't need it. It is a legacy issue. But as someone is pointing out, tariffs that Vietnam imposes on the US actually are already low. But since this number, as we began this conversation by saying, is based on the total trade imbalance and not the rate, then how do you get out of this? And that has got implications for a lot of companies here, right? Because a lot of companies are saying that others are being charged at a higher tariff rate. So maybe in sectors like textile, we may not come out on top, but it's less negative in that sense. So 30-second response, Mr. Garg.
No, I think we'll need to figure out. My sense is per unit tariff has been compared, not the trade balance. Trade imbalance you can never deal with.
No, Mr. Garg, that is the whole point. They are taking they're taking the trade imbalance. So actually, I mean, I'll share later after the show. I'll share the details with you. What in the case of India, that 52% number, which has been calculated, is also basically the deficit by imports. That's how they've got to that 52% number for all countries. So essentially what the US is saying, you've got to wipe out this deficit clean. That's the only way you can get out from under this.
I think if this is the case, like we export about 85 billion and the export was about 42, and the difference is divided by the total. If that is the way it has been calculated, this is stupid. It
is stupid, but it is what is. That's what everyone is saying. That it is. It is. Now I think now we've got to the crux of the conversation. So then, how do you? If this is the way it's been. Now, by the way, it's been now confirmed, Mr. Garg. I think there is a statement which has come in, and I just want to read that to you because I think it's important. The White House has now confirmed this. They're saying the specific reciprocal tariff rate was half of the current trade imbalance. Because the president is lenient and blah, blah, blah. But then they go on to say the numbers have been calculated by the Council of Economic Advisors based on the concept that the trade deficit that we have with any country is the sum of all trade practices, the sum of all cheating. End of quote. So this is what it is. They're confirming this.
No, this I would interpret as the sum total of the tariff and non-tariff barriers, etc. That everything boils down to ultimately the deficit, which is fine. But deficit is not equivalent to the difference in the tariff.
But that is what they're saying. That is exactly how that's how they're getting to that 52 and then 26% number.
We'll need to check this. I don't think you are leading to a situation where American tariff on India or Vietnam or China for that.
I think we lost the line there, Mr. Garg, if he's going to come back. But Mr. Shah, if you want to respond to this?
No, I think I agree with what you're saying. That's how the US has worked on it. I think it's pretty. I mean, I don't know whether this will help them in any which way to bridge the gap. God bless them. But I think this is a challenge we have to encounter, we have to face, And hopefully, wider counsel will prevail as we go forward, and we'll be able to negotiate a way to a more reasonable sort of a tariff. The point being that they are going to impose tariffs on us. We have got to live with it and see how best we can help our exporters continue to remain in the US markets.
So, Mr. Shah, to sort of come to final thoughts, definitely...
By the way, Surabhi, there's breaking news. I don't know what the source is. Vietnam cuts all tariff on US goods.
There we go, what Mr. Garg was just saying.
But again, the tariffs, the point is that they want to, US is saying we want to wipe out the deficit.
Trade deficit. So even if you cut your tariff to zero, that's the point, gentlemen, that you can cut tariffs to zero. But if the deficit is still what it is, then that cutting the tariff doesn't matter. So,
So
yes,
you can
Mr.
go
Garg.
back to America to tell them that you can't be more stupid. We have done zero tariff now. You can't impose.
Now what? Yeah,
exactly.
So, which is
so this is exactly the response which I was expecting from the countries like Vietnam and others. That all right, we will charge you zero. Now export to us. Exporting to us is not our problem of importing from you. Exporting is you manufacture, export. That is the way.
So, Mr. Shah, in light of this and with this news coming in, I think the point that Mr. Garg was also making, that this could become another bargaining chip. The US trade reps could say, this country is cut down to zero, this country is cut down to 5, this country is cut down to 7. So why isn't India cutting down? You also need to cut down. That's one part. On the exact tariff number, but no matter what you cut down to, that number becomes irrelevant, right? If we're still running a trade surplus with the US will anyway not be happy. So what would your advice be to Indian negotiators who have been spending many sleepless nights and continue to do so?
We look at all the items we want to buy from US so that we can cut down our trade imbalance, because ultimately there's the only way to breach this sort of a gap. And if this is the attitude which they are going to adopt, there's no other way in which we can breach the imbalance. So look at all items we want to import from there and bargain for a good rate for that.
Obviously, they don't want to wipe the slate clean. I mean, how can that be, right? That's not possible. So the only explanation is that they somehow wanted to get to 50% or maybe very high levels to start the negotiation and then maybe bring it lower. Maybe that is the only explanation. Otherwise, how do you... There's no way out. Mr. Garg, you want to come in? Sorry.
There is another way, which is most likely to happen. If these kind of absurd tariffs stays, the American imports will simply get down, will get reduced, will get obliterated. And then you don't have the trade deficit or something. Suppose the Indians don't export to them, or Indian goods are not imported by Americans with this kind of tariffs, or Chinese goods are not imported. The deficit goes away.
So another thought, Prashant, here I'd like to leave you with. It was supposed to be reciprocal, right? So if Vietnam has cut down to zero, then you should also cut down to zero. Let's forget the trade imbalance issue, right? It was supposed to be reciprocal tariffs. You are zero, I'm zero.
They've cut tariffs on all goods. I don't know how much. And as I said, I don't know the source. So I'm asking the team to check. But I mean, at a point...
The concept of reciprocity would be equal.
Serious economists have also pointed out, of course, before this happened, that actually if, you're asking everyone in a reciprocal way to bring down tariffs, if everybody reduces tariffs to a certain level, actually it increases global trade. That is also one point of view. But doing it like this, it's like I'm not sure, but has to be opening gambit in terms of negotiation more than anything else.
I want to sort of take out the silver lining in all this. Perhaps, and gentlemen, weigh in on this. Perhaps they started with calling out this tariff war, and somewhere down the road they realized that what's more important is not tariff but overall trade imbalance, which can still be addressed. It depends on I import some from you, you import some from me, and therefore there is a trade surplus or deficit. So perhaps if that is the way the US is thinking, then that does open up room for more negotiation, for protecting, India's interests versus maybe giving in to some American, pressure points like bourbon whiskey and, like of course, the Harley Davidsons. Mr. Garg, you coming in?
I just wanted to say one more thing. See, the days of FTAs, bilateral negotiations, regional negotiations are all gone now. with this kind of thing coming in and the world becoming a one single manufacturing global entity itself, the national manufacturing, etc., and in a situation where there is a global surplus of supply of industrial goods now, the time has come to virtually do a very fresh thinking on the entire tariff structure. Maybe like domestic economies, we have abolished the duties on interstate kind of thing. Globally now, the time has come to do away with all tariffs everywhere, except a small list.
Trump was called tariff the most beautiful word in the world. So I don't know, it's going that way. Anyway, Mr. Shah, just last word, sir. You know, this uncertainty cannot linger very on, even from the US side, right? Because then how will anyone plan, invest, etc.? So it's counterintuitive, but what has been imposed in that sense, there has to be some sense of permanency here. This is it. It's high, low, whatever, this is it, and that's how you got to plan and move ahead. But there is also the part of negotiation. Do you think it'll all happen very quickly and then it gets settled, because you can't linger, it can't linger on for the next, months? Yeah.
I really hope it happens quickly, because like you rightly pointed out, this will hurt everybody. Forget the American consumer, forget the American manufacturer. We are concerned about our domestic industry, our domestic exporters. It will hurt us a lot. The exporter now will pause, will wait to see how things are panning out, because to say that President Trump is mercurial is an understatement. Things could change very rapidly and dramatically because he feels that he has got what he wanted to, and he may again, say that India is not so bad a country after all. We do not know. So I think it is. I hope it is a short-term pain which everybody has to endure. Uncertainty is not good for Indian business and industry. Our negotiators are continuing. I'm aware of the fact they're continuing the negotiation. They should continue to impress upon them that we can look at items and reduce wherever tariffs are required. This Vietnam story is very interesting. One would need to confirm that is indeed so. And like what was pointed out by your colleague, if reciprocity is what was started off with, the US ought to be reducing accordingly. And if that happens, that will give us again an entry point for us to say that, look, these are the products we're reducing. Kindly ensure that you reduce accordingly. But if they're working on the principle of trade imbalance as the reason why they have arrived at 52 and 27, then we need to again relook at how things will go forward.
Absolutely, gentlemen. And I think that's the learning this morning, that two different principles have collided in the last couple of weeks. The principle of tariff reciprocity and the principle of a trade imbalance. And I think somewhere it's all gotten muddled. Hopefully in the coming few days and weeks, sooner rather than later, we'll have more clarity on these issues. Thank you so much for weighing in on what has been a really, really chaotic and busy morning. Thanks for joining in. Well, with that, we'll slip into a very quick break. We'll continue to focus on the markets in just a bit.
India Business Hour, live every night on YouTube. With me, Shireen Bhatt.
India Business Hour, live on YouTube at CNBC TV18, weeknights at 7 p.m.
Good morning. Welcome to Trading Hour. We're coming to you live from the CNBC TV18 Motilal Oswal studio. I'm Reema Tendulkar. With me is Vivek Iyer. And the Trump tariff tantrum is hurting global markets. Indian markets are in the red, but not deeply in the red. Nifty, Sensex down close to about 1/3 of a percentage point. The Nifty is at 23,280. A minor cut of close to about 50 points. We opened much, much lower. And from there, we've managed to recover. Banks are helping. The Nifty banking index is up in the green. Pharma's higher, and barring IT, where you're seeing a big fall, the Nifty IT index has collapsed nearly 3.5%. The other sectoral indices are getting away with minor cuts. The auto metal index down about 0.5 to 0.7%. But let me straight away invite Rohit Srivastava, who has been waiting by very patiently from IndiaCharts.com to join us on the show. Rohit, thank you for joining in. Are you surprised by the market reaction? Were you anticipating a deeper cut?
Well, I was not really hoping for a deeper cut because I have been waiting for this market dip to end and for the uptrend to really resume. So I can say that I'm happy that it's not been as bad as it could have been. So it looks like a normal reaction as part of a correction to an ongoing uptrend. We saw a pretty sharp rally of 1,000 points, and we've given back quite a bit of that. Probably around 50% of that we've given back. But that puts us in a place where we can actually make one more higher low. So if you take it from the bottom of March, we first made a higher low, somewhere around mid-13th, 11th to 13th of March. And now we are probably ready to make a second higher low. And that's a sign of an ongoing uptrend. And we are probably going to be absorbing all the negative news flow that is, coming our way.
And that higher low would be at what level?
Well, so we are here right now. So the support is around 23,090. That's the 40 day exponential average. Worst case, if we do dip below that, I'll say 22,930 as our worst case support. But as of today, 23,090 seems to be holding. So keeping that in mind, we should be looking for the uptrend to resume. And probably we should head towards what I'll call the 61% retracement mark of the entire fall that we've seen from late September into early March, and that number comes to around 24,630. So we should be looking for that 61% retracement as the next level to go to once we find support here.
Right, Rohit. Good morning, Rohit. Two sectors clearly impacted. One on the positive side is pharma, and the other on the negative side actually is the auto. Which are direct impacts. Now, autos. How do you see that particular trend playing out? And as far as pharma is concerned, quite a few of the stocks have actually cooled off from the day's high. Do you feel this is the start of a new uptrend there?
So first on autos, I think it's a very much domestic sector, except for Tata Motors owning some of the foreign brands. So in that sense, why should we be impacted so much? The fear of foreign competition, I don't think is maybe also significantly discounted.
Autos as well as quite a few auto ancillaries as well. Names like Bharat Forge, Motherson, Sona.
I get that, but we still produce much cheaper, I guess. And in that sense, it's really a question about demand for the end product rather than about the price. So I don't think price will become a reason for the profits to go away. Having said that, a lot of them have seen a steep correction. So if you actually take the last 4 to 5 months, we may have discounted a lot of that already because auto sector was one of the weakest performers of the last 6-month correction. So how much more downside are we going to price into it? The next thing I'll think of from a domestic perspective, if the interest rate cycle is turning down, then these are the areas where you expect demand to come back, right? So domestic auto would be where you would expect demand to come back. But yeah, ancillaries, I get your point. But they've also seen a correction. So in that sense, is it really discounted is what you have to think about. Now, on the pharma side, while the pharma stocks do have a short-term fillip on not getting taxed, when we look at the structure, long-term we are good. But medium-term, I think, it may not be quick and easy to the new highs because, the monthly momentum is still showing weakness, whereas the weekly momentum shows us some positivity. What that really means is that you can retest the highs, but you might still be in a consolidation mode for the pharma sector from a 6-month perspective. But a 2-3 year perspective might still be good. So I think in the short term, it may do well. But 6 to 8 months, you may see it, again weaken somewhere and pick up much more only later because it's actually done pretty well last year.
What are the global macro indicators telling you? The US dollar, the bond yields, the US futures right now are pointing to a very weak start when US markets open tonight. What's the global picture telling you?
So on the global front, the US market, if we look at sentiment indicators, was already bleak ahead of this event. What happens with events like this is that all the news flow tends to end up coming beforehand, which means, number one, you already knew there were going to be tariffs. Number two, you already knew that they were going to be less than what we are putting on the US, because he said that he's going to keep it lower. So that was also anticipated. So sort of the market ends up discounting it in advance. And when the news actually comes in, it ends up being a 1 or 2 day knee-jerk reaction. This is how we've historically seen these things play out. Now, more important than the 1 or 2 day knee-jerk reaction to US equities is going to be, like you said, what happens to the dollar and what happens to bond yields. And apparently, both of them are down, even though you'd think that higher tariffs mean more inflation. Bond yields are actually off. And better still is Indian bond yields have been falling for quite some time. And if US bond yields remain suppressed, that actually helps the emerging market yields, because they're sort of correlated. And when yields are going up, then we were pressured on the upside. Now that yields are going down, it makes it easier for us to actually go into our interest rate cutting cycle, which we've already stepped into from the month of February. So that's actually a good thing for India, that interest rates or bond yields are actually heading lower. And the second one is, of course, the dollar. So if the dollar index is also entering a bear market, because it's closing now below the 20-month average, and the USD INR also has started to weaken on the daily, weekly, monthly indicators. In fact, even the quarterly indicator is in sell for the USD INR. That sort of sets a stage for a strong rupee, lower interest rates, which is very, very conducive to both foreign flows and a better, market for, in terms of demand from lower rates. So overall, I think the setup for India still remains very, very good. The macro factors are pointing positively, and that's what will end up, helping us recover in the end.
Rohit, I think we missed your view as far as crude is concerned, in case you do have a view over there. And secondly, IT stocks today have seen quite a bit of a beating. Do you feel start of a new downtrend, or it's more of a knee-jerk one-day reaction?
I think it will end up being a knee-jerk reaction, because they've already fallen with the US. And as the US goes through its knee-jerk reaction over this event, the IT sector also goes through that and then recovers with the US market. I think that is how I look at IT short term. But, medium to longer term, we can still have growth concerns, because IT sector is a defensive sector. When nothing else grows, it continues to grow at 5-6%. But when you get growth back and you have higher growth rates in other sectors, you will tend to not want to own too much IT. So in that sense, it's not the most favored sector, but surely short term, if you're still looking at it as a buyer, then we should be getting, this knee-jerk reaction should end up giving you that short-term bottom in the IT sector itself. On oil, what I would say is that it's been much more suppressed than other commodities, because, weak dollar typically means that the commodity cycle should pick up. We can see that in gold, silver, copper. Aluminium sold off, I think, on this news in the short term, but it's still higher than where it was last year. But oil prices have been suppressed, and I'm not sure we are out of the woods on oil prices yet, because the US has continued to promise, higher production. We need to certainly break past. We've gone past 70, I think around $78, $79. If we don't get past, then there could be another leg down, especially when, if at all you get the, peace in Ukraine, that could mean further supply of oil. So oil is the odd guy within commodities, which is not picking up, and you need to be open to that, potential event. For one last downside, somewhere below $70, maybe closer to 60, 55, somewhere there is where I think oil eventually bottoms. And it could, in that sense, it's also a good thing, because it keeps the pressure off, at least from the oil side, on inflation.
Thank you so much, Rohit, for joining us, giving us your view on macro, micro, as well as individual sectors as well, on a very important and a very volatile trading session like today. Well, let's now slip into a short break. Up next, we'll discuss what's buzzing in the commodity space with Manisha Gupta. Welcome back to Trading Hour. Well, let's now shift focus to the commodity space. Manisha joins in, and today we are focusing on gold.
Yes, Vivek, we are doing that because that's the only safe haven buying that you are seeing into the markets right now, because everything else is a risk aversion or a risk-off trade happen. So the gold prices have hit an all-time highs at around $3,167 an ounce. From there, you have seen some profit taking coming in. For the Indian markets as well, we are trading at an all-time highs. We've seen 91,400 come in here. With the kind of all-time high that we started Asian markets with, it's a 22nd day of record highs in 2025 till time. If you look at this year, we are up by nearly 20% now in the current calendar year. This is after 28% of gains in the previous year. So very strong going, continuing in case of gold there. Well, there is safe haven buying one. And the second thing is about US dollar index, which is trading at 2025 lows right now. There also is a probability of US recession that various economists are now putting out. That is leading to some support in gold buying as well. The street will watch out for the US non-farm payroll data. Well, that comes in on Friday, and further direction would come in from that. In the meanwhile, there's a very strong ETF buying in the global markets, and the Chinese insurance companies are buying a lot of gold via ETF as well. Almost 233,000 ounces bought in the previous week itself, and that buying has continued into this week as well. So that physical investment buying in the global markets, that in turn also is quite supportive.
Indeed, that's the big story today, the rise that we're seeing in gold prices as investors flock to risk safe havens. Thank you very much for that. We'll get into a break. On the other side, we'll discuss the impact of Trump's reciprocal tariffs with former diplomat Yamini Bhagwati.
माननीय सदस्य लोग ये कह रहे हैं कि हमारे सदस्य नहीं है यहाँ पर जो हमारे साथी हैं, लेकिन अध्यक्ष महोदय मैं ये कहना चाहता हूँ ये जो बिल लाया जा रहा है, भारतीय जनता पार्टी में एक मुकाबला चल रहा है। भारतीय जनता पार्टी के अंदर मुकाबला चल रहा है कि खराब हिंदू कौन बड़ा है। और ये बात अध्यक्ष महोदय मैं ऐसे ही नहीं कह रहा हूं। जो पार्टी ये कहती हो कि दुनिया की सबसे बड़ी पार्टी है, अध्यक्ष महोदय वो अपना राष्ट्रीय अध्यक्ष नहीं चुन पाए अभी तक। अध्यक्ष महोदय भारतीय जनता पार्टी क्या है?
जी मैं अखिलेश जी ने बहुत हंसते हंसते कहा है, इसको हंसते हंसते जवाब देना।
Well, the big global story, and we are, of course, reacting to it here in India, as is the global market at this point in time. US President Donald Trump unleashing a barrage of tariffs to match duties put on US goods by other countries. Now, a 10% baseline tariff on all imports to the US will come into effect from the 5th of April, and higher duties on some countries, which are the US's biggest trading partners, will come into effect from the 9th of April. To help us make sense of the impact and the implications of the Trump tariffs, what this means for the US, what it means for the global economy, and more importantly, what it means for India and how India should respond. Joining us now is Yamini Bhagwati, Distinguished Fellow at the Center for Social and Economic Progress. He's also the former Indian High Commissioner to the United Kingdom, the former World Bank Treasury in Washington, D.C., and the former Joint Secretary of the Department of Economic Affairs in the Ministry of Finance. Mr. Bhagwati, many, many thanks for joining us here. I know you don't do TV interviews, but you're making an exception to this morning, because it is a very important morning as we digest what's happened in the US overnight. To start with, your first reactions to the announcements that have come in from the Trump administration, and also this business of these being reciprocal tariffs, because these aren't technically, if you look at the fine print and you look at the math, it's not necessarily a reciprocal tariff in itself.
You're absolutely right. I think it's already been discussed in several quarters that they're looking at exports divided by imports and then divide that by 2 to come up with the tariff rate, which is simplistic to say the least. But let's take a step back. You know, these tariffs are a part of an overall Trump agenda. And this will have consequences in the short, in the medium, and long term around the world. And it will not just be confined to trade, it will be more widespread in terms of foreign direct investment. And then, perhaps even more importantly, strategic issues will be viewed differently. For instance, in the EU, as you know already, the EU is uncomfortable with the US attitude on the Ukraine-Russia war. But today, let us focus more on what has happened yesterday. As far as India is concerned, let's take specifics. Now, India, let's take the global. Why is Trump doing this? What is the basis? I think the US total imports are roughly $3 trillion US dollars. Total, I'm talking about goods. Total exports are about $2 trillion. This is in goods. Now, so they have an adverse balance of trade of about $1 trillion US dollars in goods. In services, the US has a surplus. It exports about $1 trillion worth of services and imports about $700 billion of services. So it has a surplus of 300. If you take both goods and services, it has an adverse balance of trade of 700 billion. Now, the problem is that on the services side, as we all know, the number of people employed is relatively low compared to manufacturing. So he's obviously carrying on with what he said during the campaign, now that he's president, to address those supporters who are very concerned about jobs lost. So that is the US. But similarly, around the world, other countries too have concerns about employment. And so if the US imposes tariffs at a level much higher than before, without getting into the specifics of each country, to that extent, manufacturing in the rest of the world gets affected negatively. Let's take specific US-India. The Indian exports to the US, lamentably, sadly, still the major component is about 12 billion of bedding and clothes, etc., etc. Another 10 billion is pharmaceutical products. And that, obviously, there must be a lot of concern on that. It's difficult for the US or anyone else, irrespective of what tariffs they put. If they are the same for Bangladesh and others who are our competitors, we may still be able to export. From the US, surprisingly, it is oils and other kinds of products which which is the highest amount, about 10 billion or so. The next one, hold your breath, is nuclear equipment. So this is an area where we are way short of our targets. So to the extent that we can, if not mollify, do something which is, to use the stock phrase, win-win for the US and India, we can do more on the nuclear front. I'll stop there because I've already spoken long enough.
Well, you know, those are important points that you bring up. So let's continue this conversation on the Indian response. Negotiations are currently underway to ink a bilateral trade agreement with the US. You know, this business of putting things on the table that could possibly mollify the US administration, the Trump administration. You spoke about nuclear equipment. We saw perhaps the moves towards opening that space up in the budget, with the government announcing that it is likely to amend the liability clause that will enable a movement towards more nuclear equipment being facilitated, or at least the import of that being facilitated into India. Oil imports up 67% from the US. That's the latest number. LNG imports, similar story. So do you believe that as India readies its response, you know, where do you believe we should draw the red lines, and what more do you believe we can offer?
Well, the first thing, you referred to the nuclear liability clause in the 2010 legislation, which was very short-sighted. I think the government has the numbers to be, it was all based on the Bhopal gas tragedy, and the people felt that we had not put in enough into our laws to be able to extract commensurate penalties from those who caused harm to our people. So I think that needs to be amended. And to that extent, the US will see that we're actually trying to do something which is of interest to them. So whether it is GE, Westinghouse, etc., you'll be surprised how much the US exports to the EU countries on the nuclear front. People don't talk about it, but it is substantial. So to that extent, I take it that they are competitive, even if we don't give them any preferential access. That said, now coming back to our bilateral front, there's too much has been made about this trade agreement that we'll sign by fall or by December and so on. There is a tremendous resistance over the decades, I've noticed, from our industry to opening up our trade sector in goods. And they are right. The US is right that we have irresponsibly high trade barriers. For instance, certain kinds of car above a certain engine size, 125% duty. We have only heard of Harley Davidson from him. Why is Indian industry so scared of competition? Or is it that they are so mollycoddled and feel so comfortable? I'm not suggesting that what Trump is doing is reasonable or right or not. But I'm talking about a spin-off benefit that if it forces our industry and manufacturing to be a little more competitive, if not hugely more competitive, it'll be good for you and me, because I'm assuming you're not an industrialist, nor am I. I'm just a consumer of products. And of course, a huge amount of the cost that we have to pay is GST, et cetera, depending on the size of the car. But if the import duties come down, to that extent, we'll be all better off for a range of manufactured products.
Yes, you're right in pointing out that neither of us are business people, and yes, the consumer will eventually benefit if we actually see lower cost imports coming in, which may force Indian industry to be far more competitive as well. But, I also want to understand from you, Ms. Bhagwati, how we should read what is happening within the region. Now, we've already started to see industry reactions coming in saying, look, while there is a cause for concern, but we should also look at the silver lining, which is that China, Vietnam, etc., have been slapped with higher tariffs in comparison to India. Now, do you believe that this kind of response at this point in time is premature? How do you believe this is going to reshape what has been happening in the region when it comes to FDI, when it comes to supply chain resilience?
Highly premature, because it's not just duties. Shireen, I'm sure you will not buy a product that you're not satisfied about just because it's a little cheaper. So in case these duties being that some manufacturing moves to India, so we need to be careful that we have the robust supply chain in place and so on, which will take time. My guess is, in the short term, I think the US and President Trump in particular have been short-sighted in imposing such huge tariffs on ASEAN, the smaller ASEAN countries. They are basically providing relatively labor-intensive products to the US. What is going to happen? Here is where I bring the strategic aspect into play. The ASEAN countries are physically closer to China. They have large volumes of trade with China, but they are strategically closer to the US because they don't want communism to overtake their countries, except for Laos, which has now effectively become a Chinese colony, and Cambodia is also hugely under Chinese influence. But even somewhat larger ASEAN countries like Malaysia, etc., Thailand, they may gravitate towards China in terms of looking for ways in which they can meet market demand in China on some preferential basis. And the Chinese, given the size of their economy, will look to provide some kind of alternative to the US. So that is more likely than India immediately replacing Vietnam or Malaysia or Thailand as a place where manufacturing will quickly shift. It could over time, as we know in the case of Apple. We are now producing Apple phones because that's also somewhat political in terms of the summit level meetings between India and the US. And I don't see that we will become a world leader in terms of a trading nation. If we had that confidence, we would have joined RCEP because we were nervous about our own capabilities, or the CPTPP. I think those are groupings that we should have a fresh look at. We don't have to do it in public view. This can be done quietly by experts within government and also pulling in non-government experts to look at the change scenario. Do we still feel that nervous about these trade blocs as compared to earlier, given the kind of attitude that the US has taken yesterday?
Well, that's an important point that you make, that perhaps one of the unintended consequences of the Trump tariffs could be a shift towards China. You know, through the pandemic, there was a move away from China. Could this move a lot of these smaller ASEAN countries and perhaps large economies as well to re-look or review their engagement with China? That's an important point that you raise as well. But, you know, coming back to FDI, because you said that there is likely to be a question mark now on what happens as far as FDI is concerned. You know, growth projections globally are being cut at this point in time, given the impact of the tariffs, expected impact of the tariffs. On FDI, do you believe that we're going to enter a phase of pause, or do you think that people are going to go ahead with their plans to set up fresh capacities, etc.? I'll also ask you this in the context of the clamor that's already started from trade associations, industry bodies in India saying, look, let's extend the PLI scheme, let's bring more sectors under the PLI scheme. The PLI schemes that were expected to sunset, those should be granted another 2-3 year extension. Your thoughts on that, Mr. Bhagwati?
You know, the PLI scheme, I have some reservations about it, but this is not the time to discuss that. Some industries and some companies have been favored. I'm not suggesting that there is any corruption involved. I mean, it is the nature of that scheme. I think we need much more than PLI schemes to kickstart or jumpstart several parts of our industry. Manufacturing is still languishing at that same percentage. You know, services keeps increasing as a percentage of our GDP every year, incrementally by 0.2, 0.3, 0.5, while manufacturing somewhere there, depending on how you count, 15, 16, 17. I mean, that is a reflection of the fact that there are serious issues here in terms of manufacturing. And whenever I talk to any major a company which has a very large, should we say, production capability in India, they tell me that our labor is untrainable. Plus, the cost of labor keeps increasing, while mechanization also keeps increasing. So take a company which was producing X units or X widgets 20 years ago. The cost of labor per person was, say, something like 20 or 30,000 rupees. And they used to produce 100 units, out of which most of them had some human input. Now the cost of that same labor, doing the same kind of job, has gone to 60, 70,000 rupees a month, while they have had the benefit of increased mechanization to bring down the workforce by 50%. Now, where are these things being discussed, and how is all this relevant to what Trump has done yesterday? These are underlying weaknesses in our manufacturing, which a PLI can barely scratch the surface of. So we need to think of how and why some of our workers, you know, we are both aware of AI and DeepSeek and ChatGPT and so on. I'm not saying that tomorrow ChatGPT will take over tire production or whatever. The problem is that things are getting increasingly sophisticated, and you know and I know about the Acer tests, you know, how class 8 students don't know as much as what they would be expected to know at class 2 and all that. So there is a short-term solution, there is a medium-term solution, there is a long-term solution. So PLI may help a little bit in the short term. it cannot help even in the medium term. Medium term and long term solutions are different, of which you have discussed a number of times with various finance secretaries and finance ministers.
So, Mr. Bhagwati, before I let you go, you talked about the intended and unintended consequences in the short, medium and long term. Let's address the short term because, we don't know what may change perhaps as early as tonight or tomorrow morning, and the possibility of that is fairly high given what we've seen through the course of the last 70 days of this administration. In the short term, in the very near term, the consequences of the measures taken by President Trump?
Number one, all investment, whether it is domestic or foreign, fresh investment, unless it is already in the pipeline and you've done 90% of the investment, you'll carry on with the 10% of the investment. All fresh investment will be put on a hold. I can just imagine, I'm on the board of one company, but I've been on boards of other companies. I know how the conversation will go. The risk management chaps will say, hang on, let us wait for the dust to settle. Let us see how things emerge. So if you are planning a 50 million or a 1,000 crore investment over the next 6 months, because all the clearances, everything is through, and you even found or located the piece of land where you will do this, my own guess is that everybody will go into a mode of go slow. Let's watch, which is not good for us. It is not good for the US. It's not good for ASEAN countries. It is not good for anyone. So business must go on. The business of business is 24 hours. That means at some place on earth, it is day and something should happen. And what Trump has done by throwing this spanner into this works of trade is also going to affect investment. I would be very, very surprised if somebody who's thinking of fresh capacity on producing some widget, which may face higher tariffs, and to that extent skew their projections of what their market would be, they'll say, hang on, should we now do it in 2 phases? We were going to produce 1,000 widgets. Let's now think of only 500. So that's the unfortunate thing, to which it means that whatever they were thinking in terms of employing labor, that will also get slowed down. And I am most concerned about underemployment in India. We can't have unemployment, because if you have unemployment, then you are dead. You're starving. So a lot of people are underemployed, and I worry that they may continue to be underemployed. So that is my worry that Mr. Trump has imposed, not just on our country, on around the world, actually.
Yes, a period of uncertainty, volatility, and as we are hearing there from Mr. Bhagwati, one of the consequences of the actions could be that there is a chilling effect as people try and digest and decode and decipher what this could mean for the global economy, what it could mean for their individual businesses, and fresh capacities perhaps may be put on hold. That could be an unintended consequence of these measures. Mr. Bhagwati, always a pleasure. Appreciate you joining us here on CNBC TV18. Thanks very much for your time this morning. We will, of course, check back in with you as details emerge from the Trump administration on how they intend to take this forward. That's the reaction there coming in from someone who has seen trade negotiations and the economic policy making from very close quarters. We are, of course, going to continue to bring you more from around the world. Stay tuned to CNBC TV18. We're tracking the markets and the Trump tariffs. Back in a moment after a break.
पार्टियां हैं, उनका राष्ट्रीय अध्यक्ष उन 5 लोगों को ही चुनना है परिवार के। हमें माननीय अध्यक्ष जी करोड़ों सदस्यों में से 12-13 करोड़ सदस्य प्रक्रिया कर चुनना है तो देर लगती है। आपके यहाँ जरा भी देर नहीं लगेगी। मैं कह देता हूं अभी 25 साल तक आप अध्यक्ष हो जाओ, नहीं बदल सकता।
अध्यक्ष महोदय, क्योंकि जो बात निकल के आई है वो मैं फिर आगे बढ़ा दूं। अध्यक्ष महोदय, जो बात सोशल मीडिया या और जगह गुपचुप हो रही है, कहीं ऐसा तो नहीं था कि अभी कुछ दिन पहले यात्रा जो हुई है वो कहीं 75 वर्ष की एक्सटेंशन वाली यात्रा तो नहीं थी?
Over 3,000 entrepreneurs, investors, and heirs have made it to the Forbes list of billionaires in 2025. That's 247 more than last year. Not only are there more of them, but they're richer than ever. The billionaires on the list are worth $16.1 trillion in total, up nearly $2 trillion over 2024. Their total net worth is more than the GDP of every country in the world besides the US and China. The US, with a record 902 billionaire citizens, continues to boast more billionaires than anywhere else on the planet.
Welcome back to Trading Hour. Well, one particular stock that's under pressure today is Bajaj Finance, and this on the back of a news development that CNBC TV18 just put out a while ago. Let's understand the development. First up, what we understand from our sources is that Bajaj Finance has received a letter from the RBI, and this is a letter of displeasure regarding the company's co-branded credit card business. RBI communication has also cited earlier communication that RBI has had with Bajaj Finance on Jan 31st, as well as Bajaj Finance's response to the RBI communication on Feb 22nd. Now, what are the key observations that RBI has cited in this particular letter? Number one, they say Bajaj Finance has not proactively identified gaps and vulnerabilities as far as the process of doing business in the credit card segment is concerned. Along with that, they say that this flagged significant risk for the customers. They also point to a reactive approach, failure to maintain adequate internal controls as far as Bajaj Finance role in the credit card business is concerned. Also, what they're saying is that they have gone ahead and countered the claim of Bajaj Finance, where they say that the company's role was only limited to customer solicitation and it was up to the banking partners to go ahead and ensure all of the other regulations were in place. RBI does not buy Bajaj Finance's story or response in that particular regard. So what are the regulatory directions that RBI has given Bajaj Finance? Number one, they need to monitor and ensure adherence to specific timelines that RBI has drawn up. Along with that, they need to seek independent validation through external audit with prior RBI approval, and also the audit must cover data security measures as well as cyber security controls. Now, very importantly, RBI has said that the company now needs to take explicit approval from the Department of Supervision of RBI if it intends to re-engage in co-branding arrangements. It is important to note that currently RBI regulations do not require a bank or an NBFC that tie up for co-branded credit cards to take explicit permission prior from the RBI. So this is something that's a little concerning. Now, let's understand the impact of this particular development. Number one, Bajaj Finance has a tie-up both with RBL Bank as well as DBS Bank as far as co-branded credit card business is concerned. But it's important to note that at the end of Q3, and something that the company has been saying for quite a while, that they have already ceased internal sourcing of co-branded credit cards, both with RBL as well as DBS Bank. So they've been scaling down on the credit card business for a while. However, they've mentioned that existing cardholders will continue to receive services from the respective banks as usual. We reached out to Bajaj Finance. Bajaj Finance has yet to respond to CNBC TV18 query, but it will be important, and this particular development, especially if Bajaj Finance has any further ambitions as far as co-branded credit cards are concerned.
Thank you very much for that. Outside of IT, Bajaj Finance is one of the top losers today, and the Nifty IT index has moved to the day's low. It's a 4% knock, and the top 5 Nifty losers are the IT heavyweights, led by Tech Mahindra, down nearly 4%. TCS, HCL Tech, Infi down close to about 3.5%. So deep gash is seen on these, frontline indices. Here's what we'll do. We will slip into a very short break. We'll come back with more on the market. Stay tuned.
516 remains second, and India with 205 still ranks third, which is 5 more billionaires than we had last year, but not a single Indian has a net worth of over $100 billion. So who's on the list? The richest man in the world is Elon Musk with a net worth of $342 billion, followed by Mark Zuckerberg with $216 billion and Jeff Bezos with a net worth of $215 billion. There are only 3 people in the world with a net worth of $200 billion. Oracle's Larry Ellison, Louis Vuitton's Bernard Arnault, and legendary investor Warren Buffett round up the top 6 in the world. There are 15 billionaires with a net worth of more than $100 billion. US President Donald Trump's net worth has doubled in the last year from $2.3 billion to more than $5 billion thanks to his social media platform Truth Social and cryptocurrency bets. Mukesh Ambani remained the richest Indian and the 18th richest man in the world with a net worth of $92.5 billion. The other Indians on the list included Gautam Adani at number 22 and Savitri Jindal at number 48. Shiv Nadar was at the 51st position with a net worth of $34.5 billion. Dilip Shangvi at number 7.
Welcome back to Trading Hour. Well, the recovery that you're seeing as far as the broader end of the markets actually continues. A certain set of stocks, especially the pharma pack, doing very well in the session. Relief of no tariffs is something that has aided the rally. So some of the generic names that have significant exposure to the US markets are the ones that are doing the best. Gland, Oro, Lupin, Cipla, all of these names amongst the top gainers. The other stock on radar is actually GMR Airports. A very interesting initiating coverage report from Citi today has ensured that this particular stock is up over 4%, and one of the key triggers has been the recent tariff regulation or an upgrade as far as tariffs are concerned for the Delhi airport. 2 stocks that are reacting negatively on the back of weak operational updates. The first one is Dabur, down 6%, and M&M Financials recovered a little bit but still down over 1%, both on the back of muted Q4 operational updates. And lastly, Naukri or InfoEdge, this particular stock a couple of hours ago was down significantly, almost 3.5%. It's recovered. This on the back of the fact that the Naukri JobsPeak index has actually declined 1.5% on a year-on-year basis and almost 9.5% on a month-on-month basis. But with that, it's all the time we have on this edition of Trading Hours. Stay tuned. Halftime report is up next.
Worth of $24.9 billion and Cyrus Poonawalla at number 86. Only 13.4% of the billionaires on the Forbes list are women. There are 2,681 male billionaires and only 406 female billionaires.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go.
Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18, now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits, and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC TV18 and CNBCTV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending
Stocks recovered after a sharp drop earlier at start as silver linings from the US tariffs emerge even as uncertainties about the future linger. Pharma and utilities are the big gainers, while IT is the big drag.
US President Donald Trump slaps hefty tariffs of up to 50% on trading partners, disrupting the world trade order. Economists expect this to dent global growth, fuel inflation, and roil markets.
Exports from India will attract a high reciprocal tariff of 27%, but less than that imposed on China, Vietnam, Indonesia, and Bangladesh. This can boost the textile, electronics, and other exports, even as drug makers cheers being excluded from the tariff ambit.
Experts are aghast at Donald Trump's method of tariff computation that ignores real tariffs and expresses trade surpluses as a percentage of exports. Some, like India, gain from this novel formula.
An RBI letter to Bajaj Finance expresses its displeasure over lapses in maintaining and managing data of co-branded credit card customers. It directs the lender to take corrective steps. Bajaj Finance is yet to respond to CNBC TV18's query.
You're with us live from the CNBC TV18 Motilal Oswal studios. You're watching Halftime Report. I'm Hormuz Patakia. With me as always is Mangalam Malu. Not as bad as feared, Mangalam, as the morning screen was indicating. You would take this with both hands.
You would. In fact, to be very honest, it was in the morning, the GIFT Nifty was indicating a Donald Trump-sized hole in the market, a 400-point downtick. But then turns out it is a Donald Duck-sized hole in the market, not a Donald Trump-sized hole. The important part is that, for whatever it's worth, the global uncertainty and all of that and stuff, we still have a significant amount, nearly 2/3, if not more, of our GDP coming in from the domestic consumption. The other part is that even among the countries that we export to, US accounts for just about 18%. And in that, a large part is export of services. And the other part is export of pharmaceuticals. So what is left is very sector-specific, very stock-specific. And in that as well, the other benefit is that the others have been taxed a little more than us, so we tend to benefit from that, and that's something that we're seeing in the textile space, for instance. And I'm sure you're going to talk a lot about that in just a bit. But the one sector, the only sector that seems to be impacted by this from a stock market standpoint is the shrimp feed sector, which is why we're seeing that big cut in Avanti Feeds and the likes itself. But today, from the market, it's clearly a tug-of-war between the IT pack and the pharmaceutical pack. The pharmaceutical pack rejoicing on being excluded from those, tariffs, and the IT stocks lower on account of fears of growth in the US itself. We'll talk about that as well. But by and large, we're down, but not out. And why do I say that? Because look at the advanced decline hormones. 1,800 stocks in the green for just about 762 stocks, which are in the red. So those lines are far and wide apart. In fact, at the furthest point, after the initial volatility that we saw, the last 2 hours, it's been like a train track.
Well, someone who had seen the early morning screen and would switch on the TV now would think that this is an error, but no, it's not. The advance decline firmly in favor of the advances. But of course, as Mangalam was mentioning, IT is one sector that is also bearing the brunt. And that is, of course, because of a sentiment impact considering the sell-off on the NASDAQ. And that is after Donald Trump's announcements of a 27% reciprocal tariffs. Now, Jeffries is saying that higher tariffs may impact demand from manufacturing, logistics and retail verticals. Rima is joining in with more on this. Rima.
Thanks so much for that. So broadly, there is no direct impact on IT with respect to tariffs, but the fear is that global growth is going to suffer, and that will hurt the Indian IT companies, especially at a time when valuations of Indian IT company are much higher than their pre-COVID level, and that table will come up for you on your screen. So for instance, in the case of TCS, the current valuations for FY26 stand at 24 times, which is higher than the pre-COVID. We're talking about FY19 valuations. When you looked at it 1 year forward, was at 22 times. And it's a similar, premium for the rest of the large cap IT pack versus their pre-COVID levels. This high valuations comes at a time when growth is struggling. So just putting out JP Morgan's estimates on what they expect IT companies to report in terms of growth in FY26. And we're talking about very low to mid-single digit kind of a revenue growth. So therefore, the question is the high valuation premium justified? The mid caps are seeing a bigger cut today. Pull up the individual stock price of a Persistent, a Coforge, KPIT, Emphasis. These are stocks which have taken the biggest knock. One reason is they've been ranked outperformers over the last 3 to 4 years on account of higher growth. So stocks have done very well. Persistent, for instance, despite the recent correction, so stock has still doubled in the last 3 years. And here, the kind of re-rating that we had seen in the PE multiples is substantial. So some of that is now being shaved off. So for instance, Coforge is trading at 36 times, Persistent is trading at 45 times. KPIT Tech is trading at 38 times. So some derating is seen. Now coming to what Jefferies is saying as they assess the impact of Trump's tariff orders. They also concur that the IT sector is not directly impacted by Trump's tariff order, but there will be an indirect impact on account of slower GDP growth worldwide. Higher tariffs may impact the manufacturing, logistics and vertical sectors. Also, the slower GDP growth in the US could result in Fed rate cuts. If the Fed cuts rates, then it could be positive for sectors, companies with exposure to communications, energy, utility, because these companies have very high debt. So if there are Fed rate cuts, then their balance sheet is, in a much, in a much more better position, and therefore maybe they will look at cutting tax rates, increasing their tech spends. So therefore they're saying that companies with exposure to manufacturing, logistics could get hit, but on the flip side, companies with exposure to communications, etc., if there is a Fed rate cut, will be positively impacted. So they've done the analysis of the kind of impact that we've seen, the revenue exposure to manufacturing and logistics, and according to the calculation, Tech Mahindra, HCL Tech in the large cap space, IKS and Sagility, these are companies most favorably placed. So for instance, IKS and Sagility get 100% of their revenues from the pharmaceutical, life science, healthcare sector, which is not been impacted as of now. Back to you.
Interesting. The top three losers on the Nifty 500 are the principal culprits that Rima was highlighting: Persistent, Coforge and KPIT Tech. Persistent down 9.25%. Coforge is down 6.5%. KPIT Tech also down 6.5% in today's trading session. So IT taking it on the chin in today's trading session. Meanwhile, the auto sector, though, has been exempt from the reciprocal tariffs, although the tariff announcements made earlier, they come into effect today. But Sudarshan is joining in now to tell us how this could have an impact on the sector. Sudarshan.
So reaction of auto stocks will tell you that today's announcement related to reciprocal tariffs was almost a non-event for the sector, because almost all the stocks are down, or some of the stocks are up in the range of 1 to 2%, while some of the stocks like Bharat Forge, Samadhana Motherson, Sona BLW are down in the range of 1 to 2%. Now the question is, because today's announcement was a status quo, but what has happened to earlier announcement? If you remember last month, President Trump had announced that 25% tariffs on the auto sector, and effective date for the same was April 3. So that 25% tariffs remain, and President has reiterated that that has come into effect from today. Now the second point is that baseline tariff. For example, on UK, baseline tariff is 10%. So does it mean that on JLR, tariff would be 10% or the 25% tariff that President Trump had announced earlier? The answer is 25% tariff, because here the auto sector is exempt. So that's the reason 25% tariff will be imposed, not the baseline tariff. Another important point about the USMCA agreement. What is the USMCA? That is the US-Mexico-Canada agreement. So some of the products that these companies supply to other companies are part of USMCA agreement. And some of those companies which are positively impacted by this are Samadhana Motherson, which form nearly 10 to 15% from Mexico and Canada. And similarly for Sona BLW. So these companies can be positively impacted if the President decides to continue the exemption under USMCA agreement. So overall, it was a status quo, but 25% tariff that was announced last month remains on the auto sector.
All right, Sudarshan, thanks a lot for that. So that's about the auto space. In fact, it remains exempt from reciprocal tariffs, but the 25% tariffs that Sudarshan spoke about imposed earlier will come into effect. Our colleague Parikshit Luthra spoke to Mercedes-Benz CEO Santosh Iyer on the likely impact and spoke about the demand pricing scenario and how business is likely to be going forward as well. So a peek into that right up for you.
The biggest impact will be for components, because there is a lot of components exports to the US. There are a lot of supplier ecosystem based out there. Also, I know many component suppliers who also have factories in the US. So they need to see how to calibrate their supply chains. And you made the right comment. This puts inflation up. This puts pricing up, not only for consumers in the US, but also with supply chains getting distorted. There may be an adverse impact on the pricing even for cars in India.
Right. So you are saying that there could be a price increase all across the world, including for the India market as well. Now, in terms of negotiations going forward, and actually before I ask you about the negotiations, the global tariff situation, and we believe that the Trump automobile tariffs are here to stay. They may not be paused immediately anytime soon. Will this, according to you, lead to more manufacturing in the US? Will car makers like Mercedes consider making more? Do you think this long-term bet would be taken?
As I said, I cannot comment on the global strategy, but in general, we even today have a plant in Tuscaloosa. We make 300,000 cars there. So technically, we have a major footprint in the US. Of course, because of the free trade, as I said, we used to sell 50% of that in the US and export the 50%, and we would import the balance 50%. But this has now, we need to take a look at it to see how to balance this. And hopefully there is maybe a better solution, between the EU and the US on their bilateral discussions.
Right. Now, in terms of negotiations between India and the United States, India and EU, what do you think would be the best way forward in terms of reducing automobile tariffs? There is one view in the government that auto tariffs are getting highlighted a lot in bilateral trade conversations, and there is a need to bring them down. The industry does not want any major tariff reductions suddenly overnight. What would be your view and the best way forward?
I get a different sense when I talk to colleagues, mostly from the component industry and even from OEMs. I think the Indian automotive industry is quite now matured enough, and it's time that these tariffs are much more open. The Indian industry can easily compete from imports from the US or from any other markets, because I think the automotive industry has one of the best cost structures in India. And I think it's not easy just because of tariff reduction now for cars to come in and compete with the Indian players. So I think the automotive ecosystem is quite matured. Overall, there should be definitely reduction. As I said, we always advocate free trade. We always advocate fair trade. I would not say zero structures, but maybe if it brings down, it also opens up Indian automotive OEMs to export even further. If you see the last fiscal, the automotive industry has recorded a growth in exports, but it is still to most of the developing markets or to the home country, wherever the OEMs are. So if India wants to participate in the global economy and export, then I think the long run, these bilateral discussions with EU and of course now with the US should help to bring down tariffs both ways. And that should overall help the economy and also drive more manufacturing.
And one more question as we let you go, Santosh. Which jurisdiction do you expect to be most impacted by these reciprocal tariff announcements? Because one, there is a tariff on the automobile sector. The reciprocal tariffs would also impact some aspects of the supply chain of the automobile industry. Which parts of the world and your markets do you expect to be the worst hit in the coming months?
See, to be honest, next 3 to 6 months, I don't think there'll be a knee-jerk reaction to move supply chains, because this is, I think, ongoing discussions, if you see, and it's impossible to shift supply chains overnight. But what generally these causes is inflation on pricing, also because of higher cost, vice versa for different markets, different products. And that gets impact, and the consumer ends up paying, which may have an impact on the demand, because when the car prices goes up, definitely the demand for sure may be impacted as well. So that's a cyclic effect. In the long run, let's assume it continues for a couple of years and there is no change in stance. Then, of course, as OEMs and as business houses, they will have to see how do we now optimize the supply chain and which is the most important market and how do we optimize. But short run, it's more inflationary driven, and actually there would be a wait and watch to see the final outcome, then already reacting to supply chains.
As these conversations continue through the day, it's time to take a short break. But before we do that, here's some good news for our viewers. And that's, of course, India's business news leader, who is now just a click away. And that is CNBC TV18's all-new app, where you get instant access to breaking news, financial world updates, and in-depth articles. All of it at your fingertips. You can download the app from the App Store or the Google Play Store, or even scan the QR code that's up on your screen. We take a short break. Back on the other side.
Unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21. Only on CNBC TV18 and CNBCTV18.com. CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhat.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
Talking about 25% permanent tariffs on steel, aluminum, and autos. And I think this has the potential to bring inflation back in a serious way in coming months. And if that's the case, I think that has the potential to really depress the consumer. And this time around, the Fed is not going to be able to come to the rescue here because it can't possibly lower interest rates when inflation is significantly above its 2% target. I think that inflation, which has been running around 2 to 3%, is about to run at 3 to 4%. I think the proposal.
A couple of stocks hitting highs of trade. BF Utilities, an interesting one, up 6% right now as we speak. We have Snowman Logistics, which continues to do well as well. Promoters been saying that they'll be buying from the open market, so we'll keep an eye out on that one. Raymond is the other one. Of course, a large part of their business now, the Raymond listed entity, is more to do with the real estate stuff. That stock is up around 9% as well. Monte Carlo is the other one too, which is moving higher. And as we speak, just as this moment, we have a lot of these FMCG stocks which have moved to the high point of trade. So pull up Britannia, that's done well. Nestle has done well. ITC itself has moved to the high point of trade. There's just one FMCG stock which is currently lurking around the lows of today's trading session, and that's Dabur. Why is that? Because the company has gone ahead and given its fourth quarter update, and it's not a very good update. They say that the FMCG volume trends continue to remain subdued in the fourth quarter. The India FMCG business is likely to decline by mid-single digits. There are three reasons why the India business is not doing well. It's delayed winter, urban slowdown, and the weakness in general trade. Remember, Dabur was the first to call out that they are doing this inventory reset in general trade, so that could be a problem for their volumes. Turns out that's sustaining. And as a result of which, their consolidated revenue will be absolutely flat. And because of the decline in revenues or no growth in revenues, operating deleverage comes in, and they are expecting margins to decline by 150 to 175 basis points. Now, where's the problem, you would say? There is a slowdown, everyone knows about it. Problem with Dabur is that over the last 3 quarters, every time post the quarter, they have given a certain guidance and they have not met it. If you look at the third quarter, they said consumer sentiment is bottomed out. Mohit Malhotra said this on the air, said we will only see improvement from here, and they aspire to grow mid to high single digit in FY26. Mid to high single digit is what they had said for H2 at the end of H1 as well. But H2, they've grown absolutely flat. 3% in the third quarter, flat in the fourth quarter. So they are missing guidance for 3 quarters in a row. So the street is not taking that well. And as a result of which, the stock is a lot lower at a time where other companies are seeing improvement in their business prospects. Dabur goes ahead and reports this update.
Possible sore spot in what has turning out to be a rather okay or a good day for a lot of these FMCG stocks. Well, 6.5% lower for Dabur in today's session after its quarterly update. But the stock that's doing well, though, among the broader markets is GMR Airports, and that's on the back of a positive note coming in from Citi, and they've initiated coverage here, a buy recommendation there, 4% higher on the stock. Vivek is here to tell us more on that. Vivek, tell us more.
Well, that's right. So like you mentioned, Citi has initiated coverage on GMR Airports. They have a buy rating on the stock, target price of 90 rupees a share. They call it an Indian airport pure play business that they like. They call it fundamentally well placed, where they see India's passenger volume growth at 8% CAGR over FY24 to FY27. Their assets actually possess comparative advantages, and with the free cash flow cycle actually turning positive, as well as regulations turning quite positive, they like GMR at this point of time. They expect GMR to turn profitable from FY26 onwards, where core earnings stand almost 5 to 6% above the street for FY26 and FY27. This is as per Citi's estimates. They also see FY27 EBITDA, or they assign a target multiple of 18 times EV to EBITDA as per their FY27 forecast. This is double to the APAC average as far as Citi is concerned, and this is, they feel, justifiable given stronger midterm structural organic as well as inorganic growth opportunities. They expect GMR to turn profitable in FY26, number one, driven by 8% tariff growth, 2.4% tariff increase in the Delhi airport, and 7.5% per annum increase in non-aero spending per passenger across Delhi, Hyderabad, as well as Goa airports that GMR operates.
All right, Vivek, thanks a lot for that. So that's about 4% higher on GMR. We'll take a short break. On the other side, we'll get Sudeep Shah to give in some trading strategies on a day where, the Nifty's down, but perhaps not out.
The risk of losing their majority in both houses of Congress next year. I think this is just a disastrous policy.
There certainly is going to be a near-term spike up in inflation, but in 12 to 18 months' time, are we going to be in that sort of still lingering at 3 to 4%? I'm doubtful, and therefore there's still, I think, scope for 2 rate cuts that we have. We've got I think near-term, the Fed are going to be hesitant. We've got a September rate cut and a December rate cut and a March 2026 rate cut.
My fellow Americans, this is Liberation Day, waiting for a long time. April 2nd, 2025 will forever be remembered as the day American index.
You're watching us here on Halftime Report, and perfect time to bring you the market setup of the day. The Nifty is down by just around 58 points. At one point was a lot lower than this, and we'll talk about that. At midday, how's the F&O setup looking? If you look at the frontline indices, the Nifty is mildly lower. The Nifty Bank is actually higher, more domestic facing, hence, protected from any sort of tariffs that are announced globally. The mid-cap index is marginally lower as well. But, the frontline index, it's nearly a tug-of-war between the IT space and the pharmaceutical space. The Nifty Pharma seeing a bit of a relief rally on account of being excluded from tariffs. The IT index down 4% on account of fears of a growth slowdown or recession in the US as well. No problems for the broader markets. We've been talking about this train-like movement that we've seen in the green and the red lines, right? After this initial bout of volatility that we saw, we have advances at 1,800 stocks, declines at around 767 itself. So lows are being protected, and we've seen some purchase itself. A couple of stocks on our radar. Good updates are being rewarded. AU Small Finance, for instance, up 3%. Dabur, we spoke about, weak business update coming in. That stock down by about 6%. So very stock-specific market as well. Today is also the weekly options expiry. So the Nifty 23,250 put fairly active. The street believes that maybe this could be an important support to watch out for. But on the way up, crossing 23,300 may be a little difficult because we've seen some writing at the 23,300 call itself. So just keep an eye out on this. Maybe a narrow band of 23,250 to 23,300. But were we to break that on the downside, there is a fair amount of support. Today's low, 23,145, comes in at the first support. Below that, we have the 23,000 mark, which is the 50-day moving average. And were we to fall below that as well, we have the 20-day moving average at 22,928. So short point, we're closer to supports than we are to supply zone for our market. Just a couple of stocks, fresh shots being built on mid-cap IT more vociferously than the large-cap IT names. And IDFC First Bank is one of the stocks in the financial space which is seeing a lot of long build-up taking place out there. So just keep an eye out on it.
Positive reaction to another business update. IDFC First Bank just came out with its update a few minutes earlier. Both advances and deposits growing over 20% on a year-on-year basis, and you can see the reaction there, 3% higher on IDFC First Bank. But a quick chart check with Sudeep Shah of SBI Securities, who's joining us on the show now. Sudeep, good afternoon. Thank you for joining in. Well, the initial gap down was very quickly bought into. Does this trend continue? What are the charts indicating on the Nifty? And would the Nifty Bank continue to lead it higher? And couple that up with your stock recommendations as well.
Good afternoon, Thomas. Yes, I feel, today's reaction by the markets is a mature reaction. Now, last several days, we have been under this uncertainty about how the tariffs would be and what the actual numbers would be and what would be its impact on the markets. But ahead of that, Nifty had already corrected by 300 to 400 points. And that is the reason I feel today from the opening lows, we have seen some decent buying. Although we have not yet managed to sustain in the green today, but overall I feel that 23,130, 23,150, which are sacrosanct to yesterday's as well as day before yesterday's lows, were quite closer to that zone. This cluster of support zone will be a very important number to watch out for, 23,130 on the downside. So till the time we are sustaining above 23,130, there is a possibility that we might consolidate between 23,130 and 23,350, 400. But the larger trend remains now buy on dips, and I feel selective spaces would offer decent opportunities. So from a Nifty level, yes, 23,130 will act as an important support. Stock specific, if we see, there are a couple of spaces apart from banking which are doing well today. Now, a case in point is defense stocks. If you see HAL, BDL, BEL, Mazgaon Dock, all have seen some decent buying, and they're not yet impacted more with the tariff thing. Another sector is cement, where we feel that Grasim could do well. So one could buy Grasim Industries with a stop loss at 2,600 on the downside and a target at 2,750 on the upside. On the weekly charts, there is a consolidation breakout, as well as it's trading above all its important moving averages and outperforming the markets since last few weeks. So 2,600 stop loss, 2,750 targets here. The second stock that is on our radar is from the defense space, which is BDL, Bharat Dynamics Limited. Here also we have seen the stock breaking out of a long consolidation post September 2024, and the breakout is with volumes. So the stop loss here would be 1310 on the downside, and the first target would be 1420, and the second target would be 1450.
What about mid-cap IT, Sudeep? Persistent, Coforge, they're falling as swiftly as they went higher. 9.5% down on Persistent, 7.5% down now on Coforge. Would you use this as a buying opportunity, or would you stay away from the sector as a whole, more so because you're heading into earnings season as well?
Perfectly put, Hamas, because we are heading into an earnings season right now, and this would be more crucial now with the tariff thing now out of the way. We've seen what impact it has had to add on the IT stocks. So what I feel is I would be a bit skeptical getting into this IT space right now, whether it is large cap, whether it is mid cap. Mid cap, by and large, till now were kind of aloof, and they were kind of protected from the downfall. But in the last few days, even these names have participated into the downfall. So I feel wait and watch would be the right approach to invest or trade into the IT stocks from a long side perspective.
And as you can see on the charts on your screen, both Persistent and Coforge are now convincingly below their 200-day moving average. Persistent more so, Coforge still hovering around those levels or just below that. The top three losers on the Nifty 500 in today's session: Persistent, Coforge and KPIT Tech. Sudeep, thank you so much for sparing time and joining us today, though, with your views on the index and on specific stocks as well. We take a short break. Up next, we discuss the impact of Donald Trump's tariff announcements with Anurag Sehgal of PwC and Agneshwar Sen of EY India. Stay tuned. We'll be right back.
Born the day America's destiny was reclaimed, and the day that we began to make America wealthy again. We're going to make it wealthy, good and wealthy. For these reasons, starting tomorrow, the United States will implement reciprocal tariffs on other nations. It's been a long time since we even thought of that. We used to think about it a lot. We didn't think about it for many decades, and you see what's happened. For nations that treat us badly, we will calculate the combined rate of all their tariffs, non-monetary barriers, and other forms of cheating. And because we are being very kind, we're kind people, very kind. but we will charge them approximately half of what they are and have been charging us. So the tariffs will be not a full reciprocal. I could have done that, yes, but it would have been tough for a lot of countries. We didn't want to do that. But such horrendous imbalances have devastated our industrial base and put our national security at risk. I don't blame these other countries at all for this calamity. I blame former presidents and past leaders who weren't doing their job. They let it happen, and they let it happen to an extent that nobody can even believe. That's why, effective at midnight, we will impose a 25% tariff on all foreign-made automobiles.
Investing.
Welcome back. Now, the US President Donald Trump has slapped hefty tariffs of up to 50% on his trading partners of the US, disrupting the world trade order. Now, exports from India will attract a reciprocal tariff of 27%, but less than what has been imposed on China, Vietnam, Indonesia, and Bangladesh. Now, this can boost textile and electronics exports, even as drug makers have cheered being excluded from the tariff ambit. We are now being joined by Anurag Sehgal, the managing director at PwC, along with Agneshwar Sen, the trade policy leader at EY India. Gentlemen, good afternoon. Thank you for joining in. I'd like to start off with you, Anurag, first up. I start off with the textile sector itself, right? All the textile companies are doing very well in today's trading session. But is the fact that the competitor countries have been taxed more than India the only differentiating advantage for this sector, or do you see some other competitive advantages as well?
Thanks for inviting. And I totally agree that, the competitive advantage in the landscape, the competition landscape, would be better for Indian exporters as compared to, say, exports from Bangladesh or Vietnam or China to the US. But this may not be the only factor. What is the other factor which may be impacting the sentiments of the industry would be the fact that India is the only country with which US is negotiating a bilateral trade agreement. So what industry realizes or what the market realizes is that one, we competitively have got a better deal, even though 27% is a quite high figure and the landed cost would increase. But competitively, we have got a better deal as compared to our direct competition in Vietnam, Bangladesh, China, and maybe other countries. But there is further possibility of mitigating this tariff impact also, because there is an active negotiation going on. And if you see the last week's press release by the government of India, they have expedited these negotiations. And a deputy USTR was in India, and post that, specifically the press release mentions that the negotiations now will take virtually so as to expedite the process. So all in all, industry realizes this sentiment that there is a possibility of mitigating this impact further. And already maybe some mitigation has happened because of India's proactive steps. India has been taking proactive steps since budget this year, liberalizing duty on Harley-Davidson, bourbon whiskey, ethanol switches, abolishing equalization levy. So maybe some proactive steps have already gone behind the lesser tariff as compared to the other countries, though we are not totally aware of the calculation matrix. And maybe the further mitigation is in offing due to G2G talks. So maybe that is also, working on the sentiments.
Right, we take that point. What about fisheries and aquaculture? If you could comment on that, how does India stack up in exporting segments out there? Anurag's given his word. What about you, Agneshwar?
Well, if I could just continue from what Anurag was saying, I look at this as an opportunity, not just in the context of the BTA that we are now discussing with the US government. We are trying to fast forward that. But along with this, there are two other developments, which are as important. One is we've also put, our the FTAs that we were negotiating with Europe and UK, they also are going to help, in creating, in the new circumstances, opportunities for India. One other issue again is the huge tariff differential, and it's really huge tariff differential that we have with our competing countries. We could also see a redrawing of the supply chains within Asia itself. As you know, we are in FTAs with literally all the countries other than China and Asia, and the impact on them could certainly, be an opportunity which we could also look at and exploit. Having said that, on fisheries, and there one will have to take a look, because the issues that US has been raising for putting up the tariffs has also been a variety of SPS and TBT issues, which came up in that in the foreign trade barriers report that they mentioned. So we will have to work hard in trying to streamline those requirements, to, if possible, do away with some of them, or at least adopt, international measures. So some more concentrated action by the government, I think, will minimize any kind of a market disruption that we will see, even in the short to medium term.
Right. Anurag, there are so many other sectors at play as well, right? The electronics components is one of them as well. Other electronics in general. But what will be the duty differential here with compared to other exporters like China? If you could shed more light on that.
Absolutely. And when we were talking about competitive tariff arbitrage, one of the important player vis-a-vis with whom India is comparing is China. Say, for example, smartphone exports. Now, smartphone exports from India, and you would agree, have increased considerably post success of the PLI. So now, major smartphone manufacturers have set up their base in India and exporting from India. Though smartphone exports will now attract 27% tariff when they're exported from India to US. But compared to that, if you consider exports from China, they will attract 34%, which will be layered on top of the 20% which was imposed earlier in the months of February and March. So 54% as compared to 27%, that is just half of what China's exports of smartphones will attract. So in smartphones and for other electronic component sectors also, there is a considerable tariff arbitrage advantage which Indian companies will enjoy. Here, one more important point to note is that while the aim of the US of bringing in these reciprocal tariffs is clearly twofold. One is to reduce the trade deficit with the countries, and second is to increase manufacturing and increase jobs in India, or manufacturing related jobs in, US. The reason is very clear. They are trying to reshore these jobs to the US. But having said that, what they have done is, whether it is electronic components or smartphones, that is smartphones components as well as smartphones, they are kept at same rate, that is 27%. So this will not incentivize manufacturing in the US. In any case, incentivizing manufacturing in US will be a long drawn process. So in that sense also, India will be benefited, and you would rather see US businesses backing India's ongoing negotiation with the US, because they would want us a reliable supply chain trade partner in the form of India to be exporting to the US market.
Right. So, what happens from now is a function of how the negotiations play out, whether this gets implemented or not. And if anything, it just opens the room up for discussion a little more. Anurag, it's a big list of exempted products that are there in the Annexure 2. Which ones do you think are important for India? That's point number one. And second one, are there any relevant items for India in the HST-US exempted list?
Yes, absolutely. If you see India's export basket, out of top 5 export items exported by India, 2 are exempted: pharmaceuticals and petroleum products. And if you see all the exempted items, then close to 20% of India's ongoing trade with the US, that is the export factor of it, is exempted. So what this does is, while other countries would want to enter into a negotiation with the US to protect their 100% export basket, India already has 20% taken care of. Now what remains is 80%, on which A lot will depend on G2G communications, which are going on in the form of BTA. And of course, a lot will also depend on how India provides avenues to the businesses to diversify in the form of, like my co-panelist was saying, in the form of other free trade agreements with Middle East, with UK, with EU.
Final word from you as well, Agneshwar. Since you mentioned the tariff exemptions on products, as Anurag was mentioning, is there any relevant items for India in the harmonized tariff schedule as well, if there's something that needs to be given attention to?
See that two things. One is I've been, of course, watching, these exemptions, pharma and petroleum products, as he mentioned very, very clearly, they are of interest. But, we have to also take into consideration some of these other statements, where they mentioned that, some of these would be looked at in a sectoral kind of a format, that is pharma, the copper, semiconductors and things like that. So I think some more transparency is required on three aspects. One is, of course, the taxation legislation, which is winding through the US system. We'll have to see what the domestic taxation regime is put in place, because that will really determine, whether they're really looking to, say, shift the supply chains from one country to another, or, to onshore it in a serious way. Given that, they're saying that they need both revenue and jobs in the US and to have the factories shift to the US, we would also have to perhaps take a look at, partnering with the US firms and firms which are setting up manufacturing there in a serious way. So, yeah, this is how to put it, the paradigms have changed pretty drastically. So we'll have to take a look at the opportunities that come in. And this could certainly be other sectors, than the ones which we are traditionally been focusing on.
All right, final word from you then. We'll just get one from PwC. Just, Anurag, on, what sectors, apart from what we've discussed so far, stand to get impacted the most? Just simple for our viewers.
So sectors which will get impacted the most would be electronics, smartphones, fishery exports, gems and jewelry, auto components were already covered, but certain other machineries. All of these sectors of India's export interest, rice, textiles and apparels, all of these sectors will be impacted considerably. And the businesses in all of these sectors will be looking at two things. One, G2G communications in the form of bilateral trade agreement. Second, what they themselves can do in the competitive landscape. How can they diversify their products? How can they make their products more cost effective? So these will be considerably affected sectors.
Follow up quickly, do you see an impact on the shrimp sector as well? Because they are also a major exporter to the US.
They are already impacted. So 27% tariff has been imposed. So India exports a lot of frozen shrimp. So this sector is clearly impacted. And this sector would also be relying a lot on the BTA, not only for tariff mitigation, but also for some other ways to incentivize their exports to the US, say in form of a mutual recognition agreement, which lowers down the non-tariff barriers. So this sector would be, eagerly looking at the bilateral trade negotiations because they are clearly affected.
They're clearly affected, and how you can see that in the stock prices as well. Avanti Feeds down 18%, Apex Frozen also down 6%. But gentlemen, both Anurag and Agneshwar, thank you so much for sparing time and joining us to decode this major announcements made by Donald Trump in the early hours of a Thursday morning. Thank you so much for joining in. We take a short break, but before that is a small programming note for our viewers. CNBC TV18 and HSBC India are back with Season 2 of the SME Champion Awards. This prestigious platform celebrates SMEs that are pushing boundaries, making an impact and shaping the future. Nominations are now open. You can scan the QR code now and submit your entry for the SME Champion Awards Season 2.
Baton of power set to shift, Bharat's youth will drive the next wave of change. The biggest leaders and policymakers, global trendsetters, business icons, and entrepreneurs will come together to inspire the next generation of change makers. Don't miss your chance to witness it all live. Rising Bharat Summit 2025.
Not a full reciprocal. I could have done that, yes, but it would have been tough for a lot of countries. We didn't want to do that. So if you look at that, China, first row, China, 67%. That's tariffs charged to the USA, including currency manipulation and trade barriers. And so we're going to be charging a discounted reciprocal tariff of 34%. I think, in other words, they charge us, we charge them less. So how can anybody be upset? They will be, because we never charge anybody anything, but now we're going to charge. You know, you think of European Union, very friendly. They rip us off. It's so sad to see. It's so pathetic. 39%, we're going to charge them 20%, so we're charging them essentially half. Countries like Canada, you know, we subsidize a lot of countries and keep them going and keep them in business. In the case of Mexico, it's $300 billion a year. In the case of Canada, it's close to $200 billion a year. And I say, why are we doing this? Why are we doing this? I mean, at what point do we say, you got to work for yourselves and you got to, this is why we have the big deficits. This is why we have that amount of debt that's been placed.
Look at Power Grid. That stock's moved higher. So we have a couple of these stocks which are doing well. Again, a domestic play here, moved to the high point of trade, recovered about 4% from lows. In fact, it's not alone. We have NTPC as well, which has done well. So that's moved higher too. So we have about a couple of power-related stocks which are doing well. And then you have some others as well. Ramco Cements is doing well. Astral is moving higher. Prestige Estates continues to recover from lows. HFCL, the latest F&O entrant as well, has moved higher too. But is the financial space which is doing well in today's trading session. In that, an underperformer is Bajaj Finance, because we learned from sources that the RBI has sent a letter of displeasure to the company on its co-branded credit cards. Vivek joins in with the exclusive details. Vivek.
Well, that's right. So what we understand is that, RBI has sent a letter of displeasure to Bajaj Finance on co-branded credit card business. The RBI communication cites earlier letter dated both Jan 31st as well as Bajaj Finance's response dated February 22nd. What are the key observations of the letter? The RBI letter says that the company proactively has not identified any gaps or vulnerabilities. They flagged significant risk to customers. There are also communication that is pointing to reactive approach, failure to maintain adequate internal controls. The RBI letter also has gone ahead and contested Bajaj Finance's claim that his role was simply related to customer solicitation. They say that Bajaj Finance has an integral role in co-branding arrangement and also has access to sensitive customer data. RBI letter also argues that Bajaj Finance cannot absolve itself of responsibility to partner banks as well as customers. What are the key RBI directives? Number one, the Bajaj Finance now needs to monitor as well as ensure adherence to timelines. Company must also seek independent validation through external audit along with prior RBI approval. The audit also must cover data security measures as well as IT and cyber security related controls. Now, very importantly, RBI has clearly directed Bajaj Finance, saying that it now needs to obtain explicit approvals from the Department of Supervision of RBI if it intends to re-engage in co-branded arrangements. Now, what is important to note is that the current RBI rules does not explicitly need any NBFC and bank to take permission from the RBI before going into an agreement. So again, this is something that is a bit of a concern for Bajaj Finance. We reached out to Bajaj Finance. They've not yet responded to our queries to understand the impact. Remember, they have co-branded agreements both with RBL Bank as well as DBS Bank. The company said that it will cease incremental sourcing of co-branded credit cards with RBL Bank as well as DBS Bank. Important development, stock at the day's low.
Stock at the day's low, almost 2% lower now is Bajaj Finance, cooling off from the record highs that it had made in the month of March. What is also at the day's low now is Persistent Systems, and Midcap IT continues to get hammered in today's session. 10% lower now on Persistent Systems, continues to remain the top loser on the Nifty 500. Coforge is now down 7.5%. KPIT Tech also down 7.5%. What's also at the lowest point of the day though is Navin Fluorine. and that stock is now down 7% as we speak. Among the chemical names that have seen an impact in today's session, Navin Fluorine, one of them, and SRF continuing to maintain losses of around 4%. We take a short break. On the other side, Manisha Gupta joins in with Shaunak Parikh, the Vice Chairman of the Gems and Jewellery Export Promotion Council. Stay tuned.
Over the last number of years, and we're really not taking it anymore. April 2nd, 2025 will forever be remembered as the day American industry was reborn, the day America's destiny was reclaimed. Very tough, very tough. The Prime Minister just left, and he's a great friend of mine, but I said, you're a friend of mine, but you're not treating us right. They charge us 52%. You have to understand, we charge them almost nothing for years and years and decades, and it was only 7 years ago when I came in, we started with China charged them. We took in hundreds of billions of dollars from China in tariffs, and they understood, honestly. President Xi understood. He said, look, I understand, and the other countries, and they all understand. We're going to have to go through a little tough love, maybe, but they all understand. They're ripping us off, and they understood it. Prime Minister of Japan, Shinzo Abe. He was a fantastic man. He was unfortunately taken from us, assassination. But I went to him and I said, Shinzo, we have to do something. A trade is not fair. And he said, I know that. And he was a great gentleman. He was a fantastic man. But
welcome back, and joining us now on the show is Shaunak Parikh. He's Vice Chairman, DJPC. Mr. Parikh, hi, thank you for joining in. And a lot of problems right now and a lot of confusion right now as well as far as we read those numbers. First of all, would want to understand if you as DJPC understand if 27% is going to be the total tariffs or 27% plus the existing tariffs.
Hi, Manisha. Thanks for having me. Yes, there is some amount of confusion as we speak. The team is actually looking at the fine print, trying to really understand what it is. There is no 100% clarity yet. I think soon we will have whether this is addition to the existing tariff or is it flat 26. So I think in some time we'll have that clarity.
Mr. Parikh, the other thing is that the last couple of years, Indian jewelry exports to US have been slightly on a weaker side. And in addition to these tariffs now, where does the industry see itself?
So we believe there will be short term, there will be some impact with all the tariffs. But we are very confident that the Indian government and the US government will work out a bilateral trade agreement, which is in the process. And once that is negotiated and signed, we believe I think it will be normal days. But it will take some time to land.
Mr. Parikh, also when we look at the overall numbers, would India be then looking at countries apart from US as well? Where do you see better growth coming in? And even putting that question aside for a second, if you look at the other jewelry makers like Turkey or Egypt for that matter, Singapore for that matter, these countries have much lower tariffs at 10% or thereabouts. Would India lose out to these other manufacturers then?
So two things, Manisha. One, yes, there's anyways a continuous efforts from the council and the trade to continuously grow other countries around the world. The likes of Latin America. There are Far East countries. So we are continuing. Our efforts have been there to continuously grow that business. Secondly, in terms of competition from other countries, as you mentioned, India has a certain advantage in terms of skill set, in terms of manufacturing, and the other countries, they have their own strength. Having said that, we are again hoping that the negotiation will get sorted and time will come back to normal. If it doesn't come, there is a possibility of business moving to other low tariff countries. But we are hoping that that won't happen.
Oh, well, absolutely, Mr. Parekh, because a UAE and a Singapore and a Turkey have 10%, while India is 27%. And as you said, it's not very sure whether it's 27% plus the current or not. Do you see a lot of Indian businesses then moving out to these better competitively placed countries?
Long term, if it doesn't get sorted, that is, yes, a possibility.
Mr. Parekh, by how soon do you see a clarity coming in on this? Because at this point in time, the markets really seem to be working with both these numbers, whether it is 5% plus 27 or is it overall 27. By when do you see this clarity really coming through?
Well, that should come, I think, we are hoping before the end of the day or at the most, I think, another day or so. So we are already working with the legal team to look at the fine print.
As you mentioned about the bilateral trade that both the countries are talking about, and we do understand these are high-level conversations already on, what is it that the jewelry industry, or as DJPC put its recommendations as?
So we have already proposed to the government to lower some of the tariffs that we have to import, for example, jewelry, loose diamonds from the US, and bringing it, so overall bringing it in line with the duty that we have compared to the US. And by largely, we agree, and the government kind of agrees with the thought process. And hence we are very, very hopeful that as far as gem and jewelry is concerned, we should be able to have a fair trade on both the sides.
Mr. Parekh, what is the trade volumes right now with the US vis-a-vis other countries? And does US continue to be the largest destination for Indian jewelry exports now?
It is one of the amongst the largest destination, yes, with roughly about 10 billion going to the US.
And how much would that come to in sense of percentage terms? Is it like half your market?
So again, depending on the category, like loose diamonds would be roughly 35%, jewelry would be 50%. So again, each category kind of differs.
But in overall scheme of things, would you say it's 50% or more?
No, it would be roughly about 35-40% of the business to US.
So that means that with the kind of tariffs that are coming in would be a big hit if that doesn't get sorted, would you say, Mr. Parekh?
It will be, as I said, big at short term, but long term we should be able to resolve it. That's what the hope is. Yes.
My final question, Mr. Parekh, a lot of sectors are talking about maybe the supply chain, the route of business will change. Do you see that happen with US as well, with India and US?
It can happen. I think the way things are going on, it can change the supply chain. Having said that, this can also open up opportunities for India as a country, because also a lot of the other manufacturing countries have higher tariffs than India. So we could possibly even be at an advantage at some point of time.
Fair point that, Mr. Parekh. Thank you so much for joining in with the sense. And as you said, the next 24 hours are going to be important as we get more clarity on those final numbers there. But thank you so much for joining in with your sense. And with that, it's a wrap on Halftime Report. Business Lunch Take calls the action ahead.
Immediately what I was talking about, I said, Shinzo, we have to do something. He said, I know that. and we worked out a deal, and it would have been a much better deal, but frankly, there were many years left on the deal that was made previous to my getting there, but it was something.
Stocks recover after a sharp drop at start as silver linings from US tariffs emerge even as uncertainties about future linger. Pharma and utilities are the big gainers while IT is a big drag. US President Donald Trump slaps hefty tariffs of up to 50% on trading partners, disrupting the world trade order. Economists expect this to dent the global growth, fuel inflation, and roil the markets. Exports from India will attract a high reciprocal tariff of 27%, but less than imposed on China, Vietnam, Indonesia, and Bangladesh. This can boost textile and electronic exports, even as drug makers cheer being excluded from tariff ambit. India government in a huddle post Trump's reciprocal tariff announcement. Sources say meeting is underway to discuss the impact and assess India's strategy. The government is not in favor of any knee-jerk reaction. Experts are aghast at Donald Trump's method of tariff computation that ignores real tariffs and expenses trade surpluses as a percentage of exports. Some, like India, gain from the novel formula. An RBI letter to Bajaj Finance expresses its displeasure over lapses in maintaining and managing data of co-branded credit card customers. It directs lenders to take corrective steps. Bajaj Finance is yet to respond to CNBC TV18's query. Hello, good afternoon. You've tuned into CNBC TV18, watching Business Lunch with me, Vinny Motiwala, coming live from the CNBC TV18 Motilal Oswal studios. Thank you so much, as always, for tuning in. While obviously we did see a bit of a red start coming in for the Indian markets, a sharper red start, now we've started seeing that recovery coming in. And as of now, 23,200 levels is what the Nifty has managed to hold on to, post the 10 o'clock time period that we're seeing coming in. So, people were understanding what actually happened on the Trump tariff front, who would be benefiting, who would see a bit of a negative impact. Mid caps, that's an interesting one. While it went up in the green, it came down again, but recovered from the day's lowest point. So as of now, it's down 0.4%. Small cap managing to hold on to some bit of that flip-flop between the red and the green, but not much of a sharper decline that we're seeing coming in for the Nifty small cap. Banks, that's seen a sharp recovery in today's trading session. From the red, it's moved to the green, managing to hold on to that. And at the day's highest point, even as of now, 51,470 2020 levels is what the Nifty Bank is at. Top sectoral gainer today, the one that opened with a bang, was Nifty Pharma, because the pharma play was exempted from those Trump tariffs and they were cheering that. So Nifty Pharma opened up with gains of almost 4 or 5% in today's trading session, now holding on to gains of 2.3%. So that's also settling down. PSU Banks is another one that saw good recovery coming in today's trading session, up almost 1%. Now the big drag today was the Nifty IT that felt a bit of a brunt coming in down, and as of now trading at the day's lowest point. Nifty IT is down 4.3%. So surely keep an eye out on that and where that is going to be headed. A lot of other stocks, individual stocks, are moving on the back of these Trump tariff issues, but we'll take you all through that a bit later. But first, let's go across to what's actually coming on that front. Now, US President Donald Trump had announced his tariff strategy last night. A baseline tariff of 10% on all countries will be effective from the 5th of April, while the discounted reciprocal tariff will come into effect from 9th of April. President Trump also said that the US will charge an import duty of 27% on India and 34% on China. A 25% tariff is being announced on automobile imports and auto parts, while the previously worried pharma sector that remained exempted from now, bringing in some sigh of relief in terms of the move that we saw. For truck makers also, we saw a bit of a move coming in, but let's listen in to his comments and what he had to say.
For these reasons, starting tomorrow, the United States will implement reciprocal tariffs on other nations. It's been a long time since we even thought of that. We used to think about it a lot. We didn't think about it for many decades, and you see what's happened. For nations that treat us badly, we will calculate the combined rate of all their tariffs, non-monetary barriers, and other forms of cheating. And because we are being very kind, we're kind people, very kind. But we will charge them approximately half of what they are and have been charging us. So the tariffs will be not a full reciprocal. I could have done that, yes, but it would have been tough for a lot of countries who didn't want to do that. So if you look at that, China, first row, China, 67%. That's tariffs charged to the USA, including currency manipulation and trade barriers. And so we're going to be charging a discounted reciprocal tariff of 34%. I think, in other words, they charge us, we charge them less. So how can anybody be upset? They will be, because we never charge anybody anything, but now we're going to charge. You know, you think of European Union, very friendly. They rip us off. It's so sad to see. It's so pathetic. 39%, we're going to charge them 20%, so we're charging them essentially half.
Okay, the likely effects of this reciprocal tariffs could begin a trade war or a rearrangement in the global trading mechanism. But how does it play out domestically in the US? We have CNBC's Steve Leisman, who's joining in with us, and to help us understand the tariff effect on the US economy.
I think it's worse. I don't know what the average tariff is. Maybe we could just pull up. I asked him to make a board on Canada, the EU, Mexico, and China. Those are the principal sources of our imports. So that's the stuff that matters. I think it's over 20%, if I'm not mistaken. So a good chunk of all of our imports will have a tariff over 20%, I believe. And by the way, yeah, you see that big one on China, which I think is actually 54 because it's 34, I believe, plus 20. In any event, people modeled in 20%, and they were detracting from GDP. They were adding to the CPI. This just seems like the president having his own sort of school of economics that's different from everybody else. And he said that the economists were all wrong, but in fact, they would insist they were absolutely right. Here's a comment from the Cato Institute, which, as you know, is very conservative. They said, quote, "These so-called reciprocal tariffs don't mirror foreign trade barriers and ignore those imposed by the United States. For all of President Trump's talk of a new golden age, this huge tax increase will inevitably result in higher prices for American families, lower growth and business investment, and diminished exports and manufacturing output. So it is not a good forecast or a good look from the economists and the forecasters. And as you can see from Wall Street on these tariffs here, the president believes this will lead to a golden age of growth and increase in manufacturing. Economists believe it will lead to lower growth and higher inflation, and really puts the Fed in a pickle here. You can see that there was something of a bump, however, in the probabilities of Fed rate cuts, and I think that comes from a view of greater economic weakness, and they believe that it will be so great, I think, that the Fed will be forced to ignore the surge in inflation. There are the probabilities a touch higher than they have been. That December number for the third cut had been as low as 60, even 50%. But now that he's very serious about these tariffs, you have the market saying, hey, the Fed's going to cut 3 times because I believe not that inflation is going to be low, but that the economy is going to be that bad.
Thank you so much for that. Now let's move on. The U.S. trading partner countries reacted to the tariff announcement and vowed swift retribution. Now here is what the world leaders and top government officials had to say on the announcements.
President Trump's announcement of universal tariffs on the whole world, including the European Union, is a major blow to the world economy. I deeply regret this choice. Let's be clear-eyed about the immense consequences. The global economy will massively suffer. Uncertainty will spiral and trigger the rise of further protectionism. The tariffs will also hurt consumers around the world. It will be felt immediately. Millions of citizens will face higher grocery bills. Medication will cost more, as well as transportation. Inflation will go up. And this is hurting in particular the most vulnerable citizens.
We're in a situation where there is going to be an impact on the U.S. economy, which will build with time. In our judgment, it will be negative on the U.S. economy. That will have an impact on us. But the series of measures will directly affect millions of Canadians. We are going to fight these tariffs with countermeasures. We are going to protect our workers, and we are going to build the strongest economy in the G7. In a crisis, it's important to come together, and it's essential to act with purpose and with force, and that's what we will do.
Following this announcement, we have once again conveyed to the U.S. government that the recent measures are extremely regrettable and have strongly requested that they be reconsidered. We believe that the recent measures and other broad trade restrictions imposed by the U.S. government could have a significant impact on economic relations between Japan and the U.S., and ultimately on the global economy and the multilateral trading system as a whole.
The unilateral action that the Trump administration has taken today against every nation in the world does not come as a surprise. For Australia, these tariffs are not unexpected, but let me be clear, they are totally unwarranted. President Trump referred to reciprocal tariffs. A reciprocal tariff would be 0, not 10%. The administration's tariffs have no basis in logic, and they go against the basis of our two nations partnership. This is not the act of a friend. Today's decision will add to uncertainty in the global economy, and it will push up costs for American households. This is why our government will not be seeking to impose reciprocal tariffs.
Okay, on that note, it's time for a very short break. But after the break, we'll get you more updates on Trump tariffs plans and its impact on India's various sectors. Welcome back to Business Lunch on CNBC TV18. Now, let's move on and talk a bit more in terms of the Trump tariffs. US President Donald Trump announced that long-awaited Liberation Day reciprocal tariffs, and global markets shifted into a risk-off mode. Hormaz is able to take us through what Trump has announced and the impact on India and various sectors as well. Hormaz.
Far-reaching effects of Donald Trump's tariff announcements. We'll start off with the broader announcements first. The 10% base tariff line that has been imposed by the US president, that will be applicable from Saturday midnight, and additional duties on 60 countries that also includes India, China, Vietnam. But of course, interestingly, Canada and Mexico, which were the first countries where Trump had imposed tariffs after taking office, they have been exempt from any further reciprocal tariffs as well. Now, when do these take effect? As I said, the 10% that takes effect midnight Saturday, and the additional duties, they take effect on 12:01 a.m. on the 9th of April. Now, when it comes to the Indian context, 27% reciprocal tariffs. Of course, there was some back and forth between 26 and 27. It's a 27% reciprocal tariff that has been imposed. And Donald Trump also mentioned that Prime Minister Modi is a great friend, but he told him that India does not treat the US right when it comes to trade, and hence they are imposing these reciprocal tariffs. And as a result of which the global market shifted into risk-off mode. The Nasdaq futures fell very sharply. The risks of US recession have risen, and as a result of which IT stocks in today's trading session are taking it on the chin, particularly the mid-cap IT names, be it the likes of Persistent Systems, Coforge, KPIT Technologies, all of them seeing losses of anywhere between 8 to 10% in today's session. A winner that has emerged from this is pharma, because pharma as a sector has been exempt from tariffs as of now, because there will be investigations that will be held on the pharma sector and semiconductors as well. And if there is a conclusion that is arrived on, there may be a tariff imposition in a future date, which is not clear, of course. But for now, pharma is a definite winner in today's trading session. The Nifty Pharma up 2.5%. And another potential winner, though, are the apparel and export manufacturers. And look at Gokaldas Exports, Arvind, Raymond, all of them seeing good gains, not because they've been exempt from tariffs, but that's because other competitive countries, be it Vietnam, be it China, they've been taxed more in comparison to India, and that gives India a competitive advantage, and as a result of which you can see the impact on these names. We even in fact spoke to the management of Arvind earlier in the day, and they mentioned that they are now looking forward to the bilateral trade agreements. They're expecting such with countries like the US and the UK as well, and this will make it more exciting for the Indian textile industry, and going forward they are looking at a holistic approach for the Western market. So some winners, some losers, but for now the markets in India in particular have been fairly resilient to these tariff announcements.
Absolutely, Hormaz. Thank you so much for rounding that up so well for us. But now let's get to some reactions also coming in. And first, from the government side, we have the Ministry of State and for Finance, Pankaj Chaudhary. He says that India will revive from the reciprocal tariffs imposed by President Trump last night. Listen in.
देखिए यूएस का काम है, उनका अमेरिका फर्स्ट है ट्रम्प साहब का, तो मोदी जी के लिए इंडिया फर्स्ट है. अब उसकी हम लोग समीक्षा करेंगे, फिर क्या उसका असर पड़ेगा, कैसे उससे निपटना देखा जाएगा.
We also got in touch with former Joint Secretary of Economic Affairs, Gemini Bhagwati, former Finance Secretary, also SS Garg, and former CBEC Chairman Najib Shah to understand how Indian industry could cope with the impact of Trump's tariffs. Listen into what they had to say.
The ASEAN countries are physically closer to China. They have large volumes of trade with China, but they are strategically closer to the US. Larger ASEAN countries like Malaysia, etc., Thailand, they may gravitate towards China in terms of looking for ways in which they can meet market demand in China on some preferential basis. And the Chinese, given the size of their economy, will look to provide some kind of alternative to the US. So that is more likely than India immediately replacing Vietnam or Malaysia or Thailand as a place where manufacturing will quickly shift. I don't see that we will become a world leader in terms of a trading nation.
In automobiles 20 years, 30 years back, we perhaps needed some protection. But today, compare the prices of a Tesla being manufactured in America or Tesla being manufactured here. It makes hardly any difference in cost, because so much of automation, robotics and other things have taken place that in automobiles, the labor advantage is completely gone. Even today, in EVs, etc., many of the components, engines, and others, you are in any case importing. So I don't really see any threat if you reduce the 60% tariff to 10% on automobiles. I think we need to get out of this unnecessarily overprotective mindset.
I think we need to focus on specific commodities where we believe we need to export and not lose our export share. So which means if, for instance, take for instance engineering goods and engineering products, if we believe that that is a market we don't want to lose, we should, if necessary, reduce the tariffs on that specific commodity. Go tariff by tariff, commodity by commodity, rather than look at an overall reduction, because I don't believe that we should violate our MFN principle. We should ensure that whatever we agree to reduce for US is applicable to imports for all countries and negotiate accordingly with the US. That's the only way I think we should go forward, and our exporters need to brace up for challenges.
Earlier, we spoke to Ed Yardeni, president at Yardeni Research, and James Knightley of ING to understand the impact of Trump's reciprocal tariff. Listen in to what they had to say.
Talking about 25% permanent tariffs on steel, aluminum, and autos. And I think this has the potential to bring inflation back in a serious way in coming months. And if that's the case, I think that has the potential to really depress the consumer. And this time around, the Fed is not going to be able to come to the rescue here because it can't possibly lower interest rates when inflation is significantly above its 2% target. I think that inflation, which has been running around 2 to 3%, is about to run at 3 to 4%. I think the Republicans are running the risk of losing their majority in both houses of Congress next year. I think this is just a disastrous policy.
What we've got is it's basically looking at the ratio of exports to the US divided by the trade balance. And if you run through that and look at all the countries, that is exactly what they've done. These aren't a scientific calculation of all the trade tariffs and all the barriers at all. It's seemingly somewhat of a fabricated number. So I think that there could be some reasonable scope for some renegotiations here, as a lot of countries make the point that these numbers do not match up with reality.
Earlier, we also spoke to Sandeep Bhatia, Managing Director and Head of Equity India at Macquarie Capital, and he had highlighted on this front as well that Trump administration was not immune to internal politics pressure as well. Listen in to what he had to say.
The Trump administration not immune to domestic internal US political pressures and requirements, and the pharma business is definitely integrated into the entire medical healthcare system in the US. So we remain positive on pharma. We like Sun Pharma. And this is, I think, an indication of what should be taken as a broader message, is that the tariffs that have just been announced are opening move, and there could be negotiations. India is already in bilateral trade agreement negotiations, and we could see changes in the tariffs for India and even for some other countries.
We also spoke to Nilesh Shah, Managing Director at Kotak Mahindra AMC, and Neelkanth Mishra of Axis Capital, who gave their reactions to Trump tariff orders as well. Listen in.
President Trump has proven Sant Tulsidas correct. Sant Tulsidas wrote centuries ago, Samrat ko nahi dos kosai. And President Trump is proving that for weaker nations, WTO is there. For stronger nations, WTO doesn't matter. In fact, he has historically coined new definition of import duty, which is your trade surplus with US divided by your exports to US. That is called import duty. I'm sure we are going to see one Ivy League case study on this new definition. President Trump has not finished. He will continue to make announcements. And it is up to India as to how we leverage this.
The $700 billion odd of extra revenue that on an annualized level the US will start now to collect is about 0.6% of global GDP. So this is effectively fiscal tightening for the world.
Okay, on that note, we're going to slip into a very short break and we'll come back with more news and updates after this break.
माननीय सदस्य लोग ये कह रहे हैं कि हमारे सदस्य नहीं है यहाँ पर जो हमारे साथी हैं, लेकिन अध्यक्ष महोदय मैं ये कहना चाहता हूँ ये जो बिल लाया जा रहा है, भारतीय जनता पार्टी में एक मुकाबला चल रहा है। भारतीय जनता पार्टी के अंदर मुकाबला चल रहा है कि खराब हिंदू कौन बड़ा है। और ये बात अध्यक्ष महोदय मैं ऐसे ही नहीं कह रहा हूं।
Welcome back to Business Lunch on CNBC TV18. A quick look at what the market is doing as of now, holding on to that 0.3% of decline that we've seen recovered from the day's lowest point is what the Nifty is doing. Let's pull up some of these names that are coming in. We have Vardhaman Textile from the textile side. So Vardhaman Textile, KPR Mills, Trident Limited, all of these from the textile side are managing to hold on to very, very strong gains. So that is something interesting to watch out for. Other than that, obviously, we have Bharat Dynamics that's buzzing in trade today as well, holding on to gains of almost more than 5%. So interesting to watch out for that. AU Small Finance Bank in terms of the update that came in from the company. So keep an eye out on that front as well in terms of the update for Q4. As of now, stock holding on to gains of 3.8%. But with that, we'll wind down this edition of Business Lunch on CNBC TV18. Thank you so much for tuning in. Up next, your Mid-Cap Radar.
With the baton of power set to shift, Bharat's youth will drive the next wave of change. The biggest leaders and policymakers, global trendsetters, business icons, and entrepreneurs will come together to inspire the next generation of change makers. Don't miss your chance to witness it all live. Rising Bharat Summit 2025.
जो पार्टी ये कहती हो कि दुनिया की सबसे बड़ी पार्टी है, अध्यक्ष महोदय वो अपना राष्ट्रीय अध्यक्ष नहीं चुन पाए अभी तक। अध्यक्ष महोदय भारतीय जनता पार्टी क्या है?
जी मैं अखिलेश जी ने बहुत हंसते हंसते कहा है, इसको हंसते हंसते जवाब देना। इस सामने जितनी पार्टियां हैं उनका राष्ट्रीय अध्यक्ष उन 5 लोगों को ही चुनना है परिवार के। हमें माननीय अध्यक्ष जी करोड़ों सदस्यों में से 12-13 करोड़ सदस्य प्रक्रिया कर कर चुनना है तो देर लगती है, आपके यहाँ जरा भी देर नहीं लगेगी। मैं कह देता हूं अभी 25 साल तक आप अध्यक्ष हो जाओ, नहीं बदल सकता।
अध्यक्ष महोदय, क्योंकि जो बात निकल के आई है वो मैं फिर आगे बढ़ा दूं। अध्यक्ष महोदय, जो बात सोशल मीडिया या और जगह गुपचुप हो रही है, कहीं ऐसा तो नहीं था कि अभी कुछ दिन पहले यात्रा जो हुई है वो कहीं 75 वर्ष की एक्सटेंशन वाली यात्रा तो नहीं थी?
Over 3,000 entrepreneurs, investors, and heirs have made it to the Forbes list of billionaires in 2025. That's 247 more than last year. Not only are there more of them, but they're richer than ever. The billionaires on the list are worth $16.1 trillion in total, up nearly $2 trillion over 2024. Their total net worth is more than the GDP of every country in the world besides the US and China. The US, with a record 902 billionaire citizens, continues to boast more billionaires than anywhere else on the planet. China, with 516, remains second, and India, with 205, still ranks third, which is 5 more billionaires than we had last year, but not a single Indian has a net worth of over $100 billion. So who's on the list? The richest man in the world is Elon Musk, with a net worth of
It's red on the screen, but the bulls will be happy that the shade of red is not as deep as what Vamakshi is wearing right now. But you're watching Midcap Radar live from the CNBC TV18 Motilal Oswal studios. I am Hormuz Fatakia and Vamakshi, good afternoon. The bulls will be fairly happy to see the screen right now, considering it's also the weekly expiry today.
Well, absolutely, Hormuz, lower, but we're still quite resistant today, especially, the mid-cap and the small-cap end of the market. It has not fallen as much, so that bodes well. But, there's a lot lined up on the show for you. So let's get started with some of the top headlines. Stocks recover after a sharp drop at start as silver linings from the US tariffs emerge, even as uncertainties about the future linger. Pharma and healthcare are the big gainers. IT and auto drag. Mid-caps fall in line.
GMR Airports has surged after Citi initiates coverage with a buy recommendation and a 90 rupee price target, saying that the company is fundamentally well placed as they anticipate India's passenger volume growth to increase.
AU Small Finance Bank gains after their fourth quarter business update shows that the company has achieved its growth guidance for FY25. Poonawalla FinCorp sees assets under management rise over 40% year-on-year. Stock gains over 3%.
Dabur's corrected over 6% following a weak fourth quarter business update. The company is expecting FMCG volumes to remain subdued along with flat revenue growth.
IT is the top sectoral loser as Trump's tariff announcements raise concerns around growth and bring up fears of a recession in the United States. Names like Persistent, Coforge and Emphasis lose between 4 to 9%.
It is a very ugly looking screen. If you look at the mid-cap IT names, all of them getting badgered in today's trading session. But for the benchmark indices, it's good going, particularly so because if you were expecting a 400-point gap down at the start of programming this morning, you would take a 63-point downtick with both hands. 23,250 is the level that the Nifty is holding on to currently. Similar story for the broader markets as well. It is a lot of stock and sector-specific activity that's taking place. The mid-cap index almost into the green now, another 70 points lower there as well. The small cap index is already in the green, and Vivek is now joining in to take us through the broader market movers this afternoon that are contributing to this positive advance decline. Vivek, good afternoon.
Good afternoon, Hormaz. Well, what an important session, especially as far as the broader end of markets, and the resilience, especially in the broader end of markets, is quite heartening to see. But let's have a look at individual sectors, individual stocks within those sectors that have been impacted quite significantly. Pharma stocks, a lot of worries, especially going into yesterday's event, but no tariffs there, and that's led to a bit of a relief rally, short covering seen across the entire pharma pack. They've cooled off a little bit from the day's highest point, but despite that, have a look at names like Ipca, Lupin, Gland, all of these stocks, significant exposure as far as the US market is concerned, all of them moving higher in the session. But on the other hand, fears of recession have risen quite significantly, and IT has taken quite a bit of a beating. The entire mid-cap IT pack, along with the large caps, in fact, have seen significant selling pressure. Persistent Systems almost 10% lower today. Coforge, Emphasis, all of these stocks, significant exposure as far as US spends are concerned. All of them seeing quite a bit of sell-off. Some stocks, individual sectors that have seen the impact of selling pressure come by due to the imposition of tariffs. Look at Avanti Feeds, the entire shrimp industry, both Avanti as well as Apex down significantly. Bharat Food, Sona, as well as Samvardhana, the auto ancillary stocks, all of them under significant pressure today. And some stocks, that are moving either on the back of either news flow or brokerage updates that have come by. Have a look at GMR Airports, initiating coverage up almost 4.5%. Angel One, Kotak has initiated coverage on this particular name higher by 2.5%. Some operational updates coming in as far as the entire BFSI space. And look at CSB Bank, AU Small Finance Bank, very healthy quarterly numbers coming by, and all of these stocks moving higher in the session today.
Well, thank you so much for that, Vivek. Quite a comprehensive list. But it's a good time to welcome in our guest, Vinay Rajani of HDFC Securities, for a technical check on the market. Well, good afternoon, Vinay. This is Vamakshi Thoria joining in. The initial dip that we saw in the market was bought into, but where are we headed now? What are the charts telling you as far as Nifty and the Nifty Bank are concerned?
Good afternoon. So for last 3 trading sessions, Nifty has been finding support around 23,100. This happens to be the 20 and 50 days exponential moving average support. So it's a good sign that Nifty has not breached the important level there and it has found support. Breadth of the market has been quite good since the start of April month. And derivative data also suggests that there should be a positive move because put call ratio has been rising. FIs have been covering their shorts in the index future. So overall scenario is quite good. The advanced decline ratio is good. Mid cap, small caps are performing well. So except IT, other sectors are participating in this market and the move should be on the higher side. However, if we were to look at the overall trend, Nifty is into a consolidation of 23,100 to 23,400. 23,400 is a 200-day exponential moving average. Once we see that level to be taken out on the higher side, then we can expect a resumption of an uptrend. So above 23,400, we can expect a previous swing high to retest again, which is at 23870. So the conditional levels are there. About 23,400, Nifty could go up to 23,870. And overall, we feel that there is a strong support zone between 22,900 to 23,000. So the Nifty long should be held with that stop loss.
What about specific stocks then, Vinay?
Yeah, so today we have already recommended to our clients, the housing finance companies are looking good to us. So other housing finance is looking good to us positionally around 457. One can go long. We are recommending a stop loss, positional stop loss at 411, and the target should be kept at 490 to 512. So this is a 1 month view. So 490 and 512 are the targets. The second pick is from the hospital space, Healthcare Global. So HCG, which is placed around 535, can be bought. Stop loss, positional stop loss should be kept at 481. On the higher side, we are expecting a targets of 578 and 625. These both calls are for the horizon of 1 month.
Well, thank you so much for that, Vinay. But viewers, now let's slip into a very short break. We'll get you more on the markets and stock-specific action on the other side, so don't go anywhere.
With the baton of power set to shift, Bharat's youth will drive the next wave of change. The biggest leaders and policymakers, global trendsetters, business icons, and entrepreneurs will come together to inspire the next generation of change makers. Don't miss your chance to witness it all live. Rising Bharat Summit 2025.
$2 billion, followed by Mark Zuckerberg with $216 billion and Jeff Bezos with a net worth of $215 billion. There are only 3 people in the world with a net worth of $200 billion. Oracle's Larry Ellison, Louis Vuitton's Bernard Arnault, and legendary investor Warren Buffett round up the top 6 in the world. There are 15 billionaires with a net worth of more than $100 billion. US President Donald Trump's net worth has doubled in the last year from $2.3 billion to more than $5 billion thanks to his social media platform Truth Social and cryptocurrency bets. Mukesh Ambani remained the richest Indian and the 18th richest man in the world with a net worth of $92.5 billion. The other Indians on the list included Gautam Adani at number 22 and Savitri Jindal at number 48. Shiv Nadar was at the 51st position with a net worth of $34.5 billion, Dilip Shangvi at number 79 with a net worth of $24.9 billion, and Cyrus Poonawalla at number 86. Only 13.4% of the billionaires on the Forbes list are women. There are 2,681 male billionaires and only 406 female billionaires.
Welcome back. You're watching Midcap Radar on CNBC TV18. One stock that is actually gaining momentum in trade today is Bazaar Style Retail. The company reported its Q4 update. They reported a 55% jump in their revenue in the fourth quarter. For FY25, the revenue growth stands at 38%. And to discuss just that, we are being joined by the management. We are being joined by Shreyans Surana, who's the managing director of Bazaar Style Retail. Well, good afternoon to you. Let's understand from you. Q4 revenue stood at 345 crores. Can we get some more internals from you in terms of the products as well as the revenue mix?
Good afternoon, everyone, and thank you for having me at your show. I think this year has been very good for us in terms of the guidance that we have given. And as you said, Q4, we have grown by 55%, majorly on the account of early festivals in the month of March. So there was a shift of Eid sales from April to March of around 7 days. So there's an impact of that also in this numbers. We have almost opened around 52 stores for the entire financial year. And we have grown at a rate of 38% for the entire financial year. We started this year with a guidance of around 25% in terms of revenue, which we shifted to 30%, and at the full year we are at 38%. And at the L12 growth, we were at around 8% as a guidance at the start of the year, which we again changed to 10%, but we landed around 13% in terms of L12 for the entire year.
Shreyans, good afternoon. Thank you for joining in. Before, since you mentioned store additions, let's get that out of the way. What are your store addition plans for FY26? You mentioned, if I heard you correctly, you said you opened 52 new stores. What are your targets for the new financial year, and what are the specific geographies that you're targeting as well?
So the target would be around to open around similar to 40 to 50 stores next year also, with the geography in which we are present right now. So we are right now present in 9 states, out of which the core states for us are Bengal, Odisha, Assam and Bihar. And the focus are majorly on UP and Jharkhand side. So I think in these 6 states only, the most of the openings will be happening for the next year.
Well, Shreyans, you mentioned that you did much better as compared to what you had guided for earlier in FY25. But, we're looking at FY26 now. So what are some of your targets? Would you like to highlight some of the revenue growth guidance, the same-store sales growth? What are you targeting going into FY26?
So for 2026, our guidance would be to grow around 25 to 30% in terms of revenue, out of which L2L growth will be between 8 to 10% for this year. And as in terms of store expansion, I have already told around 40 to 50 stores.
Just before I get back to business, Shreyans, just a couple of questions on the regulatory aspect of things. You recently received an income tax order worth around 6 crores. What's the update on that? And part 2 is you also received a GST demand order worth around 10.5 crores in February. If you could share what's the latest on both of these.
So I think in terms of the income tax demand, we've already submitted to the SEBI already that out of 6 crores, there was some clerical mistake from the government side, in which 4.5 crores, there should be a credit. It is actually a demand of around 1.5 crores, in which we have initiated again, we will be fighting that case from a legal aspect. And on the GST side also, we have already filed in the High Court against that case on the penalty side. And I think the thing that we are seeing, we are going to win the case also.
Sure. And, I'd also like to understand, what your outlook is with respect to your margins, because, in the first 9 months of this year, your margins stand at 15%. This is slightly lower as compared to the first 9 months of last year, wherein you had posted a margin of 15.8%. Now, you earlier had given us a guidance of FY25 EBITDA margin to be in the range of 16 to 17%. So my question to you is, do you think you'll be able to meet this guidance of 16 to 17% for the full year? And what are you targeting going into the next year?
Actually, the guidance for this year was around 14 to 15% only. And the coming year guidance is around 15 to 16% for the EBITDA. And we will be able to achieve the numbers between 14 to 15% for this year, and for the coming year it will be between 15 to 16%.
So you are expecting margins to be better compared to what they were this year. And how do you plan on achieving that?
I think the model that we follow is the cluster-based approach. And I think in the cluster-based approach, what we do is that we go into a state, into all deep manner. So we don't spread across entire India. Whenever we go into a state, we try to open a lot of stores over there, which help us to achieve economies of scale. And I think as we achieve economies of scale, we get a better margins in those states. And as the stores gets mature, we get higher profit. And I think that is the reason, as the SSG numbers are doing good in all mature stores, and we are able to achieve these margins.
Is competition a reason why you are only expecting 100 to 150 bips expansion in your margins? Because there are many other value fashion retailers out there, right? Because you're almost with so many players in this market, you are the user, the end user is almost spoiled for choice. What's your take on the competition that's rising in this space? And do you feel that this is one of the reasons why you are only expecting 100 bips expansion on your margins? Or does that keep a lid on your pricing as well?
So I think first on the margin side, I think because we are a value player, we will stick to that, I will say inherent name value. And we want to have a very high profitability as a percentage. So the idea is actually to just have margins around 15 to 16. Ultimately in the longer term, it's around 16 to 17%. And at the PAT level, maybe around 4 to 5% is the idea. Anything above that should be passed on to the consumer, just to that you have the value thing in your stores and in terms of pricing and quality. Coming to the competition, I think the market is big enough for every player. As we are opening in tier 2, tier 3 cities also, if you see, this is a very highly unorganized market. Even in tier 2, tier 3, we are opening in high streets, which is more unorganized. And the idea is to give them three things: the lower middle class and the middle class. It's a comfort, quality, and the pricing. And we are giving them that ambience, and where they can come together as a family. They can shop under one roof with all the air conditioned facility, trial room facility, with the pricing. That is the reason that everyone is growing in this space. What we are doing in order to sustain this growth with a good profitability, we are focusing a lot on back end also. So we are this year, as you rightly said, for the first 9 months, the margins are lower than last year in terms of EBITDA, which was majorly on the account of the back end expenditure that have been increased. And we are working a lot on the technology side and the data analytics side for this year, which will be able to sustain us for the future growth and profitability, which will help us to go there.
All right, Shreyans. And what about the debt on the book? As of September, your debt was at 668 crores. This is much lower as compared to 1,700 odd crores that we had seen in the month of March. So where does the debt stand at now?
So the net debt would be around, for this year, would be around 100 crores, net debt for the 31st March.
And do you expect that to bring it down to zero anytime soon?
Not be, it's a working capital, which will be a part of this business, but yeah, it will reduce. I think in the coming year, we expect next 2 to 3 years, we will be a debt-free company.
All right, Shreyans, thank you so much for sparing time and joining us today. Wish you good luck for FY26 as well. The management there of Bazaar Style Retail, a healthy fourth quarter update. The stock was up 20% yesterday, building on those gains, almost 6% higher in today's trading session as well. By the way, just before we take that break, some of the other movers in today's session, though, is Vardhaman Textiles is one of them. We mentioned about textile and apparel names being some of the potential winners of this Trump tariff impositions, and Vardhaman Textiles now the top gainer on the Nifty 500, 15% higher on the stock at the highest point of the day. What's also doing well, though, is Tejas Networks, 9% higher on that stock as well. And IDFC First Bank, after its quarterly business update, has surged 6.5%, and also among the top performers and at the highest point of the day is IDFC First Bank. Take a short break, but just before we do that, here's some good news for our viewers. India's business news leader is now just a click away, and that is CNBC TV18's all-new app. You can get instant access to breaking news, financial world updates, and detailed articles on the app. You can download it from the App Store or the Google Play Store, or you can also scan the QR code that comes up on your screen to get the app on your phone. Take a short break, back soon.
informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18. Now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC TV18 and CNBCTV18.com.
What does it take to build India's largest startup platform? It takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community.
Welcome back. And while the focus is on Donald Trump, tariffs and the impact of that, a lot of business updates have been trickling in over the last few minutes. Marico is one of them, and it was a decent quarterly business update. And Mangalam is here to tell us just that. Mangalam.
Well, it is a decent quarterly business update, and as a result of which we've seen the stock recover from the lows as well. Let me take you through what the company is seeing in terms of demand. They are seeing stable demand conditions with mixed, mixed news coming in from urban with improving rural trajectory as well. For India, they expect sequential volume growth, and that's a positive. And importantly, the international business as well for them is growing in mid-teens constant currency. What does that do to the overall consolidated business? It's moved to high teens on a year-on-year basis in the fourth quarter. And remember, it started weak in the first couple of quarters, picked up in the next couple of quarters, and as a result of which, the entire year will see high growth in double digits for FY25, and they believe this will continue for FY26 as well. Margins had been a problem for Marico over the last couple of quarters. The company said that there would be marginal operating profit growth in this quarter, so that should be a positive, and they expect this momentum to continue. Parachute coconut oil witnessed some sluggishness, but they believe this is seasonal. The most important part for me was that after many quarters of weakness in value-added hair oils, it's beginning to show gradual improvement, and that's also a barometer of the improvement in urban demand, and that explains why the stock is marginally in the green after being in the red for most part of today's trading session.
Well, that was Marco for you, but Mangalam, do stay on. Dabur is trading more than 7% lower following a weak Q4 business update. So tell us more.
A couple of reasons why Dabur is under pressure. The one reason is the weak fourth quarter numbers, where the company said that, the consumer sentiment has been weak for them. In this quarter itself in India, they've seen, mid-single digit sort of decline in their FMCG business, and that was led by urban slowdown, that was led by delayed winters, and that was also led by the modern trade uptick and general trade slowdown that these guys are seeing for the company. The second major reason for the stock to decline in today's trading session is there is no revenue growth. The margins have compressed by about 150 to 170 basis points, and this against what the management had told us at the end of the third quarter itself, saying that the worst is behind and things are improving. It's the third straight quarter where the management's commentary post-quarterly earnings does not match the next quarter's update, and as a result of which, we've seen weakness in Dabur, the stock lower today.
Well, absolutely, Mangaram. The stock is trading lower today, but let's move on and let's also focus in on GMR Airports. The stock is trading with gains of nearly 4% after Citi has initiated coverage on the stock with a buy rating. Vivek Iyer is now joining in to tell us more. Vivek.
Well, that's right. So GMR Airports is in focus. A very interesting, important note coming in from Citi as far as GMR is concerned. They've initiated coverage on the stock with a buy rating. Target close to 90 rupees a share. What is it that they're saying? They're calling it an India airport pure play business. They say it's fundamentally well placed, where they see India's passenger volume growth at 8% CAGR from FY24 to FY27. Also, they say that the company's assets actually pose competitive advantages with the free cash flow cycle turning positive. Regulations at this point of time are quite defensive, and along with that, they say that GMR is expected to turn profitable from FY26 onwards, where the core earnings for Citi actually stands at 5 to 6% above the street estimates. Along with that, what is it that will drive profitability as far as GMR is concerned? 8% traffic growth in FY26. 2.4 times tariff increase at the Delhi airport, and 7.5% per annum increase in non-aero spending per passenger across Delhi, Hyderabad as well as Goa. So overall, a strong note coming from Citi. GMR doing very well in the session today.
Well, thank you so much for that, Vivek. 23,270 thereabouts is where the Nifty is at. The mid-cap index, though, has managed to now slip into the green. In fact, good recovery for the mid-cap index. There you have it, 0.06% higher. But that's all we have on mid-cap radar today. MF Corner, when we return, so don't go anywhere.
Young Turks at 21. Only on CNBC TV18 and CNBCTV18.com. CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
Talking about 25% permanent tariffs on steel, aluminum, and autos. And I think this has the potential to bring inflation back in a serious way in coming months. And if that's the case, I think that has the potential to really depress the consumer. And this time around, the Fed is not going to be able to come to the rescue here because it can't possibly lower interest rates when inflation is significantly above its 2% target. I think that inflation, which has been running around 2 to 3%, is about to run at 3 to 4%. I think the Republicans are running the risk of losing their majority in both houses of Congress next year. I think this is just a disastrous policy.
There certainly is going to be a near-term spike up in inflation, but in 12 to 18 months' time, are we going to be in that sort of still lingering at 3 to 4%? I'm doubtful, and therefore there's still, I think, scope for 2 rate cuts that we have. We've got I think near-term, the Fed are going to be hesitant. We've got a September rate cut and a December rate cut and a March 2026 rate cut.
My fellow Americans, this is Liberation Day, waiting for a long time. April 2nd, 2025 will forever be remembered as the day American industry was reborn, the day America's destiny was reclaimed, and the day that we began to make America wealthy again. We're going to make it wealthy, good and wealthy.
Hello, good afternoon. You've tuned into Mutual Fund Corner on CNBC TV18. I'm Vinny Motiwala, and thank you so much for tuning in as always. Now, today what we were talking about since the get-go was US President Donald Trump announcing that 27% import duty on India. But what does it mean for a mutual fund investor as well, right? Overall, in terms of the investment that they would be making in the US market, should Indian investors now trim their exposure if they have that in any US-based funds that they're holding? What is it that they're watching out for? Should they be looking at pharma, IT, shift to other sectors? What is the outlook on this front? We'll be discussing all of that. And to discuss that, we do have our expert joining in with us for today, Jimit Modi, founder and CEO at Samco Group, to talk to us about that. Jimit, good afternoon, and thank you so much for joining in with us. Interesting day to talk about, especially US, in terms of the funds. What should one be doing, right? Now, given this evolving economic landscape that we've seen today, the change that we could see coming in terms of trade as well, do you believe that, US funds is something that now one should look at getting out of? We've seen that run-up coming in for US funds as well, and that is now going to be fading out. What are the key indicators you're watching out for now?
So first of all, thank you so much, Vinny, for having me on the show. It's an absolute pleasure. And it's a great day to be talking about the US in general. So, see, from the perspective of looking at US allocation in investor portfolios, the way to think about it, at least the way our systems are looking at the US, is that the best part of US's outperformance seems to be behind us. And going forward, we anticipate that emerging markets in general should do better than the US. And with all of this tariff tantrum that is going on under Mr. Trump's presidency, there's all the more uncertainty in the US. So our outlook is that for the next 6 to 18 months, there is going to be great uncertainty in the US. And there are two possible outcomes. One is if there is a US recession, then there could be a prolonged bear market. Right now, the US has just entered correction zone. But if there is a recession, there could be a prolonged bear market, which could last between 18 to 24 months. And at the same time, if there is no recession, which seems unlikely at this moment after the Trump tantrum, then you could still see a 6 to 9 month correction. So the general outlook is that, if you've been overexposed to US equity over the past 12 to 18 months, it's good time to cut allocation. You should bring down allocation to a more sustainable level. An 8-10% US allocation in Indian investors' portfolio is a reasonable level.
Okay, 8-10%. Oh, you're talking from the international point of view, or overall portfolio point of view?
Well, if you are an Indian investor, from an overall point of view, an 8-10% US allocation is
enough. And then other international funds you can still look to invest in, right? Over and above this.
Yes,
okay. Right. With this rupee depreciation, historical depreciation against the dollar, Fed's potential rate cut moves also now that we're keeping an eye out on, right? Still, we'll have the RBI decisions coming in next week as well. Overall, what should one watch out for as a strategy? If it is a new investor, I don't have any investment in US, then, given that you're seeing this correction, or, given that we could see a fall, does it make sense then also to maybe look at it from that, lower NEV point of view and build up on this as a long-term story?
So see, if somebody still wants to look at the US and thinks that, okay, this 10% correction is a good starting point for me to start looking at US mutual funds and US equities, then I think the best way to play that probably would be to do a staggered investment over a 12 or 18-month period. Because as I said, the pain is probably going to last for a bit. It's impossible to call a bottom. And in that case, the best bet for an investor is, if you have, let's say, 10 lakh rupees to invest, divide it over the next 12 months or the next 18 months and stagger your investment. And in such a case, what will happen is that if at all this correction continues, this bear market, this converts into a bear market, then you'll actually get the benefit of dollar cost averaging and better unit accumulation.
Right. Jimit, now obviously when we talk about exposure to the US, we also talk about two specific sectors, that's pharma and IT. Now today pharma surely is cheering because as of now, they're out of the woods. But IT, in terms of if there's a recession that comes in, the possibility of that which you're talking about, how should one play this story, right? Because they were said to be defensives. Now, when I'm looking at it in terms of returns also, last 1 year return, surely I'm checking on not a very, very long term, but just 1 year and 6 months return. For pharma companies, they managed to give positive returns in the range of around 12 to 19%, most of the funds. While 6 month return, we're seeing a decline because obviously pharma stocks overall were seeing a fall coming in the last 6 months. IT also, similarly, in the last 6 months is when we've seen that decline coming in, right? Do you think now this play will be changing and the decline that we've seen for IT stocks is something that could sustain? And as a thematic fund, if you're holding one of these, what should they be doing as a story? Pharma, IT, both separately? And now does it make sense to start playing those consumption capex themes also as a domestic play coming in?
Okay. So see, as far as the allocation to pharma and IT is concerned. So first, let me talk about IT because I think with this, if at all the US goes into a recession, then the most affected is going to be the Indian IT sector. And in case, investors have, and the thing about thematic sectoral funds, specifically sectoral funds that are focused on a particular sector, it's very important to get the timing right, because if you get caught on the wrong end of a cycle, you could see sustained underperformance and poor results from a portfolio perspective. So I think IT, the best, at least for the next 6 to 12 months, seems that it's behind us. Even pockets of the IT indices, our systems suggest that there is excessive valuation, there is some amount of pressure that is yet to come in. So definitely that is one space to stay away from, at least from an incremental allocation perspective. And if somebody made an allocation at a lower level, it might not be a bad time to trim allocation. Now, coming to pharma specifically, as you rightly said, they are happy of the fact that they're out of the woods for today, but there is still going to be uncertainty of the fact that whether this is temporary or pharma is actually permanently going to be out of this whole tariff tantrum issue. So my sense is that the investors should not get swayed by the fact that, oh, our pharma has been left out, let's go all in pharma and let's make this like a 10-15% allocation of our portfolios. My suggestion is that at best, if you're looking at sectoral funds like a pharma fund, they deserve a not more than a 4-5% allocation even for a risky investor, and which should remain the case. So don't try and go overboard with pharma, but yeah, I mean, considering the fact that it is one of the safer spaces to be in, and it is insulated from tariffs, at least for now, it may not be a bad idea to have some allocation as a part of your overall mutual fund portfolio.
Okay, some allocation is what one could go in for pharma, but don't go gung-ho on it, is what Jimit is saying as well right now. Do you think my other point was in terms of consumption story, the capex story? You have so many options, right, on the thematic side as well. So I want to know, does that make sense? And, is it better to look at overall as a fund story, if I'm looking at multi-asset funds, where companies or where funds have more exposure to these consumption capex stories?
Yeah. So, when first, from an investor strategy point of view, I'll answer the second question first. If you are an investor who's starting out in 25, 26, has a 3-4 year outlook, I think the times that we are in the sense that we are going through a economic world war of sorts, and which has just started really now. And in such a time, it is actually best that an investor has exposure to multiple asset classes that are uncorrelated to each other. And I think multi-asset allocation funds are a great way to play that, because as a fund category, an investor will get exposure to equities, which will have some amount of domestic equity services, which form a part of the composition of the Indian indices. You'll also get some exposure to commodities like gold and silver. You'll also get some exposure to debt. So all in all, it actually will be a well-balanced portfolio to sort of make sure that you are able to navigate through this time that probably will last for the next year and a half or two at least. So that's point number one. Now, as far as, if you're looking at Indian consumption, that's a great story in the sense that if you look at the past 10 years, the Indian government has focused excessively on infrastructure spending, developing roads, ports, defense, all of that. And this year's budget actually made a shift towards consumption because it actually put more money in the hands of the Indian consumer, after the income tax slabs, which have actually gone in from the 1st of April. So a higher disposable income, we believe, will actually translate to better earnings for consumption names, better growth for Indian domestic consumption names, Indian lenders, Indian services businesses. So these themes or sectors could be looked at from an investor perspective. As I said earlier, when you're looking at a sectoral fund specifically, it's very important to get timing right. So you've got to get in at the right time, get out at the right time. Otherwise, you could get caught on the wrong end of the cycle. And if you're not feeling confident about timing it too well, then diversified equity funds or multi-asset allocation funds are a great place.
Absolutely, Jimit. Surely an option that comes in on that front as well. Diversification is key wherever you're going, right? At any point of time. That's the key, and investors should always remember that, because every expert we talk to, time and again, diversification is something that will save you. If one thing goes downhill, there's at least something to protect you. Jimit, what I want to understand is in terms of if we reduce our exposure in terms of US, I still want some international exposure as well, right? Apart from US. What are the alternatives I have as an Indian mutual fund investors? What is looking attractive right now?
So, we are an algorithmic asset management. The way we look at things is that, where are trends moving? And one of the cases where we believe that a new trend is emerging is Chinese equity. So, China has actually been beaten down for the past few years. It's started to make a comeback sometime in the second half of last year. And especially Chinese tech after DeepSeek has seemed to sort of found a lot of interest and is beginning to show an uptrend. So I think if investors were to look at some other global asset allocation, then there are Hang Seng tech ETFs available. There are Hang Seng tech fund of funds that are available. And in general, that is a great space that you can look at. Again, as I said, don't go overboard, don't go gung-ho, but a small 2-3-5% allocation will probably could act as a good upside kicker from an investor's portfolio perspective.
Right. Jimit, while we do have China, surely turns out to be one of those plays, right, as a story. And like you were mentioning as well, just I'm looking at the returns in the last 1 year. Most of the funds in India, which have a NASDAQ exposure and all of them, they manage 11% return. We also have options coming from Japan, other emerging market opportunities as well. There are funds on that front as well. Does that also make into play, and does that make sense that you could look at other emerging markets as a bet right now?
Well, I wouldn't classify Japan as an emerging market really. But yeah, as I said, at the beginning of this conversation, that we believe that going forward, emerging markets definitely will do better than US and in general developed markets. So, looking at something like, and in the emerging markets basket, the two big plays really are India and China. So, and if you're able to get exposure to India and China, then you pretty much covered bases. Then you can then look at some diversified emerging market funds that could probably give you some exposure to Taiwan, Indonesia, Korea, etc. But I think those are marginal positions. Broadly, if you're looking at the emerging markets basket, I think India and China is what an investor needs to focus on.
India and China is what the investor need to focus on. So you would say get out of something like a NASDAQ funds that you have on those sides, or US tech side, and come into maybe a Hang Seng side or the China fund or the India story is what you would highlight, right?
Yeah, that's right. So cut your allocation to the NASDAQ, cut your allocation to US equities, and reallocate part of that to a combination of, as far as the global portfolio is concerned, to Chinese equity as well as Chinese tech specifically, and then secondly to Indian equities.
Okay, Jimit, thank you so much for that and explaining our viewers how this change in dynamics and how all this that is come in as an announcement in terms of Trump tariffs, what one should be doing with their US-based mutual funds or in terms of pharma and IT as a sector and sector-specific thematic funds as well. On that note, we'll slip into a very short break. Viewers, don't go anywhere because after the break, we'll be discussing new regulations that have come into play in FY26, the new financial year. What does it mean for you as an investor? Anything that you should watch out for on that front? And how will it benefit investors? We'll talk about all of that with Jimit, so don't go anywhere.
For these reasons, starting tomorrow, the United States will implement reciprocal tariffs on other nations. It's been a long time since we even thought of that. We used to think about it a lot. We didn't think about it for many decades, and you see what's happened. For nations that treat us badly, we will calculate the combined rate of all their tariffs, non-monetary barriers, and other forms of cheating. And because we are being very kind, we're kind people, very kind. But we will charge them approximately half of what they are and have been charging us. So the tariffs will be not a full reciprocal. I could have done that, yes, but it would have been tough for a lot of countries who didn't want to do that. But such horrendous imbalances have devastated our industrial base and put our national security at risk. I don't blame these other countries at all for this calamity. I blame former presidents and past leaders who weren't doing their job. They let it happen, and they let it happen to an extent that nobody can even believe. That's why, effective at midnight, we will impose a 25% tariff on all foreign-made automobiles.
Welcome back to Mutual Fund Corner on CNBC TV18. We still have with us Jimit Modi, founder and CEO at Samco Group. And now what we're going to be discussing, because there are some new introductions and new changes that were made by the SEBI that is coming into effect from FY26. There's some NFO fund deployments that is there, some rules coming in from the point of view of AMC employees and their participation also that comes in as an important play in mutual fund schemes. What does that mean? And also, what are the exciting options that one could look out for in terms of FY26 as a tax-saving option now with the changes in income tax regulations? We'll talk about all of that. Jimit, a lot of changes that are there, a lot of new things that have come in from the fund side as well, right? We have the 250 rupees SIP that is starting. A lot of funds have started on that front. We have mandates coming in from AMC employees. We have NFO deployments also. If you could break it down for us, what this means for a mutual fund investor, what will it entail for them?
Well, I think specifically from an investor's perspective, one of the more interesting developments is the requirement of AMCs to deploy NFO proceeds in a stipulated time frame. So earlier, what used to happen is that, let's say, a fund would launch an NFO, and it would take its own sweet time in order to actually reach the desired asset allocation as far as the fund is concerned. So let's say you invested in a large cap fund, and the fund manager decided, and you thought that you were actually getting 80% large cap exposure at least, because that was the mandate of the fund. But in case of an NFO, what a fund manager earlier had the flexibility to do was to wait for a while. He could decide that he was investing only 10% this month, or 20% or 50%, and then gradually actually build exposure to the 80-100% kind of levels. Whereas now SEBI has stipulated and said that within a 30-day period, whatever deployment that has to be made of NFO proceeds has to be completed in 30 days. So you have to reach your fund mandate at least at the end of the 30-day period. So what happens with that is that even investors actually will get funds which even when they put money in an NFO, the fact that the time from NFO deployment will get cut down, and they'll essentially get true to label funds. Otherwise, what would happen is that you would essentially be investing in cash, and the fund manager paid for being in cash. So that aspect is really helpful from an investor perspective. I think, and the Choti SIP again is a great initiative. It will encourage more and more people from Tier 2, Tier 3, Tier 4 cities to look at SIP. While where typically 500 rupees or 1,000 rupees were the earlier popular SIP ticket sizes, but yes, a 250 rupee Choti SIP could look at much wider participation, from a pan-India level, especially from, as I said, the Tier 2, 3, 4 towns. So I think that is again one more big development that's happening. And I think generally, like we spoke earlier in the conversation today, that there is a tax saving that investors are going to make in this year. Since the tax slabs have gone higher with effect from 1st of April, there is more disposable income in the hands of an investor. So you actually, I think investors, one of the best things they could do in the first week of April is top up their SIPs, because you've got additional savings. Don't wait till the end of the year. Actually get your money to start working from the first month itself, and allocate that extra additional saving to your investments, whether it is MF through a lump sum or an SIP route. But yeah, I think that's a great option for investors to look at early on in this.
Absolutely. Earlier on in the year, just top up your SIP, so you start saving more accordingly as well. For the whole year, you will start on that compounding journey that you're supposed to. And Choti SIP is something that will support the growth coming in from the Tier 2, Tier 3 cities as well. Jimit, what I want to know is also in terms of, right, while we said that the tax slab has gone up, but when you have the new regime that comes into play, that 1,50,000 that everyone used to put in that ELSS fund, that is, not that much effective now. That doesn't make sense for a new regime person. Are there any other options that are there as a tax saving opportunity for an investor in FY26, what they could start right now?
Well, you're right. I think even last year, as we saw, almost thirds of the Indian tax filers had moved to the new regime. And our anticipation is that after the increase in the tax slab in the new regime, probably that number will go to 85-90%. So as you rightly pointed out, the whole ELSS category in a sense has actually become an irrelevant category from a tax saving perspective. So I don't think today, if you are in the new regime, you can actually try and game the system, or try and make those 1.5 lakh ATC allocations. That's not going to work anymore. I think the government just has said we've put more money in the hands of the end consumer, the end investor, and they can decide what to do. And all of these excess deductions have been taken away. So I think I don't think there is much scope left from a tax planning perspective in the new regime.
Yes, absolutely. And Jimit, just one last word, right? Beginning of the new year. But what I would also like to know is, as an option that are there for investors to look at in terms of investing, where should they be looking out for right now? And which categories do you think would be somewhat of an outperformer in FY26? Because there are reports also that suggest, right, that one could see a faster pace in terms of growth coming in from the consumption side of the story. So what should we be looking out for in FY26?
So if you're looking at from an FY26 perspective, I think I'd look at three broad categories. The first is, like we spoke about, multi-asset allocation funds. So if you're, if you are a conservative investor or a moderate risk taker, the best way for you to participate in wealth creation journey is through multi-asset allocation funds. So that's point number one. As far as which segment of the market do we expect to outperform over the next 12 to 18 months, we are definitely more positive on the large cap space. So over the past 4-5 years, large caps have seen underperformance as compared to mid and small caps. Part of that outperformance is coming back over the past quarter or so. And we believe that 26-27 is going to be the year of large caps. So even if you look at the share of CNX 100 to the CNX 500 is at levels not seen in the past 20 years. So that's a great space to be in. It's an ignored space. It's an under-owned space. So that's a space that you can look at from an investor perspective. And then specifically, if you're looking at themes and sectors, then as you rightly said, the consumption space is one space so you should be looking at. So there are a bunch of consumption funds, non-cyclical consumption funds as well that an investor could look at. Even in the Indian space, I think one of the great ways to play the Indian domestic consumption story is through financial services. So you will look at a financial services fund or a bank. And we anticipate that is also going to be a space which will actually outperform over the next 12 to 18 months, because there's great strength that we can see in bank financial services companies.
Right, Jimit, thank you so much for, highlighting all those options that are available, what you believe as a story could play out in FY26, and highlighting what it means for investors in terms of the changes that we've seen in coming in for NFO deployments, as well as AMC employees, mandating that in terms of what their investment should be as well. So thank you so much for that, Jimit, and thank you so much for joining in with us. Viewers, with that, we'll wind down this edition of MF Corner on CNBC TV18. Thank you so much for that. Up next, you have Closing Bell.
Not a full reciprocal. I could have done that, yes, but it would have been tough for a lot of countries who didn't want to do that. So if you look at that, China, first row, China, 67%. That's tariffs charged to the USA, including currency manipulation and trade barriers. And so we're going to be charging a discounted reciprocal tariff of 34%. I think, in other words, they charge us, we charge them less. So how can anybody be upset? They will be, because we never charge anybody anything. But now we're going to charge. You think of the European Union, very friendly. They rip us off. It's so sad to see. It's so pathetic. 39%, we're going to charge them 20%. So we're charging them essentially half. Countries like Canada, we subsidize a lot of countries and keep them going and keep them in business. In the case of Mexico, it's $300 billion a year. In the case of Canada, it's close to $200 billion a year. And I say, why are we doing this? Why are we doing this? I mean, at what point do we say, you got to work for yourselves, and this is why we have the big deficits. This is why we have that amount of debt that's been placed on our heads over the last number of years, and we're really not taking it anymore. April 2nd, 2025 will forever be remembered as the day American industry was reborn, the day America's destiny was reclaimed.
Beyond market headlines, to understand the reasons for the day's movers and shakers, and get your portfolio ready for tomorrow. Beaming live from the CNBC TV18 Motilal Oswal studio.
Starting tomorrow, the United States will implement reciprocal tariffs on other nations.
Futures on Wall Street cratered as these sweeping tariffs were announced.
We start sharply lower for the Nifty. We get to the first big support zone, which is 22. I mean, it comes in at 22,867.
Talking about tariffs, you'll want someone to come in there and bat for the bulls.
This is not a good policy. This is a very bad policy.
23,180 is where we are at. It's 150 points lower.
Tariffs are going up not only for India, but tariffs are going up for other countries.
I said more than 1%. I said 1% because of investment getting delayed.
With the increase in tariffs, how much inflation is going to be there in the U.S. economy? And
Nifty Sensex down close to about 1/3 of a percentage point. The Nifty's at 23,280.
Tariffs are a part of an overall Trump agenda.
lower, but we're still quite resistant today, especially, the mid-cap and the small-cap end of the market. It has not fallen as much, so that bodes well.
Okay, it is a very, very decent response to what was not kind or nice last night. The market here holding on, market breadth is positive and things are looking pretty all right, just like any other day, I dare say. This is Closing Bell. We're coming to you from the CNBC TV18 Moti Rosewal studios. I'm Prashant. With me, my colleagues Surabhi and Rima here. Nigel is joining us from the newsroom floor. Guys, hi, good afternoon.
Hi,
afternoon.
It's looking all right just for us because Asia closed in the red.
Yeah.
Europe is down 1.5%, and the Dow futures is still down 1,000 points.
I don't want to be sort of the negative person out here, but I just have to place this on the record as well, on the table, that I think what we've seen today is the first order effect. And India is not that badly hit in the first order effect. And, a lot of conversations since morning have established that. It's the second and third order effects, and we'll talk about that as we go forward. I was looking through a Morgan Stanley note before coming to the studio. They are talking about a certain number of basis points being shaved off FY26 growth targets, not because our exports get hit, but because of the other issues that would be coming in place. So I think today is fantastic, but is this the worst being over for our markets?
So the second order impact is being felt on IT, right? IT is not directly impacted, but on the back of this indirect impact, global economy slowing, the Nifty ID index, Nigel, is down 4%. So that's a clear case of the second, third order impact that we've just started to see.
Well, that's right. But pretty good times, right? If someone told you at the start of trade that you'll have the mid-cap index wave in the green, 3 stocks advancing for 1 stock that's just declining, and you'll have the Nifty bank that's up close to around 225 points. You're definitely taking that. That said, I think, Prashant, you want to do a quick recap of what's happened so far?
No, it's been good, but it's day one, right? And it's just getting baked in. There are still talks about calculation, 26%, 27%. So we're still kind of, these are still pretty fresh in the minds of many people. I mean, it's instructive. A few sort of people that we spoke with through the course of the day, and these are not market participants, but on the trade side, I mean, they were unaware of how the calculations were done. So people are still, in a way, I mean, because we are doing this day in, day out, minute by minute, we're kind of on top of what's happening. But in terms of the real impact, I mean, I think that will seep in slowly and steadily, and it'll start to show up as well. So with that kind of sort of short take, let me just quickly welcome in our guest. Samir Arora is now joining in, founder and fund manager at Helios Capital. Samir, good afternoon. Great to have you with us here. Thank you very much. This was worse than what anyone thought. Although at the margin here, the narrative became that, well, others are taking a hit larger than us. So for some sectors like textiles, etc., it may not be that bad. Positive, I don't know, but maybe lesser hit in that sense. What is your own perspective, Samir, on the overall situation?
Textiles, it is not. Yeah. The first thing in a big picture sense, although, in our long only fund, we are fully invested and all that. But I would think this behavior of the market is a bit suspicious and not to be trusted because, Indian market has made this simple thumb rule, not that they will analyze a stock, but whether that day there is net selling or not by FIIs. I think beyond a point, just because if today they have not come in or there's a slight match or mismatch of these two, then the market is up. But it just looks a bit too much because my general thumb rule is that you can't suddenly negatively surprise either in a company results or in macro events. And within 10 minutes, say it is discounted because now it is known and it is bad, but it is the worst that we can be. These things take time in real world. And to just discount everything in 30 seconds is a bit much. Although big picture, we are very happy that our long short and both these funds are sort of playing a bullish stance. But this still looks a bit much.
You mean the resilience? It looks a bit much.
Yeah.
Tariffs also look
too strong. It's a bit too strong. You suddenly can't go from an expected 10% type tariff to 26% type tariff and say it doesn't matter. I think it can be handled. But the market is assuming everything. For example, I saw on your channel and others that India is about to do an FTA with US and it will be done by year end. Year end is 9 months away. So for these 9 months, these tariffs will remain, right? You can't say that, okay, because we'll be negotiating something today, only give us our waivers. or give us a lower rate. Also, I think these second round effects and third round effects. First of all, we have not seen European response, Chinese response. Tonight should be Canadian response. And then US, that is Trump and Scott Bessent have already said that please don't try and do reciprocal tariffs on my reciprocal tariffs because that might aggravate the situation. I think we can wait 2-3 days and see how this whole thing goes to second and third round.
You know, there was Neelkant Mishra who was with us in the morning, and he was saying that the way this impacts economy-wise India is not that much, but the impact will come from higher equity risk premium. And he was generally broadly saying that this is it's going to linger. It's not done, and I think that is your view as well. But broadly, but beyond that, what is your view? How does this seep in? How will it show up? Yeah.
From an economy point of view, it's not a big deal because we don't have big scale of imports and exports. So this thing is that we need to import additional $30 billion. How? If we assume that formula is what it is, India is exporting some 90 billion, importing 40 billion. So the trade deficit is 50 with US, divide that by 90, that is broadly this number. So to bring that 50 billion down, you have to bring it down to 20% type number, because then you get 50% discount and your tariff is 10%. And there's no need to go below that because that is the minimum tariff, which I guess will continue for 4 years for sure. So we have to reduce deficit or import more $30 billion. And it's not a waste of $30 billion. You're not saying, oh, extra thing we have to do. You have to substitute something here, something there, maybe 10 billion of oil, 5 billion of cars, and the rest 15 billion the government can figure out. But these are too easy to do things that can be done. But basically, you need to somehow show a path, or I don't know whether they want to see actual numbers or just a path to see this going down to, 20-odd% deficit as they have defined it.
Samir, hi. Afternoon. Rima here. What does an emerging market investor do? Now, he's grappling with 34% on China, 36%, Vietnam is 46%. What is the call foreign investors are taking now when it comes to investing?
I think 5-10 days, somebody should wait. I also don't believe that Vietnam will remain at 46% simply because they have already officially announced, not proposal, they have officially announced that the tariff for US goods is going to be 0. They've already put it out there. It's just that because the current numbers are such, Vietnam does not have the ability to import much from the US, but they can easily say that you please send us whatever our guys can buy, just that they can't buy. But the tariff is 0. Then what do you do? I think they will go to 10% by 9th April is what I think. So please don't, because you see, they have said means, I don't know whether legally what is the word, but it's public and known that they have made it 0, just like Israel has made it 0. So these other countries can go all the way. It doesn't matter to them. There is not much you can, they can import anyway. So that's not their fault. So Vietnam will be out. China, my thinking is that China is not going to accept so easily. So what if they say that for things that US needs, let's say bulk drugs, we put an export tax. They can do any of these things because if you put tariffs, so what I'm saying is every investor, including me, who is actually fully invested more or less, 4 or 5 days, let's see at least for 30 seconds.
Yeah.
You're not going to miss a big rally. That's all I can say.
No, absolutely, Samir, take that point, and this is what we've been discussing since morning, right? That it's not just about that tariff number that you can match. Vietnam will cut, India can cut, all countries can cut. If it's about trade deficits, which the US is running, then it's a much bigger issue.
No, I think India and all can't easily cut to 0, no, because there are so many, because it's a bigger country, so it's not as small. But for Vietnam or something, they can say, what can we do now? And that I think those can be accept.
No,
otherwise the same things will come from China plus Vietnam. They might as well promote Vietnam at the expense of China.
Absolutely. The reason why the US is running such large trade deficits is that it's more cost effective to produce those products in a Vietnam or in a China or in a India. So that's a much larger issue that we'll wrap our heads around. Anyway, now coming to India, we'll pull up some graphics in a bit. I was looking at a Morgan report, lots of estimates doing the round on what the numeric impact on us is. So most people are saying maybe 30 to 40, 50 basis points shaved off this year's growth. That's direct impact because of our, small exporting segments that we have, electronics, etc. Everyone is more worried about the second and third order impacts. Morgan Stanley, for instance, is saying that it could actually delay the invisible private sector capex cycle even further. Because how do you invest when you don't know where the trade lines are, where is your supply chain, should you look at US as a key market or not? So it pushes back private capex. Yes.
Absolutely correct. And also, as soon as US signals that these things are the max tariffs and now they can be negotiated. Obviously, every company will assume that my government will negotiate downwards and there will always be a plan that government will have. So the investment into US also will be delayed. Everything will be delayed by 4-6 months. And in our case, the other issue is IT, which, by the way, I've been saying for some time now. But IT is, Rima was saying IT is a second order effect or third order effect. Actually, IT's impact will be a fifth order effect. Because if IT is not strong, what does that mean for our consumer and other things?
Yeah.
And other things. So what I'm saying is, it is uncertain. India is at a relative advantage. But also, if the US market, for example, let's say does not fall much because we accept it, obviously US will put more tariffs on sectors now because they will feel comfortable that the world has accepted it because they have already said that they want to put sectoral tariffs, which they've done on
Samir, so coming back to my simple short question, because of all the complexities, because of all of these complexities, would it be a little foolhardy to assume that the great Indian bull market had begun again? March, we had a good month and people wanted to believe the worst is over. Bull market chalu. Would it be wrong to assume that?
No, relatively it is over. Absolute depends on what happens to the world. So my logic is, first of all, next 4-5 days, so somebody should just relax and see his conferences and press conferences.
We can't relax, no, Samir. We have
to report morning, evening.
Beyond that, you have to see if the US market goes down in a dignified manner, goes down 8-10%, we can all handle it and we will outperform it and maybe not be up in that period, but at least it will be dignified and you will get FI flows. But if the US market is down, much more than that, then we cannot say we are isolated. That is what my lesson experience is from 2008. If these other markets go down a lot, then you can't make money, you may lose less, you may do this. Of course, in 2008, even though we had no connection with the US subprime crisis, India was down double of US. So you don't want to be at that stage where you think that US will fall a lot. But
so 8 to 10%.
We are outperforming. It's a relative bull run. One day it will become an absolute bull run.
Yeah. I like it in a dignified way. Hindi में तमीज से थोड़ा 8-10% घट जाए.
हम थोड़ा इज्जत से गिरेंगे.
Just Samir on just a quick word, right? You invest in other markets, etc. So what is the behavior of the point that Rima said? Eventually, I mean, does money go back home in a situation like this, which is US? Go into the dollar?
I don't think it will go home. This is a serious change. And, like I sold mostly everything in the Feb month and a little bit in early March, but I have not felt even to buy 1% back in US, not even 1%. Also, by the way, look at it. If Europe has said it in black and white yesterday in their press release that they will be targeting US services because they understand that US has services surplus. And so they are saying we will target US services. US services means what? That means you have to target Google and Facebook and all these kind of guys. So this will be messier than normal. And so right now it's too early to buy. Of course, people in US will do some, just like we keep doing in India, a little bit of plus minus. But overall, what I'm saying is it's too early to even celebrate, although relatively today is a great day. And yesterday was a great day. But I'm saying let's not jump in. That's all. There's nothing.
Yeah. As nowadays the youngsters say, everything is about vibe. The vibe today is one of not jubilation or celebration. It is confusion.
Relief. Actually. No, somebody you can say it's relief. But I'm saying it looks a bit, fishy if things go completely unexpected and still the market is okay. It should. That's what I think.
Correct. No, absolutely. On pharma, Samir, do you have a view?
See, pharma clearly has relatively benefited and in absolute also benefited. The only thing is that Trump has said that he wants to have 5 sectors in US which he wants production there, manufacturing there, whatever. So if he has some sectoral tariffs, I don't know. But otherwise, obviously, it's relatively escaped, and in absolute also escaped. So that way, it is justified for that to be up today.
But Samir, finally the question is कि करना क्या है? You're saying 3-4 days do 3-4 days. Okay, चलो 3-4 days. You're saying don't do anything. Just watch this, understand it. Beyond that.
So बाद में it depends. As I said, if the US has escaped it, it'll fall for sure. But it doesn't fall apart. Then this emerging market flows will come. Somebody will go and explain that India has outperformed. India is this. We will say we have less intensity of exports, and our exports, the total absolute amount that we need to do is $30 billion. And in 5 minutes, you can make this thing that 10 billion you can import oil, 5 billion you let cars come in, which will be about 3% of India's car volume. If you say 5 billion divide by say $25,000-$30,000 per car, so you can import 150, 160,000 cars. It is just 3% or 4% of India's volume. It doesn't change the world. So you got 15 billion covered. Another 15 you have to find here, there, something, and you can say, hello, my deficit is down. Story over. It's not a big deal if you have to explain it. But if in between they say, but US is down 15%, what is the secondary effect of that? Then it becomes very confusing. Also right now, since IT is doing badly and consumer large companies are doing badly or not doing great, we are left with financials and a little bit of my food delivery type high growth companies and a few here and there. So that universe should expand a little bit. It just needs a little bit of time, I think. Just give some time so that a new story can be firmly in place rather than just saying it didn't fall today, therefore the bottom must have come. That's all.
So while we're making the narrative over the next 3-4 days, Samir, is there a case to sell today and watch the dignified decline from the sidelines?
No, I don't know whether it'll decline, but what I'm saying is we must see not 3-4 days also, it could be 2 weeks also. What I mean is
so why not sell today and watch, right? What's happening? Is there a case for that?
Well, we have shorted a little, but we are not selling anything now that, we have come in absolutely distancing ourselves from IT and from these zero growth companies and anything to do with US. Please understand the risk right now is not India like it was 3 months ago. It is what happens to the US and its effect on India. I don't think the effect is on direct India. It is what these policies mean for US in terms of inflation and other things. Today, I think JP Morgan or somebody is saying 150 or 125 basis points increase in inflation. Right now on Bloomberg, I saw somebody saying no interest rate cut this year. It's all going to be driven by US now. So we have to see that market and then react. But I'm saying first day, we can't be jumping with joy, even though one more day has passed without paining us. So that is good.
All right, Samir, absolutely. So we will wait and we will come back and we will chat again. There'll be many conversations over the next many weeks, months. As this story progresses, April 9th is that day, right? You said Vietnam, perhaps tariffs go to 10%.
No, I'm not saying that, but I'm saying logically.
It's possible, yes.
It could be, or maybe a few days later, it could be. Because now they have no tariffs, then what can you do about that?
Correct. No, absolutely. Although there are other longer discussion we can have is what the tariffs itself are not reciprocal, actually. They are based on the size.
But they are a good summary. By the way, they are a good summary. I saw on Twitter, which is a good thing. You can also try. You put this formula on Grok and on ChatGPT, and it says very good formula. Actually, it is a summary. Instead of saying how much is your non-tariff barrier, what is your policy on this sector, that sector, you say in aggregate.
So you're saying they've got on ChatGPT to arrive at these tariff numbers, Samir, on a lighter note.
Sorry, what?
No. I was just joking. I was wondering.
Is embracing AI and Grok.
It's AI, Grok, ChatGPT. That's how they've arrived at this glorious number of 27%.
For sure. They must have said, give us a good, easy number.
What's a good tariff for India? What's a good tariff for Vietnam? Okay, chalo, let's go with this. All right, Samir. We really look forward to more conversations. We, of course, need much more clarity as this juggernaut rolls on. Thank you so much for joining us this afternoon. Okay, on that note, I think we have to take a quick break. Yeah, we'll do that. Market's still down about 80 odd points on the Nifty. Take a break. We'll come back on the other side. We will have Pathik Gandotra and Gurmeet Chadha joining in to talk about the market verdict after Liberation Day.
very tough, very, very tough. The Prime Minister just left, and he's a great friend of mine, but I said, you're a friend of mine, but you're not treating us right. They charge us 52%. You have to understand, we charge them almost nothing for years and years and decades. And it was only 7 years ago when I came in, we started with China and charged them. We took in hundreds of billions of dollars from China in tariffs. And they understood, honestly. President Xi understood. He said, look, I understand. And the other countries, and they all understand, we're going to have to go through a little tough love maybe, but they all understand. They're ripping us off, and they understood it. Prime Minister of Japan, Shinzo Abe. He was a fantastic man. He was unfortunately taken from us, assassination. But I went to him and I said, Shinzo, we have to do something. A trade is not fair. And he said, I know that. I know that. And he was a great gentleman. He was a fantastic man, but he understood immediately what I was talking about. I said, Shinzo, we have to do something. He said, I know that. And we worked out a deal, and it would have been a much better deal, but frankly, there were many years left in the deal that was made previous to my getting there, but it was.
Welcome back. Well, from the broader markets, a couple of stocks actually are cutting their losses. Navin Fluorine, I recall earlier this morning, it was down close to around 5%. That's down just 1% or thereabouts. So good recovery is what we're seeing on that one. Pfizer was another stock that's seen a good recovery in the last few minutes. And Tata Communications, well, that one has spiked to the high point of the day. So good going on some of these names. But let's focus on the markets yet again. We have Pratik Gandotra, partner Drone Capital Advisors, as well as Gurmeet Chadda, Managing Partner and CIO at Complete Circle, who join us in the conversation. Hi, gentlemen. Thanks a lot for joining in. Pratik, let's come across to you first. What do you make of what you heard from President Trump overnight? The tariffs now have been announced. All eyes on whether or not there is some renegotiation and negotiation. But how are you placed currently? What would you do? For the time being, we're celebrating that the Indian markets have done a relative outperformance. But are we calling it too early?
The Indian markets are obviously outperforming because we have been better placed on a relative basis vis-a-vis all our competitors. China is anyway, I think, out of the race because it has issues other than just trade with the US. And with the other near-term competitors in various sectors, you find that India has had a relatively lower tariff. Second point, it appears that these tariffs are based on not absolute duties, but absolute quantum of trade deficit. And so given the fact that, say, countries like Vietnam, Bangladesh, etc., smaller countries which compete in some of our sectors, apparel, say, for example, they will not be able to bridge this gap on a sustainable basis because they physically can't do it, whereas India can. And so we have a chance to build on these duties and to try and reduce these duties on us and are at an advantage on an absolute basis right now. And also going forward, we can have a stronger advantage over them. And so obviously, I think we are at a very, very significant advantage. You may have obviously near-term issues about a sudden increase in tariffs, obviously hits contracts as they are live. So there may be some volatility in margins, etc. But overall, I think it's a great opportunity for India to at least significantly improve its share in the worldwide in the labor-intensive sectors.
Gurmeet Chadda, Managing Partner and CIO at Complete Circle, is also with us on the show. Gentlemen, afternoon. Gurmeet, what have you done today? There's not been too much volatility, surprising, but have you made any trades?
Not much, Rima, to be honest. I think you have probably seen the second leg of this. You can probably divide it into 4 parts. I think the third leg would be when the negotiation starts, and if they don't do, retaliation happens. We'll have to see how China does, how Europe does. There's that clause 4 in the executive order where a lot of countries will try and negotiate back in terms of the relative tariffs. So for now, I think pharma clearly stands out. I think that's been exempted, but you don't know how things pan out. So I think we've added a little bit of branded pharma. We added some CDMO names in the portfolio. We have Mankind Pharma, we have Laurus, we have Newland and Hikal. So we have a decent healthcare portfolio, and we have been overweight on it for a while. So that's helped us. We are continuously looking at more domestic consumption stories right now. I think banks will gain with bond yields falling, treasury incomes going up. That will offset the NIM pressure. And then you have an RBI policy on 9th as well. So Bank Nifty obviously has also done well from relative lows. And we are looking at some, travel tourism plays. So we are right now adding domestic consumption and bit of financials and pharma. And wait out for 4 or 5 days. I agree there could be some opportunities which will come because the relative tariff on Asian peers is far higher. And if India is able to negotiate well over the next 4 or 5 days, a lot of opportunities may emerge. But for now, just wait it out for 3 or 4 days, one day at a time.
Absolutely. And that's exactly what Sameer was also saying, that there's no need to fire the gun immediately. Sit back, observe, see what's going on, and then decide what's the best course of action. Take your point, Gurmeet. By the way, let's look at some of the textile stocks, and they're soaring. They're doing really well in trade today. Arvind, Gokuldas, and Trident. And if you'd wonder why, given the 27% tariff on India, that's because others have been taxed a lot more. Our major competitors in textile and apparel, which would be Bangladesh, Vietnam, and countries like Sri Lanka. So let's go across to, I think, Vinny. Vinny is now standing by to give us a better perspective on whether Indian textile makers actually stand to gain. Vinny.
So absolutely, when you look at it in terms of a tariff that's charged on India, 27%, it seems like a lot. But versus the other countries that we're seeing, whether our main competitors, Bangladesh, China, even Turkey, Japan, Taiwan, the percent that is charged to them is much higher. So yes, versus the other countries, we are charged much less, and that turns out to be a bit of a benefit for all these companies and exporters in India. Now, we had a note that came in from Prabhudas Leela this morning as well. They said this tariff will actually give an edge and an opening for India in terms of an opportunity in the US market, because other countries would become much more expensive. Currently, in terms of textile exports as well, the shipments that are made to the US is totaling to around $2.8 billion in FY24. And the share of US apparel imports for India as an import country is very less. India is just 6%. When you look at China, 20+%. Vietnam around 20% as well, and Bangladesh is around 9%. So yes, our share in the apparels is also very less in the US market. So not much of an impact that comes in for us, but it becomes an opportunity because then they would want to increase the share. The 6% could further increase as an opportunity versus China, Vietnam, and Bangladesh. Now, other than that, what Prabhudas Leela is highlighting is that Indian exporters, a relief tariff advantage would come in, enhancing the competitiveness by around 10 to 20 percentage points for the Indian players in the industry. Arvind Limited, when we spoke to them earlier as well, they said that they expect these new trade agreements that are going on in the market in US and UK to be a bit of a benefit. Bilateral trade agreements will come in. That is more exciting for Indian textile industry, as well as the Indian textile industry will now look at a more holistic approach, especially for the Western market. So a positive cues that are coming in for the textile front, despite this 27% tariff.
Got it, Vinny. Thank you very much for that. Let's take this conversation back to our guests. Pathik and maybe Gurmeet, I mean, if either of you, both of you can comment on this. Textiles and apparel as a space, I mean, these stocks have not dominated market imagination for obvious reasons. Individually, yes, these companies have been doing well. Gokuldas has been one of the biggest exporters for a long time. But perhaps it was a bit of an opportunity lost in the last 20 years because other countries, were way ahead of us in the race. So now is it a case to relook at some of these mid-cap or even small-cap textile and apparel exporters? Gurmeet?
So, I think we should wait for the end consumer demand in US to pan out. While relative tariffs are lower, but if the end demand, sees a slowdown, it won't affect. So Gokuldas is more uniquely placed because 80% is US exports, and they also acquired one plant in Kenya about 6 months back, where the tariff is 10%. So there, the effective tariff for their acquisition, they did one in Middle East, and now, would be relatively lesser than even, let's say, whatever the rate is, which is around 25, 26%. So that's an advantage. KPR Mills also, to a certain extent, is fully integrated. So you have to be a little selective here as far as, textile goes. So if you see, for example, Vietnam is 46%. Even Thailand, Indonesia are mid-30s. Bangladesh is pretty high. Bangladesh was something where India and Gokuldas competed on a lot of things. Gokuldas does these labels called Superdry, Adidas, Puma, the Merchant Navy, Indian Navy brand in US. So I think Gokuldas in particular, post the change in management, has done well. But I would wait out for, if the US economy, let's say, broadly goes into a hard landing or a recession, then these things don't really add up. It could be right now more a reaction, more to do with the positioning of the stocks rather than anything else.
Yeah, I guess that's why they say that ultimately you cannot take away that big line, right? When the US catches, or when the US sneezes, the rest of the world catches a cold. So while there could be an opportunity if US consumers aren't buying, then really what are we talking about? Got that point. On pharma specifically, Pathik, what would your call be? Would you still be wary of companies that have a big exposure to the US market? Or are you happy to own those names, who are far more dependent on the US sales?
I'd like to add to Gurmeet's point. Just one point I want to add before I comment on pharma. See, the US demand, I guess, obviously will be optically, it looks like will get impacted because of the tariffs. But also remember that the president has said that he will cut taxes across the board, and numbers of around $400 to $500 billion in tax cuts is what they are thinking about. So if those tax cuts come, it's like you populate one pocket and take it out of the other pocket. And so all those things are also material to figure out as to what demand will be. And I agree, you have to wait. But the picture isn't as sordid as it appears. That's my point on April. Second, pharma, I think, given the fact of the criticality of medicine, and also the fact that there are not too much of capacities which are coming up in the US, I think the pharma sector will be dealt with leniently over a period of time. So I would go out and look at decent companies in the CDMO space, and I would agree with Gurmeet as to what he said, that look for good quality names in the CDMO space, which have firm contracts with large majors, and those would be very interesting. I would not obviously go for just normal exporters because, who just export generics. I think CDMO is a more preferred space.
I think Samir was just telling us that he will absolutely stay away from the Indian IT space. In your portfolio, do you own Indian IT? And now what would the approach be?
No, I don't own any IT. Absolutely zero.
All right. And the advice would be continue to stay away.
Yeah, I mean, we look at, actually, it's not specifically about the IT sector at this point in time. We do look at companies from time to time. We are bottom-up focused. We don't mirror the indices or anything. We don't look at large companies in any case. And so, I mean, I'm not the right person to answer the question.
Okay, all right. We'll leave things there. Gentlemen, thank you very much. We'll have, this is, I'm assuming, the first of many conversations, and the word tariff isn't going anywhere as much as we like it to be. So thank you very much, Gurmeet and Pathik. Appreciate your time here on CNBC TV18. Just about 30 minutes to go, 28 to go for the market close. Last 30 minutes coming up. I think we'll take a quick commercial break here. Well, there's always chatter in terms of specific stocks, in terms of what's happening in dealing rooms, and Nimish gets us that on the other side.
Welcome back. We are, of course, analyzing all the key developments of the day, including the impact on India when it comes to these tariffs. Just very quickly, I just want to summarize what Morgan Stanley has already put out. Their economist, Upasna Chachra, has put out a note already saying specifically in terms of numbers what this means for India. So they're saying that their original estimate for growth was 6.5% for FY26. Now Morgan Stanley is shaving off 30 to 60 basis points from that growth estimate. And the issue is they're saying the direct hit is not that important for India. It is the second order effect, which is far more concerning, where they're saying that this whole uncertainty around the business environment will probably dent corporate risk appetite, and therefore it will further delay and derail and push back the private sector capex cycle that anyway has not been showing signs of taking off. And then there could be a risk of even deeper monetary policy cuts than what has been anticipated at present. They're saying the government in that case will have to perhaps step in. It will have to stop its fiscal consolidation, thought process or roadmap and start priming the economy with further capex spending, basically a boost of capex spending in the worst case scenario. So coming down to the numbers, they're saying that the monetary policy stance is expected to remain supportive. In fact, they're expecting a change in the stance to accommodative on the 9th of April itself. 25 basis points rate cut is also expected in the April policy. So expecting on all hands on deck, as they say. That's the Morgan Stanley view. Now, what is the Indian government's response? There is actually, a statement that has come through. We have Abhimanyu joining in to tell us exactly what the government of India's official viewpoint on this is now.
Post-announcement of reciprocal tariffs by the US president, the Department of Commerce has issued a statement saying that it is assessing and studying the situation and is also engaged in consultation with stakeholders. It's taking feedback from relevant stakeholders, which include traders, exporters and manufacturers, and is going to calibrate its further decisions based on the consultation itself. Also, it has noted the imposition of additional ad valorem duties ranging from 10% to 50% on imports from all trading partners of the US, and a baseline duty of 10% would be imposed from the 5th of April, and the remaining country-wise duties, that is the additional ad valorem duties, would be effective from 9th of April onwards. The total duty which is going to be imposed on goods from India is going to be 27%, that is 10% baseline duty plus 17% ad valorem duty. It remains to be seen how the situation is going to pan out, even as India and the United States are already engaged in talks for the first tranche of a bilateral trade agreement between both the countries, in which both the countries are looking to not just increase market access for each other's products, but are also intending to grow trade, investments and technology transfers. Both the countries are aiming to double their overall trade and are also aiming to ensure that the first tranche of the BTA is concluded by the fall of 2025.
Okay, all right. Thanks a lot for that, Abhimanyu. Well, the markets are a little bit lower, but as we've been mentioning, the good news is breadth is good and the Nifty Bank is good. Let's get in Nimesh on D Street Chatter. Nimesh, I mean, very good performance, one would have to say. Yesterday you thought that, we were preempting something, but today had a gap down and that gap got bought into, and the breadth is something that's really encouraging.
So breadth has been positive for the last many days, right?
Yes.
So that's been the trend, and that shows that there is momentum and commitment now again in the broader market stocks. But as you rightly pointed out, good recovery from the intraday lows. Bank Nifty is in the green. I guess there is a clear shift now happening from IT to financials. And what has helped financial today is that the Q4 updates across most of the banks have been quite decent and strong, right? So that's also helped at the margin. I understand even a couple of other banks which are going to report the quarterly updates are likely to report good numbers, the likes of Bandhan and also. Maybe that's the reason that all those banks are buzzing in trade today. Flows, again, it's quite mixed. I said yesterday as well, there was no big buying or big selling. That seems to be the trend today as well. There is no big commitment or a big sell-off, so to speak, from larger institutions again in today's trade. Technically, 23,800 is the level to watch on the upside. And that's a level where you might see some supply coming in. But broadly, the way India market has bounced back, at least it suggests that there is momentum clearly, and there is no big selling happening from the large institutions.
Well, that's right. At least the broader markets and the outperform portfolios feel good. And it seems, the interest is back in those names, which is heartening. What about individual stocks? What are you picking up?
So, a lot of stocks are buzzing in trade, and there is a lot of chatter as well across many companies with regards to fundraising. I'll highlight a couple of them, but there are a few more as well. First one is Parag Milk. That's been buzzing in trade, good volumes as well. The stock is sharply recovered from the recent lows of 140 back to 180 levels. And now there is a buzz that maybe there will be a board meeting for fundraising very soon. It's likely that there will be a preferential issue, and even the promoters may participate in this fundraising. So that's a trigger in Parag Milk. The second stock is IIFL Finance. Again, that's from the recent lows. I've seen a bit of a pullback. There has been a lot of chatter with IIFL Finance as well. But I understand even there is a very high chance of a fundraising plan very soon in IIFL Finance. So that's the reason why that stock is buzzing in trade. I guess that's the kind of buzz for a couple of names like IDFC First Bank as well. Third stock is DB Realty. Again, a decent pullback from the recent lows, and the HNI activity is quite strong in the last many days. I understand some large HNI investors have started buying again DB Realty. And the last is a couple of stocks where this is delivery-based buying from larger institutions, JSW Infra and HDFC Life. Both these names stands out because after a long time, some sort of interest seems to be back. The stocks are flat, but I understand there is delivery-based buying, though it's price limit, but there is buying interest from larger institutions in both those names, JSW Infra as well as HDFC Life.
Okay, all right, got that. Nimesh, thanks very much as always for all the buzz and the chatter from the street. We'll quickly go back to Mitesh. I think we have him with us for some final thoughts and comments. Mitesh, so the roller coaster is leaving us about 74 down. Who knows what overnight news flow is going to be like. So final advice on the indices and any quick trades.
So, good afternoon, Surabhi. I think in the morning also I was saying that it is the bank Nifty which will do better than the Nifty. And I think that trade is continuing. If you look at the structure on the daily, weekly chart, the bank Nifty is much more stronger. And therefore, the focus should be on the banking index and some of the financial names. Nimesh was mentioning Bandhan Bank. I think that stock has given a breakout. December, we had some positions. We just booked part of it. That apart, I think, Axis Bank looks good to me. So as a BTST trade or even a short-term trade, I would be comfortable recommending Axis Bank. Buy here with the stop just below levels of 1082 for a BTST trade. Look for a 1105, 1110 as the target for tomorrow and day after. And the other one is ACC, which is a BTST. It's closing near the day's high, so very strong chart pattern over here. ACC is a BTST with a stop below 1980 and look for a target of around 2015.
Okay.
All right, Mitesh, thank you very much for that. So those are some trades coming your way. GMR Airports is another one which we're going to talk about. Stocks up 3-4%. There've been some sort of broker commentary initiation reports, and this time it's Citi. Vivek is here to wrap it up for us. Vivek.
Well, that's right. So GMR Airports was in the news a couple of days ago after the Delhi airport finally received the tariff hike. Now, today, Citi has initiated coverage on the stock. They have a positive view. They have a buy stance, and they have a target price of 90 rupees per share for GMR. They call it an Indian airport pure play business. They say that the company is fundamentally well placed, where they see India's passenger volume growth at 8% CAGR from FY24 to FY27. They also say that the company's assets actually possess comparative advantages, especially when you're comparing it to the rest of the Asia Pacific pack. The free cash flow cycle is turning positive for GMR, and one of the key triggers is the fact that Citi, along with other brokerages, are now expecting that FY26 will be a profitable year for GMR after a while. Core earnings for Citi stands almost 5 to 6% above street estimates. Along with that, they see FY27 EV to EBITDA at 18 times, and this is almost double the APAC average, given the fact that, and they justify it saying that the Indian airport business has stronger structural organic as well as inorganic growth opportunities. What will drive profitability for GMR in FY26? 8% traffic growth, 2.4 times increase as far as the tariff is concerned, especially in the Delhi airport, and 7.5% per annum increase in non-aero spending per passenger across all three of the Indian airports that GMR actually operates. That's Delhi, Hyderabad, as well as Goa. One of the top movers in trade today is GMR Airports.
Thank you very much for that. And one of the top losers is all the IT names. In fact, across the board, there is no respite, whether it's large cap names like TCS, HCL Tech down 3.5–4%, even mid cap names like Persistent down close to about 8%. The problem is companies are trading at valuations higher than the pre-COVID level and growth is struggling. So that plate of the current valuations versus the pre-COVID valuation. We're comparing it to FY19 because post-COVID growth boomed. There was this entire digital transformation wave. Growth rates were much higher. Hence, we're going back in time to the time when growth rates were fairly muted. And currently, as you can see, large cap IT names are trading at a valuation premium compared to the pre-COVID level. So, for instance, TCS is at 24 times. Pre-COVID, FY19, it was close to about 22 times. Now, growth rates for the companies are going to be very, very muted. Now, I'm putting out the JP Morgan estimates for FY26, and you can see the growth is likely to be low to mid-single digit. In fact, closer to low single digits in FY26. They're baking in some amount of macro uncertainty into this, but no one knows the full extent of that. Mid-caps are seeing a bigger knock today, particularly names like Persistent, KPIT Tech. One, because these stocks have done so well. Persistent has doubled in the last 3 years, even after the recent correction. And these companies had seen a very sharp valuation re-rating post-COVID. That's the number. So, for instance, Persistent, which used to trade 13, 14 times PE, is now trading at 45 times. At its peak, it was even closer to 50 times. A KPIT Tech at one point of time was trading close to 50, 55 times PE. And pre-COVID, these were all in their teens. So mid-cap valuations got re-rated substantially, and now that is coming off. Now, Jefferies has come out with a note as they assess the impact of Trump's tariff order. They say the IT sector is not directly impacted, but it can be indirectly impacted. And the way they're looking at it is sectors like manufacturing, retail, and logistics. These are sectors which could be negatively impacted by the tariff. So companies which cater to them, they have a higher exposure, could be negatively impacted. The second impact that they're seeing is that if US growth slows down, there is a possibility of Fed cutting rates. If that plays out, then companies with high debt on their books, so for instance, communication, these could positively benefit. And then you've got pharma, which is, escaped the entire, Trump tariffs. So they've put out the math about the companies with the highest exposure to manufacturing retail, and that will come up for you on your screen. So if you do all the second order impact of the affected sectors, they're saying Tech Mahindra, HCL Tech is best placed from a favorable vertical exposure. And in the mid-cap space, it's IKS and Sagility, because these companies get 100% of their revenues from healthcare pharma, which are completely unaffected. So IKS, Sagility, recent listings, they're sort of catering to the insurance companies, medical insurance companies. They cater to many of the hospitals, clinics, 100% revenue from the healthcare in the US. And these stocks have done pretty well compared to the pre-IPO prices. Amrish Baliga is now joining us on the show. Amrish, a quick word on IT. Did you own any IT stocks? Have you cut down your exposure? Are we overreading the impact?
No, in fact, once there was talk of tariffs, that is the time we started. We stopped buying fresh into IT. Whatever we had about 6 months back, we're just holding on, but we are neither sold nor bought fresh. And clearly, I think, with the expected slowdown in the US, I think the IT sector as such could get affected. But that doesn't mean that one has to really go out and sell off immediately, because I think it's better to wait and watch.
Okay, all right. Amrish, before we ask you a few more questions on a lot of stocks, I believe you have a pick for us. Varun Beverages is the one?
Well, I think the theme, at least for the next 6 to 9 months, would be manufacture local and sell local. And Varun Beverages actually fits in quite well out there, is not affected by tariffs. One of the largest franchisee of PepsiCo globally, outside US. And the India footprint is across 26 states, about 6 union territories. Around 90% of PepsiCo's India volume comes from Varun Beverages. And after the buyout of Bevco of South Africa, they've expanded in the African region and have clearly improved the footprint in the last year or so. In India, they have about 40 lakh retail touch points, and they're growing at about 10 to 12% out there. And the available retail touch points universe in India is about 1.2 crores. So I think there's a huge headroom still left. If you look at the carbonated soft drink category, about 70% of the total beverages is carbonated soft drinks. And the juice category is about 6% of the sales volume. Water is about 20% of their volume. And the main season actually starts with summer. And since summer has started and the weather report also indicates that the summer will be severe with heat waves, it should be positive for Varun. Generally, the energy drinks consists of about 14 to 15% of the total beverage market. And here, their brand Sting energy drink is about 72% of the market share. Expected revenue growth is about 20% CAGR over the next 3 years. PAT CAGR, I'm expecting about 25%. So expected EPS is around 12 rupees for calendar year 26. They don't follow financial year, it's calendar year. So the target is about 660.
660 on Varun Beverages, and that would be your preferred pick. Completely take your point, Amrish, that this is very much the time to look local, invest local. I guess we don't have to worry about the global headlines. But speaking of local and speaking of consumer, Dabur. So what's going on here? I mean, clearly you're not negative on overall consumption, which is why your pick is Varun. But look at what Dabur is saying. I mean, they're talking about a margin fall of as much as 175 basis points. They're saying that the India FMCG business will decline in mid-single digits. Stock is down 6%. Your thoughts?
No, I mean, see, I think the management is, being too cautious at this point of time. And also, to a certain extent, they will also get affected, as far as the US sales is concerned, because the huge Indian population there also buys the Dabur goods. So I think that effect also would be there. So both these have, in fact, made the stock come down by about 6-7% today. But then I think it's a buying opportunity, because if you're talking of, at least a year plus, I don't think one can go wrong with with the sort of a market and consumption where Dabur is. So I think this is a good time to start buying.
Got that. Amrish, do stay on. We still have about 10 minutes of trade left before we can wrap this trade. As we get into a break, here is some good news for all our viewers. India's business news leader is now just a click away. Introducing CNBC TV18's all-new app. Get instant access to breaking news, our articles, financial world updates at your fingertips. Download the app now from the Apple or the Google Play Store, or you could just scan the QR code on your screen.
Baton of power set to shift, Bharat's youth will drive the next wave of change. The biggest leaders and policymakers, global trendsetters, business icons, and entrepreneurs will come together to inspire the next generation of change makers. Don't miss your chance to witness it all live. Rising Bharat Summit 2025.
Welcome back. Well, the markets are holding with that card, but I'll tell you what, I think you need to turn your attention to the dollar index. That one slipped below that 102 odd mark. At the start of today, it was hovering a little above that 103 odd mark, but the dollar index has now moved to around 101.7 from emerging market perspective. Normally you see a weaker dollar index. That's good for emerging markets. So let's see how that plays out. But Amrish is still with us. Amrish, I wanted to ask you about a couple of these stocks that actually have seen a sharp correction. Yeah. Z Enterprises as well as India Mart. Either of the two interest you? Because as we speak, both of them have moved to the high point of the day.
Z is one stock which I would surely recommend at this point of time because if you go by the last earnings, we are clearly seeing some uptick in margins, in terms of subscription as well as the ad revenues. And whatever issues were there as far as the management was concerned, to a large extent, it's been sorted out. So at these levels, after it's become 1/3 of what it was close to about 12 months back, at these levels, valuation-wise, it looks quite decent. Downside seems limited. I think the upside can easily be about 30-40% from here.
Okay, all right. You're thinking that there is enough of value. And in fact, the management commentary as well at the end of Q3 was fairly positive that for FY26, they're expecting margins to improve. The promoter entity came in there. They bought, I think, 0.2, 0.3% from the open market. All of that is encouraging. Let's focus on a couple of other names then. BHEL, I'm trying to look at some domestic-facing sectors. Any view on BHEL or Suzlon? Do you like either of the two?
Suzlon, I still think at these levels, it is still, decently highly priced. So I would not buy really fresh into Suzlon. In case of an upside, I would say those who have been holding since it was 8-9 rupees, I think it's still time to book some profits. BHEL, I would surely hold and possibly buy more on a decline, clearly looking at the sort of order flows which it has and more of that India-centric approach. I think, at levels of closer to about 195, 200, it makes sense to buy BHEL.
Okay, all right. Got that. What about Hitachi Energy? I'm just looking at the exchanges. That's some communication that's come out on an HVDC order out there as well. The stock, remember, the last 2 years has moved from 3,000 rupees. It's moved up, I think, close to around 4 times because it's hovering around the 12,000 rupee odd mark. Hitachi Energy?
Nigel,
yeah.
I track this very closely, so difficult to give comments on this.
Okay, whatever. Let's focus on a few more domestic-facing themes then. Cement. I'd done a presentation around 3 weeks or so ago. I said there's too much of uncertainty with regard to what's going on in the globe. And with cement, we're expecting demand to come back because now the capex spends is there. Housing demand is pretty okay is what we understand. Pricing in all probability has bottomed out and input costs have cooled off. Anything you like in particular? Any particular stock you like?
I also believe that this year cement should really do well because whatever said and done, the infra projects have taken off. I think execution, which was the key, should be really good in the current financial year. And along with this, looking at the way the input costs have come down, and there is clearly a delay between the demand increasing and the supply also increasing. So since a greenfield plant takes about 3 years plus to be built, I think there would be some sort of a gap there because of which we could see the prices also increasing. And that should be good for most of the cement companies. So Ultratech Cement is my best pick in this space.
Tejas Networks is a big mover today. That's up close to about 10%. There are reports which suggest that the company has got 61,000 crore of a 5G spectrum allocation. So the DoT has allocated spectrum to BSNL in certain 5G bands, and with this, the company will be able to launch 5G. Now, it's seen as a positive for Tejas Networks because BSNL had given the order to TCS, and TCS had procured equipment from Tejas Networks for 4G. And even the company, Tejas Networks, in the Q3 presentation that they put up on the exchanges, had spoken about the opportunities that they're targeting, expansion of BSNL's 4G network and 5G upgrade, and 5G's standalone network build-out. So stock is quite excited in trade, and I think now Vardhaman Textiles is locked in an upper circuit of close to about 20%. So limit up on Vardhaman Textiles. Amrish, Tejas Networks, is that a stock that you look at? It's down 25% year to date.
Yeah, that's true. I think the correction was decent for this stock, and even the margins that come down earlier. I think that was one of the reasons why for the stock to correct. And I expect the margins to start moving up from here. So I think at the current levels, it can be bought.
Okay. All right, let's start wrapping up what has been a roller coaster day, and the end result actually is far better for India than many of the markets that have shut shop. Most of Asia has closed anywhere lower by 1 to 3.5%. Europe is down between 1 to 2.5%, and US futures are still down by as much as 3.5%. So contrast that with the Nifty's decline of less than 0.5%. It's not bad at all, and the mid-cap index is actually positive. So is the Bank Nifty. Let's pull up the Bank Nifty. It's up about 0.5% as we speak. So let's start with the good then. What worked? Clearly a move towards some financials, a move towards some PSU stocks, Power Grid, and of course Pharma was the sector of the day for obvious reasons. So Power Grid, Sun Pharma, Cipla, NTPC, BEL, these are some of the names which have seen buying. Some consumer names like Nestle also making the cut. Asian Paints on the higher side, Titan on the higher side. So Pharma, consumer and PSUs. That was the buying flavor today. On the flip side, IT took it on the chin because it stands exposed to a lot of US risk. So TCS, HCL Tech, Tech Mahindra, Infosys, big knock on these stocks. TCS is the worst performing stock on the Nifty, down 4% as we're closing out. Bajaj Auto, JSW Steel, Hindalco, these were some of the other names that were weak. Bajaj Finance, Kotak Mahindra Bank also on the lower side of the screen. Final tally on the Nifty at least is 90 points, but mid-cap's actually closing positive, guys.
Indeed, mid-cap index up 0.2%, small-cap index up in the green, positive advanced decline ratio, 1,900 stocks gaining today compared to 750 stocks are declining. Lots of other themes playing out. So textiles did well. So Vardhaman Textiles 20%, Trident, Gokuldas Exports ending with a gain of about 7 to 7.5%. The hope is that India emerges as a preferred destination for textile manufacturing. Lots of BFSI banking updates came through. IDFC First, ESAB Small Finance Bank, Poonawalla, AU Small Finance Bank. These are companies that came out with the Q4 updates. Stocks closed up in the green, 4-5%. And on the way down, Dabur was the big casualty on the back of their Q4 subdued update. We'll take a leave on this show, but don't go anywhere. After a short break, we'll be back with Markets Forward.
माननीय सदस्य लोग ये कह रहे हैं कि हमारे सदस्य नहीं है यहाँ पर जो हमारे साथी हैं, लेकिन अध्यक्ष महोदय मैं ये कहना चाहता हूँ ये जो बिल लाया जा रहा है, भारतीय जनता पार्टी में एक मुकाबला चल रहा है। भारतीय जनता पार्टी के अंदर मुकाबला चल रहा है कि खराब हिंदू कौन बड़ा है। और ये बात अध्यक्ष महोदय मैं ऐसे ही नहीं कह रहा हूं। जो पार्टी ये कहती हो कि दुनिया की सबसे बड़ी पार्टी है, अध्यक्ष महोदय वो अपना राष्ट्रीय अध्यक्ष नहीं चुन पाए अभी तक। अध्यक्ष महोदय भारतीय जनता पार्टी क्या है?
जी मैं अखिलेश जी ने बहुत हंसते हंसते कहा है, इसको हंसते हंसते जवाब देना। इस सामने जितनी पार्टियां हैं उनका राष्ट्रीय अध्यक्ष उन 5 लोगों को ही चुनना है परिवार के। हमें माननीय अध्यक्ष जी करोड़ों सदस्यों में से 12-13 करोड़ सदस्य प्रक्रिया कर कर चुनना है तो देर लगती है, आपके यहाँ जरा भी देर नहीं लगेगी। मैं कह देता हूं अभी 25 साल तक आप अध्यक्ष हो जाओ, नहीं बदल सकता।
अध्यक्ष महोदय, क्योंकि जो बात निकल के
A much better performance for the Indian market, almost some could say a bit of a relief after the suspense around Trump's tariff ends. We got clarity last night. The Nifty managed to hold on to the 23,200 level. The Sensex ends near the 76,300 level. IT as a sector took the biggest knock. Pharma stocks cheered.
US President Donald Trump slaps hefty tariffs of up to 50% on trading partners, keeps Canada, Mexico out of the picture. India is at 27%. The Indian market escaped the pain, but US futures stumble amid inflation and trade war concerns. World leaders hit out at Trump and call for retaliatory measures.
Well, the Indian government is taking stock of the situation after US levied reciprocal tariffs on India. Sources say India is not in favor of any knee-jerk reaction. The 27% duty on India is less than that imposed on China, Vietnam, Indonesia and Bangladesh, giving India's textile and electronics exports an edge over other Asian countries. Hello and welcome to a fresh new edition of Markets Forward. It was a busy day. The start was early and for some there was no sleep, I guess. This is, of course, Markets Forward, your go-to program where we aim to get you everything you need to know as you prepare for the next session. I'm Prashant. With me, my colleague Rima. Rima, hi.
Hi. I think the one word which describes today is resilient, right?
Yeah.
In the face of so much uncertainty, chaos,
yeah.
we were just down.
100%. I mean, when Samir Arora was with us of Helios during the closing session, he was saying...
too good to be true, kind of.
Suspiciously strong. But anyway, I mean, that was essentially the reaction. So it's just about 80 points lower. Could have been any other day, and that would be true. For the Nifty Bank as well, I mean, I think the reaction was quite remarkable. We actually ended about 0.4% higher. Mid and small cap indices, I mean, ended small, but, down small. Market breadth was positive. Okay, mid-cap index actually higher. I think the small-cap index was up, also recovered. So market breadth was positive, about 2.5 to 1. 2,000 stocks higher and 800 stocks which were lower. And this, by the way, is what we've seen here. This was not the same picture that we had in, the rest of Asia, or for example, through the course of the day, if you were tracking the S&P E-mini futures contract or any other number of other things. But here, of course, there was relative calm. A lot moved under the surface, but otherwise, and all told, net, it was not a bad way to end the session after what we heard last night. Rima.
Okay, so let's straight away find out what the numbers look like in terms of tariffs imposed on India and the other trading partners by United States. Hormus is now joining in with the key highlights.
With the kind of day you've had, you'd take that with both hands, especially considering the start that was anticipated after Donald Trump's tariff announcement. So we'll take them through one by one. Of course, a 10% broader tariff announcement on every country that is exporting goods to the United States and additional tariffs on almost 60 countries. But the bigger takeaway was that Canada and Mexico, where Donald Trump was the first country to impose tariffs after he became president, they have been exempt from any further tariffs. Now, the first bit of the tariff takes effect on Saturday of midnight, and the second bit takes effect at 12:01 a.m. on the 9th of April. Now, when it comes to India-specific tariffs, 27% reciprocal tariff announced by Donald Trump. He did mention that although Prime Minister Modi is a great friend, but I've told him that they haven't treated us well when it comes to trade, and hence they charged us 52%, so we are charging you half of that, and hence the 27% reciprocal tariff coming into picture. But as the day got clearer, there were very clear winners and losers, and IT was a big loser in today's trading session. Mid-cap IT in particular, be it Persistent, Coforge, KPIT Tech, all of them were smashed in today's session, not because of the fact that there was any tariff-related concerns, but because of the rising fears of a recession in the United States, which is now a key market for them. Of course, the big winner today was the pharma sector, although most of these names cooled off from the highs of the day, but the Nifty Pharma a clear winner in today's session. The question is for how long, because there is not that there will be no tariffs, there is investigations going on, and that leaves the window open for any future tariff imposition. Another winner in today's session was the textile and apparel garment exporters, be it Gokaldas Exports, Arvind, Raymond, Arvind, Trident, most of these names ending significantly higher in today's session. And we also spoke to the management of Arvind, where they said that they're expecting new trade agreements with markets like the US and the UK, and the Indian textile industry is expecting holistic approach for the Western markets. But the one sector that also was battered in today's session was the shrimp exporters. Avanti Feeds and Apex Frozen. Avanti Feeds at one point was down 18% in today's trade. India is, of course, one of the largest shrimp exporters to the US, and Incred has done an analysis that if these tariffs stay, then the shrimp import duty would now rise to 45%, and hence the reaction in these shrimp feedstocks. So clear winners and losers. It'd be interesting to see how the market moves tomorrow after today's resilience.
All right, Hormuz, thank you very much. A pretty quick, comprehensive look at what the tariff day looked like. Ambarish Baliga is with us. Ruchi Jain of Motilal Oswal Financial Services is also with us. Let's just take a quick look at the market itself. Ambarish, you think the effect will slowly but surely creep in? Today has been resilient?
No, I think the market has taken this in the stride because I think in the last 2 weeks, people clearly were expecting this sort of a tariff imposition. I think the only thing in the last 2 or 3 days, people are expecting some sort of concessions for India, which actually did not really happen. But the positive part is that pharma and IT as such is not that affected by the tariffs. And as far as automobiles is concerned, we are not affected because we don't export automobiles to USA. It's only the auto ancillaries which have been affected. But the way I see it is that most of the large auto ancillaries have operations in US. So I think the effect will not be as bad as what otherwise one would have thought. And if you look at the differential tariffs, I think it's extremely good for textiles. I think that should be the one to actually stand out.
Price action wise, Ruchit, what is your sense? What we saw and what lies ahead?
Hi, good afternoon, Prashant. No, market participants does not like one thing, which is uncertainty. And last few trading sessions, a lot of uncertainty was there related to these tariffs. So I think once that news flows is out, the market is now trying to discount whatever announcements have been done. And the kind of reactions that we have seen, especially in today's trading sessions, where the IT was negative, but certain other sectors such as banking is there, or even the defense space, showed strength. So I think this is clear indications that in the near term going ahead on the index front, we would not see any significant trended phase on either side, but rather a consolidation or a time-wise corrective phase could be seen in the Nifty. So I think for next few trading sessions, markets on the index should consolidate within a range. 23,000 followed by 22,800 are good supports for the market, which should not be broken. And on the high side, 23,500, 23,800, which were the recent swing highs, continues to be the resistance. So I think now focusing more on a sector-specific or a stock-specific approach, if you're a trader, would be a good idea rather than expecting any directional move on the index itself.
Got that. And 22,800 is the base or support for our markets. Let's turn our attention now to the FMCG sector. Both Marico and Dabur came out with the Q4 business updates. Mangalam joins in with the details.
Well, it was a tale of two cities. On the one hand, Dabur was down 6% in today's trading session as the company said that their India FMCG business saw mid-single-digit sort of decline. And the reason for that was, one, delayed winter, secondly, urban slowdown, and thirdly, the general trade slowdown that they're seeing in that channel itself. And add to that, because of flattish revenue on a consolidated basis, their margins would decline by about 150 to 175 basis points, and that stock on the back of that was lower by 6%. Marico, on the other hand, had been an outperformer in the FMCG space over the last 10 to 15 days itself, and they are showing signs of improvement. Yes, there were concerns around margins in the third quarter, but the company has shown sequential improvement out there. The volumes too have seen sequential improvement. The revenue, led by price hikes, have grown in mid-teens. They will, for this year, grow in double digits for the revenue, and the next year as well, maintain that double-digit revenue target. So Marico was a lot better than what Dabur would have you believe about the consumer sentiment, though that stock did not move as much because it had already been an outperformer. So that's the sum and substance of the FMCG updates that have come so far.
Thank you very much for that. Ruchit, Dabur had quite a bit of a fall, 6% down on Dabur so far today. Marico held up pretty okay. What are the charts telling you?
I think this trend itself should continue because if you look at the FMCG space as a whole, we are not seeing any significant participation along with the market up move in the FMCG sector. And Dabur has been one of the relative underperformer within the sector itself. So that low top, low bottom structure is still getting continued. And today's news flows led to further volumes on selling. So whenever we see negative price action along with the rising volumes, that stocks generally tends to underperform in short to medium term. So I think that relative underperformance should continue in Dabur. Marico is relatively better placed. The weekly RSI is showing a positive crossover. So no, I think we should see a slow and gradual move towards 690, 700 in the near term.
Okay, all right. Richard, got that. IT stocks were under pressure, right? I mean, if you just sort the top losers on the Nifty, they were all IT. But outside the Nifty as well, you had sharp cuts in names like Persistent, which was down 10%, Coforge, which fell about 7-8%. Jeffries in a note said that higher tariffs may impact demand from manufacturing, logistics and retail companies in those particular segments. I mean, looking at the reaction, you would think that actually special tariffs have been imposed on the services side, which is not the case. But
I think the problem is that valuations are high. Valuations are much higher than pre-COVID level. We're comparing it with pre-COVID level because post-COVID, there was a digital transformation wave and companies had very strong growth rates going up to double digits. So we're going back in time to pre-COVID when growth rates were far more subdued. And today, companies are still trading at a premium to that, large cap and mid cap. And growth rates are struggling. Now, put up the JP Morgan estimate. For FY26, we're looking at low single digit kind of a top line growth, 1, 2, 3, 4% kind of a top line growth for the large cap IT companies. So therefore, is the valuation premium justified? For mid caps, they've also had a very strong run up, particularly names like a Persistent, KPIT Tech. Now, Persistent, for instance, doubled in the last 3 years. KPIT Tech, even after the correction, is up 104% in the last 3 years. And these are the stocks where we had seen the maximum PE re-rating over the last 5 years. So some of those valuation, froth which was there perhaps is now coming off because growth concerns are rising. Now, Jeffries today in their note, as they assess the impact, says the sectors which could be impacted negatively are the ones with exposure to manufacturing, retail, logistics, because these sectors are facing the direct impact of tariffs. But sectors like communication, for instance, could benefit if US growth slows down and the Fed decides to cut rate, because sectors like communication have very high debt on their books. So therefore, it will help in terms of deleveraging their balance sheet. Also, they're watching out for companies like IKS Sagility because they get 100% of their revenues from the US healthcare pharma sector, which is unaffected. So in the large cap space, they're saying Tech Mahindra, HCL Tech had the most favorable vertical exposure, and IKS and Sagility in the mid cap space. Amrish, I know you told us that you've sort of been paring down your exposure to IT ever since the tariff word came into the equation. But do you own any IT stocks, and which ones do you have right now in your portfolio?
No, in fact, I mean, I've got a few of the large cap ones, which is where I was concentrating on: Infosys, TCS, HCL Tech. These are the ones which are there in the portfolio. And going by, what we saw today, I think it was more of a collateral damage than a direct damage due to tariffs. I mean, there was no tariff as far as this sector is concerned. But looking at the customer sector, which could get affected, and because of which I think the order flows could get affected going ahead. I think that was the fear as far as the IT space was concerned, because of which we saw this correction.
No, absolutely. Let's talk about the other space as well, right? And we're talking about the entire textile exporters in focus. Now, it could be a combination of things. There was at the margin some, not relief, but the understanding that some of the competitors in the space, Bangladesh, Vietnam, Cambodia, tariffs there are also pretty high relative to what's been imposed here. And of course, there's also the fact that these stocks have done pretty poorly. So stocks did well. Vinny is here with the explanation. Vinny.
Absolutely. So, what is happening is that now everyone is comparing India versus its competition. That's China, Vietnam, as well as Bangladesh specifically. Now, India, yes, we're seeing the 27% tariff coming in, which is higher versus what we were previously charged. So, on that front, yes, surely that is an increase on that import duty. But China, that has been charged 34%, and there's already a 20% before that. So, overall, it's going to be 54% for China. You do have Vietnam, that is 46%. Bangladesh is high, and other Asian countries are also quite high in terms of the tariff that is charged. So where you see most of these exports from these countries goes to the US, and that is why that impact comes in, and a bit of a benefit on that front for the Indian players. Now, obviously, this becomes an opening for Indian exporters specifically, because now this means that maybe we could see some bit of those competition, some bit of those companies from US coming into India front. What PL is highlighting, Prabhudas Pilada, that shipments from US are totaling to around $2.8 billion in FY24, but the US apparel imports as an India percentage, that is quite low. India is just 6% versus China is somewhere around 20%. Similarly, for Vietnam, around 20%. Bangladesh is 9%. So maybe now we could see that shift coming in. And overall, they believe that this is a very big opportunity, and we could see orders starting to pick up because the China plus one opportunity, Bangladesh plus one opportunity, where everyone was talking about textile benefiting from those. Now, could see that story coming in. And Arvind Limited also highlighted similar things that, Indian textile industry now may look at this whole approach for the West as a holistic approach, and they may look at more bilateral trade agreements, hoping for some positive signs on that front. And that is what we are understanding in terms of commentary.
Thank you very much for that, Ambrish. The entire global trade landscape has shifted now. But for Indian textile manufacturers, is there an opportunity in this disruption? And your preferred bet?
So clearly, there is an opportunity. I think the opportunity started when we had that political issue in Bangladesh, and from then on, it's been positive. And now, because of this tariffs, I think there's an additional benefit which we are getting. So I think, companies like Arvind, Welspun, Himmat Singh Ka Seede, Gokul Das, Trident, I think these are the ones we should gain because of whatever has happened.
Anything, Ruchit, on your radar, on your tracker, any trades which are coming up, textile, outside textile? What are you watching? What looks like a trade here?
Textiles, I think today it was a news-based up move, so the follow-up move would be very important. It happens many times that there's no follow-up move. So I think I would wait for some high top, high bottom kind of structure. But I think outside textiles, if we see, there's been one segment which has shown consistent strength, which is defense. Irrespective of the market volatility that we have seen over last few days, defense has been one of the space where the price volume action is quite strong. So I think stocks such as HAL is there, Mazgaon Dock is there. These are the stocks where a relative outperformance could continue. So I think if one is looking from a bit short to medium term perspective, then defense would be one sector where we think that still much more upside is left.
I think BDL did very well today as well. Gentlemen, thank you very much for joining in. Need to slip into a short break on that note. On the other side, we'll get you key market voices on Trump's tariff and the impact in the Indian market. Stay tuned.
आगे बढ़ा दूं, अध्यक्ष महोदय, जो बात सोशल मीडिया या और जगह गुपचुप हो रही है, कहीं ऐसा तो नहीं था कि अभी कुछ दिन पहले यात्रा जो हुई है वो कहीं 75 वर्ष की एक्सटेंशन वाली यात्रा तो नहीं थी?
Over 3,000 entrepreneurs, investors, and heirs have made it to the Forbes list of billionaires in 2025. That's 247 more than last year. Not only are there more of them, but they're richer than ever. The billionaires on the list are worth $16.1 trillion in total, up nearly $2 trillion over 2024. Their total net worth is more than the GDP of every country in the world, besides the US and China. The US with a record $902 billion.
Welcome back. You're with us here on Markets Forward. Let's get you some opinion. And we got lots of opinion, varied opinion, ex-policymakers, market participants, of course, global economists on what the implications of this could be. The Trump cabinet is not immune to internal political pressures. That's the word coming in from Sandeep Bhatia of Macquarie Capital. Nilesh Shah, Managing Director at Kotak Mahindra Asset Management, believes Trump is not done yet. Neelkan Mishra, chief economist at Axis Bank, claims reciprocal tariffs are essentially a form of fiscal tightening for the rest of the world. Listen in.
The Trump administration not immune to domestic internal U.S. political pressures and requirements, and the pharma business is definitely integrated into the entire medical healthcare system in the U.S. So we remain positive on pharma. We like Sun Pharma. And this is, I think, an indication of what should be taken as a broader message, is that the tariffs that have just been announced are opening move, and there could be negotiations. India is already in bilateral trade agreement negotiations, and we could see changes in the tariffs for India and even for some other countries.
President Trump has proven Sant Tulsidas correct. Sant Tulsidas wrote centuries ago, Samrat ko nahi dos kosai. And President Trump is proving that for weaker nations, WTO is there. For stronger nations, WTO doesn't matter. In fact, he has historically coined new definition of import duty, which is your trade surplus with US divided by your exports to US. That is called import duty. I'm sure we are going to see one Ivy League case study on this new definition. President Trump has not finished. He will continue to make announcements. And it is up to India as to how we leverage this.
The $700 billion odd of extra revenue that on an annualized level the US will start now to collect is about 0.6% of global GDP. So this is effectively fiscal tightening for the world. So India economically, I think, will be less affected. There may even be new opportunities that come up. So if Vietnam is not in a hurry to bring down its tariffs, then there is a lot of apparel, footwear. India becomes relatively cheaper. I mean, there's a 20% gap between Vietnam and India. Tariffs on Vietnam versus tariffs on India. It's an advantage that can actually start to play out in our favor. I mean, it's very unlikely that footwear and apparel will start getting manufactured in the US because of these tariffs. So there may even be opportunities that come our way. But the channel through which I think the impact will be the worst will be the financial markets. So remember that people are just about starting to cope with the fact that this uncertainty will be there for a long time.
And the uncertainty, I think, is this is one word you can pick out to describe the day, and of course what we heard, the varied opinions that we got. I think that is the word, uncertainty. And that'll play out over the coming weeks and months, since you heard from many of those voices. Well, I think we're going to wrap up on this edition of Markets Forward. Programming continues with more important opinion on the other side. News and updates follow as well. Stay tuned.
Continues to boast more billionaires than anywhere else on the planet. China with 516 remains second, and India with 205 still ranks third, which is 5 more billionaires than we had last year, but not a single Indian has a net worth of over $100 billion. So who's on the list? The richest man in the world is Elon Musk with a net worth of $342 billion, followed by Mark Zuckerberg with $216 billion and Jeff Bezos with a net worth of $215 billion. There are only 3 people in the world with a net worth of $200 billion. Oracle's Larry Ellison, Louis Vuitton's Bernard Arnault, and legendary investor Warren Buffett round up the top 6 in the world. There are 15 billionaires with a net worth of more than $100 billion. US President Donald Trump's net worth has doubled in the last year from $2.3 billion to more than $5 billion, thanks to his social media platform Truth Social and cryptocurrency bets. Mukesh Ambani remained the richest Indian and the 18th richest man in the world with a net worth of $92.5 billion. The other Indians on the list included Gautam Adani at number 22 and Savitri Jindal at number 48. Shiv Nadar was at the 51st position with a net worth of $34.5 billion. Dilip Shangvi at number 79 with a net worth of $24.9 billion. And Cyrus Poonawalla at number 86. Only 13.4% of the billionaires on the Forbes list are women. There are 2,681 male billionaires and only 406 female billionaires.
Make informed decisions with comprehensive analysis on the go.
Strengthen your portfolio with real-time market updates on the go. Create effective strategies with insightful expert opinions on the go.
Grow on the go with CNBC TV18. Now streaming live 24/7 on YouTube. How about listening to global market maestros before crafting your investment strategy? How about getting deep insights into their businesses from top Indian honchos before putting your money on the line? How about making every trading day profitable with strategies from the market masters, macro pundits and chart wizards? Only one show gives you a head start to your trading day. Get ready to profit. Get ready for business with Bajar at these times on CNBC TV18 and CNBCTV18.com.
What does it take to build India?
Hello and welcome to our special broadcast. I'm Parikshit Luthra and here are the headlines we are tracking this evening.
Fellow Americans, this is Liberation Day, waiting for a long time. April 2nd, 2025 will forever be remembered as the day American industry was reborn, the day America's destiny was reclaimed.
US President Donald Trump unleashes the reciprocal tariff blitz, imposes higher than expected tariffs on many countries, including 34% tariffs on China, 20% on the European Union, and 46% on Vietnam. Adds that these numbers include a baseline tariff of 10% that comes into effect on the 5th of April. Russia, Canada, and Mexico are not on the list. European markets tumble, Asia feels the heat. The Trump administration imposes a higher than expected 27% levy on imports from India. Commerce Ministry says it is carefully examining the implications and talks to seal a trade deal are underway. India's textile and electronics exports could get a leg up as competitors China, Vietnam, Indonesia, Bangladesh face relatively higher US tariffs. Pharma gets an exemption, but gems and jewelry industry terms the new levies a significant burden. From anger and outrage to emergency meetings, Trump's tariffs evoke a slew of reactions across the world. China calls for Washington to immediately cancel the tariffs and warns they endanger global economic development. South Korea promises an all-out response. Australia calls the tariffs a hostile act against an ally. The European Union is preparing a fresh package of countermeasures. Indian equities opened sharply lower as India wakes up to 27% tariffs, but recover to end with modest losses. Sensex and the Nifty closed less than 0.5% lower. Pharma stocks lead the gains, but IT, auto, metal stocks remain under pressure. The rupee also erases early losses to end slightly stronger against the dollar. Bajaj Finance gets a letter of displeasure from the RBI over lapses in its co-branded credit card business. Sources say the letter points to the company's lack of a proactive approach in identifying gaps and vulnerabilities and a failure to maintain adequate internal controls. All judges at the Supreme Court agree to make the declaration of their assets publicly available. The disclosures will be made to the Chief Justice of India and will subsequently be uploaded on the Supreme Court's official website. The move comes after unaccounted cash was allegedly found at the residence of former Delhi High Court Judge Yashwant Verma. Setback for the West Bengal government. Supreme Court upholds Calcutta High Court order scrapping the appointment of 25,000 teachers to school runs by state government. Apex Court rules the appointment process is tainted beyond repair. Karnataka High Court refuses interim protection to Elon Musk's social media platform X. Indian government stands firm, saying all social media companies must comply with the law. X argues the law is unclear. Lok Sabha approves the resolution to impose President's rule in Manipur after a 40-minute debate in the early hours of April 3rd. Government moves the motion at 2 in the morning despite protests by opposition. Home Minister Amit Shah calls the unrest caste violence due to interpretation of a High Court decision. Adds that there has been no violence in the state since December. Heated debate in Rajya Sabha as the upper house takes up the Waqf Amendment Bill. The bill was passed in the Lok Sabha late Wednesday night after an over 12-hour-long debate.
My fellow Americans, this is Liberation Day. We will establish a minimum baseline tariff of 10%. India, very, very tough, very, very tough. Prime Minister just left. He's a great friend of mine, but I said, you're a friend of mine, but you're not treating us right. China, 67%. That's tariffs charged to the USA. We're going to be charging a discounted reciprocal tariff of 34%. You think of European Union, very friendly. They rip us off. 39%. We're going to charge them 20%.
We're now preparing for further countermeasures to protect our interests and our businesses if negotiations fail.
We're going to fight these tariffs with countermeasures.
The administration's tariffs have no basis in logic, and they go against the basis of our two nations partnership. This is not the act of a friend.
Fear and fury, dilemma and dismay. Countries across the world are coming to grips with Donald Trump's reciprocal tariffs, one that upends decades of America's support to globalization and potentially has the power to disrupt and rearrange the global trade order. Trump unveiled sweeping reciprocal tariffs. The levies were bigger than expected. Let's quickly take you through the 5 big takeaways. Trump announced what he calls discounted reciprocal tariffs during a long, drawn-out speech at the White House lawn. Several countries, including China, Vietnam, EU, Japan and India, stare at tariffs in the range of 20 to 40%. India specifically faces a 27% tariff levy. As per the Trump administration, the rates were calculated roughly half of what the US claims these countries impose on American exports, factoring tariffs, non-tariff and monetary barriers, among others. India's Commerce Ministry says they are carefully examining the implications. So what does this really mean for the Indian industry? India's pharma sector can breathe easy as Trump's reciprocal tariffs strike exempts the sector. The IT and jewelry sectors, however, stare at a backlash. From anger and outrage to emergency meetings, Trump's tariffs have evoked a slew of reactions across the world. China calls for Washington to immediately cancel the tariffs, warning that they endanger the global economic development. The European Union is preparing a fresh package of countermeasures as well.
For these reasons, starting tomorrow, the United States will implement reciprocal tariffs on other nations. It's been a long time since we even thought of that. We used to think about it a lot. We didn't think about it for many decades, and you see what's happened. For nations that treat us badly, we will calculate the combined rate of all their tariffs, non-monetary barriers, and other forms of cheating. And because we are being very kind, we're kind people, very kind. But we will charge them approximately half of what they are and have been charging us. So the tariffs will be not a full reciprocal. I could have done that, yes, but it would have been tough for a lot of countries. We didn't want to do that. But such horrendous imbalances have devastated our industrial base and put our national security at risk. I don't blame these other countries at all for this calamity. I blame former presidents and past leaders who weren't doing their job. They let it happen. And they let it happen to an extent that nobody can even believe. That's why, effective at midnight, we will impose a 25% tariff on all foreign-made automobiles.
All right, our managing editor, Shireen Bhan, is joining us now from Vijay Chowk. Shireen, we had been trying to get a pause on these reciprocal tariffs with concessions for the United States. That has not cut ice with the US administration. Will a bilateral trade deal, even if we sign it, will that work in putting these tariffs on hold? What's your view?
Well, we just don't know at this point in time, Parikshit, and that's one of the many questions that we don't have an answer to. By the way, I'm standing at the heart of Delhi's political corridor. This is where we have the North Block right behind me, the Finance Ministry, the Commerce Ministry right next door, and of course the Indian Parliament here as well. And policymakers across governments, including of course our government, are going to be going over the impact and the implications of the Trump tariffs announced overnight. Now, as far as India is concerned, as you rightly pointed out, India was hoping for the best case scenario, that look, we are already in active dialogue and in discussion as far as a bilateral trade agreement is concerned. So the hope was that even if the tariffs were announced and they were to impact India, perhaps there could have been a suspension on the rollout as far as the tariffs were concerned. But that has not been the case. India has not been singled out. The tariffs will apply on India like they will on the rest of the world where the Trump tariffs come into effect. The hope now is that perhaps there can be a speeded up bilateral trade agreement. Look, fall is when the expectation is that we should have something concrete in place. But again, the view is that perhaps if we speed up negotiations, there could be the possibility of some sort of change. Remember, even in the White House, in its statement, it has said that if negotiations with a partner or reciprocal action with a partner to assuage and allay concerns of the U.S. are on board, then the U.S. may consider, favorably what course of action it will take. So all of this is up in the air, but what is a fact as of today is that there is a 27% tariff. And to be clear, while we heard the President Trump there talk about reciprocal tariff, this is not reciprocal in the way that we expected it to be in February when the Trump administration had put forward a broad calculation of how these tariffs would be calculated. It's very, very different as of today. So this is a global world order that is in reset and a global world order that is in flux and volatility. And I think everyone is measuring the impact at this point in time and assessing what way to go. In fact, that is what the Commerce Ministry has said. The Commerce Ministry, in its statement, by the way, has not spoken about the fact that they have asked the U.S. to roll back the tariffs. They have spoken about the fact that they are engaging in assessing the impact with all stakeholders, and they're hopeful that the BTA will provide a road forward, a path forward as far as the negotiations with both sides are concerned. But there's plenty to talk about in terms of sectoral impact. Hormuz has been poring over the fine print to understand who is going to be hit and who perhaps gets a little bit of a breather, a reprieve at this point in time. Hormuz.
A fairly resilient reaction coming in from the Indian markets today, and considering how the start was supposed to pan out, you would take this session with both hands. But as the session went by, there was a very clear demarcation between the winners and the losers of Donald Trump's tariff announcements, the 27% reciprocal tariffs that were imposed on India. And Donald Trump mentioned that he had mentioned to PM Modi that although he's a very good friend, you don't treat us well, and hence we'll be charging you half of what you charge us, and hence the reciprocal tariff imposition. But one of the sectors that took a beating in today's trade was IT, and it was the mid-cap IT stocks that took it on the chin in today's session, be it Persistent, Coforge or KPIT Tech, falling up to 10%. And it is not because of any tariff-related concerns, but because of this tariff imposition, the rising fears of a recession in the United States, which is a key market for these IT companies, is the result of why these stocks took a beating in today's session. Another sector that took a beating, we don't talk about that sector that much, were the shrimp exporters, and it was stocks like Avanti Feeds and Apex Frozen Foods that at one point were down almost 18% in today's trade. India, of course, is one of the largest shrimp exporting countries to the US, and Incred Research has analyzed that in case these tariffs remain in place, the shrimp import duty will now rise up to as high as 45%. So a negative reaction for these shrimp exporters as well. And some of the winners, though, in today's session, one very clear winner was the pharma sector, and it was the Nifty Pharma Index that was an outperformer today. Most of the stocks ending higher, although off the highs of the day, but still ending higher. The question only remains is for how long, because there are investigations that are in progress, and that leaves the window open for any future tariff levy on the pharma sector. And lastly, another winner that emerged in today's session was the garment and textile companies, be it the likes of Trident, be it the likes of Arvind, Gokaldas Exports, all of them seeing healthy gains in today's session. And that's not because they were exempt from any form of tariffs, but the competitive nations were the ones that were charged a lot more more in comparison to India, be it China, be it Vietnam, be it Bangladesh, all of them charged anywhere between 40 to 50% in terms of reciprocal tariffs. So that gave India a competitive advantage, and that is why you saw healthy gains in these names. So clear winners and losers. It will be interesting to see how this trend sustains from here on.
Hormuz, many thanks for joining us. A quick snapshot there of some of the sectors that are likely to be impacted both positively and negatively. But of course, this is a moving playing field at this point in time, so we must not come to premature conclusions. But let me go across to my colleague Manisha Gupta, because as Hormuz was pointing out, one of the sectors that is going to be impacted, is going to be hit, is the gems and jewelry sector, not just because of the tariffs, but also because of the fact that now, with the existing duties plus the current tariff, it goes up substantially. Manisha is standing by to explain to us what the implications will be. Manisha.
Well, the immediate impact is clearly not good for the gems and jewelry as an industry, and as per government sources, the 27% tariffs are going to be on over and above the existing tariffs. So when you look at the diamonds, first of all, the polished diamonds, and India does do 9 out of 10 of them for the international markets. So from 0%, we've straight away gone to 27% on this. Lab-grown diamonds as well, from 0% to straight away 27%. And when it comes to jewelry, whether it's gold jewelry and diamond jewelry or gemstone jewelry or silver jewelry, the existing tariffs was anywhere between 3 to 5%, which now stands as high as 32 to 34% as well. So clearly the impact is not so great. Well, apart from that as well, when it comes to the Indian markets, the expectation clearly is that there would be some negotiations. There are some bilateral conversations at the highest level already on between US and India. So some positive could come out from that. Otherwise, the kind of numbers that you're looking at, India does feel that while we are relatively better than various other countries like China, for example, because China has seen a 34% of tariff. This is in addition to 20% tariff already. So with India's 27 and China's 54% tariff, India stands in a better place right now. And China, mind you, is a bigger gold jewelry exporter as well. So India stands to gain in that sense. But then again, when you look at the other manufacturers and important ones like Singapore, UAE, Turkey, there the tariff is just at 10%. So India could be losing out to these countries, and that really is a bit of a concern coming in. Some of the jewelers I was talking to also said that if in the long term this just about continues, then many of the Indian manufacturers and jewelers would perhaps shift to countries where you have lower tariffs as well. I also spoke to GJPC, and they said that this is a significant higher number, and they are hoping that India and US will work on these numbers. There also is an expectation that there could be challenges going forward in sustaining the kind of export quantum that we do to US at this point in time. But then eventually India will find newer markets or will reroute its exports to US. I mean, there are various conversations happening right now, but there's more clarity clearly that this sector also is waiting for.
Manisha, many thanks for joining us. That's a quick reaction there coming in from the gems and jewelry sector, the impact and the implications of the tariffs that have now been imposed by the Trump administration. Remember, these are also significant job-creating sectors. These are significant employment-generating sectors. But let's get you a first pulse check of India Inc. Joining us on the program to take the discussion forward on the impact and the implications of the Trump tariffs is Anant S. Iyer, Director General, Confederation of the Indian Alcoholic Beverage Companies, Sudhir Sekhri, the Chairman, Apparel Export Promotion Council, Rajiv Nath, the Forum Coordinator of the Indian Medical Device Industry, and Ashok Chandak, the President of the India Electronic and Semiconductor Association. Gentlemen, appreciate you joining us here on the program. Let me start by getting a check from you, Sudhir Sekhri, as far as the apparel and textile business is concerned, because, you're not exempt like the pharma sector is, so the tariffs come into effect as far as the apparel sector is concerned. But the hope and the belief or the hypothesis is that since we're better off when it comes to tariff imposition within the region, could this be beneficial to India? Lay out the best case for us.
Okay, yeah, first of all, now that the cat is out of the bag, there is a sense of relief in the sense that, we at least know where we are heading and how we fare vis-a-vis our competition. Now, see, as far as apparel is concerned, we really stand to gain a bit when it comes to our competition. Because be it Bangladesh or be it China, their tariffs are anything 10% to 20% higher than those imposed on us. However, I think that is seeing it in a very narrow sense, because what is happening here is the US importers, they've already started asking for discounts and cancellations. Now, this is a big issue for us, and this needs to be addressed by the government. They have to take it up with the government there, or, like China did, when 10% tariff was imposed on China, many retailers, they started pushing manufacturers to reduce prices. And that's when the China government stepped in, and that they said they warned these retailers that they'd be blacklisted if they continue with this kind of a thing. So that is one part of it. The second part is
I just want to interrupt you there. I want to interrupt you there because what you're saying is very important. So I want to understand this for the benefit of everybody watching. You're saying that order cancellations have already started, and the call and the ask for discounts have already started on account of the tariff imposition, or even before the tariff imposition?
Okay. Well, actually, the discussion started last week. And now that the tariffs, it's now clear what it is. So discounts, they've started canceling orders. And in fact, last night we received a message from buyers asking for discounts. And some buyers are also asking for postponement.
So in the near term then, Sudhir, what should we expect? Because, as you pointed out, and I that's what I've been caveating as well, that, this business of what happens to the region and how much higher the region is us versus India, and whether that benefits us or not is a more medium-term aspect. But in the short to near term, what will the impact be? What is the hit likely to be? Have you done any calculations on the back of the announcement that's happened overnight?
Yes, like I said, in the immediate term, this is what they're asking. But obviously, we cannot, the kind of discounts they're asking, anything from 15 to 20%, that is definitely not workable. We don't work on very 5-6% net profit, and we definitely cannot afford this. So we have to take a stand, and we'd like this government to support us on that. Now, coming to the other aspect, of course, yes, we will become competitive when it comes to our neighbors. But let's not forget that there are many other countries where the US is buying garments from those countries, but they're not buying much because of the higher cost of production. Now, let's take Turkey as an example. Now, Turkey has they've been subject to a tariff of 10% only. So, which means the difference between Turkey and India is today 17%. Now, the 17% will more than offset the higher cost of production in Turkey. So, obviously, I think a lot of business might move to Turkey. Similarly, Germany, even the European countries where the tariff is now 20%, there is a differential of 7%. Maybe that 7% may not offset the difference in cost of production. But look at the NAFTA countries, Dominican Republic, for instance, Egypt, Jordan. Egypt has been hit with 10%. So they are 17% lower than us. Dominican Republic, 10%.
Okay.
A lot of American production is still being carried out in DR. So that is DR is going to gain, and a lot of business is going to move. So, it's very difficult to predict what exactly is going to happen in the next 3 to 6 months. But immediately, this is the negatives that we see. This is the downside we see. The upside is, yes, okay. We call Bangladesh, China, Vietnam, Cambodia, Pakistan. Yeah. They are competitors. When we talk about competition, we only name these 5-6 countries. We don't even talk about DR or Turkey. So, we are much better off than these countries. But is that a consolation? That's the big question.
Well, that's an important point that you raise. And again, this is what we've been highlighting on CNBC TV18, that let's not get carried away with the fact that in the region, countries like Vietnam, China, Thailand, etc., have been hit by higher tariffs. Very important point there being made by Sudhir Sekhri on how production bases closer to the U.S. have, in fact, been hit with lower tariffs. So, in the near term, the impact, even as far as the apparel sector is concerned, is likely to be a negative one. Of course, all of this is uncertain at this point in time, and that already is impacting order flow as order cancellation and resulting in the need for price discounts. The call there from the apparel trade body is that the government needs to step in. But let me also go across to Rajiv Nath, Forum Coordinator at the Association of Indian Medical Device Industry. Mr. Nath, many thanks for joining us. The pharmaceutical sector at this point in time is exempt, so there is a sigh of relief there, but not so for the medtech sector. What will the impact be? You're on mute, sir.
On the face of it, it looks slightly detrimental to us, but I think business people have to look for windows of opportunity, because unlike apparels where you can move things around very rapidly, for quite some time, USA has been looking at diversifying its supply chain of medical devices to address its healthcare security needs, like India has been doing also post-COVID. So I think that is more strategic in mind. So Indian manufacturers have to see product lines where USA is wanting to shift away from Mexico or from China into suppliers like India. And this may be an opportunity for us over here to take forward. So yes, domestic manufacturing.
Well, that's the medium to the long-term consequences. But what about the near term, Mr. Nath? In the near term, with the imposition of this 27% tariff, what will the impact be on medtech manufacturers?
Well, I would say in the short term, where we are competitive and ahead of the competition from other countries, that will be maintained. There should be no immediate short-term concerns over there. The buyers will, of course, have to absorb the higher costs. So it's going to be a pinch for them. For us, tariff is not the main concern. Of a higher concern for medical device industry is the non-tariff market access costs. The cost to get a US FDA approval varies from $10,000 to $500,000, depending upon the risk classification of the product. That is for the private healthcare market. And to access the public healthcare market, that is nearly impossible because of the Buy American policy, and we're not allowed to take part in the bids for the American government purchases over there, because we are not partners to the trade agreements with USA over there. So it is the non-tariff issues our government basically has to negotiate on our behalf in the bilateral agreements going forward. And we do hope, like they've seen some reprieve for pharmaceuticals, maybe they can consider a reprieve also for medical devices being healthcare products.
Well, reprieve or not, we don't know. But let me ask you very quickly, what is the quantum of exports to the US at this point in time? And do you believe that that is likely to see an impact on account of the imposition?
So currently we are exporting high quality consumables, disposables, and some electronics to the tune of about nearly $500 million over there. And we import from USA nearly $1.5 billion worth of goods. So the imports are double that from USA. So in that respect, yes, this policy is going to give an asymmetrical advantage to the US companies who are accessing the Indian market. Interestingly, the biggest market for Indian medical devices is USA, and also the biggest suppliers to India is USA in medical devices.
Yeah. Yes, and this will, of course, be something that I guess both sides will take up, even as far as the bilateral treaty is concerned. But let me go back across now to bring a view there from the Indian Alcoholic Beverage Association. Joining us now is Anant Iyer. Ms. Iyer, many, many thanks for joining us. We've already seen that cut by India on bourbon whiskey ahead of the Trump tariffs coming in, with the hope that perhaps that would assuage and allay some concerns that the U.S. had. But the tariffs have come in. Nevertheless, take me through the impact that you see.
Yeah, Sireen, thanks a lot for having us on your channel. We are still awaiting some clarity on what will be the exact tariff on spirits as well as wines. Currently, India has only reduced its duty on bourbon to 100%. Our fear is that it's not so much from the US, because the exports from US into India, the imports into India are about, $24 to $25 million, which is very small when you compare it to the overall imports, of spirits and wines from the other parts of the world, especially, the United Kingdom, EU, and other countries. So our fear is that, there are other FTAs now in the on the table, and those countries should not use whatever concessions we give to the US as a benchmark for discussions, because that doesn't safeguard the interests of our members and our industry. As you know, our industry is a state subject. We face a whole host of challenges, and the cost of operations that we have in India, right, are at least at least 50 to 75% more than what it is in any developed country, or even in the middle kind of developing or developed countries, in just play production costs, input costs, etc. So we have our own challenges, and we have already given our representations to the concerned ministries, including our nodal ministry, which is the Ministry of Food Processing, and requesting them that yes, they should safeguard our interests. And we have ourselves recommended, as an industry, a staggered reduction of customs duties over a period of 10 years. So it's not that we haven't done it, but to have a very drastic cut may set the cat among the pigeons, as it were.
Yes, because there is a negotiation underway with the EU as well, and of course that is going to be one of the items there. Of course, will be wine and spirits will be up for discussion and debate, and your fear is that if India cuts on this, just as we have done as far as bourbon whiskey is concerned, that will open up the room for negotiation there as well. Let me bring in Ashok Chandra, the president of the Indian Electronic and Semiconductor Association, into the conversation. Mr. Chandra, many thanks for joining us. Very quickly, the near-term impact, the short-term impact of the tariff imposition, and of course, eventually the silver lining as well, but the near-term impact.
I don't see any major near-term impact, except for the fact that whatever exports we do to United States, almost like $12 billion of electronics, if there is a short-term demand reduction in US because of the prices going up for the consumers, that's the only impact I would see. But India is well placed as of now compared to the other electronics and semiconductor exporting countries such as China, Vietnam, Taiwan, Thailand, as well as Mexico. So overall, we are, I would call, at a positive edge, and it depends on India now. How do we make use of the opportunity that is available? And I want to add one point over here, that recently one policy was announced on PLI for electronic components, and I call this as one of the winning trio for India now. The PLI for electronic components, there is a PLI running for electronics manufacturing, and there is a Semicon India program. All three put together creates a very good combination of a value addition for electronics manufacturing, and India need to capitalize on these policies and ramp up faster. So short term, no major issue. Long term, yes, maybe United States electronics manufacturing industry would get developed, but still I would call the demand in US for electronic goods is tremendous. It's quite huge. It's almost like a $500 billion. So we will still have a huge opportunity to grow forward and expand.
Well, that is the hope, that as far as the electronic sector is concerned, this could be a silver lining. This could be an opportunity as we see significant tariffs being imposed on the likes of China, Vietnam, etc. But of course, in the near term, as the gentleman was pointing out, the fear is what will the tariffs do to global demand? What will the tariffs do to global growth? Is the U.S. possibly headed into a recession? That is now an issue up for discussion and debate. Gentlemen, appreciate you joining us here on CNBC TV18 for the first pulse check of India Inc. on the Trump tariff imposition, what it means for India and its different sectors in the near, medium and long term. We are going to take a break here, but we will continue with Trump Watch and the tariff plan right after this. Stay tuned to CNBC TV18. Big news breakers coming up. Our platform, it takes a journey of starting out as an unknown and ending up as unforgettable. It takes more than 2 decades of celebrating the most influential and influencing the most celebrated entrepreneurs. From chronicling the stories of India's startup universe to becoming a success story in itself, as India's longest-running show on startups and entrepreneurship, celebrating 21 action-packed years of building India's biggest startup community. Young Turks at 21, only on CNBC TV18 and CNBCTV18.com. CNBC TV18's most comprehensive and award-winning news show, India Business Hour, drops first on YouTube. So get the first access to the most influential architects of policies and politics, the key newsmakers of the day. Discover the big themes as we decode the business of markets, macros and more. Be the first to go to the heart of all the top stories that drive the day's agenda. Catch the award-winning India Business Hour live every night on YouTube with me, Shireen Bhatt.
India Business Hour live on YouTube at CNBC TV18 weeknights at 7 p.m.
Talking about 25% permanent tariffs on steel, aluminum, and autos. And I think this has the potential to bring inflation back in a serious way in coming months. And if that's the case, I think that has the potential to really depress the consumer. And this time around, the Fed is not going to be able to come to the rescue here because it can't possibly lower interest rates when inflation is significantly above its 2% target. I think that inflation, which has been running around 2 to 3%, is about to run at 3 to 4%. I think the Republicans are running the risk of losing their majority in both houses of Congress next year. I think this is just a disastrous policy.
There certainly is going to be a near-term spike up in inflation, but in 12 to 18 months' time, are we going to be in that sort of still lingering at 3 to 4%? I'm doubtful, and therefore there's still, I think, scope for 2 rate cuts that we have. We've got I think near-term, the Fed are going to be hesitant. We've got a September rate cut and a December rate cut and a March 2026 rate cut.
My fellow Americans, this is Liberation Day, waiting for a long time. April 2nd, 2025 will forever be remembered as the day American industry was reborn, the day America's destiny was My fellow Americans, this is Liberation Day. We will establish a minimum baseline tariff of 10%. India, very, very tough, very, very tough. Prime Minister just left. He's a great friend of mine, but I said, you're a friend of mine, but you're not treating us right. China, 67%. That's tariffs charged to the USA. We're going to be charging a discounted reciprocal tariff of 34%. You think of European Union, very friendly. They rip us off. 39%. We're going to charge them 20%.
We're now preparing for further countermeasures to protect our interests and our businesses if negotiations fail.
We're going to fight these tariffs with countermeasures.
The administration's tariffs have no basis in logic, and they go against the basis of our two nations partnership. This is not the act of a friend.
Hello and welcome to Trump Watch. We're of course focusing on the big takeaway coming in from the United States. I am Ashmit Kumar. Now, fear and fury, dilemma and dismay, countries across the world are coming to grips with Donald Trump's reciprocal tariffs, one that upends decades of America's support to globalization and potentially has the power to disrupt and rearrange global trade. Now, Trump unveiled sweeping reciprocal tariffs. The levies were bigger than expected. Let's quickly take you through the big 5 takeaways. Now, Trump announced what he calls discounted reciprocal tariffs during a long-drawn speech at the White House lawn. Several countries, including the likes of China, Vietnam, EU, Japan and India, are staring at tariffs in the range of 20 to 40%. India specifically faces a 27% tariff levy. As per the Trump administration, the rates were calculated as roughly half of what the US claims these countries impose on American exports after factoring in tariffs, non-monetary barriers, among others. Now, India's Commerce Ministry says that it has carefully started examining the implications. So what exactly does this mean for India Inc.? Well, to begin with, India's pharma sector can breathe easy as Trump's reciprocal tariff strike exempts the sector. IT and jewelry sectors, however, are staring at a backlash. From anger and outrage to emergency meetings, Trump's tariffs have evoked a slew of reactions from across the world. China has called for Washington to immediately cancel the tariffs, warning that they endanger global economic development. The EU, meanwhile, is preparing a fresh package of countermeasures.
For these reasons, starting tomorrow, the United States will implement reciprocal tariffs on other nations. It's been a long time since we even thought of that. We used to think about it a lot. We didn't think about it for many decades, and you see what's happened. For nations that treat us badly, we will calculate the combined rate of all their tariffs, non-monetary barriers, and other forms of cheating. And because we are being very kind, we're kind people, very kind. But we will charge them approximately half of what they are and have been charging us. So the tariffs will be not a full reciprocal. I could have done that, yes, but it would have been tough for a lot of countries. We didn't want to do that. But such horrendous imbalances have devastated our industrial base and put our national security at risk. I don't blame these other countries at all for this calamity. I blame former presidents and past leaders who weren't doing their job. They let it happen, and they let it happen to an extent that nobody can even believe. That's why, effective at midnight, we will impose a 25% tariff on all foreign-made automobiles.
We're in a situation where there is going to be an impact on the U.S. economy, which will build with time. In our judgment, it will be negative on the U.S. economy. That will have an impact on us. But the series of measures will directly affect millions of Canadians. We are going to fight these tariffs with countermeasures. We are going to protect our workers, and we are going to build the strongest economy in the G7. In a crisis, it's important to come together, and it's essential to act with purpose and with force, and that's what we will do.
The unilateral action that the Trump administration has taken today against every nation in the world does not come as a surprise. For Australia, these tariffs are not unexpected, but let me be clear, they are totally unwarranted. President Trump referred to reciprocal tariffs. A reciprocal tariff would be 0, not 10%. The administration's tariffs have no basis in logic, and they go against the basis of our two nations' partnership. This is not the act of a friend. Today's decision will add to uncertainty in the global economy, and it will push up costs for American households. This is why our government will not be seeking to impose reciprocal tariffs.
Reaching for tariffs as your first and last tool will not fix it. This is why from the outset we have always been ready to negotiate with the United States to remove the remaining barriers to transatlantic trade. At the same time, we are prepared to respond. We are already finalizing the first package of countermeasures in response to tariffs on steel, and we're now preparing for further countermeasures to protect our interests and our businesses if negotiations fail. We will also be watching closely what indirect effects these tariffs could have, because we cannot absorb global overcapacity, nor will we accept dumping on our markets.
So how much revenues can the new reciprocal tariffs bring into the United States, and what impact will it have on the country's GDP? Steve Leisman is here with a report on the outlook for USA's economy.
President Trump's economic advisors have said the tariffs could bring in as much as $600 billion a year. But the Nonpartisan Tax Foundation believes it could be half of that. What economists say cuts into tariff revenues are a decline in imports, because if you tax it, you'll get less of it. Lower returns to capital and labor, as well as lower GDP. Erica York from the Tax Foundation says the $600 billion estimate from the administration, assuming a 20% tariff on all imports, could be more like $300 billion in revenue, and that's before the effects of retaliation. York told me the White House tariff revenue numbers are not realistic. They missed that imports would fall and that tariff payments would shrink the income and payroll tax basis, both of which significantly reduce the expected revenue tariffs will yield. Already, several forecasters have downgraded U.S. GDP forecasts because of the coming tariffs. Goldman says it would be a 0.4% hit to GDP and wrote this week the fiscal package is unlikely to offset the GDP hit from the tariffs. The White House has said that tariffs are tax cuts, but because they're believed to be mostly paid by U.S. businesses and consumers, economists treat them and score them like tax hikes. Steve Leisman, CNBC Business News.
Well, from USA to Europe, and the European Union is gearing up to give a response to Trump's 20% tariffs on imports from the bloc, which it called a major blow to the world economy. CNBC's Sylvia Amaro gets us more from the EU game plan from Rome.
What we've heard from Donald Trump has confirmed some of the biggest fears that EU officials had going into yesterday's announcements. They are looking at another round of tariffs from the United States, this time around totaling 20%. So, of course, this is going to have implications for the European economy. And in fact, some banks are already today downgrading their forecasts for the European economy. So what we're expecting at the EU level is that the European Commission will be developing countermeasures in response to this new round of tariffs from the United States. Earlier this week, we heard from Ursula von der Leyen, the president of the European Commission, and she said that they are preparing, quote, a strong package of measures, and these could actually hit digital services, in particular US big tech firms. So let's see what the detail will be over the coming days. But as we are in Italy today, I would also like to highlight some of the reactions from Rome this morning. In fact, Giorgia Meloni, the Prime Minister of Italy, was among the first EU leaders to react. And she said that, of course, the announcement from the United States was a wrong step, of course, but she wants to see some sort of compromise. She would like to see a deal with the United States that will prevent further trade escalations.
That's the picture coming in from Europe. But let's also get you a global pulse check on how policymakers, economists are reading into the reciprocal tariff announcements.
I think my baseline is that this is the opening round of what may be a very complex set of negotiations across scores of different countries. So I think maybe, as Secretary Besson has been quoted, it maybe puts a cap on max tariffs, but I think there's a long way to go to see how the tariff war is going to eventually be settled. I think there's definitely a headwind, Sarah, from the trade policy uncertainty. We saw evidence of that back in 2019. There's much more uncertainty now. So companies are not eager to invest or hire, so long, especially if they're exposed to trade. And so I think it's a headwind to growth. A recession would not be my baseline, but you'd have to say that the odds of a recession have gone up compared to where we would have been 3 or 4 months ago, just from really the uncertainty effect on consumers and businesses in and of itself.
This was stronger than what many of us expected. But it's, it's the opening step. So I would expect, I would assume that this will not be in place in a month, 2 months. definitely not in the back half of the year. So I'm in the camp that this is the beginning of a big negotiation. Korea and Japan don't charge tariffs for automobiles anymore. So Mexico and Canada will most likely be addressed with the USMCA agreement. That's scheduled for 26, but that will be brought forward, hopefully in the next month or two. And that the autos will be folded into that discussion. Germany, it's about, they charge us 10%, we charge them 2.5%. That could be fixed.
So this is a broad-based, all-out assault by Trump on the notion of free trade that was supposed to benefit the U.S. and the rest of the world. And it is striking that this is such a broad swath of tariffs encompassing a wide variety of products, and it doesn't discriminate between U.S. allies and rivals. It hits everybody pretty hard, and countries in Asia in particular seem to be hit quite hard. But there are many countries around the world, even those like the United Kingdom, with which the United States runs a trade surplus, that have gotten hit with some tariffs. So nobody really has been spared. Mexico and Canada seem to have gotten off lightly on this round at least, because it seems like there are no additional tariffs being imposed on them.
I think that, up until now, what we had, were the skirmishes between the administration and Canada, Mexico, China, Europe. And then today is when the war actually began. The global trade war starts today. And I was really struck by, pundits and strategists and economists and analysts all saying, well, today was going to be the day, that at least the uncertainty is going to end today. But no, the uncertainty didn't end today. All we know is that it was the official day of the trade war, the global trade war. And now we're going to go through a multi-month or multi-quarter period of the law of unintended consequences. And so we're going to be writing fresh chapters in this book on making uncertainty great again. Everybody talks about, the breath of fresh air, that it's a 10% baseline tariff. That's the baseline. The average tariff rate just went from 2.5% to 20%.
When we started off, when you do a back-of-the-envelope calculation, most of us started off with the tariff differential. It is to mean that what India imposes on the US and US imposes on India. What you've seen now is 26%, which is almost more than 2.5 times what that tariff differential is, to mean that there are a lot of other soft factors that have been added in. Non-trade barriers, you've also seen currency movements, not only for India, for across other trading partners as well, which means that if there are, again, to my mind, if there are some concessions that are made, it could be that you could get a bit more discounted, tariff rate, and that would be a part of the negotiations that are going on. So I would think the window to lower this 26% is very much still live.
What we've got is it's basically looking at the ratio of exports to the US divided by the trade balance. And if you run through that and look at all the countries, that is exactly what they've done. These aren't a scientific calculation of all the trade tariffs and all the barriers at all. It's basically, it's seemingly somewhat of a fabricated number. So I think that there could be some reasonable scope for some renegotiations here, as a lot of countries make the point that these numbers do not match up with reality.
Talking about 25% permanent tariffs on steel, aluminum, and autos. And I think this has the potential to bring inflation back in a serious way in coming months. And if that's the case, I think that has the potential to really depress the consumer. And this time around, the Fed is not going to be able to come to the rescue here, because it can't possibly lower interest rates when inflation is significantly above its 2% target. I think that inflation, which has been running around 2 to 3%, is about to run at 3 to 4%. I think the Republicans are running the risk of losing their majority in both houses of Congress next year. I think this is just a disastrous policy.
And coming up, China gets hit the hardest after Trump imposes a 34% reciprocal tariff on the country. And that's over and above the existing levies. Details when we come back.
and the day that we began to make America wealthy again. We're going to make it wealthy, good and wealthy. For these reasons, starting tomorrow, the United States will implement reciprocal tariffs on other nations. It's been a long time since we
Welcome back. Now, China has been hit the hardest by Trump's reciprocal tariffs. The U.S. president imposed tariffs of 34% on China, and this is over and above the levies already imposed on Beijing. Now, the Chinese government has responded, vowing retaliation if the U.S. does not immediately cancel its unilateral tariff measures. CNBC's Eunice Yoon gets us the latest on China's plans.
China's Commerce Ministry has vowed to take resolute countermeasures, taking into account the tariffs during President Trump's first term, as well as the 2 rounds since he's taken office. The effective rate now for the U.S., for China, in terms of tariffs, is around 70%. So in addition, President Trump had announced plans to close a trade loophole on May 2nd. This is one that had been benefiting e-retailers such as Temu and Shein. They were able to send their goods duty-free. That's not going to happen anymore. And based on China's responses that we saw during those first 2 rounds, the expectation is that China is not only going to use counter tariffs to retaliate, but also to use its expanded retaliation toolbox. So that means tighter controls potentially for certain items like critical minerals, also punishing individual American companies with blacklisting or more investigations. Now, Macquarie had said that it expects that Beijing is going to take a page out of that playbook to try to pressure help Chinese suppliers to pass that cost along to U.S. consumers as well as to companies. If you remember, Frank, the Chinese had summoned Walmart to stop what they see as an unfair practice of pressuring Chinese suppliers to take on more of that cost. So Macquarie believes that we could see more of that type of measure this time round.
And U.S. President Donald Trump's reciprocal tariffs formula is all about trade deficit. Prashant Nair is here with exactly how Trump arrived at the 52% figure that India imposes on the U.S. Prashant.
Well, that's right. You know, as global markets react to the latest round of U.S. tariff announcements, one number has raised eyebrows. President Trump's claimed tariff rates which countries impose on U.S. imports. Now, in India's case, what has been claimed is a very high 52%. But where did that number really come from? That's the question we are sort of asking and discussing here. Now, India's actual tariffs tell a different story. On a blended basis, tariffs on U.S. imports stand at about 9.4%. Now, even if you add VAT, this number would have risen, but nowhere close to 52%. Yet, Trump has publicly claimed that India's total tariff burden on U.S. goods is this 52%. What's behind the discrepancy? Just to sort of rewind the clock back to the 13th of February, to be sort of precise, because that's the day when Trump signed an order demanding an analysis of non-reciprocal trade relationships with all U.S. trading partners. The scope, everything from tariffs, taxes, non-tariff barriers to currency practices and market access limitations as well. In short, any unfair structural impediment to American goods and businesses. But what was done last night was very different. The formula used to arrive at the 52% number is not based on actual tariff lines. Instead, it was based on a broad proxy. The formula goes something like this. Actually, the formula is this: U.S. trade deficit with country X divided by U.S. imports from country X gets you that figure. And once calculated, this number has been divided by 2, resulted in the so-called discounted reciprocal tariff. Let's specifically look at India's case. U.S. trade deficit with India, $45.7 billion. U.S. imports from India, $87.4 billion. Divide 45.7 by 87.4, and there you have it, that 52% number. the natural question is, why was this done? The official US explanation, and this came from USTR earlier, and I quote, individually computing the trade deficit effects of tens of thousands of tariffs, regulatory tax and other policies in each country is complex, if not impossible. The combined effects can be proxied by computing the tariff level consistent with driving bilateral trade deficits to zero. In other words, it's a back-of-the-envelope economic proxy, not a customs handbook. While that is the official US explanation, most market participants see it differently. They see this as a deliberate sort of highballing, a maximalist sort of starting point meant to pressure countries into concessions and force a lowering of non-tariff barriers, basically reframe the global trade narrative around, of course, US leverage. Now, while the headline number may be debatable, the strategic intent, I think, is pretty clear for everyone. Reset the rules of engagement and reshape global trade around American industrial and geopolitical interests. Back to you.
And with that, it's a wrap on this special show. Stay tuned as more news and updates will continue right here on CNBC TV18.
We used to think about it a lot. We didn't think about it for many decades, and you see what's happened. For nations that treat us badly, we will calculate the combined rate of all their tariffs, non-monetary barriers, and other forms of cheating. And because we are being very kind, we're kind people, very kind. But we will charge them approximately half of what they are and have been charging us. So the tariffs will be not a full reciprocal. I could have done that, yes, but it would have been tough for a lot of countries who didn't want to do that. But such horrendous imbalances have devastated our industrial base and put our national security at risk. I don't blame these other countries at all for this calamity. I blame former presidents and past leaders who weren't doing their job. They let it happen, and they let it happen to an extent that nobody can even believe. That's why, effective at midnight, we will impose a 25% tariff on all foreign-made automobiles. Not a full reciprocal. I could have done that, yes, but it would have been tough for a lot of countries who didn't want to do that. So if you look at that, China, first row, China, 67%. That's tariffs charged to the USA, including currency manipulation and trade barriers. And so we're going to be charging a discounted reciprocal tariff of 34%. I think, in other words, they charge us, we charge them less. So how can anybody be upset? They will be, because we never charge anybody anything. But now we're going to charge. You know, you think of European Union, very friendly. They rip us off. It's so sad to see. It's so pathetic. 39%, we're going to charge them 20%. So we're charging them essentially half. Countries like Canada, you know, we subsidize a lot of countries and keep them going and keep them in business. In the case of Mexico, it's $300 billion a year. In the case of Canada, it's close to $200 billion a year. And I say, why are we doing this? Why are we doing this? I mean, at what point do we say, you got to work for yourselves, and you got to, this is why we have the big deficits. This is why we have that amount of debt that's been placed on our heads over the last number of years, and we're really not taking it anymore. April 2nd, 2025 will forever be remembered as the day American industry was reborn, the day fellow Americans, this is Liberation Day. We will establish a minimum baseline tariff of 10%. India, very, very tough, very, very tough. Prime Minister just left. He's a great friend of mine, but I said, you're a friend of mine, but you're not treating us right. China, 67%. That's tariffs charged to the USA. We're going to be charging a discounted reciprocal tariff of 34%. You think of European Union, very friendly. They rip us off. 39%. We're going to charge them 20%.
We're now preparing for further countermeasures to protect our interests and our businesses if negotiations fail.
We're going to fight these tariffs with countermeasures.
The administration's tariffs have no basis in logic, and they go against the basis of our two nations partnership. This is not the act of a friend.
Fear and fury, dilemma and dismay. Countries across the world are coming to grips with Donald Trump's reciprocal tariffs, one that upends decades of America's support to globalization and potentially has the power to disrupt and rearrange global trade. Trump unveiled sweeping reciprocal tariffs. The levies were bigger than expected. Let's quickly take you through the big takeaways. Trump announced what he called discounted reciprocal tariffs during a long, drawn-out speech at the White House lawn. Several countries, including China, Vietnam, EU, India and Japan, stare at tariffs in the range of 20 to 40%. India specifically faces a 27% tariff levy. As per the Trump administration, the rates were calculated as roughly half of what the US claims these countries impose on American exports. Factoring tariffs, non-monetary barriers, among others, India's Commerce Ministry says it is carefully examining the implications from anger and outrage to emergency meetings. Trump's tariffs have evoked a slew of reactions across the world. China calls for Washington to immediately cancel the tariffs, warning that they endanger global economic development. The European Union is preparing a fresh package of countermeasures.
For these reasons, starting tomorrow, the United States will implement reciprocal tariffs on other nations. It's been a long time since we even thought of that. We used to think about it a lot. We didn't think about it for many decades, and you see what's happened. For nations that treat us badly, we will calculate the combined rate of all their tariffs, non-monetary barriers, and other forms of cheating. And because we are being very kind, we're kind people, very kind. But we will charge them approximately half of what they are and have been charging us. So the tariffs will be not a full reciprocal. I could have done that, yes, but it would have been tough for a lot of countries. We didn't want to do that. But such horrendous imbalances have devastated our industrial base and put our national security at risk. I don't blame these other countries at all for this calamity. I blame former presidents and past leaders who weren't doing their job. They let it happen, and they let it happen to an extent that nobody can even believe. That's why, effective at midnight, we will impose a 25% tariff on all foreign-made automobiles.
Jayant Dasgupta, former ambassador to the WTO, and Pankaj Mohindru, chairman of the Indian Cellular and Electronics Association, are joining us on the program. Pankaj Mohindru, if I can come to you first, what's going to be the impact on the mobile phone industry? India has big ambitions to become a supplier for the world, but is this going to have a negative impact? What's going to be the spillover effect on India?
So fortunately, at the moment, the way they have been rolled out, there's going to be no impact because the two competing nations, which is China and Vietnam, have got a higher tariff, Vietnam at 46% and China at 54%, which is that the 10 of February and March 25, and the 34 on top of that. So because of that, we'll not have an impact. The impact could be in terms of shrinking of demand in the US, which is possible. So that is likely to happen. For other electronics, also the tariff difference is China is at 79% now, and Vietnam is at 46%. These are the other tariff lines, like consumer electronics and air conditioners, etc. So currently, we have this short-term big advantage. And I think the bilateral trade agreement, which is getting hammered out, we are going to make a lot of changes in our tariffs and also other investment climate issues. So I see it very, very positively. I think the other very positive outcome is that India incorporated both government and the industry work together in a very positive way, not screaming about protection and outdated ideas like import substitution, etc. We truly work towards globalizing India and making it a fit and fine and competitive place and the blessed investment climate. So there are
Mr.
many
Mohindru,
positives
Mr. Mohindru, very quickly, before I go to Mr. Jayan Das Gupta, a question that I'd like to ask you. We've been hearing from several industry associations. Some of them have gone on to say that over the last week or 10 days, there were instances when US companies were either cancelling contracts or seeking discounts on contracts or for future contracts as well. Is this a situation that you are seeing right now? Do you expect a period of uncertainty?
There'll be a small period of, say, 3 to 5 weeks in which there will be some readjustments. But because the overall position is very positive with the two competing nations, so India has a short-term advantage. But we should not feel gleeful about it. I think the path of liberalization, the path of rationalizing tariffs, chipping away at our disabilities, that should be carried on relentlessly. We don't see a threat to our exports, electronic exports at the moment at all. And the opportunity to take them from 10 billion to 70 billion is a reality. Work towards that relentlessly.
All right, let me get in Ambassador Das Gupta. Ambassador Das Gupta, whatever has happened overnight and over the last few weeks, clearly the rules of engagement on global trade, all of that has been thrown up in the air. Whatever Trump is doing, is it all WTO compliant? What options does India have at this stage?
To answer your first question, it is not WTO compliant at all. Because, of course, President Trump has mentioned in passing that there is a national security angle to his raising the tariffs. But that is quite far-fetched, I think. So what he has done is that he has violated two basic principles which bind the WTO together. One is the MFN principle, which says that you have to treat all exporters who are members of the WTO in a similar way. That is, the tariffs for the same product should be same unless there is an FTA. And by having a differential tariff system, for instance, EU is getting 20, India is getting 27, China 34 plus 20. So that is violating the MFN principle. The second thing is that the US has given commitments at the WTO that it would not raise its bound tariffs beyond a certain limit for each tariff line. Now, if you take the average of the bound tariffs of the US, it comes to about 3.8%. And from what he has done, he has violated those obligations which the US had made as a member of the WTO in a very brazen fashion. So these two things, I think, strike at the very root of the WTO. And it is the signal for, I think, some introspection and, emergent action being taken by the other trading partners. Perhaps.
Ambassador Dasgupta, what is India's option at this juncture? We are negotiating a bilateral trade agreement that has not cut ice with Donald Trump. He still imposed reciprocal tariffs on us. He did not give us a reprieve. What is the best option for India at this juncture if we were to protect and ring-fence ourselves?
Well, if I can venture my personal opinion, I don't think this is sustainable. So, and President Trump also in his heart of hearts would be knowing that it is not sustainable. So this is the opening gambit. He is forcing others to come to the negotiating table. Even the EU, despite making the usual warlike noises, has given an indication that it would be willing to negotiate. China is the only one which has not really mentioned anything, and it has not come to the negotiating table. So the first thing is that we should continue to negotiate. The bilateral trade agreement is proceeding along the right lines. So that is one thing. The second thing is that we should try to have a kind of a dialogue with the European Union, the Japanese, the Australians, all the others who have, the Canadians, for instance, all the others who have been hit by the Trump tariffs, and find out what we can do collectively and what can make the US, climb down and roll back its tariffs. So that is the second aspect of our strategy. And the third one I wanted to mention in the which is a continuation of the first point, is that there are many areas where we can concede ground, which will not really hurt us, our core interests, and we can provide, for instance, the quality control orders. The national trade estimates have also mentioned this. These are certain things which we need to take a very deep look at, non-tariff barriers.
All right. All right. We've completely run out of time, but we'll thank our guests right now, Jayant Dasgupta and also Pankaj Mohindru for joining us. We're going to take a short break, but don't go anywhere. When we return, we're going to get you an exclusive interview with Shyam Saran, India's former foreign secretary, on how what Trump has actually done with reciprocal tariffs really changes the rules of engagement when it comes to geopolitics and country-wide bilateral relations as well.
He was reclaimed. Very tough, very, very tough. The Prime Minister just left. He's a great friend of mine, but I said, you're a friend of mine, but you're not treating us right. They charge us 52%. You have to understand, we charge them almost nothing for years and years and decades. And it was only 7 years ago when I came in, we started with China and charged them. We took in hundreds of billions of dollars from China in tariffs. And they understood, honestly. President Xi understood.
Welcome back. You are watching our special broadcast. Donald Trump, who is self-admittedly a fan of tariffs, has in a way upended the world order with a slew of tariff measures over the last few months. How will this United States trade relations with India and the rest of this world? I'm now joined by former Foreign Secretary Shyam Saran. Mr. Saran, what's the impact of reciprocal tariffs on geopolitics?
As far as the geopolitical impact is concerned, I think perhaps this is one aspect which is being neglected in much of the commentary which I see, because Essentially, what Trump is doing is that he's now suggesting that the organizing principle of interstate relations would in fact be trade. That means, other aspects which determine interstate relations, like maybe ideological affinity or, security relationships, or, a larger sort of sharing of political values. These are not important. That the overriding principle is going to be the trade relationship. That is the foundation. This is a very big change, from the principles on which the world order has been organized so far. So to me, if this is going to be the kind of, shall I say, the standard by which US is going to determine its relationship with other countries, then we are in a completely different kind of a world. And this could therefore mean that countries who are going to be impacted by this are going to be looking for other partnerships, are going to be looking for other ways of, organizing their relationships so that they can deal with a US which is now an outlier in a sense to the global system.
Let me ask you about the Trump announcement. He mentioned India among a group of countries which he said are getting discounted rates, a 27% rate compared to more than 50% for China. Would you say 27% is a discounted rate?
No, I don't think that is a correct interpretation, because essentially what the US has said it has done is to take into account the tariffs which are imposed by the partner country on the US, the average tariff, and secondly, also taking into account what may be domestic measures like non-tariff barriers. He has counted, for example, VAT. In our case, the GST would have been counted in as well. And taking that into account, to actually impose 50% of that, notional tariff. So in India's case, what may have been the calculation that it would have been perhaps on the Indian side, as he has said, 52% was what was imposed by India against US goods. So he is taking about half of that. This is the formula which he has followed apparently with respect to other countries as well.
Right. So there is no exception. There is a formula on the basis of which US has arrived at this. Let me also ask you about...
We may not agree with that formula, but there is some formula and there is no exception made for India. That's what I wanted to make, sir.
Very important, sir. Do you believe, right now we're also seeing statements from the Commerce Ministry saying that they are looking at all options, seeing opportunities for India. They're also talking to the Trump administration. Is there possibility for any reprieve or a temporary pause from these tariffs till the time we sign a bilateral trade agreement? The White House notification says, yes, if President Trump so feels that trade deficit issues are resolved, then these tariffs can be stopped. But do you think India can get a pause earlier?
Well, India did try to get a pause, as you recall, when we said that we are ready to come to some kind of a deal by the autumn of this year, and that any kind of trade measures taken by US should be paused till then. The US declined to do that. So I have seen no evidence that right now, when actually these tariffs have been imposed, that there is any indication from the US that it is likely to give India a reprieve.
All right. Let me also ask you, what do you think has really changed in the India-US relationship going forward, sir? What do you think will be some of the deciding factors? You, of course, mentioned trade, but are there going to be cracks now in the India-US relationship?
Well, trade is certainly a most important component in that relationship. But, if I go by, for example, the joint statement which was issued after Prime Minister Modi's visit to Washington, then that joint statement actually has a number of very important and significant issues on which the two countries wish to, cooperate together, and one of them is defense, both hardware relationship as well as the, strategic relationship. There is also, as so far, a continuing commitment, for example, to the quadrilateral, to the Indo-Pacific strategy. We have not seen those components of the relationship negatively impacted. So going forward, I think we should be open to maybe having some setback as far as the trade part is concerned, and move ahead on the categories of relationship, or components rather, of the relationship, where there is a willingness on both sides to move ahead and expand our cooperation. Those opportunities are there. Secondly, even with respect to the current tariffs, you would have noticed that some items, some commodities have been exempted, like, for example, pharmaceuticals. And, pharmaceuticals is a very important, export from India to the United States. Maybe some opportunities might open up there. The second thing you would have noticed is that quite perhaps unexpectedly, the largest tariffs have been imposed on Asian countries. For example, you take Vietnam, which was a bit of a surprise to me, or if you take even smaller countries like Cambodia, or even next door Bangladesh. So the focus has been very much on these Asian countries, and of course, top of the pile is China, with possibly a tariff rate which will come to something like 54% if you take the 20% initially, and now 34% being added to that. Could there be some diversion of trade towards India? Those possibilities are there, but I do not think we should take it as a given. We will still have to work to make sure that our goods are competitive compared to other partners.
Right. Do you feel that these tariffs also bring an opportunity for India? What is also being said by certain market observers, that if Chinese tariffs on China is almost as high as 54%, 37% on other nations, India gets a chance to probably become a bigger exporter to the US, because India's goods will be cheaper compared to other jurisdictions. Do you think that argument makes sense? Are we going to see that happening?
So as I just mentioned, there could be those opportunities, but it is not something which is a given. It still requires India to make efforts to try and expand our market share, to become more competitive. There will be quality issues involved. To merely think that there will be necessarily a trade diversion towards India, I don't think that is a correct assumption. We should focus much more on how we can make our domestic economy more competitive. We should be able to, address some of the very major quality issues that our exports have. There are issues relating to logistics. So, to think that somehow because China has a bigger tariff on its products, therefore necessarily there will be a diversion towards India, I don't think that is a correct assumption to make.
Right. My final question to you would be, sir, do you think it's also high time for certain sectors, such as, take cars, for example? US has been saying that India charges 70% tariffs on imported cars. Apple's 50%, rice and husk 80%. Do you believe that the time has also come for India to drop some of these measures, and we've been protectionist for far too long?
Well, I completely agree that, it is time for India to roll back what we have seen in the last few years of a creeping increase in our tariffs. Actually, since 1991-92 reforms, the general trend in India was towards lower and lower tariffs. It is only in the last 5 or 6 years that we have seen, every budget where we have seen tariffs being increased, and that Make in India somehow also reinforce the idea that perhaps we need to raise tariffs in certain areas. Our experience from the past has been, before 91-92, that we ended up because of those very high tariffs, we ended up by actually having an Indian economy unable to compete in anywhere in the world. That situation changed after 91, 92, precisely because of the liberalized policies that we adopted. I think we should relearn those lessons of the past. And it is high time that we actually open the Indian economy much more, reverse the trend towards higher tariffs. And by the way, if you look at the last budget, there were indications that the government was itself becoming aware of this particular factor, and some changes in the tariff had actually been made. I would hope that this tendency becomes much stronger going forward. Not only because of the US factor, but because in terms of making India really a globally competitive economy.
All right, Ambassador Saran, thank you for joining us on the program. With that, it's a wrap on this special edition of the show. Thank you for watching. Goodbye.
Understand, and the other countries, and they all understand. We're going to have to go through a little tough love, maybe, but they all understand. They're ripping us off, and they understood it. Prime Minister of Japan, Shinzo Abe. He was a fantastic man. He was unfortunately taken from us, assassination. But I went to him and I said, Shinzo, we have to do something. A trade is not fair. And he said, I know that. And he was a great gentleman. He was a fantastic man, but he understood immediately what I was talking about. I said, Shinzo, we have to do something. He said, I know that. And we worked out a deal, and it would have been a much better deal, but frankly, there were many years left in the deal that was made previous to my getting there, but it was something. My fellow Americans, this is Liberation Day. We will establish a minimum baseline tariff of 10%. India, very, very tough, very, very tough. Prime Minister just left. He's a great friend of mine, but I said, you're a friend of mine, but you're not treating us right. China, 67%. That's tariffs charged to the USA. We're going to be charging a discounted reciprocal tariff of 34%. You think of European Union, very friendly. They rip us off. 39%. We're going to charge them 20%.
We're now preparing for further countermeasures to protect our interests and our businesses if negotiations fail.
We are going to fight these tariffs with countermeasures.
The administration's tariffs have no basis in logic, and they go against the basis of our two nations partnership. This is not the act of a friend.
Fear and fury, dilemma and dismay. Countries across the world are coming to grips with Donald Trump's reciprocal tariffs, one that appends decades of America's support to globalization and potentially has the power to disrupt and rearrange global trade. Trump unveiled sweeping reciprocal tariffs. The levies were bigger than expected. Let's quickly take you through the big 5 takeaways. Trump announced what he called discounted reciprocal tariffs during a long, drawn-out speech at the White House lawn. Now, several countries, including the likes of China, Vietnam, EU, Japan and India, are staring at tariffs in the range of 20 to 40%. India specifically faces a 27% tariff levy. As per Trump administration, the rates were calculated as roughly half of what the US claims these countries impose on American exports. That's after factoring in tariffs as well as non-monetary barriers, among others. Now, India's Commerce Ministry says that it is carefully examining the implications. So what does this mean for India Inc.? Well, India's pharma sector can breathe easy as Trump's reciprocal tariffs strike exempts the sector. Meanwhile, IT and jewelry sectors, however, stare at a backlash. From anger and outrage to emergency meetings, Trump's tariffs have evoked a slew of reactions across the world. China has called for Washington to immediately cancel the tariffs, warning that they endanger global economic development. The EU, meanwhile, is preparing a fresh package of countermeasures.
For these reasons, starting tomorrow, the United States will implement reciprocal tariffs on other nations. It's been a long time since we even thought of that. We used to think about it a lot. We didn't think about it for many decades, and you see what's happened. For nations that treat us badly, we will calculate the combined rate of all their tariffs, non-monetary barriers, and other forms of cheating. And because we are being very kind, we're kind people, very kind. But we will charge them approximately half of what they are and have been charging us. So the tariffs will be not a full reciprocal. I could have done that, yes, but it would have been tough for a lot of countries who didn't want to do that. But such horrendous imbalances have devastated our industrial base and put our national security at risk. I don't blame these other countries at all for this calamity. I blame former presidents and past leaders who weren't doing their job. They let it happen, and they let it happen to an extent that nobody can even believe. That's why, effective at midnight, we will impose a 25% tariff on all foreign-made automobiles.
Well, India's textile and electronics exports may get a leg up. This comes as competitors, the countries such as China, Vietnam, Indonesia, Bangladesh, could face relatively even higher US tariffs. Now, the pharma industry, meanwhile, has heaved a big sigh of relief after staying out of the tariff ambit. Hormaz Fatakia joins us. Hormaz, tell us, give us a pulse check of India Inc.
A fairly resilient reaction coming in from the Indian markets today, and considering how the start was supposed to pan out, you would take this session with both hands. But as the session went by, there was a very clear demarcation between the winners and the losers of Donald Trump's tariff announcements, the 27% reciprocal tariffs that were imposed on India. And Donald Trump mentioned that he had mentioned to PM Modi that although he's a very good friend, you don't treat us well, and hence we'll be charging you half of what you charge us, and hence the reciprocal tariff imposition. But one of the sectors that took a beating in today's trade was IT, and it was the mid-cap IT stocks that took it on the chin in today's session, be it Persistent, Coforge or KPIT Tech, falling up to 10%. And it is not because of any tariff-related concerns, but because of this tariff imposition, the rising fears of a recession in the United States, which is a key market for these IT companies, is the result of why these stocks took a beating in today's session. Another sector that took a beating, we don't talk about that sector that much, were the shrimp exporters, and it was stocks like Avanti Feeds and Apex Frozen Foods that at one point were down almost 18% in today's trade. India, of course, is one of the largest shrimp exporting countries to the US, and Incred Research has analyzed that in case these tariffs remain in place, the shrimp import duty will now rise up to as high as 45%, so a negative reaction for these shrimp exporters as well. And some of the winners, though, in today's session, one very clear winner was the pharma sector, and it was the Nifty Pharma Index that was an outperformer today. Most of the stocks ending higher, although off the highs of the day, but still ending higher. The question only remains is for how long, because there are investigations that are in progress, and that leaves the window open for any future tariff levy on the pharma sector. And lastly, another winner that emerged in today's session was the garment and textile companies, be it the likes of Trident, be it the likes of Arvind, Gokaldas Exports, all of them seeing healthy gains in today's session. And that's not because they were exempt from any form of tariffs, but the competitive nations were the ones that were charged a lot more in comparison to India, be it China, be it Vietnam, be it Bangladesh. All of them charged anywhere between 40 to 50% in terms of reciprocal tariffs. So that gave India a competitive advantage, and that is why you saw healthy gains in these names. So clear winners and losers. It'll be interesting to see how this trend sustains from here on.
Right, Hurmaz, thanks a lot for that. Now, market experts believe that Trump's reciprocal tariffs on India could hurt the country's financial markets significantly. Speaking to CNBC TV18, Axis Bank's chief economist Neelkant Mishra maintained that while the impact on the Lal Street could be bad, the economy will be less impacted than other countries. Macquarie Capital's Sandeep Bhatia echoed the sentiment while adding that the duties will destroy global demand. Meanwhile, Samir Arora of Helios Capital said that the Indian market could be hit if Wall Street witnesses declines of over 10%.
The $700 billion odd of extra revenue that on an annualized level the US will start now to collect is about 0.6% of global GDP. So this is effectively fiscal tightening for the world. It's only through higher inflation that tariffs actually become effective on what the US government is trying to do. So, but the US government will have some tools to provide some solace, some assumption, some comfort to the US consumer through some other tax cuts. But the gist is that this is a straight first shot 0.6% of GDP, global GDP. The postponement of production could be another 1%. I think we are talking about a significant rise in uncertainty for financial markets.
Neelkant, sorry, just to get those figures in, 1% hit to 1% hit to US GDP, right? Or global GDP?
Global.
1% hit to global GDP, which
because of postponement of investments.
Okay.
In addition to what is actually a 0.6% of global GDP tax that the US is now collecting. I don't think it is possible to quantify the impact of non-tariff barriers very efficiently. So some of the speculation on how this may have been calculated is right. But remember that the objectives remain the same, which we had discussed the last time. Multilateralism is over. The US does not want to get hollowed out industrially. And the dollar they want to depreciate, though I don't think this is going to help. And thirdly, that they want to generate out of revenue out of import. So all of those three objectives are what I think we should solve for.
So for someone sitting here in India and watching all this, a very simple question. Should we feel slightly relieved because we are not as badly impacted as a lot of the Asian exporters, export-facing economies? Or is there a lot of reason to worry because of the second and third order effects? What you said, 1% being shaved off global growth itself, which eventually will come back to hit us as well.
I said more than 1%. I said 1% because of investment getting delayed. That's a broad ballpark back of the envelope thing. And in addition to the 0.6%.
In addition, so it's 1.6%, yeah. Overall impact on the global economy.
Exactly, which is at the first shot, right? And so now we have to see second order, third order effect. So this is not going to help anyone. We are slightly less affected directly, and remember that many of the problems that we had self-inflicted on ourselves, we are starting to solve them. Like the liquidity side, I think the RBI has been very proactive, and it has shown a lot of action after stating its intent, and therefore the liquidity premium that existed, which was very significant and which was actually slowing down the economy, is now very quickly getting whittled away. So the domestic economy actually should be on a better footing for its internal demand. So India economically, I think, will be less affected, but the channel through which I think the impact will be the worst will be the financial markets. So remember that people are just about starting to cope with the fact that this uncertainty will be there for a long time. The Fed put that the markets had become addicted to over the last 3 decades, that whenever there is a problem, the Fed can cut interest rates and the things will get sorted out. This time, it is a much, much more complex problem. While we are less affected because of this, in fact, the gap, as I said, between MFN rates and what has been imposed is perhaps India is much better off. Second, we are less exposed to global trade on the good side than we have than many other countries. And thirdly, our own economic headwinds that we had created for ourselves are now starting to ease. So economically, I think we'll be fine, but I think the financial markets, the currency markets, I think are going to get badly affected.
President Trump has proven Sant Tulsidas correct. Sant Tulsidas wrote centuries ago, Samrat ko nahi dos kosai. And President Trump is proving that for weaker nations, WTO is there. For stronger nations, WTO doesn't matter. In fact, he has historically coined new definition of import duty, which is your trade surplus with US divided by your exports to US. That is called import duty. I'm sure we are going to see one Ivy League case study on this new definition. President Trump has not finished. He will continue to make announcements. And it is up to India as to how we leverage this.
The real challenge actually is not directly to India, but the entire political, economic system and order is being overturned as we see. The real impact, therefore, on India will be the demand destruction that will happen globally. I think people will be very simplistic to assume that this is my exports and this is my direct impact. But remember that tariffs are going up not only for India, but tariffs are going up for other countries. And a lot of other countries around the world are significantly more globally dependent on exports to the US than India is. I would think that right now is a risk-off moment. So to say that foreign flows will be rushing into India because of that, no. But yes, India will be least impacted of all the emerging markets. That much I can definitely see.
The first thing in a big picture sense, although, in our long-only fund, we are fully invested and all that, but I would think this behavior of the market is a bit suspicious and not to be trusted because, Indian market has made this simple thumb rule, not that they will analyze the stock, but whether that day there is net selling or not by FIIs. The thing is, from an economy point of view, it's not a big deal because we don't have big scale of imports and exports. You have to see if the US market goes down in a dignified manner, goes down 8-10%, we can all handle it and we will outperform it and maybe not be up in that period, but at least it will be dignified and you will get FI flows. But if the US market is down, much more than that, then we cannot say we are isolated. That is what my lesson experience is from 2008. If these other markets go down a lot, then you can't make money. You may lose less. You may do this. Of course, in 2008, even though we had no connection with the US subprime crisis, India was down double of US.
Well, with that, it's time now for a short break, but we continue our special coverage on Trump tariff and its impact on the other side.
माननीय सदस्य लोग ये कह रहे हैं कि हमारे सदस्य नहीं है यहाँ पर जो हमारे साथी हैं, लेकिन अध्यक्ष महोदय मैं ये कहना चाहता हूँ, ये जो बिल लाया जा रहा है, भारतीय जनता पार्टी में एक मुकाबला चल रहा है। भारतीय जनता पार्टी के अंदर मुकाबला चल रहा है कि खराब हिंदू कौन बड़ा है। और ये बात अध्यक्ष महोदय मैं ऐसे ही नहीं कह रहा हूं। जो पार्टी ये कहती हो कि दुनिया की सबसे बड़ी पार्टी है, अध्यक्ष महोदय वो अपना राष्ट्रीय अध्यक्ष नहीं चुन पाए अभी तक। अध्यक्ष महोदय भारतीय जनता पार्टी क्या है?
जी मैं अखिल
Welcome back to our special broadcast. Now, former diplomat and fellow at the Center for Social and Economic Progress, Jamini Bhagwati, fears that Trump's tariffs is set to impact movement of FDI globally. Further, called out US for being short-sighted as it imposed hefty tariffs on its trading partners. Meanwhile, former Finance Secretary S.C. Garg doesn't see any reason why India needs to be protectionist and consider cutting down on tariffs on auto imports. On the contrary, former chairman of Central Board of Excise and Customs says that auto sector has reached maturity in India and can look at reduction in rates. He added that India must approach free trade agreements cautiously.
They're looking at exports divided by imports and then divide that by 2 to come up with the tariff rate, which is simplistic to say the least. But let's take a step back. You know, these tariffs are a part of an overall Trump agenda. And this will have consequences in the short, in the medium, and long term around the world. And it will not just be confined to trade. It'll be more widespread in terms of foreign direct investment.
So do you believe that as India readies its response, where do you believe we should draw the red lines and what more do you believe we can offer?
You know, there's too much has been made about this trade agreement that we'll sign by fall or by December and so on. There is a tremendous resistance over the decades, I've noticed, from our industry to opening up our trade sector in goods. And, they are right. The US is right that we have irresponsibly high trade barriers. For instance, certain kinds of car above a certain engine size, 125% duty. We have only heard of Harley Davidson from him. Why is Indian industry so scared of competition? Or is it that they are so mollycoddled and feel so comfortable? I'm not suggesting that what Trump is doing is reasonable or right or not. But I'm talking about a spin-off benefit that if it forces our industry and manufacturing to be a little more competitive.
Yes, you're right in pointing out that neither of us are business people, and yes, the consumer will eventually benefit if we actually see lower cost imports coming in, which may force Indian industry to be far more competitive as well. But, I also want to understand from you, Ms. Bhagwati, how we should read what is happening within the region. Now, we've already started to see industry reactions coming in saying, look, while there is a cause for concern, but we should also look at the silver lining, which is that China, Vietnam, etc., have been slapped with higher tariffs in comparison to India. Now, do you believe that this kind of response at this point in time is premature? How do you believe this is going to reshape what has been happening in the region when it comes to FDI, when it comes to supply chain resilience?
Highly premature, because it's not just duties. Shireen, I'm sure you will not buy a product that you're not satisfied about just because it's a little cheaper. So in case these duties mean that some manufacturing moves to India, so we need to be careful that we have the robust supply chain in place and so on, which will take time. My guess is, in the short term, I think the US and President Trump in particular have been short-sighted in imposing such huge tariffs on ASEAN, the smaller ASEAN countries. They are basically providing relatively labor-intensive products to the US. What is going to happen? Here is where I bring the strategic aspect into play. The ASEAN countries are physically closer to China. They have large volumes of trade with China, but they are strategically closer to the US because they don't want communism to overtake their countries, except for Laos, which has now effectively become a Chinese colony, and Cambodia is also hugely under Chinese influence. But even somewhat larger ASEAN countries like Malaysia, etc., Thailand, they may gravitate towards China in terms of looking for ways in which they can meet market demand in China on some preferential basis. And the Chinese, given the size of their economy, will look to provide some kind of alternative to the US. So that is more likely than India immediately replacing Vietnam or Malaysia or Thailand as a place where manufacturing will quickly shift. It could over time, as we know in the case of Apple. We are now producing Apple phones because that's also somewhat political in terms of the summit level meetings between India and the US. And I don't see that we will become a world leader in terms of a trading nation. If we had that confidence, we would have joined RCEP because we were nervous about our own capabilities, or the CPTPP. I think those are groupings that we should have a fresh look at. We don't have to do it in public view. This can be done quietly by experts within government and also pulling in non-government experts to look at the change scenario. Do we still feel that nervous about these trade blocks as compared to earlier, given the kind of attitude that the US has taken yesterday?
Times ahead, difficult times ahead. What I had mentioned in that article was basically the Nifty Aayog study itself, which pointed out that India's exports under the FTA to ASEAN countries specifically had not really shown the sort of export benefits which we anticipated when we went into the FTA. So one was only telling that you go to FTAs with caution. And currently, the silver lining apart from everything else, the other countries being impacted with higher tariffs, is that pharma is not there. Textiles are another area of strength for us. Bangladesh and Vietnam seem to be having a higher tariff as of now. But there's a great amount of uncertainty. And I don't think this helps business, this helps trade, this helps the Indian exporters. He'll have to factor how much pain he will absorb.
Mr. Garg, come in here on this discussion. Your first thoughts, sir, impact and what can we do? Mr. Shah earlier said FTA is, of course, work in progress, but we need to enter those cautiously and carefully because we have data which shows they don't, outshine growth otherwise. I mean, FTAs them by themselves. Go on, sir.
India cannot simply look at that bilaterally, goods by goods or sector by sector we'll negotiate. I don't think Americans have patience and the time to do these bilateral negotiations. We'll have to also see whether we can take broad brush calls. And here, again, if you analyze the Indian basket of exports to America and American exports to us, I don't think we need to have such high tariffs at all, whether it's agriculture or whether it's industry. So slash the tariffs down massively. The Indian industry might suffer some short term, but Indian consumer will not suffer at all. I think the time has come to join in this big reordering of the world trade and the economy which is happening.
You're saying India needs to have a far wide-reaching sort of thought to this. But if India were to start opening up, in sync with what the US wants, this could be pretty damaging for domestic industry, wouldn't it?
Automobiles, which you just said. In automobiles 20 years, 30 years back, we perhaps needed some protection. But today, compare the prices of a Tesla being manufactured in America or Tesla being manufactured here. It makes hardly any difference in cost, because so much of automation, robotics and other things have taken place that in automobiles, the labor advantage is completely gone. Even today in EVs, etc., many of the components, engines and others, you are in any case importing. So I don't really see any threat if you reduce the 60% tariff to 10% on automobiles. I think we need to get out of this unnecessarily overprotective mindset. It's not required any longer. Why should American almonds or apples have a higher tariff than Afghanistan or Iranian almonds? What is the problem if we have the same tariff?
Mr. Shah wants to come in, I think. He's shaking his head. Mr. Shah?
No. The rates of, we don't have any US-specific tariffs, Subhash. All our tariffs are MFN, except where we have a FTA, which is WTO compliant, and which permits us to have this reduced tariffs in respect of those countries with whom we have a free trade agreement. Otherwise, the tariffs are common across the board. So if you're going to reduce tariffs for any product which is coming in from America, it will apply across the board for all imports coming in from all countries, which is the principle of MFN, as you are more than aware. So I think auto sector specifically is a sector which, because of protection, has gotten investment into the country, and we are an export country now. Hyundai and Nissan and Volkswagen, everybody exports from India. So I think auto sector has reached maturity. So it's Mr. Subhash Garg, and that perhaps you can look at some reductions.
Yeah. I want to sort of take out the silver lining in all this. Yeah. Perhaps, and gentlemen, weigh in on this. Perhaps they started with calling out this tariff war, and somewhere down the road they realized that what's more important is not tariff but overall trade imbalance, which can still be addressed. It depends on, I import some from you, you import some from me, and therefore there is a trade surplus or deficit. So perhaps if that is the way the US is thinking, then that does open up room for more negotiation, for protecting, India's interests versus maybe giving in to some American, pressure points like bourbon whiskey and, like of course, the Harley Davidsons. Mr. Garg, you coming in?
I just wanted to say one more thing. See, the days of FTAs, bilateral negotiations, regional negotiations are all gone now. With this kind of thing coming in and the world becoming a one single manufacturing global entity itself, the national manufacturing, etc., and in a situation where there is a global surplus of supply of industrial goods now, the time has come to virtually do a very fresh thinking on the entire tariff structure. Maybe like domestic economies, we have abolished the duties on interstate kind of thing. Globally now, the time has come to do away with all tariffs everywhere.
And with that, it's a wrap on this special broadcast. Thank you so much for watching. News and updates will continue right here.
बहुत हंसते हंसते कहा है, इसको हंसते हंसते जवाब देना। इस सामने जितनी पार्टियां हैं, उनका राष्ट्रीय अध्यक्ष उन 5 लोगों को ही चुनना है परिवार के। हमें माननीय अध्यक्ष जी करोड़ों सदस्यों में से 12-13 करोड़ सदस्य प्रक्रिया कर कर चुनना है तो देर लगती है। आपके यहां जरा भी देर नहीं लगेगी। मैं कह देता हूं अभी 25 साल तक आप अध्यक्ष हो जाओ, नहीं बदल सकता।
अध्यक्ष महोदय, क्योंकि जो बात निकल के आई है वो मैं फिर आगे बढ़ा दूं। अध्यक्ष महोदय, जो बात सोशल मीडिया या और जगह गुपचुप हो रही है, कहीं ऐसा तो नहीं था कि अभी कुछ दिन पहले यात्रा जो हुई है वो कहीं 75 वर्ष की एक्सटेंशन वाली यात्रा तो नहीं थी।
Over 3,000 entrepreneurs, investors and heirs have made it to the Forbes list of billionaires.
My fellow Americans, this is Liberation Day. We will establish a minimum baseline tariff of 10%. India, very, very tough, very, very tough. Prime Minister just left. He's a great friend of mine, but I said, you're a friend of mine, but you're not treating us right. China, 67%. That's tariffs charged to the USA. We're going to be charging a discounted reciprocal tariff of 34%. You think of European Union, very friendly. They rip us off. 39%. We're going to charge them 20%.
We're now preparing for further countermeasures to protect our interests and our businesses if negotiations fail.
We're going to fight these tariffs with countermeasures.
The administration's tariffs have no basis in logic, and they go against the basis of our two nations partnership. This is not the act of a friend.
Fear and fury, dilemma and dismay. Countries across the world are coming to grips with Donald Trump's reciprocal tariffs, one that upends decades of America's support to globalization and potentially has the power to disrupt and rearrange the global trade order. Trump unveiled sweeping reciprocal tariffs. The levies were bigger than expected. Let's quickly take you through the 5 big takeaways. Trump announced what he calls discounted reciprocal tariffs during a long, drawn-out speech at the White House lawn. Several countries, including China, Vietnam, EU, Japan and India, stare at tariffs in the range of 20 to 40%. India specifically faces a 27% tariff levy. As per the Trump administration, the rates were calculated roughly half of what the US claims these countries impose on American exports, factoring tariffs, non-tariff and monetary barriers, among others. India's Commerce Ministry says they are carefully examining the implications. So what does this really mean for the Indian industry? India's pharma sector can breathe easy as Trump's reciprocal tariffs strike exempts the sector. The IT and jewelry sectors, however, stare at a backlash. From anger and outrage to emergency meetings, Trump's tariffs have evoked a slew of reactions across the world. China calls for Washington to immediately cancel the tariffs, warning that they endanger the global economic development. The European Union is preparing a fresh package of countermeasures as well.
For these reasons, starting tomorrow, the United States will implement reciprocal tariffs on other nations. It's been a long time since we even thought of that. We used to think about it a lot. We didn't think about it for many decades, and you see what's happened. For nations that treat us badly, we will calculate the combined rate of all their tariffs, non-monetary barriers, and other forms of cheating. And because we are being very kind, we're kind people, very kind. But we will charge them approximately half of what they are and have been charging us. So the tariffs will be not a full reciprocal. I could have done that, yes, but it would have been tough for a lot of countries. We didn't want to do that. But such horrendous imbalances have devastated our industrial base and put our national security at risk. I don't blame these other countries at all for this calamity. I blame former presidents and past leaders who weren't doing their job. They let it happen. And they let it happen to an extent that nobody can even believe. That's why, effective at midnight, we will impose a 25% tariff on all foreign-made automobiles.
All right, our managing editor, Shireen Bhan, is joining us now from Vijay Chowk. Shireen, we had been trying to get a pause on these reciprocal tariffs with concessions for the United States. That has not cut ice with the US administration. Will a bilateral trade deal, even if we sign it, will that work in putting these tariffs on hold? What's your view?
Well, we just don't know at this point in time, Parikshit, and that's one of the many questions that we don't have an answer to. By the way, I'm standing at the heart of Delhi's political corridor. This is where we have the North Block right behind me, the Finance Ministry, the Commerce Ministry right next door, and of course the Indian Parliament here as well. And policymakers across governments, including of course our government, are going to be going over the impact and the implications of the Trump tariffs announced overnight. Now, as far as India is concerned, as you rightly pointed out, India was hoping for the best case scenario, that look, we are already in active dialogue and in discussion as far as a bilateral trade agreement is concerned. So the hope was that even if the tariffs were announced and they were to impact India, perhaps there could have been a suspension on the rollout as far as the tariffs were concerned. But that has not been the case. India has not been singled out. The tariffs will apply on India like they will on the rest of the world where the Trump tariffs come into effect. The hope now is that perhaps there can be a speeded up bilateral trade agreement. Look, fall is when the expectation is that we should have something concrete in place. But again, the view is that perhaps if we speed up negotiations, there could be the possibility of some sort of change. Remember, even in the White House, in its statement, it has said that if negotiations with a partner or reciprocal action with a partner to assuage and allay concerns of the U.S. are on board, then the U.S. may consider, favorably what course of action it will take. So all of this is up in the air. But what is a fact as of today is that there is a 27% tariff. And to be clear, while we heard the President Trump there talk about reciprocal tariff, this is not reciprocal in the way that we expected it to be in February when the Trump administration had put forward a broad calculation of how these tariffs would be calculated. It's very, very different as of today. So this is a global world order that is in reset and a global world order that is in flux and volatility. And I think everyone is measuring the impact at this point in time and assessing what way to go. In fact, that is what the Commerce Ministry has said. The Commerce Ministry, in its statement, by the way, has not spoken about the fact that they have asked the U.S. to roll back the tariffs. They have spoken about the fact that they are engaging in assessing the impact with all stakeholders, and they're hopeful that the BTA will provide a road forward, a path forward as far as the negotiations with both sides are concerned. But there's plenty to talk about in terms of sectoral impact. Hormuz has been poring over the fine print to understand who is going to be hit and who perhaps gets a little bit of a breather, a reprieve at this point in time. Hormuz.
A fairly resilient reaction coming in from the Indian markets today, and considering how the start was supposed to pan out, you would take this session with both hands. But as the session went by, there was a very clear demarcation between the winners and the losers of Donald Trump's tariff announcements, the 27% reciprocal tariffs that were imposed on India. And Donald Trump mentioned that he had mentioned to PM Modi that although he's a very good friend, you don't treat us well, and hence we'll be charging you half of what you charge us, and hence the reciprocal tariff imposition. But one of the sectors that took a beating in today's trade was IT, and it was the mid-cap IT stocks that took it on the chin in today's session, be it Persistent, Coforge or KPIT Tech, falling up to 10%. And it is not because of any tariff-related concerns, but because of this tariff imposition, the rising fears of a recession in the United States, which is a key market for these IT companies, is the result of why these stocks took a beating in today's session. Another sector that took a beating, we don't talk about that sector that much, were the shrimp exporters, and it was stocks like Avanti Feeds and Apex Frozen Foods that at one point were down almost 18% in today's trade. India, of course, is one of the largest shrimp exporting countries to the US, and Incred Research has analyzed that in case these tariffs remain in place, the shrimp import duty will now rise up to as high as 45%. So a negative reaction for these shrimp exporters as well. And some of the winners, though, in today's session, one very clear winner was the pharma sector, and it was the Nifty Pharma Index that was an outperformer today. Most of the stocks ending higher, although off the highs of the day, but still ending higher. The question only remains is for how long, because there are investigations that are in progress, and that leaves the window open for any future tariff levy on the pharma sector. And lastly, another winner that emerged in today's session was the garment and textile companies, be it the likes of Trident, be it the likes of Arvind, Gokaldas Exports, all of them seeing healthy gains in today's session. And that's not because they were exempt from any form of tariffs, but the competitive nations were the ones that were charged a lot more more in comparison to India, be it China, be it Vietnam, be it Bangladesh, all of them charged anywhere between 40 to 50% in terms of reciprocal tariffs. So that gave India a competitive advantage, and that is why you saw healthy gains in these names. So clear winners and losers. It'll be interesting to see how this trend sustains from here on.
Let's get you a first pulse check of India Inc. Joining us on the program to take the discussion forward on the impact and the implications of the Trump tariffs is Anant S. Iyer, Director General, Confederation of the Indian Alcoholic Beverage Companies, Sudhir Sekhri, the Chairman, Apparel Export Promotion Council, Rajiv Nath, the Forum Coordinator of the Indian Medical Device Industry, and Ashok Chandak, the President of the India Electronic and Semiconductor Association. Gentlemen, appreciate you joining us here on the program. Let me start by getting a check from you, Sudhir Sekhri, as far as the apparel and textile business is concerned, because, you're not exempt like the pharma sector is, so the tariffs come into effect as far as the apparel sector is concerned. But the hope and the belief or the hypothesis is that since we're better off when it comes to tariff imposition within the region, could this be beneficial to India? Lay out the best case for us.
Okay, yeah, first of all, now that the cat is out of the bag, there is a sense of relief in the sense that, we at least know where we are heading and how we fare vis-a-vis our competition. Now, as far as apparel is concerned, we really stand to gain a bit when it comes to our competition, because be it Bangladesh or be it China, their tariffs are anything 10% to 20% higher than those imposed on us. However, I think that is seeing it in a very narrow sense, because what is happening here is the US importers, they've already started asking for discounts and cancellations. Now, this is a big issue for us, and this needs to be addressed by the government. They have to take it up with the government there, or, like China did, when 10% tariff was imposed on China, many retailers, they started pushing manufacturers to reduce prices. And that's when the China government stepped in, and they said they warned these retailers that they'd be blacklisted if they continue with this kind of a thing. So that is one part of it. The second part is
I just want to interrupt you there. I want to interrupt you there because what you're saying is very important. So I want to understand this for the benefit of everybody watching. You're saying that order cancellations have already started, and the call and the ask for discounts have already started on account of the tariff imposition, or even before the tariff imposition?
Okay. Well, actually, the discussion started last week. And now that the tariffs, it's now clear what it is. So discounts, they've started canceling orders. And in fact, last night we received a message from buyers asking for discounts. And some buyers are also asking for postponement.
So in the near term then, Sudhir, what should we expect? Because, as you pointed out, and I that's what I've been caveating as well, that, this business of what happens to the region and how much higher the region is us versus India, and whether that benefits us or not is a more medium-term aspect. But in the short to near term, what will the impact be? What is the hit likely to be? Have you done any calculations on the back of the announcement that's happened overnight?
Yes, like I said, in the immediate term, this is what they're asking. But obviously, we cannot, the kind of discounts they're asking, anything from 15 to 20%, that is definitely not workable. We don't work on very 5-6% net profit, and we definitely cannot afford this. So we have to take a stand, and we'd like this government to support us on that. Now, coming to the other aspect, of course, yes, we will become competitive when it comes to our neighbors. But let's not forget that there are many other countries where the US is buying garments from those countries, but they're not buying much because of the higher cost of production. Now, let's take Turkey as an example. Now, Turkey has they've been subject to a tariff of 10% only. So, which means the difference between Turkey and India is today 17%. Now, the 17% will more than offset the higher cost of production in Turkey. So, obviously, I think a lot of business might move to Turkey. Similarly, Germany, even the European countries where the tariff is now 20%, there is a differential of 7%. Maybe that 7% may not offset the difference in cost of production. But look at the NAFTA countries, Dominican Republic, for instance, Egypt, Jordan. Egypt has been hit with 10%. So they are 17% lower than us. Dominican Republic, 10%.
Okay.
I mean, a lot of American production is still being carried out in DR. So that is going to, DR is going to gain, and a lot of business is going to move. So, it's very difficult to predict what exactly is going to happen in the next 3 to 6 months. But immediately this is the negatives that we see. This is the downside we see. The upside is, yes, okay. We call Bangladesh, China, Vietnam, Cambodia, Pakistan. They are competitors. When we talk about competition, we only name these 5-6 countries. We don't even talk about DR or Turkey. So, well, we are much better off than these countries. But is that a consolation? I mean, that's the big question.
That's 247 more than last year. Not only are there more of them, but they're richer than ever. The billionaires on the list are worth $16.1 trillion in total, up nearly $2 trillion over 2024. Their total net worth is more than the GDP of every country in the world besides the US and China. The US, with a record 902 billionaire citizens, continues to boast more billionaires than anywhere else on the planet. China, with 516, remains second, and India, with 205, still ranks third, which is 5 more billionaires than we had last year, but not a single Indian has a net worth of over $100 billion. So who's on the list? The richest man in the world is Elon Musk with a net worth of $342 billion, followed by Mark Zuckerberg with $216 billion and Jeff Bezos with a net worth of $215 billion. There are only 3 people in the world with a net worth of $200 billion. Oracle's Larry Ellison, Louis Vuitton's Bernard Arnault, and legendary investor Warren Buffett.
Let me also go across to Rajiv Nath, Forum Coordinator at the Association of Indian Medical Device Industry. Mr. Nath, many thanks for joining us. The pharmaceutical sector at this point in time is exempt, so there is a sigh of relief there, but not so for the medtech sector. What will the impact be?
It looks slightly detrimental to us, but I think business people have to look for windows of opportunity, because unlike apparels, where you can move things around very rapidly, for quite some time, USA has been looking at diversifying its supply chain of medical devices to address its healthcare security needs, like India has been doing also post-COVID. So I think that is more strategic in mind. So Indian manufacturers have to see product lines where USA is wanting to shift away from Mexico or from China into suppliers like India. And this may be an opportunity for us over here to take forward. So yes, domestic manufacturing.
Well, that's the medium to the long-term consequences. But what about the near term, Mr. Nath? In the near term, with the imposition of this 27% tariff, what will the impact be on medtech manufacturers?
Well, I would say in the short term, where we are competitive and ahead of the competition from other countries, that will be maintained. There should be no immediate short-term concerns over there. The buyers will, of course, have to absorb the higher costs. So it's going to be a pinch for them. For us, tariff is not the main concern. Of a higher concern for medical device industry is the non-tariff market access costs. The cost to get a US FDA approval varies from $10,000 to $500,000, depending upon the risk classification of the product. That is for the private healthcare market. And to access the public healthcare market, that is nearly impossible because of the Buy American policy. And we're not allowed to take part in the bids for the American government purchases over there, because we are not partners to the trade agreements with USA over there. So it is the non-tariff issues our government basically has to negotiate on our behalf in the bilateral agreements going forward. And we do hope, like they've seen some reprieve for pharmaceuticals, maybe they can consider a reprieve also for medical devices being healthcare products.
Well, reprieve or not, we don't know. But let me ask you very quickly, what is the quantum of exports to the US at this point in time? And do you believe that that is likely to see an impact on account of the imposition?
So currently we are exporting high quality consumables, disposables, and some electronics to the tune of about nearly $500 million over there. And we import from USA nearly $1.5 billion worth of goods. So the imports are double that from USA. So in that respect, yes, this policy is going to give an asymmetrical advantage to the US companies who are accessing the Indian market. Interestingly, the biggest market for Indian medical devices is USA, and also the biggest suppliers to India is USA in medical devices.
Yeah. Yes, and this will, of course, be something that I guess both sides will take up even as far as the bilateral treaty is concerned. But let me go back across now to bring a view there from the Indian Alcoholic Beverage Association. Joining us now is Anant Iyer. Ms. Iyer, many thanks for joining us. We've already seen that cut by India on bourbon whiskey ahead of the Trump tariffs coming in, with the hope that perhaps that would assuage and allay some concerns that the U.S. had. But the tariffs have come in nevertheless. Take me through the impact that you see.
Yeah, Sireen, thanks a lot for having us on your channel. We are still awaiting some clarity on what will be the exact tariff on spirits as well as wines. Currently, India has only reduced its duty on bourbon to 100%. Our fear is that it's not so much from the US, because the exports from US into India, the imports into India are about, $24 to $25 million, which is very small when you compare it to the overall imports, of spirits and wines from the other parts of the world, especially, the United Kingdom, EU, and other countries. So our fear is that, there are other FTAs now in the, on the table, and those countries should not use, whatever concessions we give to the US as a benchmark for, discussions, because that doesn't safeguard the interests of our members and our industry. As you know, our industry is a state subject. We face a whole host of challenges, and the cost of operations that we have in India, right, are at least, at least 50 to 75% more than what it is in any developed country, or even in the middle kind of, developing or, developed countries, in just play production costs, input costs, etc. So we have our own challenges, and we have already given, our representations to the concerned ministries, including our nodal ministry, which is the Ministry of Food Processing, and, requesting them that, yes, they should safeguard our interests. And we have ourselves recommended, as an industry, a staggered, reduction of customs duties over a period of 10 years. So it's not that, we haven't done it, but to have a very drastic cut may, set the cat among the pigeons, as it were.
Yes, because there is a negotiation underway with the EU as well. And of course, that is going to be one of the items there, of course, will be wine and spirits will be up for discussion and debate. And your fear is that if India cuts on this, just as we have done as far as bourbon whiskey is concerned, that will open up the room for negotiation there as well. Let me bring in Ashok Chandra, the president of the Indian Electronic and Semiconductor Association, into the conversation. Mr. Chandra, many thanks for joining us. Very quickly, the near-term impact, the short-term impact of the tariff imposition, and of course, eventually the silver lining as well, but the near-term impact.
I don't see any major near-term impact, except for the fact that whatever exports we do to United States, almost like $12 billion of electronics, if there is a short-term demand reduction in US because of the prices going up for the consumers, that's the only impact I would see. But India is well placed as of now compared to the other electronics and semiconductor exporting countries, such as China, Vietnam, Taiwan, Thailand, as well as Mexico. So overall, we are, I would call it, at a positive edge. And it depends on India now, how do we make use of the opportunity that is available. And I want to add one point over here, that recently one policy was announced on PLI for electronic components. And I call this as one of the winning trio for India now. The PLI for electronic components, there is a PLI running for electronics manufacturing, and there is a Semicon India program. All three put together creates a very good combination of a value addition for electronics manufacturing. And India need to capitalize on these policies and ramp up faster. So short term, no major issue. Long term, yes, maybe United States electronics manufacturing industry would get developed. But still, I would call the demand in US for electronic goods is tremendous. It's quite huge. It's almost like a $500 billion. So we will still have a huge opportunity to go forward and expand.
Well, that is the hope that as far as the electronic sector is concerned, this could be a silver lining. This could be an opportunity as we see significant tariffs being imposed on the likes of China, Vietnam, etc. But of course, in the near term, as the gentleman was pointing out, the fear is what will the tariffs do to global demand? What will the tariffs do to global growth? Is the U.S. possibly headed into a recession? That is now an issue up for discussion and debate. Gentlemen, appreciate you joining us here on CNBC TV18 for the first pulse check of India Inc. on the Trump tariff imposition, what it means for India and its different sectors in the near, medium and long term. We are going to take a break here, but we will continue with Trump Watch and the tariff plan right after this. Stay tuned to CNBC TV18. Big news breakers coming up.
Top 6 in the world. There are 15 billionaires with a net worth of more than $100 billion. US President Donald Trump's net worth has doubled in the last year from $2.3 billion to more than $5 billion thanks to his social media platform Truth Social and cryptocurrency bets. Mukesh Ambani remained the richest Indian and the 18th richest man in the world with a net worth of $92.5 billion. The other Indians on the list included Gautam Adani at number 22 and Savitri Jindal at number 48. Shiv Nadar was at the 51st position with a net worth of $34.5 billion, Dilip Shangvi at number 79 with a net worth of $24.9 billion, and Cyrus Poonawalla at number 86. Only 13.4% of the billionaires on the Forbes list are women. There are 2,681...
Welcome to Indianomics. This is a banking special. Banks have been facing pressure on their margins because their lending rates have fallen because of the repo rate cut. You know, their lending rate is linked to repo rate. But the cost of their deposits has remained high. Bankers and Reserve Bank are hoping that as the Reserve Bank floods the market with liquidity, deposit rates will fall. But that hasn't happened so far. It's 2 months since the repo rate was cut. 7 trillion rupees have been infused, but deposit rates haven't fallen. Now, the other reason why deposits are staying high is Indians are saving less and less via bank FDs. Instead, they are preferring mutual funds. The mutual funds also keep their money in banks, but in the current account, from which they are frequently withdrawing for transactions. Such current accounts are unstable, so for longer-term loans, banks are forced to raise one-year money at 8% through certificates of deposit, CDs or bulk deposits. The question we are asking today, therefore, is, given the new savings pattern of Indians, is it likely that bank margins will continue to remain under pressure and never return to the pre-2022-23 levels? Will loan growth also be under pressure for want of stable deposits? In short, is the best of margins and loan growth behind us? For all these questions, I'm joined by 3 veterans: Dinesh Kara, former chairman, State Bank of India; S.S. Mundra, former deputy governor and a former chairman of BOB, deputy governor of the Reserve Bank; Srinivasan Varadarajan, chairman of Union Bank and a veteran banker at Axis in his previous avatar. Gentlemen, thank you very much indeed for sparing time for me. I'm deeply grateful. Let me start with someone whom I can call a practicing banker, Srini Varadarajan, who is still the chairman of Union Bank. Srini, what is your sense? Is this shift in savings behavior going to permanently impact banking as a business, as Uday Kotak puts it, that there is a challenge to the business model?
I think you got to look at it from multiple perspectives. You looking at the last couple of months, which has been, which everyone knows is the busy season as far as the banking system is concerned, and the maximum growth happens in that quarter. I think looking at it as a signal for what is deposit rates is not necessarily the right indicator. We will see some of the deposit rates coming down this quarter, which is typically a sort of a lean season. So that is one aspect. The other aspect which you touched upon is that whether the peak of bank margins in terms of NIMs is behind us, and is that something which we need to factor in going forward? I would think the market to a large extent is reflecting that, even though every analyst on the street is to some extent overweight banks or recommending banks. I think the banks are struggling to perform over the last couple of years. That, to a large extent, is due because of consolidation of market share amongst few banks. If you look at the last couple of years, incremental market share of 3-4 banks is above 50%. And therefore, every other bank is forced to fight for the remaining piece of the pie. And that, which means that when you're looking at bulk deposits or CD rates, when rates are set at a high level, others typically become price takers. And therefore, costs are not coming down on the deposit side. As you said, CASA and retail term deposits are growing at a steady pace, but nowhere to the pace which credit growth is happening. And therefore, NIMs continue to be under pressure and will continue to be under pressure.
Okay. Well, let me get Mr. Khara in on this. Clearly, he is a price setter. I mean, State Bank is one of the guys who's doing the consolidation. Mr. Khara, we don't see rate cuts even from State Bank. And liquidity aplenty has been given. A CRR cut in December, almost 7 trillion rupees by way of OMOs, swaps, you name it. And now we have ended the quarter with a little bit of a surplus, actually, in the interbank system. What is your sense? Is there a permanent problem? In spite of liquidity, will this deposit cut not be commensurate with the lending rate cut?
Well, I think I tend to agree with what Mr. Srinivasan has just mentioned. There are different segments of the economy, and when it comes to the seasonality of the deposit and the credit of the economy, there are various dimensions. So when it comes to deposit, particularly when we look at the credit deposit ratio for the system as a whole, which is around 80%. So naturally, when the credit deposit is at 80%, so there are many banks which are clamoring for the deposit. And particularly when it comes to the price setters, also what you mentioned in terms of banks like State Bank of India, who are witnessing about 12% plus growth in terms of the loan book. And also when it comes to deposit, they have to maintain the pace of the deposit growth. So they cannot be out of the market. And that is the reason why perhaps they have not seen the reduction of interest rate in the deposits.
Okay.
There are, we look at it from the point of view of the structural changes, a couple of structural changes which have happened. We have seen that, for last 10, 12 years, there is significant growth in the mutual fund AUM.
Yes.
It used to be about 12 trillion. Today it stands at about almost about 67 trillion. So that very clearly means that it's one segment of the society who have become saver in this particular position. They have only seen the upside of the mutual fund. Only for last about 2 months' time, they have started witnessing the reversion to mean.
Yes.
And that is one of the reasons why probably you would have seen that, when it comes to SIP, whether those SIPs have been paused or there have been stoppage of SIPs. So I think this is one phenomenon, what you mentioned, whether deposit will go away and people will go for only for the mutual fund. Perhaps this is one area where now the behavior will undergo a change.
Yes.
This generation of the savers will probably have much more mature outlook. There will be allocation principle which they will be applying. They will be going deposit and as well as for the market instrument. depending upon the risk appetite.
No, that's the point, sir. You know, my father saved only on FDs. Whereas I would assume that, and I am on the threshold of retirement in a few years, I would perhaps be more, different in my asset allocation. So, Mr. Mundra, my more elementary point, I take what Srini and Mr. Khara are saying, seasonal, slack season, busy season, all that is taken. But isn't there a permanent issue that lazy deposits era is over? And therefore, bank margins won't be what they were. Banking business won't be as easy as it was.
Okay. Interesting point, Lata, and both Srini and Mr. Khara has made very relevant point. But let me start with, there had been certain narration, and you have also mentioned recently. Number one is about, looking at that you raise deposit 8%, where the cost ultimately comes near to 9%, and you land at 8.5%.
Yeah.
Similarly, there had been narration that CD ratio is running at 80%. Now, what I would like to argue that these are a very valid point, and they indicate to a long-term trend, but they are not as binary as we can very simplistically look at them.
You're referring to the, I think we should run the Uday Kotak tweet. I think you're referring to that. That 8% cost and 9.5%, 8.5% home loan.
Yes, I am referring to that. The fact remains that while you are raising deposit at 8%, you are also having the CASA, which is maybe 3 to 5 or 7% in saving rate and zero cost at current account. So ultimately, you look at blended cost. Why I'm telling it is not as binary. Similarly, you are talking about that a home loan is given at 8.5%, but at the same time, there are loans which are also earning 11, 12%. So again, you have to talk about the blended yield. The point I am trying to make, Lata, that with all this, even with the trend which is little declining, but if you look at the NIM of Indian banks, they are still very high if you look at globally. So there is a room, and there is a atmosphere is building up where I agree these NIMs have to come down to a level which is more matching with that. So I agree with Srini that couple of months or 3 months did not to be taken as a permanently lasting trend. But my opinion, fact remains, this is a high time for Indian banks that they will have to look at the credit side and move away from this model of, getting into wedlock with an asset. Means you underwrite an asset and then till maturity it remains. It has to be originate and distribute model. And for originate and distribute model, you have to have an efficient market. It was not there at all few years back. Today there are avenues are available, but fact remains that lot more is to be done, and banks have to be prepared for this change where the NIM would be under pressure, NIM would be declining, and they would have to learn to recycle their assets and do the new underwriting. As well as one last thing. One cannot
can I come to you? Can I come to you in a minute? I'll come to you in a minute. I take your point entirely that one point you make, yes, the era of lazy deposits and therefore high NIMs is under challenge. And secondly, that now banks have to circulate their assets, buy and sell their assets a little more. I'll come to that in a minute, but I want to ask Srini another thing. The constant criticism, I get even trolled for that ultimately money remains in the banks. And therefore, why are you all cribbing? You tell me why it is not different. That money coming as FDs and money staying in the current account of a mutual fund, why are they fundamentally different?
Clearly, as you initially said, the behavioral analysis indicates that, the current account deposits are volatile and you cannot rely on them for long-term lending. So the point one needs to understand, and one possibly the market or the regulator needs to sort of mandate, is that banks need to disclose quarterly average balances of all these deposits, whether it's current accounts, savings accounts, retail term deposits, and bulk and CDs. Because the composition of this is changing. The liability composition is changing. Even though a year-end number looks like X, actually the average balances are not that. And the composition of current and savings accounts in the overall liability profile is coming down. The system is growing credit at a faster pace than the average balances of CASA are growing in the system. Therefore, even though these are low-cost deposits, their share in the overall liability profile is coming down. Therefore, the cost is getting pulled up. So structurally, the NIMs are actually declining, and that is the truth, and that is going to continue. And I agree with Mr. Mundra that, yeah, banks have to be prepared for lower NIMs. I think whether you call it lazy banking, whatever we call it, I think the CASA profile of banks and as a percentage of the overall liability is coming down on an average basis. That has implications for cost of funds, and that has implications for NIMs, and that is not going away.
Okay, I was going to put that last line to vote. Are NIMs structurally headed lower? Srini and Mundra have already said yes. Mr. Khara, where do you stand? Just yes or no. Are NIMs structurally lower?
I would say that if at all you're looking at NIM of 4, then perhaps yes. If at all you're looking at NIM of 3, then perhaps no.
Okay, I will take it as 2.5 out of 3 votes in favor of the idea that margins are going to be a little under pressure compared to the past. We have to take a break, and after that, I want to ask you whether the regulator and the tax authorities need to change some rules. After the break. Welcome back to the Special Indianomics, where we are discussing whether India's banking model has been challenged and is looking like changing and becoming tougher. I've been speaking with Mr. Dinesh Khara, Mr. S.S. Mundra and Srini Varadarajan. Gentlemen, thank you very much for your patience, for staying on. My next question is, what can the regulator or what should the regulator do? Mr. Khara, the EBLR, External Benchmark Lending Rate Rule, the Reserve Bank brought it because banks were not passing on the rate cut even after RBI announced a rate cut. So they said your lending rate, many of them, will be linked to the repo rate or the T-bill rate. But the cost of funds, the deposits are not linked to anything. Do you think EBLR needs to be refined? Do, say, savings deposit be linked also to repo, something like that?
No, actually, there was a situation where there was an effort made by banks to link the deposit rates with the external benchmark. But what we have seen that, the market does not respond to that. And normally it doesn't really work out well. So that is the reason why perhaps, and also we have to acknowledge the fact that when it comes to savers, that community is very broad-based. There are very common men who may not like to have that kind of a risk sitting in their deposit book. So this is I really wonder whether it will be a success or not.
Okay.
But I think what you mentioned, when it was introduced that, you have to link up your loan book to the EBLR, then perhaps, that can be revisited. Maybe.
Exactly. That was going to be my question. Srini, do you think, therefore, loan book could EBLR be rejigged? Because it seems to impact only one side.
I don't think so. I'm not understanding why that should be the case. I think EBLR is now reasonably well established. Okay. I think it to some extent improves transmission. See, the whole thing on the liability. See, I think the liability side starts first. I think the license to grow for a bank comes from its ability to raise deposits in a sustained, robust manner. And I think that should be the fundamental principle behind growth in any bank. If you try and grow the asset side at a pace which is much faster than what your sustainable deposit growth is, there is always going to be a problem. And therefore, banks have to calibrate their growth on the asset side based on how their deposit profile is growing. Okay. If you try and grow assets and then try and search for deposits, you will end up sort of weakening your liability profile. And that to a large extent is what we are seeing in some of the smaller banks. So the thing is, I don't see any reason to tinker with the EBLR. I think what we need to do is to try and make sure that the liability side growth to a large extent drives the pace of asset growth. And as long as that is there, I think it will work. Okay. By growing the asset side faster is when I think the risk lower NIM sort of increases substantially.
Okay. Well, there are some banks, of course, with very stable deposits, salary accounts like Mr. Khara's bank. And so they can have the ambitions of high growth. But
That's what I said, Lata. There are few banks which are on an incremental basis taking away the lion's share of CASA as well as retail term deposits because of their ability in terms of digital engagement and various other things they have in place in terms of customer profile. With the result that every other bank becomes a price taker and therefore they are in a very difficult situation.
Well, Mr. Mundra, I want to come to you because you brought the very important point that banks have to churn their assets now. You can't give the loan and hold it till maturity. You have to manage the book. Do you think the regulator also has to become a little open to banks depending on wholesale funds and managing the liability part also? The fixation with CD ratio probably, as it is, in the D of the deposits, they are not including NABARD refinancing and, the D is a little underestimated. So do you think separately, the RBI also has to become a little open to people taking bulk deposits and certificates of deposits? Nothing wrong. We have all to become marketized.
Okay. Number one, I think whenever there is a little sign of stress and the narration goes back that then our regulators should do something.
Okay.
I think all the entities are mature enough. Market process are well established. To my mind, one, I have already mentioned that you have to manage your credit book more efficiently. You have also to become more efficient in your asset liability management. Okay. Now, if you look at it, I mean to say, you see there is something like behavioral pattern in CASA deposit, which is allowed by the regulator, right, for your ALM plotting. Now, if you look at the behavioral pattern of your CASA deposit, you also look at the behavioral pattern of your wholesale deposit, you reach to a core portion of your deposit, which you can call as a core portion. You put some allowance there also further, little bit as a cushion. That core portion is what you should use for your long-term lending. Match it. And then you have the short-term lending and the consumer loan. And that long-term book also which you create, then you should be able to churn. I think it will be a virtuous cycle. But what I am trying to say, I agree with all the gentlemen, with you, the whole structure, it has to go a structural shift. Now, there has been argument that this preemption should be reduced or other the regulatory cost should be reduced. Okay, fine. To my mind, that is not a lasting solution. That is a band-aid. Okay. Regulator do it today, within 6 months or a year, everything will be absorbed and you are back to the same place where you are. So I think what we should look at is the more lasting and root cause solution rather than every time clamoring for that, regulator should come with some crutches and provide the help.
Okay, I want to quickly try and get two questions. Mr. Khara, does the government have to rethink taxes? I mean, debt is really getting a bad deal compared to equity. And the corporates also need debt capital. They can't only manage with equity. Is there a rethink needed?
Well, I think when particularly in the context of the deposits also, there is a scope because when it comes to deposits, it is subject to tax on accrual basis, whereas when it comes to capital gains, it is subject to tax on the cash basis.
Yes.
So I think that is one area which probably needs to be addressed. And what you mentioned that, when it comes to even the long-term capital gains also, for a economy which is aspiring to grow at much faster pace, we would certainly need the debt as well as the equity both. So the gap between the capital gains probably it needs to be re-looked into. So I think there is a scope which can perhaps be looked into depending upon the fiscal room which is available can perhaps be looked into.
Yeah, I guess there are a lot of votaries for low capital gains on equity. Capital gains tax on equity, but there are not so many people supporting debt. Final question to you, Srini. The usual cry is when animal spirits are there, loan growth will come. After all, every loan creates its own deposit. Therefore, this argument is only because you are under pressure, you're bringing all these arguments. Once the animal spirits come, deposits and loans will both grow. Is that a good argument?
So I agree. I think the growth drives credit rather than credit driving growth. So the whole thing of trying to say, give more liquidity and credit growth will happen and therefore growth will have an uptick. I don't agree with that. I think growth, when it happens and animal spirits are there, automatically credit will be driven up. Never have we seen banks short of money when there is demand. Just by having liquidity and money and trying to push credit, I don't think so we'll achieve growth. So it has to be that investment happens, growth comes back, animal spirits are back, automatically credit will grow and banks will be finding the deposits in whatever form.
Okay, fair point. Let's end on that optimistic note. Thank you very much, Srini, Dinesh Kara and Mr. Mundra. Very important takeaways. One, growth actually solves a lot of problems. We crib when growth is not that good. Second, there's no denying that margins are under pressure. It's not going to be as easy as it was when FDs were the way in which people saved. Third, banks will have to get more active in the way they manage their asset book, and perhaps the regulator will have to get a little more tolerant with respect to banks relying on wholesale funds. And finally, does the government have to rethink on this very big gap between capital gains tax on debt and on equity? Thank you very much, gentlemen, for a very interesting conversation.
Thank you. Thank you. Thank you, Lata.
Hello and welcome to this special edition of Market Editor. The markets may be our starting point today, but we are diving deeper into a space that's buzzing with opportunity. India's emerging dominance in the CRDMO space, we call it CDMO, contract research, development and manufacturing. And to help us decode this theme is none other than seasoned investor and market veteran Madhu Kela.
That's right. Over the next 30 minutes, we'll spend a few minutes on Madhu's current take on the market, but the spotlight is firmly on a sunrise sector where he sees immense long-term potential. We'll also be joined by the managements from Laurus Labs and OneSource Pharma, two companies at the heart of this CRDMO story, with Madhu turning interviewer, asking them the key questions on scale, strategy and science.
Well, from investment insights to industry deep dive, this promises to be a power-packed half hour. Let's dive straight in. Madhu, welcome to the program. Thank you very much.
Thank you so much.